Hello CA Inter students, the wait is over. Masterminds proudly presents a CA Inter intensive marathon video on advanced accounting subject. I have been receiving numerous number of mails requesting to upload this marathon. Since advanced accounting is a vast subject, we thought of uploading 24 hours of marathon divided into two parts rather than covering everything in just 12 hours. With this decision, we were able to cover all the important concepts in the entire subject. This video is taught by our top rated faculty CMA Pranay sir with more than 8 years of rich teaching experience. And here are the details of the chapter wise coverage offered in this 24 hours of intensive learning marathon. So chapter wise timestamps information is already provided in the description of this video. To get the most out of this marathon, I recommend you to watch in the same order and at a standard playback speed. I have seen several marathons being extracted from either pre-recorded content or recorded in recording theaters. But we have not followed that approach to give the best quality content to our students. We have carefully recorded this marathon in face-to-face classes where more than 250 students have attended in person. If you like the content, then press the like button so that YouTube can recommend this video to more number of students. If you got benefited by watching this video, then don't forget to share the same with your friends so that they will also get benefited. Feel free to share your thoughts in the comment section, and your feedback will inspire us to create more videos like this. While recording this marathon, faculty has shown an exclusive marathon material, and all of you can even download the same freely. So let me tell you the step-by-step process for the same. So in an Android mobile or a tab, first visit Google Play Store and install an app, Masterminds Online Classes. So you need to give your mobile number and finish the setup process. And after that, in the home screen, you will find 3 horizontal lines in the top left corner. So after clicking the same, you will find a menu. In that menu, you will find an option free material. In that option, click the Documents tab, open the folder CA Inter Marathon Classes, and there will be a subfolder related to the relevant subject. Open it using an Acrobat Reader or some other PDF reader app. After that, either you can download or share, or even you can take printout of the same. Stay tuned. Very soon we are going to upload the marathon videos of all the remaining subjects of CA Inter as well. So subscribe to this channel and press the bell icon so that you can receive a notification immediately after we upload a new video in our channel. Now enjoy the marathon video. All the best, my dear students.
So, welcome to Advanced Accounting Marathon, my dear children. Myself, Mr. Pranay Vidyut, who is going to take marathon classes for CA Inter Advanced Accounting subject. Upon a time in old scheme, you used to have 2 subjects with respect to accounts. One is accounts and the other is advanced accounting. But now you people are no more a normal people. Since you people are like advanced people, we have only one subject which is like advanced accounting. Let me start. This is session 1 where we are going to cover only accounting standards in this session. And what are the topics that tomorrow we are going to cover, I will be telling you at the end of this session so that you can plan accordingly. If you wish to come, you can come along with all your materials, or you can also hold on the things that needed for you. And today's coverage is all about Introduction to Accounting Standards Framework, Accounting Standard number 1, Accounting Standard number 2, Accounting Standard number 4, Accounting Standard number 7, and Accounting Standard number 9. So I have actually planned it in 4 hours 15 minutes. It might cross the time. Please bear so that you are going to get the maximum output without losing the efficiency and effectiveness. So all the best. Let's start. Shall I start now? Yeah. Let me start the first chapter. That's all about Introduction to Accounting Standards. So as usual, this chapter is not very much important from examination point of view, but in this chapter, as you people might have remembered, the classification of business entities is very much important. I mean to tell all about corporate entities, non-corporate entities. Under corporate entities, again, the classification is given like SMC and non-SMC. And coming to non-corporate entities, it was given like level 1, level 2, level 3 and level 4. And let me go ahead with minimal things also. First of all, what do you mean by accounting standards? Accounting standards are nothing but written policy documents. Who are going to write this, sir? This will be framed and issued either by government or by expert bodies or even by regulatory bodies also. And very important thing, what are the aspects that are covered by accounting standards? This is an important question. You might also get like a theory question. Format of accounting standards or aspects that are covered by accounting standards or issues with which accounting standards deal. Accounting standards deal with these 4 issues: recognition, measurement, presentation and disclosure. What are the 4 issues, Nana? Recognition, measurement, presentation, disclosure. What do you mean by recognition? Recording the transactions. What do you mean by measurement? Valuation or with how much amount is nothing but measurement. Coming to the next one, presentation. Where will you present in financial statements? And the last and final one, disclosure. Disclosures is something like giving additional information in notes to accounts is nothing but disclosure. Clear, everybody? Along with these 4 things, you will also learn objective of an accounting standard, scope of an accounting standard. What do you mean by objective? Purpose of the accounting standard, like why that standard is introduced. And coming to scope, you will be learning the concepts of applicability and non-applicability. What do you mean by applicability and non-applicability? Something like the standard is applicable to some items and the standard is not applicable to some other items. That we are going to learn in scope. Clear, everybody? So that is all about format of accounting standards. And the next important concept is all about benefits of accounting standards. Again, it is also important for theoretical question. And the benefits of accounting standards are nothing but number 1, uniformity and consistency. Number 2, standardization, comparability, reducing in accounting frauds and call for additional disclosures. Sir, it's very, very simple. Say for example, there are no accounting standards. If there are no accounting standards, every business concern will be following its own accounting policy. Whenever they are following their own accounting policy, there will be a concept of disharmony. I mean to tell, uniformity will be missing. So you will be getting that uniformity whenever each and every business concern is following the same accounting policy and same accounting rules. So to follow the same accounting policies and to follow the same accounting rules, you must have certain set of rules and regulations. Those rules and regulations are nothing but accounting standards. So whenever uniformity is there, automatically you will be getting comparability. Say for example, there is something called A Limited and B Limited. In which company you would like to invest? You have to take one decision. To take the decision in a better way, first of all, you should be in a position to compare the financial statements. But to compare the financial statements, you must have the concept of uniformity. Is the concept clear, everybody? So what are the mandatory things you should have? Uniformity, comparability, consistency is okay, uniformity, comparability and better decision making. Respond, everybody, clear. Even better decision making is also one of the advantages of accounting standard. And uniformity implies everybody are following the same accounting policy. Am I correct or wrong? Which is nothing but standardization of various accounting principles, so that you will be getting the comparability and reducing in accounting frauds. Something like best example, window dressing. Hope you know what is window dressing. My dear children, what do you mean by window dressing? Those people who are watching in YouTube, please comment what is window dressing actually. And don't Google it, okay? And now tell me, what is window dressing? Overstating more profits, showing more profits. either by understating the expenses or overstating the incomes. So this is one of the accounting frauds. Sir, say for example, wages paid on installation of machinery. What it has to be done? Wages paid on installation of machinery. What it has to be done? Is it to be capitalized or to be charged? How you are telling it is to be capitalized? Because there is something called accounting standard number 10, which was actually taught by Mr. Pranay sir. And hence you people are telling that it has to be capitalized. But frankly speaking, say if there is no such standard, and I also told you in the main class something like the other countries' accounting standards are guiding that wages paid on installation of machinery has to be charged to P&L account. So there's nothing wrong as per their accounting standards. As per our accounting standards, it's absolutely wrong. Clear, everybody? So if we did not give the rules and regulations in accounting standards, every business concern will be following their own accounting standards. I mean to tell their own accounting policies, which may not be in line with the accounting standards. So that they will be doing some frauds called as window dressing. And another thing is all about creative accounting. Take care, you might get even for 2 marks. What is creative accounting? Do you know what is creative accounting? Tell me what's that? Using the loopholes of accounting provision, manipulating the books of accounts. Manipulating the books of accounts is nothing but creative accounting. What is creative accounting, my dear children? Using the loopholes of accounting provisions, manipulating the books of accounts or manipulating the financial statements is nothing but creative accounting. But whenever there are rules and regulations which are very much clear, then automatically there is no scope of doing creative accounting, because your thinking is controlled by introducing the provisions in the accounting standards. There's no concept of thinking at all. How will you get creative thinking? Clear, everybody? So there's no concept of creative accounting and there is no concept of window dressing whenever accounting standards were introduced. And hope you have remembered one thing. Can accounting standards violate law? No. Why? Law is introduced by legal bodies, and accounting standards are introduced by ICAI, which is just a regulatory body. So a regulatory body has to regulate the profession, has to control the profession, but it cannot override the legal body. Clear, everybody? A regulatory body cannot override the legal body. So remember, my dear children, accounting standards can never override statutes or provisions of law. Accounting standards can never override statutes or provisions of law. Accounting standards must be in conformity with the law. But remember, standards can call for additional disclosures. Standards can call for additional disclosures, but it cannot override law. Understood, everybody? And now one more important concept, formulation procedure. This is another important concept. How the accounting standards are formulated in India. Remember, my dear children, there is no standard formulation procedure prior to 2001. But right from 2001, there is a prompt formulation procedure which was introduced by ICAI. My dear children, who are going to issue accounting standards in India? ICAI through a board called Accounting Standards Board, which was introduced in the year 1977. Clear, everybody? Now, listen the format and procedure. First of all, ICAI will be identifying the broad area where accounting standard need is there. Nowadays, agriculture is the broad area. While telling accounting standard number 10, your faculty might have discussed that a new accounting standard is under development. What is that new accounting standard? Standard on agriculture. So Accounting Standards Board will be identifying the broad area where the accounting standards need exist. And then immediately it will be constituting and formulating some study groups. Study group will be studying about the broad area and they will be coming up with a note, and that note is nothing but preliminary draft. Whatever the preliminary draft that was prepared by the study group shall be revised by Accounting Standards Board. It will take the preliminary draft and it will go through the preliminary draft, and if any modifications are needed, it is going to modify all the elements that are there in the preliminary draft, which is called as modified preliminary draft. Now this modified preliminary draft shall be sent to various bodies and also to members of ICAI. Various bodies implies ICMAI, Cost Accountants of India, Company Secretaries of India, SEBI, C&AG, Controller and Audit General of India, CBDT, Central Board of Direct Taxes, Company Law Board. It's not just stopped till here. Many other bodies also, something like SCOPE, Standard Committee on Public Enterprises, Association Chambers of Commerce, which is commonly called as ASSOCHAM. Like this, to various bodies it is going to send. And it will ask the comments and suggestions from all these people. And after getting those comments and suggestions, Accounting Standards Board will modify once again, which is called as exposure draft. Now this exposure draft is sent to members of ICAI and is also sent to general public. Once again it will ask the comments from general public and members of ICAI, and finally it will prepare a final draft. Sir, till now the process is carried on by ASB. Now ultimately this final draft will be taken by ICAI and it will be releasing this final draft as an accounting standard. Is the logic clear, everybody? So quickly tell me, what is the process of issuing a standard? After identifying the broad areas, formulating the study groups. After formulating the study groups, they will prepare a draft called preliminary draft. This preliminary draft shall be again revised by ASB with the name of modified preliminary draft. This modified preliminary draft is sent to members of ICAI and other bodies, and it will be collecting comments and suggestions. Once again ASB will be modifying this preliminary draft, which is called as exposure draft. This exposure draft is again sent to members of ICAI and also to the public. Once again it will take all the comments and suggestions, and finally it will prepare something called final draft. Now this final draft is taken over by ICAI and it will release it with the name of accounting standards. Respond everybody, clear? And ultimately this standards, very important from this point, this accounting standards can be directly followed by all the non-corporate entities. Non-corporate entities can directly follow the accounting standards which are issued by ICAI. And if it is a corporate entity, then it cannot follow an accounting standard which is directly issued by ICAI. Whatever the accounting standard issued by ICAI shall be reviewed and revised by NFRA. Who is NFRA? National Financial and Reporting Authority. And finally, the standard which is reviewed and revised by NFRA has to be approved by central government. And this approved standards by central government is released through section 133 of Companies Act 2013. And ultimately, these accounting standards have to be followed by corporate entities. Clear, everybody? And I hope the format is absolutely clear. So this is one more important concept, so take more care. Now, very important concept when we come about learning the concepts of introduction to accounting standards. My dear children, or accounting standards, one or many? Almost all 29 accounting standards are there. After deleting 6 and 8, it counts as 27 accounting standards. If you put burden on each and every business concerned to follow the same, then they may not follow it properly. And hence, my dear children, ICAI is regulating and controlling all the non-corporate entities, and Companies Act 2013 with the help of NFRA is controlling all the corporate entities. And these non-corporate entities are classified by ICAI once again into level 1, level 2, level 3, level 4. And all the corporate entities with the help of Companies Act 2013. Companies Act 2013. Prior to Companies Act 2013, you used to have Companies Act 1956. So now we are learning something called NFRA kada. Prior to NFRA, you are having a board called NACAS, National Advisory Committee on Accounting Standards. Now, the biggest point is that corporate entities are classified by NACAS, National Advisory Committee on Accounting Standards, which is a board established as per Companies Act 1956. And it had classified the business entities, companies, into two types, SMCs and non-SMCs. So ultimate classification, companies are classified into dash and dash. SMCs, non-SMCs. Non-corporate entities are classified into level 1, level 2, level 3. And now non-SMCs and level 1 entities has to follow all the accounting standards. SMCs level 2, level 3 and level 4 are getting some exemptions. They can follow some accounting standards in full. They can follow part applicability, or they are not going to follow some accounting standards. Clear everybody? I mean to tell, some accounting standards are fully applicable. Some accounting standards are fully not applicable. Some accounting standards are partly applicable and partly not applicable. Clear everybody? Now the biggest point. What do you mean by non-SMC? My dear children, remember, whatever non-SMC is there, almost all the similar kind of things you are going to get in level 1 entities also. So non-SMCs are similar to level 1 entities, but non-SMCs will become a corporate entity. Level 1 will become a clear everybody? Now let me start. Non-SMCs, corporate entities. You are having 5 conditions. How many conditions you are having, Amma? Any of these 5 conditions can be satisfied, it will be coming under non-SMC. Clear everybody? Sir, is it clear? Let me go ahead with condition number 1. Based on listing, if your company is listed or if your company is in the process of listing, whether your company is either listed or your company is either in the process of listing, either in India or outside India, either in India or outside India, then immediately it will be called as a non-SMC. Condition number 2, based on the nature of business. If your business is doing a banking, or if your company is doing a financial institution business, or if your business is relating to insurance business, banking, financial institution and insurance, then automatically your business concern comes under non-SMC category. Hey, what is condition number 1, my dear children? Listed or in the process of listing. Condition number 2, banking, financial institution and insurance business. Clear everybody? If at all in current year these conditions are satisfied, then immediately it will become a non-SMC. And one very, very important thing, now moving on to previous year. Which year, Amma? If at all previous year turnover at the end of the year is greater than 250 crores, very, 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 very important, not greater than or equal to, greater than 250 crores. Clear everybody? Greater than 250 crores, then it will be coming under non-SMC. Even though the turnover is exactly 250 crores, it comes under SMC, provided if all other conditions are not satisfied. A response clear? My dear children, what is the condition? Current year or previous year? Previous year turnover should be greater than 250 crores at the end of the year. And condition number 4, previous year borrowings plus public deposit at any time during the year, if at all it is greater than 50 crores, again it comes under non-SMC. Respond everybody clear. Quickly answer me. Condition number 1, listed or in the process of listing. Condition number 2, banking business, financial institution, insurance business. These two are relating to which year? Current year. If not, check for the previous year data. Previous year turnover at the end of the year is greater than 250 crores. Condition number 4, previous year borrowings plus public deposit put together at any point of time is greater than 50 crores. Clear everybody? If any of these conditions, any of these conditions are satisfied, it will be coming under non-SMC. Otherwise, you can call it as SMC. Clear everybody? Of course, there's last and final condition. Sir, my company did not satisfy any of the 4 conditions, but my holding company satisfied, my subsidiary company satisfied, then automatically you will be deemed to be satisfied. Something like best example, deemed public company. Hope you have remembered. So even if your private company is a subsidiary of public company, it will be considered as a public company, deemed public company. In the same way, even though your entity did not satisfy any of the 4 conditions, either your holding company or your subsidiary entity had satisfied any of these 4 conditions, then it is deemed that you have been satisfied and you will be coming under non-SMC. Respond everybody clear. If all the 5 things are not satisfied, then you will be coming under SMC. Respond clear? Pakka? Now, moving on to the next thing, my dear children, non-corporate entity. The last and final part of this chapter. Coming to non-corporate entity. What is the classification of non-corporate entity? Level 1, level 2, level 3, level 4. Now, listing or in the process of listing is applicable only for level 1 entities. And very, very important, condition number 2, banking business, insurance business, financial institution is also applicable only for level 1 entities. Clear? Now, the next conditions. These 2 are relating to dash year, Nana. Now, there are some previous year conditions. Just answer me what are the previous year conditions. Level 1. Turnover at the end of the year is greater than 250 crores. And next, level 2. Less than or equal to 250 crores and greater than 50 crores. Here, less than or equal to 50 crores but greater than 10 crores. Here, less than or equal to 10 crores. Simply everything is multiple of 5. 10 into 5, 50 into 5, 250. And next one, previous year, borrowings plus public deposits at the any point of time during the year greater than 50 crores. Less than or equal to 50 crores but greater than 10 crores. Next one, less than or equal to 10 crores but greater than 2 crores. Finally, less than or equal to 2 crores. Again, the multiple of 5, 2 into 5, 10 into 5, 50. Respond everybody clear. This is all about level 1, level 2, level 3, level 4. And the last and final one. Remember, if at all any of your holding or subsidiary entity is under level 1, you will be under level 1. Any of your holding or subsidiary is in level 2, not being level 1, then you also will be under level 2. Please take care. Any of your holding or subsidiary is under level 2, not being under level 1. Because if any entity is under level 1, your entity will also be under level 1 only. So not being level 1, any of your holding or subsidiary is under level 2, you also will be deemed to be under level 2. And holding or subsidiary, if any of your holding or subsidiary is under level 3, not being level 1, not being level 2, then you will be under level 3. Finally, if all your holding and subsidiary entities are under level 4, then you will be under level 4. Respond everybody clear. Let me give you an example. Say for example, there is a partnership firm. There is a partnership firm. And say for example, there is a sole proprietor. This sole proprietor is almost all holding majority stake of partnership firm and he is controlling partnership firm. So I can tell that sole proprietor is like a holding and partnership firm is like a subsidiary. Clear? Say for example, your partnership firm is under level 3. Your sole proprietor is under level 2. Clear? Modify the levels immediately. Every entity will be under level 2 because you have to pick the highest level. You have to pick the Pakka everybody. To tell you all your holding and subsidiary entities must be under same level. Respond everybody, Pakka. So this is all about your non-corporate entities. And the last and final one. Previous year, higher category. Current year, lower category. Will you get that exemptions immediately? Higher category has to follow more rules and regulations. Lesser category has to follow less rules and regulations. Now my question is all about previous year higher category, current year lower category. Previous year, current year. So in current year, do that business entity will be getting each and every exemption? No. It has to be in that lower category for for 2 consecutive years. Only then it is going to get exemptions. Otherwise, it is not going to get exemptions. Respond everybody clear. Previously, non-SMC. Current year, SMC. Will this entity gets all the exemptions available to SMC? Absolutely no. It has to be in the category of SMC for 2 consecutive years. Only then it is going to get the exemptions available for SMC. Respond clearer. But be careful, this is a bit clumsy if you did not listen properly. Previously higher category, now lower category. Will they get the exemptions immediately? No. It has to be either in that category or still lesser category, then it is going to get the exemptions. Otherwise, it is not going to get the exemptions. Let me give you an example. Previously level 2. Now it had become level 3. Will our entity will be getting level 3 exemptions immediately? It has to be in the category of level 3 or still lower category and level 4 for 2 consecutive years, then it is going to get the exemptions available for level 3. Sir, I want to claim the exemptions available for level 4. Then be in the category of level 4 for 2 consecutive years. I want to claim the exemptions available for level 2. Be in the category of level 2 or level 3 or level 4 for 2 consecutive years. Respond clear. Say for example, level 1, level 2, level 4. Which exemptions does a company will get in the next year? Please respond. Level 2. Clear everybody? Level 1 is not having any exemption. It has to follow all the accounting standards. So previous year, level 1. Current year, level 2. It will not get level 2 exemptions immediately. To get level 2 exemptions, it has to be in the category of level 2 or still lower categories in the 2 consecutive years. Then it is going to get exemptions in the following year. Respond everybody clear. And my dear children, that is the end of introduction to accounting standards. What is the most important sequence of introduction to accounting standards? Number 1, corporate entities versus non-corporate entities. Most important, frequently tested questions. And priority important number 2, format of accounting standards. Priority important number 3, benefit of accounting standards. Benefits of accounting standards. Priority important number 4, format or issue of issues with which accounting standards deal. These three parts are very, very important from introduction to accounting standards. And those people who are actually watching in YouTube, if you like, please give a big thumbs up. And if you feel this is useful for your friends, please do share and subscribe to our channel. And all the people, just relax for 2 to 3 minutes and we are going to start the next chapter, that is all about framework. Sir, to the maximum extent from framework, he is going to test a minimum of 4 to 7 marks question every time. But of course, in September 24 attempt, he did not test. But till prior to September 2024 attempt, he is being tested question from framework from 4 to 7 marks. It's highly recommended to go through each and every CRD of your framework question and also assignments of your framework question. And let me go ahead. First of all, what do you mean by framework? Framework is like providing you a base for following the accounting standards. And framework is totally dealing with financial statements, like uses of financial statements, components of financial statements, elements of financial statements, benefits of financial statements, what not. Everything framework is dealing about financial statements, and it is working like a base for all the accounting standards. And remember, this is very, very important. Contravention of different aspects and applicability. If there is a contravention between framework and schedule 3, my dear children, just tell me framework and schedule 3, what is applicable? Schedule 3 is applicable. And next, accounting standards versus framework. Contravention between accounting standards and framework, what is overriding? Accounting standards. Accounting standards versus schedule 3. Here accounting standards itself, this is important. I'll tell you the reason. Accounting standard versus law. Now, you might get a doubt with point number C. Sir, schedule 3 is issued by Companies Act 2013, which is nothing but law. If there is a controversy between accounting standard and law, you are telling that law is applicable. Then why under accounting standard versus schedule 3, why accounting standard is applicable? Because in schedule 3 itself, general instructions to be followed for filling the financial statements. In that general instructions, they have very, 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 very clearly given that this schedule 3 is only for the purpose of presentation. If at all any business concern would like to modify in accordance with the applicable principles, it can modify. Very clearly it had given in general instructions of schedule 3, and hence ultimately, my dear children, if there is a controversy between accounting standards and schedule 3, accounting standard is applicable because in schedule 3 itself that clarification is given. Respond everybody clear. This is all about the contraventions. Take care. And components of financial statements. Sir, there is no exaggeration even if he is asking a theory question from this framework. Even he might ask you, write about all the components of financial statements. And the components of financial statements are nothing but balance sheet, P&L account, cash flow statement, statement of changes in equity, and finally notes to accounts. Dash is showing the position of the company. I mean to tell not just company, but also by each and every business concern. So dash is showing the position of balance sheet. Remember, position can be solvency or profitable, which is for long term, and winding up position, insolvency or liquidation, and short term is nothing but liquid position or liquidity position. My dear children, please get the difference. Liquidation is different, liquid position is different. Liquidity or liquid is nothing but easily convertible into cash. Liquidation is nothing but winding up. Creditors always want the dash position, liquid position, because they want the repayment in cash. Shareholders and members always want the dash position. Solvency or profitable position, because they don't want cash. They want to multiply their wealth. And as usual, remaining things you all people know. P&L account, which is financial performance of the company. Cash flow statement will be showing the position of the cash and reconciles the opening and closing balances of cash, and SOCI and notes to accounts. That's it. And let me move on to the next thing, something like qualitative characteristics of financial statements. Again, no exaggeration. You might get this is very, very important for theoretical question. And the simple shortcut that I will be giving you for qualitative characteristics is nothing but curry. As I tell you that all the masala spices are needed to become a very good tasty curry. Even a financial statements will be having its own worth only when these four characteristics are there. And what are the four characteristics? I mean, what are the four qualitative characteristics? Comparability, understandability, relevance, and reliability. What are the four things, my dear children? Comparability, understandability, relevance, out of which understandability. Your financial statements must be prepared in such a way even a layman has to understand. I already told you, an engineer can invest, an actuary can invest, a doctor can invest. But frankly speaking, these people may not know how to study the financial statements. Only a CA, CMA, CS will be knowing how to study the financial statements. Then how can an engineer will come forward to invest? So even a layman has to understand the financial statements. In such a way, you have to prepare the financial statements. How will he understand, sir? Simply you follow the law, he follow the law, and you people know that ignorance of law is no excuse. So automatically he will follow law. You follow law while preparing the financial statements. Automatically you will be getting that linkage. A response clear, everybody? And that's all about understandability. And the next one, relevance. Pick a relevant period, pick relevant items, and put all the relevant items for relevant period in the financial statements. Pick a relevant items and pick relevant period and put all the relevant items for the relevant period. Relevant period is nothing but generally 1 year. Relevant items are nothing but material items. Which items, Nana? And next, comparability. So whenever we speak about comparability, there is something called intra comparison and inter comparison. Inter comparison is in between the entities. Intra comparison is within the entities when comparing from the previous year and current year. Listen, this is the biggest problem here. Sir, we learnt already the benefits of accounting standards. Tell me the benefits of accounting standards. Uniformity and consistency, comparability, better decision making. Did you remember? Of course, there are some other benefits. Let's leave those benefits aside and concentrate on these benefits. Once again, tell me, my dear children, what are the benefits that you are having? Uniformity and consistency, comparability, better decision making. So I have told you that you will be getting that uniformity and consistency only when you follow the accounting standards. You can take a better decision only when you compare. But to take the comparison part, first of all, financial statements must be uniform. You will get uniformity by following. Problem. Accounting standards are not confined to one accounting policies. Accounting standards are having many accounting policies. And hence there is something called AS1, which is disclosure of accounting policies. A accounting standards confined to one policy or many policies. If accounting standards themselves are having many policies, then it is quite not possible to get uniformity. Then how will you get comparability? So comparability will not be getting whenever there is no uniformity. To get uniformity, you have to follow accounting standards. But the problem is that accounting standards are not limited to one accounting policies. They are having many accounting policies. So now how will you get the comparability? How will you get the comparability? Just by disclosing the accounting policies. By disclosing the accounting policies. Remember, you please go through the material, either institute material or your material. There is one statement, never miss that statement while writing this theory question in the examination. Uniformity should not become an impediment for developing new accounting standards. Impediment is nothing but hindrance, obstacle. Uniformity should not become an obstacle for developing enormous and exaggerating accounting standards. I mean to tell, if you would like to get best accounting standards should not be confined to one policy. It has to give many policies. If it is giving many policies, uniformity is getting disturbed. So uniformity should not become a hindrance for developing the accounting standards. Clear, everybody? So now what to do? Simple. You'll get uniformity and you'll get comparability even when there is no uniformity, just by disclosing the accounting policy that you have been following. Clear, everybody? That's all about comparability. Take care. And moving on to the last and final one, reliability. Reliability is nothing but trust, dependence. How can we get trust on your financial statements? How can we get the reliability by looking at your financial statements? Very, very simple. By following all the secondary characteristics, which are nothing but faithful representation, neutrality, prudence, substance over form, and completeness. Faithful representation. All the transactions, whatever you record, must represent faithfully. I mean to tell, by following all the invoices, bills, etc. and etc., you have to prepare the financial statements. Faithful representation. Neutrality. You should not show bias while preparing the financial statements. Each and every creditor must be treated in the same way. Each and every debtor must be treated in the same way. Each and every customer must be treated in the same way. And the next one, prudence. As you all people know, anticipate all possible future losses but not gains. We are not in US, or we are not following IFRS to do fair value accounting. We are following accounting standards. We always have a conservative approach and a conservative mindset. Conservation in the sense not being prone to profits, but deterring to losses. Hey, there will be a loss in future. Immediately create it. Shareholders need to know it. We'll get profit in future. Don't show it to the shareholders at all. Because now if you show it to the shareholders, in future if you will not get that profit, then it will become a negative impact. All of a sudden profit come. Everybody will be happy. You showed the loss now. In future you did not get that loss. Very happy. You did not show the loss now. In future you got the loss. A big shock. So that's all about prudence concept. Anticipate all possible future losses but not gains. And you all people know substance over form. Reality over legality. Don't concentrate on the legal form. Just concentrate on the reality. As you will be having a question, something like A sold the goods to B at a price of rupees 1 lakh. B sold the same goods at a later date to A at a price of rupees 1.2 lakh. Is A fool to purchase the same goods at 1.2 lakh at a later date? Absolutely no. And can I record these transactions as purchase and sale and purchase? Absolutely no. If you observe carefully, I will give my stock to you. You hold it as a security. You give me 1 lakh loan. Again, I will pay you 1,20,000 along with interest and then release my stock back. So this is not like purchase and sale. This is like a loan. But on the agreement, they are clearly writing. How are they writing? Selling at 1 lakh, buying at 1.2 lakh. So on the agreement, it was shown as purchases and sales. But reality is not purchases and sales. So automatically what is overriding ante? Reality over legality, which is nothing but substance over form. Consider the economic reality rather than the legal form while recording the financial statements. A response clear? And last and final, completeness. My dear children, you can't prepare your financial statements by putting suspense account in that. Clear, everybody? Something like some of the people will be asking, sir, suspense account debit balance, where it will come? It should not come anywhere. Then balance sheet will not tally. You have to prepare a proper financial statements by following double entry system, so that automatically your financial statements will get a perfect note. So your financial statements must be complete. They must not be incomplete. Respond, everybody, clear? And the next one, elements of financial statements. And remember, there are 5 elements of financial statements: assets, liabilities, expense, income, and equity. Now, these are also very, very important. Even you might get the same for 5 marks. There's no exaggeration. Write the elements of the financial statements. Something like assets. So listen, what do you mean by an asset? Asset is a right or resource controlled by the business entity arising from the past events, generating the inflows of future economic benefits, and ultimately it must be measured reliably. You just remember it in parts, it will become very, very easy. And what is the liability? A present obligation should be settled by the business concern arising from the past event, outflows of future economic benefits, and ultimately it must be measured reliably. Clear, everybody? Now, what is the provision for bad debt? Asset or liability? Neither asset nor liability, because provision for bad debt, there is no outflow of resources at all. So provision for bad debt is something like decrease in asset. Provision for bad debt is decrease in asset. Clear, everybody? So there are certain provisions which are not in the nature of asset, liability, equity, expense, income. So those nature of provision is like decrease in asset. Respond, everybody. So that's all about your asset and liability. Now moving on to the next thing, equity. My dear children, remember the word, very, very important. Equity holders is having residuary interest. What do you mean by residuary interest, sir? Leftover part. Equity holders is having residuary interest, implies leftover. What do you mean by leftover? After selling all the assets, you will get some portion. That portion has to be settled for the liabilities, and the balance will be given to the equity holders. Respond clear. So equity is not liability, remember. Equity is liability or not a liability? Because company or business entity is not having any present obligation to clear the liability. If company is having present obligation to clear the liability, array yaar, first if you are having cash, settle the equity holders immediately. That is called as present obligation. Hey, clear, huh? If you are having enough cash, will you settle the equity holders immediately? If company is telling like this, you are having cash kada, immediately settle the equity and send them away. Yeah, literally you are closing your company, ra. Hope it's clear for you. So equity is a liability and not a liability. And hence equity is nothing but capital, capital employed, net worth or net assets, which is nothing but, you can observe the balance sheet, what is here, something like fixed assets plus current assets minus outside liabilities, or capital plus reserves and surplus minus miscellaneous assets. If you observe fixed assets plus current assets minus outside liabilities, after getting some assets, you settle the liabilities. Leftover shall be given to the equity holders, which is nothing but capital plus reserves minus losses. Miscellaneous assets here is nothing but losses. That's all about equity. Now moving on to the next thing, expense and income. Expense. Remember, listen very, very carefully. Expense is something like outflow of economic benefits. Outflow of income is nothing but inflow of economic benefits. Remember, with expense, assets will decrease, liabilities will increase. With income, assets will increase, liabilities will decrease. Ultimately, with expense, equity will decrease. Ultimately, with income, equity will increase. Equity is nothing but capital, which is nothing but profit. With expense, profit decreases. If profit decreases, capital decreases. With income, profit increases. If profit increases, capital increases. Respond, everybody, clear? So take care. Sir, listen very, very carefully and answer my question. What are inflows of future economic benefits? What are called as inflows of future economic benefit? Asset, liability, expense, income, pick one element. Asset is nothing but inflows of future economic benefit. Hey, what is called as increase in future economic benefits? Income. Because increase in future economic benefit, asset will be increasing with income. So that minute difference is very much important. Inflows, outflows is different. Increase, decrease is different. Respond, everybody, pakka. Sir, everything is pretty fine, but what is the nonsense of future economic benefit? Future economic benefit is nothing but cash or cash equivalent. It might not be cash, it might even also cash equivalent. Clear, everybody? And one more last and final thing. Sir, you told that financial statements are having 5 elements: asset, liability, equity, expense, income. Then what about profit? What about gain? What about losses? Expense also includes losses. Income also includes profits and gains. This was clarified in framework itself. Expense also include losses. Income also includes profits and gains. Clear, everybody? So that's all about your elements of financial statements. And moving on to the next thing, measurement basis. Measurement basis for liabilities is not very important, but measurement basis for assets is very, very important. There are 4 measurement basis, my dear children: historical cost basis, realizable value basis, current cost basis, present value basis. At the time of purchasing your asset, how much cost you have paid is nothing but historical cost basis. So historical cost basis is nothing but purchase price plus direct expenses minus depreciation, because out of cost price some portion will get depleted kada. So tell me, my dear children, what do you mean by historical cost basis, amma? Purchase price plus direct expenses minus depreciation. And realizable value basis is nothing but realizable value, market value of your asset when the asset is sold. Current cost basis is nothing but market value of similar asset when the asset is purchased or replaced. And finally, present value basis, which is nothing but present value of inflows of future economic benefits. And coming to liabilities, historical cost basis, gross value of the liability minus repayment, because some portion will be repaid kada. And the next one, realizable value basis, no realizable value, it is called a settlement value basis. As of now, if you would like to settle the liability, how much amount you have to pay? You have to pay something called prepayment penalties. Did you remember? All those things will be included. All of a sudden, I will repay the liability. I'll repay to you the creditor. To creditor, I have to repay 1 lakh. But the creditor is telling, if you repay immediately, enough of paying 90,000. Settlement value is 90,000. To bank loan, I have to repay 1 lakh. Banker is telling, if you are repaying 1 lakh, you have to repay 1 lakh 10,000. Settlement value is 1 lakh 10,000. How much ever you have to settle immediately, that portion is nothing but settlement value. And moving on to the next thing, current cost. Current cost is nothing but, if you would like to raise a similar liability, how much ever you have to apply the loan is nothing but current cost basis. And finally, present value basis, present value of outflows of future economic benefits. Clear, everybody? That's the end of assets and liabilities with respect to measurement basis. Take care. Capital maintenance. Sir, you are getting a problem from capital maintenance. Take care. Coming to capital maintenance, minimum capital in current year should be that of last year in order to run the business as that of last year. Simply to tell you, your opening capital should be equal to closing capital. In that, you are having 3 kinds of things: fixed financial capital maintenance at historical cost, financial capital maintenance at current cost, physical capital maintenance at current cost. Under financial capital maintenance at historical cost, your opening capital must equal to closing capital in rupees, which implies that total profit can be drawn. Opening is equal to closing, so total profit can be withdrawn. Financial capital maintenance at current cost, amma. Sir, financial capital maintenance at current cost anna, physical capital maintenance current cost anna, same. Only one minute difference is there. Check out. Opening capital is equal to closing capital in units. But FCM at CC is computed by considering average price index. Physical capital maintenance at current cost is computed by considering specific price index. So then what is average price index and what is specific price index? No need to worry, he will be giving you in the question. Something like he will be telling, opening index is 100, closing index is 120. You will be given with opening price, something like 1.5. Then what is the closing price? You have to find it. 1.5 into 120 by 100. Say for example, it comes to 2 rupees. Now you have to maintain the capital in units by considering 2 rupees because that is a revised price. Respond clear? So here in these 2 situations, inflation and deflation is considered, but here only amount is considered. Clear? Your financial accounting is generally following historical cost basis only. It will not follow inflation and deflationary conditions. Respond, everybody understood? This is all about capital maintenance. Opening capital is equal to closing capital in rupees. Historical cost basis in units. Current cost basis. If at all it is using average price index, then it is called as financial capital maintenance at current cost. Specific price index aithe physical capital maintenance at current cost. Take care. So simply to tell you, this is considering the financial capacity. This is considering the productive capacity units. That's it. And one last and final thing which will be closing the entire framework. And what is that, sir? Carve ins and carve outs. You might get even for 4 mark. Take care. Sir, the term carve is nothing but rule. Carve is nothing but rule. Remember. Carve in is nothing but rule in. So you are going into the rule. You are going into the rule and discussing deeper is carve in. Carve out is nothing but rule out. And you are deviating the rule and you are discussing some other thing. Now, this carve in versus carve out. Carve in versus carve out are the terms, listen very, very carefully, carve in versus carve out are the terms which are given by giving the comparison between Ind AS versus IFRS. Why this nonsense had come? Sir, now we are learning dash accounting standards. But in India, there are another set of accounting standards which are called as INDAs, which are nothing but Indian accounting standards, popularly called as Ind AS. Listen very, very carefully. Who is the world's India's accounting body? ICAI. In the same way, there is a world's accounting body also, IASC initially. International Accounting Standards Committee. This IASC introduced IAS, International Accounting Standards. This IASC is replaced with IASB, International Accounting Standards Board. This IASB issued IFRS in place of IAS, International Financial Reporting Standards. Now you know, entire world is following IFRS. Almost every country is following IFRS or their own set of accounting standards which are similar to IFRS. But India is actually following accounting standards where there are many differences when compared to IFRS versus accounting standards. Hope you have understood. Now entire world is following IFRS or their own accounting standards which are in line with IFRS. Clear, everybody? But India is actually following accounting standards. India is actually following accounting standards which are not in line with IFRS. This is the problem. And World's Accounting Body had recommended, World's Accounting Body had recommended that every nation should become IFRS compliant. It has to follow IFRS in two ways. Either direct adoption of IFRS or convergence process. Convergence process is nothing but existing accounting standards will be converged with IFRS. India had followed the second process. What is the second process? Convergence process. So existing accounting standards are modified in line with IFRS and introduced new accounting standards which are nothing but Ind AS, where Ind AS is given a phase-wise applicability. And they did not tell follow every company. No, phase-wise. Something like year 1 for some companies, year 2 for some companies, like that phase-wise applicability is given. Now, very, very important. In India, which standards are followed, sir? For non-corporate entities, accounting standards. For corporate entities, majority of the corporate entities are following Ind AS. corporate entities which are listed in SME sector of stock exchange, small and medium scale entities sector of stock exchange, are still following accounting standards. This is the history of accounting standards and Ind AS. Now moving on to the next thing. How much ever accounting standards are converged with IFRS and gives rise to Ind AS, there are little differences between Ind AS versus IFRS. Those differences were actually being considered in two terms which are called as carve-ins, carve-outs. I hope it's more clear now. Carve-in is nothing but rule in. Ind AS are giving more explanations when compared to IFRS. Carve-outs are nothing but deviations. Deviations in Ind AS when compared to IFRS. They are telling in one way, we are telling in another way, which is called as carve-out. They are telling like this. But we have built in the rule and we have given a detailed explanation. We have given additional information. We have given more explanation, which is nothing but carve-ins. Clear? And very, very important, listen carefully. Reduction in accounting policies. And IFRS is telling you, say for example, you can follow double declining depreciation method. Or IFRS is telling something like, you can follow sum of years of digits method. But accounting standards are not permitting double declining depreciation method. Accounting standards are even not permitting sum of years of digits method. So this is nothing but reduction in accounting policies. IFRS is telling 10 policies you can follow. But Ind AS is picking only 6 policies out of those 10 policies. Did I deviate anything? No. Those 6 policies in that 10 policies. It's not called as deviation. So this is neither carve-in nor carve-out. And the next one, change in nomenclature. Names are different. We call it as equity share capital. They call it as common stock. We call it as preference share capital. They call it as preferred stock. We call it as statement of balance sheet. They call it as statement of financial position. We call it as statement of P&L account. They call it as statement of financial performance. So there are differences between, there are many differences. Clear everybody? And these differences are not neither carve-in nor carve-out. Clear everybody? Carve-in in the sense detailed explanation when compared to IFRS, and the detailed explanation is given in Ind AS. Carve-out, deviation from IFRS in Ind AS, change in nomenclature, neither carve-in nor carve-out. Reduction in accounting policies, neither carve-in nor carve-out. Clear everybody? Okay. Opening capital, 10,000 units into 10 rupees. He sold each and every unit at 12 rupees. So automatically profit will be 10,000 units into 12 minus 10. Where it comes to 20,000 is the profit. So your opening capital is 1 lakh. Your current year profit is 20,000. Am I correct or wrong? In order to follow financial capital maintenance at historical cost, your opening capital in rupees must equal to closing capital in rupees. So whatever the total profit you are having, you can withdraw entire profit. This is nothing but financial capital maintenance at historical cost. Now listen very carefully, very carefully. Opening, he has purchased 10,000 units at the rate rupees 10. Index is like this. So totally it had become 1 lakh. Again same, he sold at a profit of rupees 2. So 20,000 is the profit. Now listen the index. Your opening index is 100 given in the question. Your closing index is 125 given in the question. You are purchasing each and every unit at rupees 10. So how much will be the amount you have to pay at the end of the year? 125 into 10 by 100, which comes to 12.5. Listen very, very carefully. So you need to maintain 10,000 units to purchase it to 12.5. And you need an amount of 1,25,000 rupees. Remember, you can't withdraw a single rupee. In turn, introduce additional capital of 5,000. Clear, huh? Say for example, if this is 110, then your price will become 11. Then it should become 1,10,000. So now no need to introduce additional capital. You can withdraw not the total amount, only 10,000. And you can withdraw to that extent so as the closing capital should maintain 1,10,000. Clear? And if this index is average index, we will call it as financial capital maintenance at current cost. If this index is specific price index, we will call it as physical capital maintenance at current cost. Clear, everybody? Now, check out this one. Carrying value is 40,000, which is nothing but historical cost less depreciation. Historical cost less depreciation. So what is this basis called as? Historical cost basis. It was found that it would cost us 60,000 if the entity is purchasing the same machine today. What is the 60,000? Current cost basis, because market value of the asset if business concern would like to purchase, and the amount that can be realized on sale is rupees 35,000. Realizable value basis. And given that company can earn 15,000 for 5 years and earning rate is 10% per annum. So it is nothing but present value basis. Per annum 15,000. So multiplied by, use a cumulative present value factor for 5 years at 10%. Something like 3.169. So 3.169 multiplied by 15,000, you are going to get some amount. Respond, everybody, clear? So present value basis is nothing but present value of inflows of future economic benefits. Respond, everybody, clear? One more very important thing. If you have seen that question, you'll understand this. A liability will not arise when the order is booked. A liability will arise only when the order is delivered. Something like it is nothing but present obligation. In Amazon, you will be putting an order. Are you bound to pay to him immediately? Absolutely no. You are supposed to pay him immediately only when the good is delivered. Understood? Huh? So check out this one. This is a bit different. Not exactly to the example that I have given. A Limited has entered into a binding agreement with P Limited to buy a custom made machine. What do you mean by custom made? Specifications, tailor made machine at 40,000. But the problem is that before the delivery of the machine itself, it has to change its method of production and it has to scrap the machine since it is not required. Expected scrap value is nil. Write the entry for purchase of machine. So point number 1, something like it's a custom made machine. I have changed my process of production. Can I ask the seller something like, I've changed my production process, sir. That machine is not at all required for me, so I don't take it as for my delivery. No, it's not possible because it is a custom made machine. So you're supposed to take it as delivery. But is there any amount, is there any benefit to you? Absolutely no. And hence the total amount is nothing but loss. And you have to debit the same to P&L account. Loss on change of production. And immediately you have to pay to the P Limited. As I said you can't deny purchase of machine since it is a custom made. Clear, everybody? And my dear children, that is the end of framework. Get ready. Again, just relax for 2 to 3 minutes. We are going to start accounting standard number 1. Let me start with the next standard. That's all about accounting standard number 1. What is accounting standard number 1, Amma? Disclosure of accounting policies. And what do you mean by an accounting policy? 2 things. Number 1, accounting principle and methods to follow such accounting principle. So simply to tell you, accounting policy is constituting two things. Number one, principle. Number two, method to follow such accounting principle. And remember, this is one of the 5 marks questions, theory questions. State various areas where different accounting policies can be followed. At that time, you are supposed to write as per accounting standard number 1, accounting policy includes accounting principle and methods to follow such accounting principle. See some of the examples I have given. Valuation of inventory. The principle is nothing but cost or NRV, whichever is lower, and the methods you all people know. Weighted average method, first in first out, FIFO method, adjusted selling price method, etc. Valuation of current investment. You know the rule, cost or fair value, whichever is lower, and methods you are having FIFO method and weighted average method. And next one, valuation of PPE. Remember, PPE principle is all about, as on the balance sheet date, asset book value can never be more than recoverable amount. Hope you have remembered. Asset book value can never be more than recoverable amount. And the method is nothing but historical cost method, current cost method, realizable value method, present value basis. And the next one, depreciation and amortization. Principle is same, the pattern of generation of future economic benefits. And the pattern of generation of future economic benefits is nothing but, if at all you are getting equal benefits, follow SLM method, decreasing benefits, WDV method, units basis, production units method, etc. And also SLM method and production units method for amortization. So this is actually a 5 marks question which is being frequently tested. Sometimes he is tested, chances are there. If at all he is concentrating on theory question, take care. And listen, entire accounting standard number 1 will be completed just with 6 principles or 6 provisions. What are the 6 provisions? Number 1, how to choose the accounting policy. You can choose any accounting policy so that it has to satisfy the primary consideration and other major considerations. Primary consideration, you can choose whatever policy you want. You can choose whatever policy you want, but remember that policy should represent true and fair view. True and fair view is nothing but proper valuation. Proper valuation is nothing but neither undervalued nor overvalued. It must be truly valued. But remember, along with these primary considerations, there are another 3 more principles, other major considerations, which are nothing but MPS. Materiality, prudence, substance over form. Already you know materiality. You have to consider only relatively important items. Immaterial items are nothing but relatively unimportant items. Those items which influences the decision making of the users are nothing but material items. Those items which will not influence the users is nothing but immaterial items. So which items must be recorded in the books of accounts? Material items. Which items can be skipped in the books of accounts? Immaterial items. Clear everybody? But remember, some items are always material irrespective of the amount. And those are something like, yes, penalties, fines, etc. And even frauds. Penalties, fines, frauds, etc. These are always material irrespective of quantum of amount, and hence you have to disclose separately. Clear everybody? That's all about the first point, that is materiality. And moving on to the next thing, prudence. Prudence is like playing a safe game. Anticipate all possible future losses but not gains. Gains has to be recognized as per accounting standard number 9. Gains will be recognized as and when realized or as and when earned. And possible future losses has to be estimated by the management as per accounting standard number 5. That is all about prudence concept, already discussed in framework also. And the last and final one, substance over form. Even this was also discussed in the framework. Reality over legality. While recording the transactions, you have to follow economic reality, not just the legal form. Mere legal form is not considered while recording the transaction. You have to follow economic reality while recording the transactions. Clear everybody? And the next 3 principles are about fundamental accounting assumptions. The shortcut FAAGAC. Fundamental accounting assumptions, going concern, accrual, consistency. Going concern is nothing but your business is having a foreseeable future. But what is foreseeable future is not defined in AS1. So as per the help of IGAPs and Ind AS, we can consider a minimum period of 12 months. If business is continuing for a minimum period of 12 months, we can tell that company is having or business concern is having going concern. And the next one, accrual. You all people know what is accrual basis. What's accrual? Recognize expense as and when earned. Earned as and when incurred but not paid. Recognize income as and when earned but not received. Clear everybody? And moving on to the last and final one, consistency. You are having different set of accounting policies, but remember my dear children, 1 year following FIFO, another year following weighted average, another year following LIFO, another year standard cost method, another year LIFO, another year FIFO, that's all is not permitted. So if you have chosen one policy, then you have to follow that policy consistently. Whatever the policy you choose today, you have to follow only the same policy consistently as per accounting standard number 1. Exception, you can also change the accounting policy as per accounting standard number 5 in any of the following 3 situations: when it is permitted by law, when it is permitted by accounting standards, or when there is a better presentation in financial statements. Clear everybody? Sir, as per S1 you have to follow consistency, but you can violate consistency as per accounting standard number 5 when it is permitted by law, when it is permitted by accounting standard, and when there is a better presentation in financial statements. Respond everybody, clear? And the next last and final part is nothing but disclosures. Coming to disclosures, listen very carefully everybody. Accounting policies will be disclosed only when they have followed. Fundamental accounting assumptions will be disclosed only when they were not followed. So what are the elements you have to disclose with accounting policies, sir? All the significant accounting policies must be disclosed. All the significant accounting policies must be disclosed only at one place. They should not, disclosure should not scatter through the financial statements. Disclosures must form part of financial statements, but they must not scatter through the financial statements. Disclosures must be only at one place. That place is generally notes to accounts. Clear everybody? All the significant accounting policies must be disclosed. Disclosure should form part of financial statements. Disclosures should not scatter, and they should be only at one place. That one place is generally notes to accounts. Clear everybody? Last and final, disclosure shall not be a remedy for inappropriate accounting policies or accounting treatments. Disclosure is not a remedy for inappropriate accounting policies. You are choosing wrong policy and you are telling this is our policy. Will not make the wrong into right. Will not rectify the wrong things. Clear everybody? And now moving on to the next thing, fundamental accounting assumptions. Disclose only when you have not followed. If going concern is not followed, you have to disclose why going concern is not followed. If going concern is not followed, which basis is followed. And facts. Fact that going concern is not followed, why is it not followed, and if GC going concern is not followed, on what basis books of accounts are prepared. And even the same things for accrual basis also. Fact that accrual is not followed, why is it not followed, basis on which books of accounts are prepared. Sir, remember and listen very carefully. If going concern is there, books of accounts will be prepared on historical cost basis. If going concern is not there, books of accounts are prepared on realizable value basis or settlement value basis. Hope you have remembered historical cost and settlement value framework. And coming to accrual, if at all accrual concept is there, he will be following accrual concept. If accrual concept is not there, generally he will follow cash basis. Also there is some other basis called hybrid basis, but that's very what is that called, immaterial policy. Hybrid basis is nothing but recognize expense as and when incurred, recognize income as and when received. Ante for income he will be following certainty. For expense, incur basis is followed. So it's a hybrid between accrual and cash basis. And last and final, with respect to consistency, which policy is changed? Why is it changed? If you don't know the reason, I already told you, right, for better presentation of financial statements. Which policy is changed? Why is it changed? effect on financial statements. Quantify the effect. If you are unable to quantify, disclose the fact that we are unable to quantify. And last and final one, due to change in that policy, if there is no effect in the current year, but there is an effect in the future years, then immediately disclose the same in the current year. Clear, everybody? That's all about consistency. Tell me, what is consistency? Which policy is followed? Why is it followed? Effect on financial statements. Quantify the effect. If you are unable to quantify, disclose the fact. If there is no material impact in current year due to change in policy, but there is material impact in future years, disclose the fact in the current year. Amount can be disclosed in the future years whenever there is material impact. Respond, everybody, clear? And these are the 6 principles. One is MPS and the other is GAC. Fundamental accounting assumptions, considerations for selecting accounting policies. And the last and final part is nothing but disclosures. Understood? Fine. So let's have some questions. Sir, coming to this question, what is this called? He is asking you to draft the notes to accounts. Draft the notes to accounts. Sir, I wantedly made this question to be included here because I told you while telling in the class something like, upon a time there used to be second point. Upon a time there is used to be one more point in the question. Something like, last year the capital expenditure is 100 lakhs. Current year the capital expenditure on the asset is 250 lakhs. Which implies that there is a lots and lots of investment on the fixed assets. Whenever there is lots and lots of investment on the fixed assets, it is a sign that company is changing their production pattern from labor intensive technology to capital intensive technology. But unfortunately now that point is not there. But the answer is having that point. Hope you have got my intention. So while reading this question, you be very careful and don't forget this point. The company is having a shift from labor intensive technology to capital intensive technology. If at all capital intensive technology and you are using the machinery, whenever you are using the machinery, there will be something called depreciation, and depreciation is a part of factory overheads. Depreciation is not a part of prime cost. Am I correct or wrong? Because prime cost includes only direct expenses. Other than direct expenses, indirect expenses and overheads will be included in the factory cost or works cost. Am I correct or wrong? Check out point number 1. Value year-end inventory at works cost, which is 50 crores. Instead of hitherto method, hitherto is nothing but till then or till now. Till now they have followed prime cost policy, but now they are changing it to works cost policy. Now you have to write a justification why they are changing, which policy is changed, why is it changed, why is it changed ante company is shifting from labor intensive technology to capital intensive technology. Respond, everybody, clear? Sir, how will I remember this in the examination? That's the reason I have wantedly included this question here also. If you are unable to get that point in the examination, at least write better consumption pattern in the inventory. Not better presentation in the financial statements. Better consumption pattern is depicted from works cost rather than the prime cost. Even if you forget that one, the last and final option, better presentation in the financial statements. But that's the last option. Clear, everybody? What's the first option? Labor intensive technology to capital intensive technology. Second part, better consumption pattern in the inventory. Even if you forget that one, last option, better presentation in the financial statement. Clear, everybody? And point number 2, sir, please be very, very careful. I already told you in the class also, and this provision concept is very, very important. Listen very, very carefully. Till now, I did not provide the provision. From now, I am creating a provision. Till now, I have provided the provision, but decided not to provide the provision. Till now, I have provided the provision by following one method. From now, I am providing the provision by following another method. Clear? Three things I told you. Did not provide provision to providing provision to not to providing provision, provided provision under one method and changed provision to another method. So now you are supposed to tell what is change in accounting policy and what is change in accounting estimate in these three things. And my dear students who are watching on YouTube, keep it pause, tap the pause button and give your answers in the comment. And you people, tell me the answers. It was paused. You have to tell the answer now. What is the first one? Change in? Hey, no need to keep pause button, my dear children. Even these children are not answering. Sir, answer. Change in accounting? Policy. Estimate. Okay. Next. Cheppandi malla. Change in accounting? Policy. Some other people. Problem solved. Next, last one, ra. Change in accounting? Estimate, some other people. Problem solved. Listen, whenever the amount of provision is changing, under any method, it is always accounting estimate. Whatever method you follow, it will not come under policy at all. Clear, everybody? Sir, is it understood? So provision under one method to provision under another method is nothing but change in accounting estimate. Remember. Next. Sir, I am providing provision till last year. But from the current year, our decision changed. Our policy changed. We don't provide provision. We don't provide provision. Till last year you have provided provision, kadara. Yes, sir, but from current year management has decided. They are asking me not to provide a provision. Hope the concept is clear. And this is changing accounting policy. Now what about the first one? First one. Till now they did not provide the provision and they have decided to provide the provision. Change in accounting? Nothing ante what is that then? It's adoption of new accounting policy as per accounting standard number 5. Adoption of new accounting policy is not called as change in accounting policy. Did you remember? Inka avled kada ani vaashaleikandi. Today's concept now won't work out. So take care. Did not provide the provision till from now you have decided to provide the provision. You did not provide the provision till the last year and you are providing the provision in the current year. It is called as adoption of new accounting policies. It is not called as change in accounting policy. Clear, everybody? Sorry, intaki, what are the reasons why I have told this thing? In point number 2, it's very, very clear that till the last year, company has provided the provision. But from the current year, it has decided not to provide the provision. So it is nothing but change in accounting policy. It has decided not to provide the provision for warranty because the company has shifted from labor intensive technology to capital intensive technology. I hope it's clear for you. So that's all about this question. And check out this question. Provision till now is based on 12 months no issues. And the new provision method is nothing but technical evaluation. Sir, 12 months no issues ante, you will be creating, sir, this question is all about creating a provision for non-moving stock. Listen very carefully. This question is all about creating a provision for non-moving stock. Stock is always categorized into 3 parts. Strictly speaking, 4 parts. Fast moving stock, slow moving stock, non-moving stock, normal stock. Normal stock is normally sold, normally purchased. Fast moving stock, it will be sold like a hot cake. And coming to slow moving stock, it will be sold very slowly. Non-moving stock, which is nothing but damaged pieces, which will not be sold at all. You have to scrap those things. Now, this company is creating a provision for non-moving stock. And a stock which is scrap, which is to be scrapped or which is to be non-saleable. For that, it has to create a provision. Biggest question, how much provision I have to create? Very, very simple. Sir, till now the company had followed the policy basing on 12 months no issues. In the sense it has taken the last year as base. Company is taking the last year as base. Say for example, last year 1000 goods purchased, 10 goods unsold. This year company is purchasing 2000 goods. So 20 goods is unsold. So it is estimating basing on the last year data and it is creating a provision. But now company has shifted to technical evaluation and it is physically inspecting these 2000 goods and physically telling how many goods are damaged and how many will be scrapped and how many will be non-moved. It will be estimating, which is nothing but technical evaluation. You tell me what is best method? Based on last year no issues, a technical evaluation. And hence even the company has shifted to technical evaluation. Clear everybody? Now what is this called as? Does this amount to change in accounting policy? Chappali? Absolutely no. Just now I told you. Yes, provision from one method to provision for another method is nothing but change in accounting estimate. Can the company adopt the change in method of accounting or not? Yes, this is nothing but change in accounting estimate but not change in accounting policy. Clear everybody? And coming to this question, ICDs. I hope you have remembered. Intercorporate deposits. So to tell you, question will be very clumsy actually, but the concept in the question is very, very small. And listen very, very carefully. And also this question is almost covering 4 to 5 principles. You have taken a loan on 1st September 2011. And the due date of loan is 31/12/2011. Year ending is 31/3/2011. Sorry, 31/3/2012. Unfortunately, your company did not pay the loan on due date. Loan on due date not paid. So automatically you have to pay interest on loan. Am I correct or wrong? So how many months interest you have to pay? Accountant is telling that you have taken the loan on 1/9. The due date of the loan is 31/12. So 1/9 to 31/12, which is nothing but 4 months. So you have to pay 4 months interest. Now company is asking, adentra accountant, even the company did not pay the loan till 31/3 kada. So the company has to pay the interest for all the 7 months kada. But accountant is telling, is it anywhere given in the agreement? No sir, it was nowhere given in the agreement. So why to pay interest for 7 months? Interest is there only for 4 months. Pay for only 4 months. Hey, but he is asking for the remaining 3 months. He will ask sir, but let us not pay. Why? Because it was nowhere mentioned in the agreement. So now what is the accounting treatment that you will do? Accountant is telling that this 4 months is clearly mentioned in the agreement and hence it will be charged to P&L account. This 3 months interest nowhere mentioned in the agreement, but since you are asking, but I don't admit it as my debt. So it is claims against the company not acknowledged as debt and it is nothing but a contingent liability. So the remaining 3 months interest, you don't pay. He will ask, but let us not pay. He is going for court of law. Let him go for court of law, sir. And hence I will be treating it as a contingent liability. Clear? This is what accountant is telling. But company is telling, you are trash with this 3 months. 7 months interest has to be charged to P&L account. Whether or not it is there in the agreement. Tell me now who is correct? Accountant is correct or company is correct? You already know this. Who is correct, Amma? Company is correct. You tell me why it is correct. Listen. Rule number 1. Chappandi, you are telling something. Substance over form. Substance over form. Reality over legality. Hey, you are pleading that in agreement only 4 months is there. Also there is in the agreement that you have to repay after 4 months. You are overriding the agreement. Then automatically he will ask you to pay the extra interest. So basing on substance over form, your principle is wrong. Next. Prudence. Yes, you have to anticipate all possible future losses. So, say for example, even though you are treating it as a contingent liability, what are the chances of losing? 100% chances of losing. You have to pay it for sure. Even though you go for court of law, judge will give you an order, shut and pay immediately. Because he will be striking the case as if it's a nonsense case. So automatically anticipate all possible future losses but not gains. This contingent liability is a 100% loss. So create the provision of interest even for those 3 months. Next. Accrual. Because accrual is nothing but recognize expense as and when incurred. This is 7 months expense. So you have to record it. And the next one. Disclosure is not a remedy for inappropriate accounting treatment. Even if you disclose that this 3 months is contingent liability, nothing is given in the agreement, and hence we will be recording like this. It won't make it clear. A respond clear. So disclosure is not a remedy for inappropriate accounting. So 4 principles. Number 1, substance over form, accrual basis, prudence. Disclosure is not a remedy for inappropriate accounting. Respond everybody clear. So this is the question. But take care, you read the first 3 lines of the question. It is giving you in a very clumsy way, something like ICDs, intercorporate deposits. Company is into liquidity crunch. It is not having enough money and hence it is accepting some ICDs and hence it is paying, it has to pay to the companies from whom it had accepted the ICDs. To tell you, the first 3 lines of the of the question is obviously waste. Wantedly included this question because even in your examination also, you have to pretty sure that some information will be unwanted information, especially MCQs. You will be seeing in your revision exams already. There will be nonsense, unwanted information. That's the reason. But the beauty of MCQs, I already told you, each and every standard is divided into paragraph to paragraph. So how I ask you to answer the MCQs, first check out the MCQs. Which paragraph, which standard is the paragraph related to? Write the standard first. And now you read the MCQ. After that, you will be getting from which paragraph it is related to. Then go back and go ahead. But if at all you have read all the case question and then started MCQ, time killing. You might take extra time here by requesting your in charges. But in main examination, it's quite impossible. Anyways, I hope it's clear, my dear children. So that's all about accounting standard number 1. And take care, this is another problematic part which is important. You can just prepare it. Wantedly highlighted this question here just to make you aware of the same. So if going concern is there, you have to follow historical cost basis. If going concern is not there, settlement value basis or realizable value basis. Clear everybody? Sir, this is applicable only for assets and liabilities. Then for expense and incomes, which basis, sir? Always accrual basis. Why? Because assets and liabilities already incurred, income and expenses already incurred, already earned. It will never change. Assets and liabilities are carried forward to future. And hence, there are different bases for assets and liabilities. Clear everybody? For expense and incomes, always which basis? My dear children, for expense and incomes, always which basis? Accrual basis. Whereas for assets and liabilities, if going concern is there, historical cost basis. If going concern is not there, realizable value or settlement value basis. Respond everybody, pakka. Now, last and final tagline of accounting standard number 1. A company can never violate accrual concept. Something like fundamental accounting assumptions. Disclose only when you have not followed. Disclose only when you have not followed. Very clearly given. But remember, my dear children, company has to follow accrual basis. It is as per law. You can't change that. Respond everybody, pakka. So company is not following accrual basis and it is disclosing the same in notes to accounts. Is it correct or wrong? Wrong. Why wrong? Because accounting standards can never override statutes or provisions of law. Clear, everybody? And that's all about accounting standard number 1. Let's continue with the next standard. That is all about accounting standard number 4. In this session, let's try to complete the next set of standards. I mean to tell 4, 5, 7 and 9. Let me try of completing these 4 standards in this session. I told you already that class might run up to 120 or 130. Be prepared for that. Sorry. Is for contingencies and events occurring after balance sheet date. Sir, remember point number 1 that this is a universal standard. I mean to tell that AS4 is applicable for each and every standard, because in each and every standard there might be some events and contingencies which are occurring after the balance sheet date. How to deal those events and contingencies under each and every standard, AS4 is guiding. Also, AS4 will be dealing with such provisions and impairment of such assets which are not dealt by any other standards. Say for example, generally provisions will be dealt by as per accounting standard number 29. Provision for diminution in the value of investments is dealt by accounting standard number 13. Provision for loss of construction contracts is dealt by accounting standard number 7. So like that, for some provisions there are some specific standards. For those provisions which there is no specific standard, then accounting standard 4 is taking care. Simply to tell you, impairment of current asset is dealt by accounting standard number 4, and example for that is nothing but provision for bad debts. What is that, Nana? Provision for bad debts. Now, let me tell you what is an event occurring after balance sheet date. Sir, total standard will get completed just in a matter of 10 minutes. Because under this only 2 elements are there. One is event, other is contingency. Under event you are having adjusting event and non-adjusting event. So take care, my dear children. Events which are occurring after balance sheet date. Those events which are occurring after the balance sheet date but before the date of approval. At the time when I am teaching AS4, you might not get covered with SA 560. What is SA 560? Subsequent events. Sir, even in SA 560 subsequent events, you are also having, what is it called? Event after balance sheet date but before the date of approval. But remember, my dear children, date of approval as per AS4 is different. Date of approval as per SA 560 is different. Hope you know that one. Generally, say this is the current financial year and this is the end of balance sheet date. And say for example, this is the date of approval of financial statements which are prepared by board of directors. And now these financial statements will be picked by the auditor and he will be conducting the audit. And say for example, some other date he had prepared audit report and this audit report is once again sent for board of directors. And board of directors has to take necessary actions which are specified in the audit report. And once again, these board of directors has to approve the financial statements after doing all the adjustments which are mentioned in the audit report. Am I correct or wrong? So as per your SA 560, this is the point, that is date of approval. That is date of audit report shall be considered. Whereas coming to accounting standard number 4, we are going to consider the first approval part, but not the second approval part. Clear, everybody? So events which are occurring after the balance sheet date, but before the date of approval of financial statements, which are actually relating to the previous financial year, are called as events occurring after the balance sheet date. Respond, is it clear? My dear children, one more important thing. We are not going to deal with transactions in AS4. We are not going to deal with transactions in AS4. Event is a result of a transaction. Hope you know that one. Event is a result of a transaction. It implies that transaction is already completed in the financial year. What is completed already? Effect of this transaction is nothing but an event. That event was occurred after the balance sheet date. But it has to be done before the date of approval of financial statements. Now the biggest question is that whether this event has to be adjusted in the previous year financial statements or not to be adjusted in the previous year financial statements. This is our biggest question. If at all it is to be adjusted in the previous year financial statements, it will be called as a adjusting event. If that event is not to be adjusted in the previous year financial statements, it is called as non-adjusting event. Respond everybody clear. So take care, my dear children. This is very, very, very important. So point number 1, what is event occurring after balance sheet date? Event occurred after balance sheet date, but before the date of approval of financial statement. Is date of approval as per AS4 and SA 560 same or different? Here we are considering first date of approval or later date of approval. And event is a result of a transaction. Transactions which are already occurred in the financial year, and event is the result of the transactions which were already occurred in the financial year. Now we are checking whether the events are to be adjusted or non-adjusted. Shall I continue further? And to become an adjusting event, the following 3 conditions are there. Point number 1, there should be a condition or situation existing on the balance sheet date. What is point number 1, Amma? Condition or situation existing on the balance sheet date. Second one, it should provide additional evidence, and that additional evidence should be material, and also the amount should be material, which is third condition. Respond everybody clear? If all these 3 conditions are satisfied, it is called as adjusting event, and this event has to be adjusted in the previous year financial statements. Respond everybody understood? So check out types, adjusting and non-adjusting. Coming to adjusting events, 3 conditions. Condition or situation existing on the balance sheet date, additional evidence to confirm such condition, and that additional evidence and amount should be material, which are to be adjusted in the previous year financial statements, which implies that assets and liabilities of previous year shall be altered. Now coming to non-adjusting event, those events which are not adjusting are nothing but non-adjusting event. Those events which are not adjusting is nothing but non-adjusting events. So what is the accounting treatment? They are not to be considered in the financial statements at all, but they can be disclosed in the approving authority report. I mean to tell board of directors report. Respond everybody clear? Now you tell me, I'll ask you a question whether it is adjusting or non-adjusting. Financial year is April to March. You have sold the goods in April, but the debtor premises was caught by fire in May, and he declared insolvency in June. Your financial statements were approved in July. Clear everybody? Financial year, sold goods in April, debtor premises was caught by fire in May, and he declared insolvency in June. Your previous year financial statements were actually approved in July. And you tell me whether is it adjusting event or non-adjusting event? Adjusting or non-adjusting? Why non-adjusting? My dear children, AS4 will not deal with this. Not applicable. Because, can anybody tell me? There is no transaction that is relating to the previous financial year. I have told you very clearly that events occurring after the balance sheet date but before the date of approval. This event should be the result of a transaction which was already occurred in the financial year. Did you remember? Event is the result of transaction, and those transactions might have already occurred in the previous year financial statement. So be very, very careful, my dear children. You are not supposed to write it as non-adjusting event. And while going through the printed solutions of your material, be careful. There are 2 kinds of these questions, wherein only in one question he is telling that AS4 is not applicable. In another question he is calling it as non-adjusting event. 2 answers are given by institute material itself. Hope you have got my intention. This kind of similar questions are there in your material. You cross-check with the solutions. In one solution, he had given that AS4 is not applicable. In another solution, he is giving that non-adjusting event. What is better answer ante? Since there is no transaction relating to previous year, it's better to write AS4 is not applicable. But take care, two answers were directly given by ICAI. Any answer is correct answer, but be careful. Two different opinions were given there. So this is one of the important thing that you have to take very much care. Clear everybody? And all the remaining you people know. Like sale is happened in this year, debtor declared insolvency here, and debtor premises was caught by fire here and insolvent in June. Now tell me, is this adjusting or non-adjusting? Sale happened in the financial year. Debtor premises caught by fire in May. Declared insolvency in June. Adjusting or non-adjusting? Why non-adjusting? Debtor's position is absolutely fine. Debtor declared insolvency in June because of its situation arose in May. This situation is not there on March, year ending. Hope you have got the logic. Debtor declared insolvency. That is your additional evidence. Additional evidence to confirm the condition that is existing on the balance sheet date. Where is the condition existing on the balance sheet date? As on the balance sheet date, debtor's position is absolutely fine. Understood everybody? And hence, it's a non-adjusting event because debtor declared insolvency not basing on the condition existing on the balance sheet date. Respond everybody clear. Say for example, sold goods in the financial year. Debtor's premises was caught by fire in the financial year. Debtor's premises was caught by fire in the financial year, but he declared insolvency after July. He declared insolvency after July. Adjusting or non-adjusting? Non-adjusting, because there is no additional evidence. Condition is there. His condition is worse as at the year end because his premises was caught by fire. Respond clear. But he had declared insolvency after July. Respond clear. Now very, very important. Sold during the financial year. Debtor premises caught by fire in the financial year, but luckily debtor was insured. Clear everybody? But debtor declared insolvency in May. Your financial statements were approved in July. Answer. Adjusting or non-adjusting? Answer. Something very different, right? Answer. Sold during the financial year, premises caught by fire, and debtor is absolutely insured. But he declared insolvency in May, which is before the date of approval. Adjusting or non-adjusting? Absolutely non-adjusting. Because he declared insolvency because of some other reason, not because of this reason. Because his premises, even though caught by fire, he is insured. Respond everybody clear. So you have to read the question once or twice before attempting an answer. That makes a lots and lots of difference in attempting your answer. Shall I proceed further? And sir, I have given all the examples for non-adjusting events only. I know that. So contrary to this one, everything will become adjusting event. Ante kada? And let me move on to the next thing. Yeah. One more important thing would like to tell. In the standard itself, he had given some things that they are non-adjusting event. In the standard itself, they have given some things. Examples and he'll be giving under non-adjusting event. Check out. Issue of shares or debentures. Inka. Purchase or sale of investments, fixed assets, companies, etc. Mergers and acquisitions. Changing exchange rates. Even fluctuations in market rates. What is that? Disposal of major subsidiary. That's nothing but investment or company. So take care, my dear children. all these things will be considered as if they are non-adjusting events, because there are no conditions existing on the balance sheet date unless and until negotiations were confirmed. Prospectus is finalized. Is the logic clear? Say for example, by the end of the year, prospectus is already finalized and approved by SEBI, but you are going to issue in the next year. Is it clear? Sir, respond, is it clear? Unless and until this thing is happened, it is to be treated as if it is a non-adjusting event. And one more thing, even though prospectus is finalized, even though SEBI has approved, since you are going for the issue in the next financial year, that will be called as a transaction. That's not an event. Clear, everybody? Issue of shares or debentures is a transaction. So this is obviously a kind of non-adjusting event. And next, purchase or sale of investment or fixed asset or subsidiary or any other company. You just think with common sense. Say for example, in March we have started the negotiations. And the negotiations were finalized and company was acquired in July before the date of approval of financial statements. Is it adjusting or non-adjusting? Chepali, 200% it is non-adjusting only, because negotiations were not finalized as at the end of the year. Respond clear. As at 31st March, if negotiations are finalized, as on the 31st March, if negotiations are finalized, and basing on these negotiations, you are purchasing a company before the date of approval of financial statements. In such a case, we will consider it as an adjusting event. Negotiations are not yet finalized. Negotiations are going on. At this time, we don't call it as a condition. Respond clear. Remember, negotiations will never amount to condition. Negotiations will never amount to condition. Negotiations which are finalized can be called as a condition. Negotiations which are finalized can be called as a conditions. Negotiations or will not be amounting to conditions. Respond, everybody, clear? So that's all about your adjusting and non-adjusting event. One more very, very important thing, take care. Exceptions. A non-adjusting event to be adjusted. Sir, exception. Generally, dash event has to be adjusted. Adjusting. Dash event has to be ignored. But under exception, a non-adjusting event has to be adjusted. In the following two cases, whenever law is requiring you to adjust, then you have to adjust. When going concern is affected, then you have to adjust. When dash is affected, you have to adjust. When law is requiring you to adjust, then you have to adjust. Best example is dividend. Check out very, very carefully to the diagram which is representing on the screen. Say the financial year is 13-14 and date of approval of financial statement is there, which is dealt as per accounting standard number 4. These financial statements will be audited and audit report is prepared by the auditor and the same is sent for approval once again along with financial statements. And date of approval, once again board of directors are going to approve the financial statements along with the audit report. At this time, very, very important, at this time, now board of directors are going to propose the dividend. Clear, everybody? Propose the dividend. Now coming to proposed dividend, frankly speaking, answer me, can it be adjusted? Can it be disclosed in the previous year financial statements or not to be disclosed? Not to be disclosed because financial statements were already approved and closed. But there is a point here. As per Companies Act 2013, with respect to the sections that are relating to the dividend, this proposed dividend has to be presented in notes to accounts, note to reserves and surplus. Since it is required by law, even though it's a non-adjusting event which is not to be disclosed in the financial statements, you have to disclose the same in the financial statements in note to reserves and surplus. Hey, respond, everybody understood? So non-adjusting event to be adjusted or not to be adjusted? But in the following situation, they have to be adjusted. Point number 1, when it is required by law, when dash is affected. Law is affected, whenever it's permitted by law. Best example is dividend. Frankly speaking, board of directors will be will be proposing the dividend on the date of approval of financial statements along with the audit report. And the board of directors are going to propose the dividend from audited financial statements. By that time, already they have approved the financial statements as per AS4. So as per AS4, strictly speaking, proposed dividend should not be adjusted in the financial statements. But since Companies Act, law is asking you to adjust the same in the financial statements by disclosing in notes to accounts, note to reserves and surplus, and hence it's considered like that. Respond everybody, clear? So this is all about events. Now I have to go ahead with the contingency. Remember, sir, what is the difference between event and contingency? Event, you will get additional evidence. Contingency is not the confirmation. From event, you will be getting the confirmation. From contingency, you will not be getting the confirmation. Let me give you an example. Financial year. Sold goods to debtor. Clear everybody? And during the financial year, if you ask the debtor is not paying the money. He is telling he had already paid the money. If you ask the proof, he is not in a position to show you the proof. Now, you have filed a case on the debtor. You have sued the debtor. Court had given the judgment in June that debtor has to pay the amount. Clear everybody? And your date of approval is July. Tell me, first of all, is it an event or contingency? Is it an event or contingency? As at the balance sheet date, you have filed a case on the debtor. And after the date of balance sheet, but before the date of approval of financial statements, court order was passed. The debtor has to pay. Understood. Now tell me, is it an event or a contingency? This is 200% an event. Why, sir? Confirmation is received. Judge order is received. Court order is received. What is court order? Debtor has to pay. So you can call him as debtor. Say court order given. Debtor will not pay. Then automatically you have to create a provision. Hey, respond clear. Court order is received. This is additional evidence to confirm the condition that is existing on the balance sheet date. Condition is nothing but filing a case. Say, for example, court order did not receive. You have filed a case, that's it. Your legal counsel is of the opinion that you will lose the case and debtor will not pay you the money. Contingency or event? Why? No confirmation received, just an opinion given by the legal counsel is considered. I hope you have got better clarity. If you have received a confirmation, we will call it as an event. If you did not receive the confirmation, we will just call it as a contingency. Respond everybody, clear? So contingency is also a situation which is existing on the balance sheet date, which will be confirmed in future upon occurrence or non-occurrence of one or more uncertain events. Respond clear? Sir, which will be confirmed in the future upon occurrence or non-occurrence. In the sense, till it did not occurred. If at all that is occurred, we will call it as an event. Respond pakka. Now, last and final. If it is contingent gain, it will be dealt as per accounting standard number 29. If it is contingent loss, check out whether the loss is probable, possible, remote. If remote, in the sense very, very less chances of occurring the loss, then you can ignore the same. Possible, and equally likely to occur the loss or less likely to occur the loss. In such a case, just disclose by giving in notes to accounts. If at all more chances to get the loss, then immediately you have to create a provision. Respond everybody, pakka. That is the end of accounting standard number 4. Let's check out some questions here. Check out. During the year 15-16, Raj Limited sued a competitor for 15 lakhs. Based on the advice given by the company's legal counsel, Raj Limited provided 10 lakhs in its financial statements. On 18th May, court decided in favor of the party and ordered Raj Limited to pay 14 lakhs. The financial statements were approved on 30th May. My main intention behind including this question to clarify you whether it is contingency or event. By event, court order is received. Say for example, this statement is not there. That will become contingency. And is this contingent loss or contingent gain? You are supposed to pay kada. So is it contingent loss or gain? Loss. Is the loss probable or possible or remote? Probable, because legal counsel told you are supposed to pay rupees 10 lakhs. So immediately you have to create a provision for 10 lakhs. They respond clearer. But in this question, since court order is already received and court order is you have to pay 14 lakhs. Already you have created a provision to the extent of. So still how much you have to increase your provision? So the total will become 14 lakhs. Respond everybody pakka. Check out. Company filed a legal suit from the debtor and chances of recovery is not good. As per the legal opinion of the council, can the company provide the amount as provision for doubtful debts? Check out the question. Company filed a case on the debtor on 31/3/2020 itself. As per the opinion given by the legal counsel, recovery is not good. You will not get the money. Is it contingency or event? If it is contingency, again you have to check out, is it gain or loss? Loss. Is the loss probable or possible or remote? Cheppali. How can you tell that until you have to read the question? Chances of recovery by way of legal suit are not good as per the legal opinion. And a lawyer is telling you won't get the money at all. Probable or possible or remote? Probable. Lawyer is not telling 50-50 chances, sir. Lawyer is telling 200% you will get your money, sir. Lawyer is telling you will not get your money, sir. And a probable or possible or remote? Probable. And hence, you have to create a provision. Respond everybody pakka. So that's this question. And take care. This is all about proposed dividend. Already we have discussed this one. Proposed dividend. One more important thing, rocky surface. Hope you have remembered the question. Frankly speaking, as at the end of the year, company did not know that rocky surface is there. Clear? Now, sir, say for example, during the financial year, accepted a contract. Rocky surface is already there, but company is unaware of the same. Say for example, company found the same after the date of approval, but before the date of balance sheet. Clear? Tell me, is it adjusting or non-adjusting event? Accepted the contract, already rocky surface is there, but company is unaware of that, but company found that there was a rocky surface after the date of balance sheet, but before the date of approval of financial statements. Now you tell me, is it adjusting or non-adjusting? Why non-adjusting? Ayyo, it is 200% adjusting. Because company found the rocky surface here basing on the condition that is existing on the balance sheet date. That condition is nothing but accepting the contract. Since it's is it basing on the new condition or new situation? You found the rocky surface. Why did you found the rocky surface? Because you are performing the contract. Why are you performing the contract? Because you have accepted the contract in the financial year. Is the logic clearer? And is it on the basis of new condition or existing condition? And hence is it adjusting or non-adjusting? That's 200% adjusting event. Respond everybody clear. But say for example, if the rocky surface is found after the date of approval, then So please respond after the date of approval, then it will become a non-adjusting event. Respond everybody clear. So in your existing question, he is telling that rocky surface is found after the date of approval and hence it's non-adjusting. But if at all it was found before the date of approval, then it will become adjusting event. Awareness to the company is there or not is absolutely not needed to check whether it is adjusting or non-adjusting. Company awareing the item, that's absolutely not needed. Respond everybody pakka. And the next question, problem number 5, check out this one. During the financial year, you have sold to some debtors. Debtor are sending the checks. Debtors are sending the checks. After the date of approval, after the date of balance sheet, but before the date of approval. After the date of balance sheet, but before the date of approval. Sir, if debtor sent the checks after the date of balance sheet, but before the date of approval, absolutely no problem for us. Because that is relating to the next financial year. But the problem is that debtor sent the checks before the date of balance sheet, but received by the company after the date of balance sheet. Understood everybody? Debtor sent the checks before the date of balance sheet, but received by the company after the date of balance sheet. Understood? Now tell me, is it adjusting or non-adjusting? Chapali. So as per the answer which is given by ICAI, it had given that it is non-adjusting. Is it clear? It is non-adjusting as per the answer given by ICAI. So something like if you observe the previous question and this question, there is a small controversy. Because in previous question, there was a pipeline. There was a rocky surface. Company is unaware. Instead of awareness and unawareness, we don't bother. Whether condition is there or not, we will bother. But coming to here, even the similar thing, whether debtor sent the check or not, we don't know. Company don't know kada. Whether debtor sent the check or not, company don't know. Frankly speaking, it is not known to the company. But company is receiving the check after the date of balance sheet, but the date on the check is given before the date of balance sheet. I'm sending today, 30th March. I will prepare a check as on 30th March and I will send and I'll post to the company. Company is receiving after 31st March. After opening the check and after seeing that, the date is given like 30th March. Clear? Now the biggest question, whether is it adjusting or non-adjusting? As per the answer given by ICAI, it had given that it is a kind of non-adjusting event. Because debtor sent check is not known to the company. It's not the condition in the hands of the company. Please try to get the difference between pipeline question and this question. Pipeline rocky surface is also not known to the company. Debtor sent check through the courier is also not known to the company. But rocky surface is an adjusting event. Debtor sent check is a non-adjusting event. Reason being, there the condition is on line of the company. Here, debtor sent check through the third party, postal agent. It is not the condition. It's not the condition on line of the company. Respond everybody clear. That's the conclusion. And if you observe, check out. Checks sent by the stockists. Stockist is nothing but debtor. Through courier on or before 31st March. You cannot take this as a condition. Why you can't take this as a condition? Ante? Point number 1, it's not from the end of the company. Point number 2, very, very important. After sending through the courier, whether you will receive or not is $1 billion question. If at all you are sending through an agent, which is like professional couriers or APS RTC couriers, APS RTC logistics, or what is it called, DTDC courier, then they are obviously a kind of trusted and you might get it. But if you are sending it through untrusted people or something like some sort of accident happened during the transportation, So all these things are biggest question of facts, and hence we will be considering this as a non-adjusting event, and this will not amount to condition. You have to remember this one. This is different. That's the reason I have made it included here. If at all checks collected by the agents of the company on or before 31st March, that will become an adjusting event, because agent is working on behalf of the company only. Respond everybody clear. Hey, again, you're not supposed to ask if agent is not bringing the check with the company. If agent met with an accident during the transportation, you can't ask all such kind of question. Because if you have given money to the agent, it is implied that you have given money to the company. Hope it's clear for you. So there is an understanding difference between these two things. Be careful with this point number B. In ICAI, it's very, very clearly given that it is a non-adjusting event. And my dear children, that is the end of accounting standard number 4. Number 1 is event, and you have to check out whether is it adjusting or non-adjusting. If confirmation is there, then we'll call it as event. If there's no confirmation, we will call it as contingency. Again, you have to check out whether it is gain or loss. Gain will be dealt by AS29. Loss, you have to check out whether it is probable, possible, or remote. Remote, ignore. Possible, notes to accounts disclose. And probable, you have to create a provision. And last and final thing, this is the confusion point, so you have to be very, very careful. Rocky surface, sir, to decide whether it is adjusting or non-adjusting, you don't bother about the awareness to the company. But coming to this point, it is very, very different. So in this case, it has to be considered as if it is a non-adjusting event, because it's from the third party's end. Clear, everybody? And hope you are understanding the concepts. Please do like, share and subscribe. And all you people, just relax for 2 to 3 minutes, and we are going to start accounting standard number 5. Accounting standard number 5, which is net profit or loss for the period, prior period items and changes in accounting policies. The biggest drawback is that, first of all, you have to learn the name of the standard properly, because people will be telling in general net profit or loss for the period items, so prior period items. No, it was actually period, prior period items and changes in accounting policies, estimates, both policies and estimates. That confusion will be there. So please learn the name of the standard properly. Net profit or loss for the period, prior period items and changes in accounting policies. And now let me start with period items. My dear children, period items are nothing but those items which are absolutely relating to that period, which is nothing but literally current year. And the period items are again classified into two types. One is ordinary and the other is extraordinary. Those items which are related to due course of business and incidental to due course of business. Those items which are in due course of business and incidental to due course of business is nothing but ordinary items. And those items which are clearly distinguishable from ordinary items are nothing but extraordinary items. In the sense, nobody would like to get the extraordinary items, but even though business gets affected because of those extraordinary items. Remember, nobody will be expecting that an abnormal event will occur, but your business is getting affected. Flood is not at all related to business, but because of flood, your business might get affected, which is nothing but extraordinary activities. Those extraordinary items which are clearly distinguishable from ordinary items. Sir, AS5 had classified only these two items, ordinary and extraordinary. But in schedule 3, there is one more item, which is nothing but exceptional items. Exceptional items are ordinary, but due to their size, nature and incidence of the transaction, even though it is ordinary, it will have to be separately disclosed as if it is exceptional item. Ordinary But under ordinary, due to the size, nature and incidence of the transaction, some ordinary must be disclosed separately, which are nothing but exceptional items. Now there is a problem that you need to understand. We already discussed that whenever there is a controversy between accounting standards and schedule 3, you have to follow accounting standards. Clear everybody? Then what about the position here? Standard is telling only ordinary and extraordinary. But your schedule 3 is also telling exceptional. And hence we are telling that you have to disclose exceptional items separately also. Is it clear? Sir, is it clear? Standard had classified only ordinary and extraordinary. But schedule 3 had also classified new item called as exceptional. And now I am telling that you have to segregate the items into ordinary, exceptional and extraordinary. Ultimately dash is followed. Schedule 3 is followed or standard is followed? Chappali. Schedule 3 is followed. Am I correct or wrong? Then why and what about this controversy now? If there is any contravention of provisions between AS and schedule 3, I told you have to follow AS. But your AS5 had classified only ordinary and extraordinary. Your schedule 3 had classified ordinary, extraordinary and exceptional item. I am telling that now this classification is correct. This classification may not be correct. And I also already told you that whenever there is a controversy between these two things, standard has to prevail. But here schedule 3 is prevailed. Why? Perfect, because there is no contravention here. If there is contravention, then you have to follow accounting standard. There is no contravention here. It is like sub-classification only, not deviating any provision. A logic clear? Schedule 3 did not deviate any provision of accounting standard number 5. Schedule 3 did not deviate any provision of accounting standard number 5. And hence it is not a violation. Sir, even though you follow this one, indirectly you are following AS5 ane kada. And hence it is followed. Respond everybody clear. Now, people and students will be hardly confusing to pick an item, whether it is ordinary, whether it is exceptional and whether it is extraordinary. Very simple. Very, very simple. You first check out whether is it relating to your business or not. If it is relating to business and if it is regularly occurring, it's ordinary. Relating to business and occurring once in a while, it is exceptional. It is not at all related to business, extraordinary. Let me start. Salaries paid, ordinary, and of course ordinary and general. Clear everybody? And purchase of goods, flood occurred. That's extraordinary because it's no way connected to the business. Cyclone occurred. Cyclone occurred at Japan branch. Cyclone occurred at Japan branch. For the standalone financial statements which are prepared at Japan branch, AS5 is not applicable. Hey, clear everybody? If Japan branch is preparing the standalone financial statements, Indian accounting standards are not applicable for Japan, remember. And now, whenever you are preparing consolidated financial statements by considering the Japan branch for Japan branch, cyclones, floods, earthquakes are quite common and they will be considering it as an ordinary item. Clear everybody? And insurance claims paid by insurance company, ordinary item. But insurance claims received by a normal company, extraordinary item. Clear everybody? Purchase of asset. Purchase of asset. Purchase of asset is not dealt as per accounting standard number 5. Because accounting standard number 5 is net profit or loss. With purchase of asset, profit or loss will not get affected. Take care. Sale of asset. Don't tell that AS5 won't deal with it, because after selling the asset, you will be left with profit or loss. So point number 1, sale of asset, is it connected to business or not connected to business? Yes, it's a business item, but will it happen regularly or once in a while? And hence it comes under exceptional item. Cashier manipulated cash, exceptional item. Cash lost during fire accident, extraordinary item. Stock manipulated by the storekeeper, stock exceptional item. Stock lost in fire accident, extraordinary item. And what is it called? Receipt of government grant, exceptional item. Because in business, it's quite common that you will be getting government grants, but you will not get it every time, Ante. Refund of government grant, that's an extraordinary item, because after getting government grant, nobody will be expecting that government will be taking it back. So refund of government grant is an extraordinary item, but receipt of government grant is an exceptional item. Seizure and freeze of assets. You are not paying income tax, and hence income tax department had seized your assets. Extraordinary item, because that seizure is no way connected to your business. Valuation of stock at NRV. Valuation of stock at NRV. Remember, my dear children, generally stock will be valued at cost or NRV, whichever is lower. Generally dash will be lower. Cost price. If NRV is lower, then there is no business at all. So sometimes NRV will be lower, but not every time. And hence it is dash item. Exceptional item. Creation of provision is dash item. Ordinary item. Reversal of provision is exceptional item, and not extraordinary. Reversal of provision is exceptional item, because creation is directly related. Every year you will be doing, but reversal you will not do it every year. Respond clear. And restructuring provision. In AS9 you are having a concept of restructuring. Restructuring is nothing but redesigning your business concern. For that purpose, you are creating a provision. Which item? Exceptional item. Respond everybody clear. So to the max extent, I have covered all the period items. So take more care. And moving on to the next thing, prior period items. Remember, my dear children, prior period items are those expenses and incomes which are identified in the current period due to the errors or omissions committed in the previous periods. What are prior period items? Expenses or incomes which are identified in the current period due to errors or omissions which are covered in the prior period. Omission is nothing but reliable information available but not considered. Failure to notice. Failure to notice or oversight. Reliable information is available but not considered. Error is like miscalculations, misrepresentations, or misapplication of accounting policies or accounting principles. Clear, everybody? These are nothing but prior period items. Now, question number 1. Wages paid on installation of machinery, and the same is omitted. Answer, is it a prior period item or a period item? Wages paid on installation of machinery and it was omitted. Answer. AS5 won't deal with it because it has to be capitalized. Net profit or loss is not getting affected at all. Take more care. Say for example, wages paid on installation of machinery but charged to P&L account. Dash item. Prior period item, because this time you have charged it to P&L account and hence your profit is reduced. You have to rectify the error and hence this time it is affecting your P&L account and hence it is to be considered as if it is a prior period item. Respond everybody clear. And now moving on to the next thing, changes in accounting estimates. My dear children, remember, estimation is done by the management through professional judgment by considering the past experiences, current circumstances, future projections or estimations. Depending on the past experiences, current circumstances and future projections or estimations, management is going to estimate an accounting amount. Best example, something like a provision. Respond everybody clear. And remember, if at all any change in accounting estimate is there, it can be changed, but it has to be given a prospective effect. My dear children, which effect has to be given, Nana? Remember, listen very, very, very carefully. Very, very, very carefully. What is change in method of depreciation? What is change in method of depreciation? Change in accounting estimate. Then what is method of depreciation? This is accounting policy, because I have already discussed in AS1. Because accounting policy need a principal method. Depreciation is having principle. The principle is pattern of generation of future economic benefits. And the methods are SLM, WDV, production units method, machine hours method, etc. In the sense, my dear children, remember very, very carefully, method of depreciation is an accounting policy, but change in method of depreciation is change in accounting estimate. This is very different. Whereas for all the remaining things, valuation of inventory, accounting policy, change in method of valuation of inventory, change in accounting policy. Valuation of current investments, accounting policy, change in method of valuation of current investments, change in accounting policy. Respond, is it clear? If something is called as accounting policy, change in that something is also change in accounting policy. If something is accounting estimate, change in that something is also change in accounting estimate. But special attention, method of depreciation, accounting policy, change in method of depreciation, change in accounting estimate. Because method of depreciation depending upon the future pattern of generation of economic benefits. Respond, everybody, clear? So this has to be given a special attention, take care. And the last and final one, already discussed, changes in accounting policies. In AS1 itself I have discussed. You have to follow consistency as per accounting standard number 1. Follow consistency as per accounting standard number 1. But you can violate consistency principle as per accounting standard number 5 in the following 3 situations. When it is permitted by law, when it is permitted by accounting standards, when there is a better presentation in financial statements. Respond, everybody, clear? Sir, one more thing. Dash is violated here. Consistency is violated. And hence you have to disclose. Disclosures. Which policy is changed, why it is changed, effect of financial statements, quantify the effect. If you are unable to quantify, disclose the fact. No material impact in the current year, material impact in the future year, disclose the same in the current year. That's common. Now, change in accounting policy, which effect has to be given? It's not dealt as per accounting standard number 5. But if you take the help of Ind AS, you can tell that you have to give a retrospective effect. Which effect has to be given? As per AS5, no, AS5 it is silent about the effect. Clear, everybody? And the following 2 things are not called as change in accounting policies. Number 1, adoption of new accounting policy. I told you in AS1, did you remember? Go back to AS1, rewind and check out and come back again. Take care. Adoption of new policy is not called as a change in accounting policy. Second one, very, very important. You are changing the accounting policy due to change in the substance of underlying transactions. You are not having any intention to change at all. But when VAT, value added tax, is there, you used to have one kind of policies. But whenever VAT is changed to GST, you are supposed to change that policy. You are not having any intention to change. But underlying transactions have changed and hence you are supposed to change your policy. Respond, everybody, clear? This is also not called as a change in accounting policy. Respond, everybody, clear? Pakka. Change in accounting policy. Following 2 things are not called as change in accounting policy. Number 1, adoption of new accounting policy. Number 2, change in accounting policy due to the change of substance in the underlying transactions. Clear, everybody? Now, the next one. Change in account. Sometimes board of directors might not be knowing whether the change is change in accounting estimate or change in accounting policy. In such a case, better to treat it as change in accounting estimate and give a prospective effect. If company and management is unable to decide whether the change is change in accounting estimate or change in accounting policy, then it is recommended to consider as if it is change in accounting estimate, and you have to give a dash effect, no, prospective effect. Respond everybody, pakka. So that is all about changes in accounting policies. Now, last and final, one more thing. Listen very, very carefully. In AS4 and in AS5, there is a point relating to prior period item. Listen very carefully, everybody. This is financial year. Say, for example, theft happened. This theft was identified in the current period, after the date of balance sheet, but before the date of approval of financial statements. Theft was identified in the current period due to omission in the previous period. So, is it a prior period item or not? Cheppali. Theft is affecting P&L account. It's a loss kada. So, theft is an omission. Sorry, theft is an, what is it called? Affecting P&L account. So, that can be considered as a prior period item since the company had omitted in the previous year. They respond clear. So, is theft committed in the previous year but not accounted is a prior period item in the current year or not? Yes. Now the next question, when did you identify this prior period item? If you have identified the prior period item after the date of balance sheet but before the date of approval, this prior period item can be adjusted in the previous year financial statements as if it is an adjusting event. If the prior period item is found after the date of approval of financial statements, then it cannot be considered as per AS4. It has to be considered as per AS5 and it has to be adjusted in the current year financial statements. Respond clear? So this is another clarification with respect to prior period item. And the last and final thing, changes in accounting estimate is not a prior period item. Then what is changes in accounting estimate, sir? Check out what is accounting estimate. And changes in accounting estimate is also the same. What is this one, sir? Provision for bad debt. Is it accounting estimate or not? Cheppali. It is dash item. Ordinary item. So changes in accounting estimate is also dash item. Ordinary item. Respond everybody, understood. There is a last and final controversy here. With this AS5 will be closed. What is the nature of insurance claim received? Not insurance claim paid. Insurance claim paid is obviously ordinary item because it will be paid by the insurance company. But what is insurance claim received? Remember, there are net, blogs, Google, ChatGPT, AI, etc. who are answering it as an extraordinary item. But your institute material in one of the points very clearly given that it is an exceptional item. Insurance claim received in your institute material, it was very clearly given that it is as if it is an exceptional item. Then why is this controversy, sir? Very simple. What your institute material is considering is that insurance claim lodged with insurance company is extraordinary item. Now you are receiving the claim for insurance claim which was lodged. And hence it's an exceptional item. Is it clear? Insurance claim lodged in the sense you are applying to insurance company. At that time you will be getting some loss. Clear? It will be considered as an extraordinary item. But whenever insurance claim is receiving after lodging it with the insurance company, it is considering as if it is an exceptional item. But straight away receiving insurance claim is nothing but extraordinary item. Respond clear. And conclusion, to classify whether it is ordinary or exceptional is a judgmental decision. Voluntary retirement compensations paid. Ordinary, exceptional, extraordinary. That's ordinary because in government organizations every year voluntarily many of the people will retire. But say for example all of a sudden huge employees retired in 1 year. Then that will become exceptional. Conclusion, it's a judgmental decision which has to be taken care by the management. Respond everybody clear. And my dear children, that is the end of accounting standard number 5. Let me start with accounting standard number 10. What is accounting standard number 10? Amma? PPE, property, plant and equipment. Sir, please listen very carefully because this is the lengthiest standard amongst all the standards. Of course, it's not difficult, but many concepts are covered under accounting standard number 10. So, even the class, yesterday we have gone with all the basic things like introduction, framework, case 1, 2, 7, 9, or of course, apart from 7, 4, 5, 9, everything are basic things, and hence they were a bit faster. But from today, it will not be like that because since all the basic things are done away with. And let me start with PPE, which is nothing but property, plant and equipment. Of course, the first and foremost thing is all about scope. You have to be very, very, very careful with the concept of scope here. And under scope non-applicability, remember my dear children, if at all there is any asset related standard, then this scope is not applicable. This point is not applicable for that particular standard. That is all about renewable resources and non-renewable resources. If you have remembered yesterday, accounting standard number 2, which is valuation of inventory, producer's inventory, which is engaged in renewable resources and non-renewable resources. The same point is also there in accounting standard number 10. Also, you are having the same point in accounting standard number 26. Also, you are having the same point even in accounting standard number 19. So simple. If it is an asset related standard, that standard is not applicable for renewable resources and non-renewable resources, for which dash is applicable. Amma. Industrial norms are applicable. What is applicable, my dear children? Okay, now coming to renewable resources, some of the examples were given: agricultural products, forestry products, etc. And one of the renewable resources is nothing but biological assets. What do you mean by biological assets? Living animals or living plants. What are biological assets, Amma? Living animals or living plants. Now, very, very, very important, listen very carefully. Biological assets are categorized into living animals and living plants. So now, point number 1, coming to living plants, again divided into 2 types. Number 1, bearer plants. Number 2, other than bearer plants. Coming to living animals, those living animals which satisfy the definition of property, plant and equipment, those living animals which did not satisfy the definition of property, plant and equipment. Hope the classification is absolutely understood to each and everyone. So please respond. Biological assets are divided into dash and dash. Living animals and living plants. Coming to living plants, again the first one is bearer plant and the second one is other than bearer plants. Coming to living animals, those living animals which satisfy the definition of PPE and those living animals which did not satisfy the definition of PPE. Now, next point for this bearer plant. Biological asset, living plant, bearer plant. Accounting standard number 10 is applicable. For other than bearer plant, industrial norms are applicable. Those living animals which satisfy the definition of PPE, strictly speaking, AS10 is not at all applicable. But in original accounting standard of AS10 itself, he had given a note that we are developing a new accounting standard called agriculture. Till that agriculture related accounting standard is released, those living animals which satisfy the definition of PPE, AS10 will be applicable. Once if we have released a new accounting standard on agriculture, entire living animals and living plants other than bearer will be taken care by the new accounting standard called agriculture. I hope this part is absolutely clear. For bearer plant, always dash standard is applicable. AS10. For other than bearer plants, those living animals which satisfy the definition of PPE, which did not satisfy the definition of PPE. Strictly speaking, AS 10 is not applicable. Industrial norms are applicable. But in accounting standard number 10 itself, they have given you a clarification. Till the new accounting standard on agriculture is released, those living animals which satisfy the definition of PPE, AS 10 will be applicable. For those living animals which did not satisfy the definition of PPE, industrial norms are applicable. I hope this point is absolutely clear to each and everyone. Sir, is it clear? For bearer plant, always dash is applicable. For all the remaining, strictly speaking, dash should be applicable. Industrial norms. But in the standard itself, he had spoken about agriculture standard. Till agriculture standard is released, those living animals which satisfy the definition of PPE, dash is applicable. AS 10, which did not satisfy the definition of PPE, industrial norms are applicable. Clear? Now let me move on to the next one, bearer plant. You are supposed to know, first of all, what is a bearer plant. So please respond, what's a bearer plant? Bearer plant whose life period is more than or equal to 12 months, and it should supply some agricultural produce. This is second point. And third point, very, very important. So once again, for bearer plant, is AS 10 applicable or not applicable? And you mean to tell that bearer plant is obviously PPE. So straight question, will you purchase a fixed asset to sell the fixed asset or to use the fixed asset? But can you sell the fixed asset in some rare situations or not? In the same way, bearer plant has to be used for supplying the agricultural produce. Exception. Bearer plant generally should not be sold as a plant as a whole. Exception, it can be sold as a plant as a whole in some remote situations. Clear, everybody? Is it clear? Bearer plants are those plants which are having remote likelihood to sell the plant as a whole. From bearer plant, we have to produce or supply the agricultural produce. But on the rarest of the rarest situations, remote likelihood, very, very, very less chances to sell the plant as a whole. Very, very less chances to sell the plant as a whole. Sir, our objective itself is to sell the plant as a whole. Come on, it's not a bearer plant. If your objective itself is to sell the plant as a whole, it's not a bearer plant. Sir, my objective is to produce or supply agricultural produce, but I will scrap after the produce and I will sell the plant. Yes, that's permitted. Respond clear, everybody. Can you sell PPE after scrapping the machine or not? So in the same way, can you sell the bearer plant after scrapping the bearer plant or not? This is point number one. Without scrapping, can you sell the machine in some rare situations? In the same way, even without scrapping, you can also sell the bearer plant in some rare situations. Respond, everybody, clear? So check out bearer plant. Bearer plant lifespan is greater than or equal to 12 months. It should supply some agriculture produce. Very, very important. Remote likelihood. In the sense, very less chances to sell the plant as a whole. But if you want, you can sell it as a scrap. For scrap, there is no restriction. Since the plant life is over, sell it as a scrap. Since the plant life is over, you can sell it as a scrap. There is no restriction on selling the scrap of the bearer plant. Respond clear, everybody. So tell me condition number one, bearer plant life period is greater than? It should supply some agricultural produce. It is having a remote likelihood. What do you mean by remote likelihood? Less chances to sell the plant as a whole. Except if you want, you can sell it as a scrap sale. Respond pakka. Take tree. Is it a bearer plant or not? Take tree. No, it's not a bearer plant because your objective is to sell the tree bark totally. And annual crops. Annual crops are not bearer plants because less than or equal to 12 months or simply less than 12 months. And Moving on to the next thing, very, very important. There will be some plants or there will be some trees which will be used for both agricultural produce and also used as timber or lumber. Lumber is North Indian word, timber is South Indian word, which is nothing but wood. To get wood, you have to sell the plant. So there are some examples like cherry tree. I also told you neem tree and any other things. Banyan tree is not, it's totally different. Anyways, no, mango is again different because mango wood is not that stronger. Okay, cherry tree, neem tree, etc. Those trees which can be used for both agricultural produce and timber. These are not called as bearer plants. Clear, everybody? And please don't forget, sugar cane is a bearer plant. Sugar cane is a bearer plant. Don't forget. Banana tree. There is a hard controversy with this. So better if you have got this kind of situation, you write the definition and you support your answer. Agricultural produce. Even we have clarified what is agricultural produce. It should be some produce from the tree. Tree is not a produce. From banana tree, you will get another banana tree. From each and every banana tree, you will get only one pile of bananas. From each and every banana tree, you will get only one pile of bananas, which will be cropping within a period of 12 months itself. And hence, strictly speaking, it's not a bearer plant. But from every banana tree, you get another banana tree. Another banana tree cannot be called as agricultural produce as per accounting standard number 10. Respond clear, everybody? Agriculture produce should be from the plant. Plant itself is not the agricultural produce. Respond, everybody, pakka. This is all about bearer plant. And now moving on to the next definition, PPE. Sir, what is a property, plant and equipment? Point number 1, is it tangible item or intangible item? Whose lifespan is greater than 12 months and it will be used for the purpose of production of goods, rendering of services, administration purpose, rentals. Whenever we are speaking about rentals, I have to connect with accounting standard number 13. In AS 13, you are having a term called investment property. Did you remember? Investment property is applicable only for land and building which are given for rental purposes. So, conclusion, if there is an investment property which is land and building given for rental purposes, for these elements, which standards are applicable? AS 13 is fully applicable. AS 10 is only partly applicable. That is, cost model is applicable. Revaluation model is not applicable. Sir, only which model is applicable? Cost model. Which model is not applicable? Revaluation model. To those investment properties which are held for rental purposes as per accounting standard number 13. 13 is fully applicable, 10 is partly applicable. It is limited only to cost model. And one more thing, administration purpose includes many things. It's not just administration. Selling and distribution can also be administration. Finance and accounting can also be administration. Personnel, HR, staff, employees, even these people can also be administration. Safety measures, something like fire extinguishers, etc. and etc. Even that is also administration. Environmental purpose. Government is ordering each and every factory to install smoke filters. Smoke filters is a kind of environment purpose, even though it's an asset. Respond, everybody, clear? So administration purpose includes many things. Now just answer me. Road. Is road within the factory site? Road within the factory site. Can road be called as PPE? How? You need to prove that it is satisfying the definition. Prove it. Point number 1, tangible. Point number 2, more than 12 months. Point number 3, used for which purposes? Administration purpose, rental purpose, production of goods, rendering of service. It will render the service. Am I correct or wrong? And will you get directly future economic benefit from the road? No, you will not get direct future economic benefits, but you will get Indirectly. If the road is proper, trucks can travel properly. If trucks can travel properly, repairs and maintenance will decrease. In the sense, future expense is getting decreased. If decrease in cost or increase in benefit is nothing but future economic benefit. What is future economic benefit? Decrease in costs or increasing in benefits, or nothing but future economic benefits. Respond everybody clear. So there will be some PPE which may not give future economic benefits directly, but you will be giving the same indirectly. And yesterday I also told you the recognition criteria as per S10. Recognition criteria for every standard is very simple. For all the asset related standard, it should satisfy the definition of asset. It should satisfy the respective definition as per that standard. AS2 recognition criteria, it should satisfy the definition of asset and it should satisfy the definition of AS10 recognition criteria, it should satisfy the definition of and it should satisfy the definition of PPE. Again, special attention must be given to stores and spares and loose tools. Those stores and spares and loose tools which satisfy the definition of inventory, then accounting standard number 2 is dealing with the same, and which is satisfying the definition of PPE, then accounting standard number 10 is dealing with the same. Respond everybody clear. And next concept is all about recognition and measurement, which is very, very, very important. So whenever we speak about recognition and measurement, two types will come. Number one is initial recognition. Number two is subsequent recognition. Initial recognition depends on modes of acquisition. Subsequent recognition depends on classification. Here is not classification, is all about models. Subsequent recognition generally depends on classification. As per AS11, as per AS13, you will get classifications. But as per accounting standard number 10, subsequent recognition depends on models. What are the two models you are having, Amma? Number one, cost model. Number two, revaluation model. And let me move on to initial recognition, which is actually depending on modes of acquisition. The first one, acquired for cash or credit. The second one, self-construction. The next one, exchange of assets. The next one, issue of securities. Clear everybody? Some people will be telling these two under the same lines. Even that is also correct. There is nothing wrong. And let me start with the first one. If some asset is acquired at cash or credit, it has to be recorded at dash price, Amma. Cost price. Cost price is equal to purchase price plus direct expenses till you are dealing with provisions. But whenever you are into problematic, if he is giving cost price, then it means purchase price. Even yesterday AS2 we have seen the same. While ever you are going with the problematics, if at all in the problem he is giving cost price, then you have to assume it as a purchase price itself. And let me proceed further. Now, purchase price is nothing but price which is stated in invoice. In invoice, what are the elements that are available? Number one, quoted price. In the sense you are purchasing for 1 lakh rupees. Out of that 1 lakh, I'll give you some trade discount. Trade discount is also another terminology is there. I mean to tell quantity discount and volume rebate. Quantity discount is nothing but if you purchase more than 2 items, I will give you some discount. Volume rebate, if you purchase more than the said volume, I'll give you some discount, which is nothing but quantity discount or volume rebate. And there's one more thing, that's all about taxes and duties. Remember, these three components will be included in the purchase price. Purchase price is the price which is stated in the invoice. In invoice, you're going to get quoted price, trade discount, quantity discount or volume rebate, and finally taxes and duties. Trade discount or quantity discount has to be deducted. Taxes and duties. What taxes and duties has to be done? If it is non-refundable taxes and duties, add. If it is not included. If it is refundable taxes and duties, you have to deduct if it is included. And moving on to the next thing, direct expenses. Those expenses which are incurred to bring the asset to present location or current condition. Those expenses which are incurred to bring the asset to present location or current condition. Present location is nothing but factory site or office premises. Current condition is nothing but till the point that the asset is ready to use. Whatever the expense you incur, all the expense has to be capitalized. Let me show you the list here all the carrying cost has to be capitalized, and unloading charges, loading charges, site preparation cost. Hope you know site preparation cost. Site must be prepared before installation. Assembling cost, installation fees, employee fees, borrowing cost, provided if qualifying asset definition is satisfied as per accounting standard number 16. And if any government grant is there, it has to be deducted, and special attention has to be given to testing cost. After the testing is always done after the asset is installed or before the asset is installed. After the asset is installed, you have to indulge into some testing cost. After testing, you might get some sample output also. Say my testing cost is 1 lakh. During the testing, you have got some sample output of 20,000 units, and each and every unit can be sold for rupees 2. Your cost is 1 lakh. Your benefit from testing you have got is 40,000. So net testing cost comes only to 60,000. So testing cost has to be added only when net of sale proceeds. And the last and final one, very, very important, present value of decommissioning and restoration expenses. Already you know well about what is present value of decommissioning and restoration expenses, but let me tell you in a small way. Say for example, you are installing a machine in the rented premises by altering the rented premises. So now owner is telling at the time of dismantling the machine, deinstalling the machine, the rented premises has to be brought back to its original position. This is the original position, but you have altered and installed the machine like this. But owner is asking you at the time of deinstalling the machine, again the rented premises has to brought back to its original position. Clear everybody? Dismantling is nothing but deinstallation. Restoration is nothing but bringing back to original position. Will you incur this expenditure at present or in future? So in future, in the sense, first of all, you have to bring it to the present value, and you have to create a provision. Provision for decommissioning and restoration expenses account. My dear children, generally every provision is created through dash account. P&L account, dash account. Every provision, sir, listen. Every provision is created from dash account. P&L account debtor to provision for bad debt, P&L account debtor to provision for warranty, P&L account debtor to provision for repairs and renewals account. But remember, this provision for decommissioning and restoration expense has to be added to the fixed asset or PPE account. In the sense, what is a journal entry? PPE account debtor to cash or bank account to provision for decommissioning and restoration expense account, and this has to be recorded with present value. Respond everybody, clear? So this is what all about your present value of decommissioning and restoration expense account. One more special attention. If at all that PPE is used for the purpose of producing inventory, then present value of decommissioning and restoration expense should not be added to the machine. It has to be added to the cost of production as per accounting standard number 2. Clear everybody? Sir, every provision is generally created from dash account, P&L account. But here this provision has to be created from dash account, PPE account. Please participate. Provision has to be created from dash account, PPE account. Clear everybody? But if at all that PPE is used for the purpose of producing inventory, then this provision has to be added to cost of production but not to PPE. Respond everybody, clear? And moving on to further. What about provision for decommissioning and restoration expenses account, sir? From here, this will be taken care by accounting standard number 29 with the concept of unwinding of discount. What is the concept of unwinding of discount? Let me discuss in accounting standard number 29. Clear everybody? Sir, till the point of creating provision, dash standard will take care? S10. But after creating provision, dash standard will take care? Case 29 with the concept of unwinding of discount. What is unwinding of discount? I'll discuss in AS 29. Clear everybody? And there are some other expenses which are not at all directly related to PPE, and hence they have to be excluded and they have to be immediately charged to P&L account, like administration expense, selling and distribution, initial operating losses, cost of relocation, cost of using, developing a new product, advertisement, inauguration expense, etc. In a single word, in a single word, those expenses which are incurred to bring the asset to current condition or present location, all those expenses have to be capitalized, included. Next one, those other expenses which are increasing the future economic benefits have to be capitalized. Those expenses which are incurred to maintain the future economic benefits have to be charged. Respond clear? Increasing future economic benefit have to be capitalized. Maintaining future economic benefits have to be charged. Okay. Let me move on to the next thing. Self-construction PPA. Very, very simple. Self-construction PPA in the sense, business concern itself is constructing PPE for itself. So, did you remember manufacturing of inventory? What is the cost of manufacturing inventory? Cost of raw material plus conversion cost, which might include either labor and overhead. Am I correct or wrong? And the same thing is here also. Cost of material, because for construction of asset you need some material, plus construction cost. This construction cost nothing but labor and overheads will be included. Respond clear everybody? And one more very, 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 very important thing. Never include abnormal losses of material, labor and overheads, and always eliminate internal profits. What are to be eliminated, my dear children? Internal profits. And you should never include dash item, abnormal loss, which implies that normal loss can be included or excluded. Included. Respond pakka. Now, if at all any incidental incomes and expenses are there, and if at all they are directly related to self-construction, then they will be reduced from the cost of self-construction. Say for example, you have purchased a material for 1 lakh, but at the end of construction period, some material was left out. You have sold it. So you have got a scrap value of rupees 10,000. Now what is the cost of your material? 1 lakh minus 10,000, which is nothing but 90,000. But there will be some incidental expenses which are not directly related to self-construction. Those should not be included. Best example, every teacher will be telling to you, say for example, this is the site. And here construction of building is happening. Here the place is vacant. And hence we have decided to level the site and we have decided to give it for car parking. So from car parking, we have got some rentals. Can these rentals be deducted from self-construction PPE? Cheppali? No, because these rentals is nowhere directly related to self-construction PPE, and hence this will be treated as other income in your Schedule 3 of P&L account. But it should not be deducted from self-constructed PPE. But say for example, if any material is scrapped and if you have got some incidental income, that has to be deducted from self-constructed cost of PPE. Hey, respond everybody clear. I hope this speed is absolutely okay to each and everyone. Okay, and let me move on to the next thing. Exchange of assets. It is very, 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 very different concept. Not important. Because till now this did not be questioned. This was not questioned in the examination. So I will tell you only to understand it. I can't tell you however we taught in the classroom. If I was not wrong, we have around spent 2 hours to tell that. And moving on to the next one, commercial substance, which is nothing but exchange of assets. Listen very, very carefully. If at all, one business concern is exchanging their old asset with a new asset, then at what price new asset has to be recorded is the biggest question. So remember, in order to crack this concept, first of all, you must understand commercial substance. What do you mean by a commercial substance? Sir, risk, timing, nature, cash flows are significantly different from old asset to new asset, exchanged asset to acquired asset. Or there is a term here, be careful, enterprise specific value of portion of operations. In a single word, this is nothing but post-tax cash flows. Enterprise specific value of portion of operation is nothing but post-tax cash flows from using the asset. If I was not wrong, you will be having FM. In FM, you will be doing capital budgeting. In capital budgeting, you will be getting CFAT. CF80 using that machine, which is nothing but enterprise specific value of portion of operation. Post-tax cash flows is exactly nothing but CF80. Respond everybody clear. CF80 from old asset and CF80 from new asset must be significantly differ. Only then we can tell that there exists a commercial substance. Understood? So what is commercial substance? Risk, timing, nature, cash flows should significantly differ from old asset to new asset. Or the next one, enterprise specific value of portion of operations, which is nothing but CF80. This is FM term, but accounting term is nothing but post-tax cash flows. This post-tax cash flows, what to do? Should significantly differ from old asset to new asset. In such a case, we can tell that there exists a commercial substance. Otherwise, there is no commercial substance. Now, very, very important. If there exists a commercial substance, at what price it has to be recorded? Very, very simple. New asset has to be recorded at fair value of asset given up or fair value of asset acquired, whichever is more clearly evident. If two things are clearly evident, then first preference will be fair value of asset given up. Second preference will be fair value of asset acquired. And moving on to the next thing. If at all fair value itself is not there, at that time you have to record the same at net book value of asset given up. And the difference, if any, has to be transferred to P&L account. Clear everybody? And if at all commercial substance itself is not there. If at all commercial substance itself is not there. Very, very simple. It has to be recorded at the net book value of asset given up. Respond everybody clear. Now, I'm telling the journal entry. I'm not taking the example. I'm telling the journal entry how to write in this kind of situations. Listen very carefully everybody. If you have listened this journal entry, you can answer any kind of question relating to commercial substance. Of course, here and there you will be having confusions, but if you have seen the answer, you will done away with that. So please be careful. Journal entries. Sir, just simply answer me. You are giving old asset and you are getting new asset. What is a journal entry? Yes, new asset account debtor to old asset account. My dear children, old asset always has to be credited with book value. It will never change. Sometimes what happens, either you will get cash or you have to pay cash. Sometimes along with the old asset, you may have to pay cash in such a time to cash or bank account. This value will never change. Some other times you will get cash, you will get new asset after giving your old asset. In such a case, cash or bank has to be debited. This value also will never change. Now, last and final, very, very important. At what price this has to be recorded with? These two must be, these two things. These assets acquired has to be recorded with fair value of asset given up. Sir, these two things, fair value of asset given up. Say for example, I have got a cash of 10,000. My fair value of asset given up is 1 lakh. Then fair value of new asset has to be recorded with 90,000. I hope the concept is clear for you. Two things must be considered. Please don't be in a wrong notion that new asset in the sense only new asset. Cash is also new for you because you are getting it newly kada. And hence these two things must be recorded at fair value of asset given up. Sir, say for example, if fair value of asset given up is not there, fair value of asset acquired. Already cash value is 10,000. Check out what is the fair value of new asset in the market and record at that price. Sir, fair value say not there, sir. Then book value of asset given up. Listen, my book value of asset given up is 80,000. These two things must be 80,000. Out of which cash is already 10,000. So balance will become 70,000. I hope it's clear. Please don't be in a wrong notion that please don't be in a wrong notion that only new asset has to be considered. Along with new asset, cash is also new for you. But this is the PPE, this is current asset. That is the only difference. And finally, you have to do the balancing figure, which is nothing but profit or loss. Respond everybody clear. So tell me, what is a new entry ultimately? New asset account debtor to old asset account, which has always to be recorded with, if you give cash, to cash or bank account. If you get cash, cash or bank account debtor. These values will never change. And next, these two things will be at fair value of asset given up or fair value of asset acquired, whichever is more clearly evident. If fair values is not there, you have to record it with book value only when commercial substance is there. If commercial substance is not there, straight away you have to record it with book value. And the difference balancing figure has to be transferred to P&L account. Hold on this. You can solve any kind of commercial substance questions now. Pretty sure. Of course, here and there will be some confusions for sure. But if you have see the answer, those confusions will be done away with. Shall I proceed further? So that's the end of commercial substance, my dear children. And let me go on to the next one, issue of securities. Very, very simple. If you have issued securities and if you have got one asset, that asset has to be recorded with the fair value of securities issued or fair value of PPE acquired, whichever is more clearly evident. 99.9999% fair value of securities issued will be clearly evident. Clear everybody? If these two things are not there, then it is recommended to record it at book value. I'm sorry, here book value is nothing but face value of securities issued. Clear everybody? New asset has to be recorded with fair value of securities issued or fair value of PPE acquired, whichever is more clearly evident. 99.9999% fair value of securities will be there. Fair value of securities is nothing but market price which is available in the stock exchange. If fair values itself is not there, you can record it with face value of securities issued. Respond clear? There are some special and simple items. Group of PPE acquired at a single price. If at all group of PPE acquired at a single price, then separate each and every asset in proportion to the fair value of asset as on the date of acquisition. Say 3 assets acquired at a combined price. Don't write 3 assets account debtor to cash or bank account. Asset 1 account debtor, asset 2 account debtor, asset 3 account debtor. The total price has to be apportioned in proportion to the fair value of assets as on the date of acquisition. Clear everybody? And this is advanced concept and hence I'm not covering at this point of time deferred credit period. But there are chances if he would like to lock you, he can lock you by asking this point in the question. So hold on this, I'll tell if time permits at last. Now moving on to the next thing, very, very important, component method of depreciation. Component method of depreciation is permitted only when component method of accounting is done. Sir, component method of depreciation is permitted only when component method of accounting is done. In your materials, it will be at last. Depreciation, last page of theory. Component method of depreciation is permitted only for component method of accounting. Component is nothing but part. Component is nothing but part. So part wise accounting is nothing but component wise accounting. Part wise depreciation is nothing but component wise depreciation, which is simply component method of accounting. Say for example, if you purchase a cinema theater, you are not supposed to write cinema theater to cash or bank account. In cinema theater, you are having building. In cinema theater, you are having furniture. Inka? Projector, screen, canteen, whatever, etc. to cash or bank account. Listen. Apart from the main components, you will be having sub-parts. All the sub-parts have to be called as a remainder of the asset. All the sub-parts is called as a remainder of the asset. Even if you take building, you will be having, cinema theater itself is building. And another thing, lift you will be having, roof you will be having. Apart from these things, you will be having all other sub-parts, kada. That sub-parts is nothing but remainder of the asset. And if you take ship also, ship engine is one component, ship body is one component. Clear everybody? Very, very, very important. AC is also having two parts. AC indoor unit, AC outdoor unit. But you are not supposed to do component method of depreciation for AC. Why, sir? Because outdoor unit is not readily available in the market. Indoor unit is not readily available in the market. So you have to choose component method of depreciation only when some conditions are satisfied. Pattern of generation of future economic benefit. Also, you have to go through the lifespan. Very important. Availability of component and ascertainment of cost price. Clear, everybody? Say if you take inverter, UPS is separate, battery is separate. So two things are readily available in the market. So do component method of depreciation. If you take building, if you got lift repair, you can go for lift repair. If you have got roof repair, you can go for roof repair. If you have got projector repair in cinema theater, you can do for the projector repair. In the sense, each and every part is separately identifiable, and each and every part can be replaced separately, and hence it is recommended to do component method of depreciation there. Otherwise, it's not recommended to do component method of depreciation. Respond, everybody, clear? And now moving on to the next thing, expenditure. My dear children, initial expenditure is always to be capitalized till the point that the asset is ready to use. Subsequent expenditure. My dear children, remember, very important. Some assets might be ready to use, but due to many reasons, you are not using the asset, and you are using the actual asset or put to use is at some other date. Ready to use is on 1/1. But you're putting to use on 1/2. Clear, everybody? Now, in between this 1 month, you have to put some expenditure. Am I correct or wrong? This expenditure is always to maintain the future economic benefits, and hence it has to be charged. As I already told you, single thing. Till the asset is ready to use, whatever the expenditure that you have incurred, it has to be capitalized. After ready to use, whatever the expenditure you have incurred, you have to check out the future economic benefits. If future economic benefit increases, it has to be capitalized. If future economic benefit maintains, it has to be charged. Respond, everybody, clear? So this is the expenditure. There will be some special expenditures. Sir, as I said, all the initial expenditure is always to be capitalized. But due to improper handling of the asset, a labor did not handle the asset properly, and hence the asset got an extra repair of rupees 1 lakh. Is it to be charged or capitalized? Hey, did you get the question? Labor is unable to handle properly. He did not know how to use it, and hence he is using it in a wrong way, and hence you have to incur an additional expenditure of 1 lakh. So now this has to be charged or capitalized? Charged, because this is no way connected to future economic benefits. Take more care. And one of the subsequent expenditure is major inspection. Sir, major inspection is not a minor inspection. It is like doing inspection in order to get each and every future economic benefit from the asset. After doing the major inspection will be done by a field expertise officer. Who will be doing that, Amma? Field expertise officer. In that field, whichever person is having expertise, he will be doing the same. So, listen very, very carefully. After doing the inspection, a field expertise officer is going to give a big report. Say, for example, if you check out, for building, major inspection will be there. Trains, major inspection will be there. Aircraft, major inspection will be there. Ships, oil refinery, etc. and etc. Say, for example, if at all the field expertise officer had done a major inspection for the building, he will tell you the position of the building. Roof, this is the position. If you have done this much repair, this many years it will work out. Lift, this is the position. It is exactly fine. Just go with repairs and maintenance. Immediately replace the, immediately paint your building in order not to get rust, etc. and etc. Clear, everybody? Like this, he is going to give a big report on each and every part. How is the staircase? How is the lift? How is the roof? How are the walls? How strong are the pillars? Many things he is going to give in that report. So major inspection is always to be capitalized or charged. So please respond, major inspection is to be capitalized. It must not be charged. Understood everybody? And next one, if at all you are replacing any particular component or any particular asset, very very simple, then immediately old component value or old asset value or old major inspection value has to be de-recognized, and new asset value, new component value, new major inspection value has to be capitalized. A logic understood? Old values must be de-recognized, new values must be capitalized. Understood? So let me go with the next recognition, that is all about subsequent recognition. And my dear children, coming to subsequent recognition, it actually depends on two models I told you. What are the two models you are having, Amma? Cost model and revaluation model. Under cost model, every asset will be recorded at historical cost and minus accumulated depreciation minus accumulated impairment of loss, and then you are going to get net book value. Whereas under revaluation model, asset will be recorded at revalued figure minus accumulated revised depreciation minus accumulated revised impairment of loss, and then you are going to get net book value. So the next our task is all about what is the revalued figure. Very very simple, my dear children. Revalued figure is nothing but fair value. What is revalued figure, Amma? So at the time of revaluation, you are supposed to consider whether active market is there or active market is not there. If active market is not there, management themselves can revalue. Whereas if active market is there, certified valuers will come and they will be doing the revaluation. What are the methods that were adopted? If active market is there, market based appraisal method. And you are depending on the market, you will be verifying the market, and immediately the certified valuer will be giving the value for your asset. If at all active market is not there, how will you take the reference from the market? Check out the usage, earnings approach, discounted cash approach, etc. and etc. Capitalized approach. Something like in your FM you will be doing cash flows divided by net rate of return or normal rate of return. Then you will be getting how much maximum investment you can do on that particular asset. In the same way, from this asset, this much cash flows is generated, divided by the normal rate of return is this much. So what is the maximum value that can be attained for my asset? Is nothing but revalued figure. Respond clear. Now, one more very very important thing, my dear children. There is no need for all the assets to be revalued. A single asset cannot be revalued. If you want to revalue, you have to revalue the class of assets. Entire class has to be revalued. Land is a class, building is a class, vehicle, motor vehicle. Yes, vehicle, motor vehicle are separate classes. Industrial buildings and commercial buildings, I mean to tell office buildings, are also separate classes. Plant is separate class, furniture is separate class, machinery is separate class. Clear everybody? Even fixture is a separate class. Furniture, for your kind example, this is furniture. Fixture ante that projector is getting holding on something, right? That is called as fixture. Fixture ante which can't be moved at all. Cupboard. Cupboard will not come as furniture. Cupboard is actually a fixture. But the chair on which you are sitting is nothing but furniture. I hope the concept is clear. So furniture is different class, fixture is also a different class. All the assets need not be revalued. A single asset cannot be revalued. So if you want to revalue, you have to revalue entire class of asset. Clear everybody? And now moving on to the next thing, accounting treatment. Very very important, listen carefully. First time revaluation upward. PPE account debtor to revaluation surplus account. Subsequent downward. First utilize revaluation surplus account. If any is there, debit P&L account. Finally to PPE account. Clear? And first time revaluation downward. P&L because it's loss. P&L account debtor to PPE account. And subsequent upward. PPE account debtor to use P&L account first. Balance if any is there, transfer it to revaluation surplus. Respond everybody clear. And how this revaluation surplus will be closed, sir? You are having two policies or two options here. Option number one, you can close revaluation surplus at the end of selling of your asset. Sell the asset, close the revaluation surplus. What is the entry, sir? Revaluation surplus account debtor to general reserve account. Or option number 2, you can close revaluation surplus every year in proportionate to depreciation, and you can transfer this time to P&L account. Clear, everybody? You have to close revaluation surplus at the end of the life of the asset. At that time you have to close and transfer it to general reserve. Or option number 2, you can close revaluation surplus every year. In that case it has to be transferred to P&L account, but at that time you have to close in proportionate to depreciation. Respond, everybody. Clear? And the next one is retirement and sale of PPE. Listen very carefully. Retirement of PPE. If at all any asset is held for sale but not yet sold. Why it is held for sale ante? There's no active uses. There's no future economic benefit. In such a case, no depreciation will be there, but you are having future economic benefit at the time of selling. Correct or wrong? Since there is no future economic benefit, no depreciation, even though it's your asset, because you can get future economic benefits from selling the asset. Simply in a single word, retirement of PPE ante, is there active life or no active life? So future economic benefits are no future economic benefits. No future economic benefits. Sold, held for sale. Held for sale but not yet sold. In such a case it has to be recorded. Sir, always remember one simple rule. Everything in books of accounts, if you are supposed to sell, it has to be recorded at cost or NRV, whichever is lower. Everything, whatever if you would like to sell, like inventory, it has to be recorded at cost or NRV, whichever is lower. Here cost is nothing but cost minus depreciation, which is nothing but net book value. NRV is nothing but net selling price. And hence tell me, my dear children, those assets which are held for sale but not yet sold has to be recorded at net book value or net selling price, whichever is lower. Clear, everybody? And if at all you are selling any particular PPE, then you have to de-recognize or sale of that particular PPE, and whatever the profit or loss is there, very important, as per accounting standard number 10, there is no concept of capital profit. Total profit has to be transferred to P&L account. But as per IGAAPs, Indian generally accepted accounting principles, over and above cost price, if you are selling any asset, we will call that profit as capital profit, and it has to be transferred to capital reserve. So what if we have got this kind of question in the examination? It's recommended to write in both ways. As per accounting standard number 10, the total profit has to be transferred to P&L account. But as per IGAAPs, company can have a different policy. Such profit over and above the cost price is called as capital profit, and hence it is to be transferred to capital reserve. Hope you are aware of this concept. Say for example, one asset, 1 lakh is the cost price, 80,000 is WDV, 1,10,000 is the selling price. As per accounting standard number 10, it's very, very simple. What is the current value of the machine? 80,000. What is the selling price of the machine? 1,10,000. So 1,10,000 minus 80,000. 30,000 is the profit on sale of machine, which has to be transferred to P&L account. But as per IGAAPs, this 30,000 profit will be done in two parts. Number 1, over and above cost price. My dear children, what is over and above cost price? Nana? 10,000. So balancing figure how much? 20,000. So as per IGAAPs, this is called as capital profit, which has to be transferred to capital reserve, and this will be called as revenue profit, which has to be transferred to P&L account. Respond, everybody. Clear? So this is all about sale or de-recognition of PPE. And moving on to the next one, depreciation. I'm not going to cover each and every point in depreciation because it's very, very, very easy. So let me move on to some special methods. Number 1, what is a method of depreciation? You can use any method which is representing the pattern of generation of future economic. Sir, all the time remember, my dear children, those who have drafted accounting standards are having high level of knowledge, because they are not limiting any concept just to one method. Even if you have seen in accounting standard number 2, you can use any method which is representing the fairest approximation cost. Did you remember? Any method you can use which is representing the fairest approximation cost. In the same way here also, any method you can use which is representing the pattern of generation of future economic benefits. If future economic benefits are equal, SLM method has to be followed. If future economic benefits are decreasing, WDV method is followed. If future economic benefits depending on units, production units method is followed. If future economic benefits are depending on hours, machine hours method is followed. Remember, sir, by using the machine, I got some production. After production, I'm selling those production. Sale. Sale is nothing but my future economic benefit. So can I depreciate PPE in proportionate to cash flows from my sale? Question clear? You're telling the pattern of generation of future economic benefit kada sir. By using the machine, I got production. The production is sold. Sale is nothing but future economic benefit. So can it depreciate PPE in proportion to cash flows or in proportion to sale? Answer yes or no. No, this is not permitted in accounting standard number 10. This is specifically prohibited. Whereas this was not prohibited in accounting standard number 26. And hence for under amortization, you can do in proportion to cash flows. Case 26 exam అయిపోయిందా? Age 26 amortization can be done in proportion to cash flows. But depreciation as per age 10 cannot be done in proportion to cash flows because it is specifically prohibited. Get the difference between these two things. Commencement of depreciation. Very simple. When the asset is ready to use. Not put to use. Remember. Ready to use. One more very important thing. It must be commercially ready to use. Say for example, building is under construction. Listen very carefully. Building is under construction. You have already got an asset. You have installed the asset. Asset is ready to use. But commercially it is not ready. Sir, logic understood? Huh? Factory is under construction. You have already installed the machine. You can, sir, machine is ready to use. But you can't use the machine till the factory is ready. So ready to use in the sense you should not check only that particular asset whether it is ready to use or not. Ready to use commercially. What is required, Nana? Commercial usage is very much required, remember. And cessation of depreciation, which is nothing but stop the depreciation. Don't provide the depreciation when the asset is derecognized, disposed or sold, when the asset is retired, when no future economic benefit, some other important things. If at all estimated scrap value is greater than the book value, then no depreciation. If government grant received is greater than the book value and you are following asset reduction method. Hope you have remembered. If not, I'll be covering at that point. Even in this case also, no depreciation. Take care. On land, there is no depreciation. Exception on quarries, mines, sites, etc. There is something called depletion. Depletion. And if at all land and building were purchased together, remember, if at all land and building are purchased together, immediately apply component method of depreciation. Separate land portion and separate building portion. On building portion, there will be depreciation. But whereas on land portion, there is no depreciation. Pakka everybody. And being a company, it has to follow schedule 2 for depreciation. Company has to follow, or it has to follow section 123. Section 123 is related to dividend. Section 123 of Companies Act 2013 is relating to dividend. So then why I told here about depreciation? Because in section 123, in one of the subsections, it will be given that dividend has to be given only after profit. Profit is always computed only after depreciation and tax. So that depreciation has to be computed in accordance with schedule 2. So you have to compute depreciation as per section 123 or as per schedule 2 of Companies Act 2013. Respond everybody clear? Okay, and moving on to the next thing. Depreciation on stores and spares, integral and non-integral. This is not that important. You can just go through the same. One last and final part is all about accounting treatment for depreciation. What is the entry for depreciation, Amma? Depreciation account debtor to PPE account. Now you have to close depreciation. Am I correct or wrong? So close depreciation and transfer generally to dash account. P&L account provided if it is administration or rental purposes. If it is like providing the goods and rendering of services, immediately you have to add it to cost of production as per accounting standard number 2. If it is self-constructed PPEs, then simply add it to self-constructed PPE cost. If at all you are using any asset for your intangible asset, then you have to add it to intangible asset. Say for example, you are using a computer for your research and development. Depreciation of computer has to be transferred to research and development. Clear? If you are using a tractor for constructing your building, then depreciation on tractor has to be added to self-constructed building. Respond everybody, pakka. And there's something called impairment of loss, but I'm going to cover it in accounting standard number 28. You people prepare on your own for tomorrow's examination. And one last and final very important thing, already yesterday we have discussed, method of depreciation is accounting policy, but change in method of depreciation is change in accounting estimate, because the method is depending upon the estimate. I mean to tell, method of depreciation is depending upon the estimate of the future economic benefits pattern. If you are assuming future benefits are equal, then SLM method. If you assume future benefits decreases, WDV method. Respond clear everybody? One peculiar and different situation, just answer me. Asset is ready to use, commercially ready to use, but company is not providing depreciation. Is it correct or wrong? Wrong. But company is telling that in our situation, that is absolutely correct. What might be that situation? Question clear? Huh? Auditor approved the financial statements that even though the asset is commercially ready to use, company is not providing depreciation. Absolutely correct. There's nothing wrong in this. Auditor had approved the financial statement. Hey, don't tell that auditor had done fraud. Right? The reason might be the company is using production units method or machine hours method for depreciating the PPE. And maybe the asset is not used during that year, and hence no hours consumed or no units were produced, and hence ultimately depreciation was not charged. Respond everybody clear? And even though the asset is commercially ready to use, in some situations there will be no depreciation, like whenever you choose production units method and whenever no units are produced. Clear everybody? That's it. And let me move on to some different questions. Sir, this question itself is a very different. This question itself is very lengthy. Hope you have remembered the question. Asset is purchased, in that asset a component called motor is installed. He will be asking you to depreciate up to 4 years, and after 4 years he will be replacing the motor. Sir, please listen. You purchase the asset, also motor is purchased. So a component is called motor and the other is called as remainder of the asset. Now what to do, sir? Simply in the ratio of 5:1. I mean, he had told that motor is having 1 by, what is that called? Somewhere he'll be telling. Yes, a component called motor is there of 5 lakhs and the total value is nothing but 30 lakhs. Clear everybody? So 25 lakhs is the remainder of the plant and 5 lakhs is the value of the motor. So it is nothing but 5:1. Task number 1. All the direct expenses have to be apportioned in the ratio of 5:1. Task number 2, he will be telling that provide depreciation up to 4 years. So provide normally. Task number 3, he is given that motor was replaced. So if any motor was replaced, then old value has to be de-recognized and new value has to be capitalized. Task number 4, he had also told that machine was revalued as a whole. Revalued value is nothing but fair value. Since already motor is purchased, it is at fair value only. From the total revalue, that is 25 lakhs which is given in the question, minus motor new value is 6 lakhs. So remaining 19 lakhs will be the new revalued figure of the remainder of the asset. Now start providing the depreciation for 4 more years, and after 4 years, task number 5, provide, I mean, he had told that asset was sold. Entire asset was sold. and hence you are selling plant and also you are selling motor. So that has to be apportioned as at the book value at the end of year 8. That is at the end of year of sale. Understood everybody? Task number 1, allocate each and every expense in 5:1. Motor is replaced. So old value has to be derecognized and new value has to be capitalized. And next one, asset was revalued. So you do the revaluation and finally provide the depreciation for 4 more years, and exactly after 4 more years asset was sold. So it has to be apportioned in proportionate to the book values at the end of year 8. Last but not least, whatever the revaluation surplus is there, it has to be closed and transferred to general reserve. That is this question, very, very different. Take care. And one more question, problem number 2. This is all about soft opening. Please be very, very careful. Companies contending that soft opening is a trail run. But remember, soft opening is not a trail run. Soft opening is not a trail run. Soft opening is like an advertisement. What do you mean by soft opening? Soft opening is nothing but a kind of advertisement creation. For restaurants, for exhibitions, recreation parks, they will be doing something called soft opening. Under soft opening, there will be nothing great. Simply, they will offer you at a discounted price. You can enter, you can chill out, and you can come back. Understood? This is called a soft opening. So it is like an advertisement. It is not like a trail run. Companies contending that soft opening is like a trail run, and hence we will capitalize. But the reality is that soft opening is not like a trail run. It is like an advertisement, and hence it has to be charged to P&L account. And one more thing, you can open any business concern softly only when every asset is ready to use. In the sense, whatever the expense that is ready to use, I mean after ready to use you have incurred, you have to charge. Clear? Of course, exception. If future economic benefit increases, it has to be capitalized. That's secondary part. Understood? And this question, very, very different question. Please be very, very careful. AC is having 2 parts. Number 1 is outdoor unit and number 2 is indoor unit. One very, very important thing, my dear children, be very, very careful. Now, is component method of depreciation permitted or not permitted? Because I told you that separately cost is not ascertained. At year 1, the position is like this. But exactly at year 6, the outdoor unit was blasted. And hence you are planning to purchase a new AC. But later on you have come to know that outdoor units are separately available in the market and they are having active market now. That is at the end of year 6. So now what is the accounting part? Listen very, very carefully. At the end of year 6, you just check out what is the market value of your outdoor unit. And then work back to the present value at year 0. Today, if the price is 1 lakh, might be before 6 years, the price is only 80,000. Correct or wrong? So, find the market value of outdoor unit, work back to the present value at year 0. Assume that you are purchasing this component at that price and you provide depreciation for 6 years, then you will be getting one book value. This book value has to be derecognized from entire AC and new value of outdoor component has to be capitalized. I hope the logic is clear and you have understood the concept. Initially, component price is not separately available, but in future, if component price is separately available, then work back to the present value and then provide the depreciation and then you will be getting one book value. So that book value has to be derecognized and new value has to be capitalized. So that question is this question. Bharat Infrastructure Heavy Machinery. CRD number 10 antamu. Please don't forget. CRD number 11. And one more thing, you have to be very careful. The last question of your material, which is relating to depreciation. That question is not difficult, but it's lengthy. And my dear children, that is the end of accounting standard number 10. And let's continue with accounting standard number 17. And my dear children, accounting standard number 17 is nothing but segment reporting. Sir, it's a very easy standard, and majority I'll be concentrating only on the tests for reportable segment. But before that, I'll be telling the definitions. Segment items include, exclude, and then test for reporting segments, and finally disclosures. Listen very carefully. Point number 1. Segment items include. Segment items include and exclude. Remember, segment items always include operating and ordinary items, which includes direct revenue, allocable revenue, inter-segment revenue, or direct expense, allocable expense, inter-segment expense, or direct asset, allocable asset, inter-segment asset. I mean to tell, segment items always includes operating and ordinary. It should be direct, allocable, and inter-segment. And what are the elements which will be excluded? Excluded items are investing items, financing items, extraordinary items, unallocable items, tax items. Sir, it's very simple. You remember, operating and ordinary will be included. So operating is included, implies that investing and finance is excluded. Ordinary is included, implies extraordinary is excluded. Allocable is included, implies that unallocable is excluded. And finally, tax. My dear children, tax is paid by the enterprise, but not by every segment. Clear, everybody? The biggest question is there, for which company's consolidated financial statements is applicable and for which company's segment reporting is applicable? Answer is very simple. If at all you are having many subsidiaries and the operations are performed through different companies, then consolidated financial statements are applicable. If at all you are performing only in one company, different product lines or service lines, then segment reporting is applicable. Best example, ITC is having hotels, confectionery, FMCG sector, stationery sector, etc. Hindustan Unilever, you are having many tea brands, FMCG, soap sector, and even cosmetics is there, so etc. and etc. So like this, if a single company is operating with various segments or divisions, AS17 is applicable. Understood? So always remember, my dear children, segment items includes dash and dash items, operating and ordinary items. It includes three things again. What are those? Direct items, allocable items, inter-segment items. What are excluded, Amma? Investing, financing, extraordinary, unallocable, tax. One more important notice thing, for expenses and incomes, you have to check the activity and whether is it operating activity, investing activity, financing activity. If it is operating activity, then it will be included. If it is investing and financing, it will be excluded. But for assets and liabilities, you have to check the purpose. Whether the asset is used for operating purpose, investing purpose, financing purpose. If it is used for operating purpose, then it will be included. If it is investing or finance, it will be excluded. Clear, everybody? Assets and liabilities, you have to check the purpose. Whereas for expense and incomes, you have to check the activity. Be careful with this line of difference also. That's very important. Sir, investment in machinery, what is that? Which activity? Investing activity. But you cannot tell that this is not included in segment asset. You check out for which this asset is used. So this machine is used for producing the goods, sir. Operating purpose. And hence it's segment asset. Understood? Like that you have to break down. If it is income and expense, activity. If it is asset and liability, purpose. This is the first part that is relating to definition. And moving on to the next thing, my dear children, tests for reportable segments. Tests for reportable segments. So I'm concentrating on current year tests. Current year there are 5 tests. Test 1, test 2, test 3, test 4, test 5. Test 1, segment revenue test. Segment revenue should be greater than or equal to 10% of total segment revenue. Test 2, segment assets test. Segment assets should be greater than or equal to 10% of total segment assets. Test 3, segment result test. Segment result should be greater than or equal to 10% of total segment result. Total segment result is equal to total segment profits or total segment losses, whichever is higher. And next one, test number 4, management discretion. It is their wish. Nobody are going to question that. And last and final, test number 5, overall external revenue test. Overall external revenue from all the reportable segments of test number 1, 2, 3, 4 should be greater than or equal to 75% of total enterprise revenue. Enterprise revenue and external revenue are absolutely one and the same. Enterprise revenue and external revenue are one and the same. Last test is a bit complicated. Take care. Overall external revenue test. What is this test, sir? Find the external revenue from all the reported segments of test 1, 2, 3, 4. That should be greater than or equal to 75% of total enterprise revenue. Remember, enterprise revenue and external revenue are absolutely one and the same. Shall I proceed further? Now, these all the 5 tests relating to current year. Hey, no need to satisfy all the tests. Any of the tests satisfies, then you have to report separately. Along with this, last year test 1, test 2, test 3 are also to be reported. Last year test 1, test 2, test 3, which satisfied in the last year but did not satisfy in the current year, is also to be reported. Is it understood? Current year, any of these 5 tests. Last year, 1, 2, 3. Say last year segment 1 is satisfied. Current year segment 1 is not at all satisfied, even though it has to be reported in the current year. Respond clear? So conclusion, reportable segments is equal to current year test 1, current year test 2, current year test 3, current year test 4, current year test 5 and last year test 1, last year test 2, last year satisfied but current year not satisfied, even though you have to report those segments which satisfied test 1, 2, 3 of last year. Understood everybody? Let me show you an example here. Check out. Segment revenue. Total segment revenue is equal to 600. So you have to apply dash test. Segment revenue test. Segment revenue is greater than or equal to 10% of total segment. So 600 into 10%, which comes to 60. Just answer me. A, S, B, C, D, E, F, G, H. And as per segment revenue test, only A and B are reportable. Next, let me go to segment result test. Segment result should be greater than or equal to 10% of total segment result. Total segment result is nothing but total segment profits or total segment losses, whichever is total segment profit. 5, 15, 8, 5, 7. 40. Loss 90, 5, 5, 100. Whichever is higher into 10%. 10. Sir, now 10 is just a number. Forget whether it is profit or loss. 10 is just a number. Start A, B, C, D, E, F, G, H. And as per this test, even B and C are reportable. And from test 1 and test 2, A, B, C are reportable segments. And test number 3, what is test number 3? Segment assets test. Segment assets total is 100, should be greater than or equal to 10% of total. In the sense it comes to 10. Start A, B, C, D, E, F, G, H. And now, till now, what are the reportable segments? A, B, C, D. Test number 4 is management discretion. That is their wish. Let's not bother about that. Now, conclusion, test number 5. Listen very, very carefully. What are the reportable segments now? A, B, C, D. Count only dash revenue. Test number 5. Overall external revenue test. Sir, what is test number 5, my dear children? Overall external. So now you have to count only dash revenue. External revenue. Check out here. Here you are having external sales, inter-segment sales. So you have to consider only external sales. External sales of reportable segments. What are the reportable segments till now? A, B, C, D. Check out this total. 255 plus 15 plus 10. 280. This should be greater than or equal to 75% of total enterprise revenue. Enterprise revenue or external revenue is one and the same. And hence this 400 multiplied by 75% which comes to. And you have to report till the total external revenue is up to 300. But now the reporting amount is only. So still how much is shortage? Minimum 20 is the shortage. So better to pick any other segment. Best segment is to pick F. Because minimum 20 is needed, ra. If you pick 50, then 280 plus 50. 3? That is more better, kada. So better to pick F. Now ultimately what are the reportable segments? A, B, C, D. I hope the last is understood. Sir, if I choose G, any problem is there? Absolutely no problem. That's your choice. Now listen. Current year, all these 5 were satisfied. But unfortunately, last year, segment H had satisfied test number 2. Clear, everybody? And hence, even it has to be reported in the current year. So ultimately, what are the reportable segments? A, B, C, D, F, H. And remaining E and G can be called as other segments. E and G can be called as. No need to report them separately. Respond everybody, pakka. This is the concept of reportable segments. And I hope you have understood clearly. And last and final is all about disclosures. Sir, if coming to this standard, the segments are actually divided into 2 types. One is business segment and the other is geographical segments. Now, say for example, the company is operating in 20 different products and 80 different countries. And logically speaking, the company is having 20 into 80, 0, 0, 16. 1600 segments are there. Am I correct or wrong? 20 different products and in 80 different nations. And strictly speaking, the company is having 1600 segments. Is it practically possible to report this 1600 segment wise? And hence A17 had come forward with a new concept that is all about dominant segment. You check out what is more dominant. Whose risk and rewards are more dominant? Is it product or area? If product is more dominant, then declare business segment as primary segment and geographical segment is secondary segment. If areas is more dominant, again you have to check out whether location of asset is more dominant or location of customer is more dominant. If this is more dominant, let this be primary and other 2 things be secondary. If this is more dominant, let this be primary and business segment and location of assets be secondary. Clear, everybody? Why this classification is done? Simple. For primary segment, you have to disclose all the items. For secondary segments, disclose only the most important item. Clear, everybody? How to choose a dominant segment? Based on the risk and rewards. Whose risk and rewards is more dominant, it will be called as a primary segment. The other things will be called as a secondary segments. Clear, everybody? So for primary segments, you have to disclose all. What are all things, sir? Segment revenue. Again under segment revenue, you have to disclose direct revenue, inter-segment revenue, allocable revenue. Segment expense. This is special. Take care. Under segment expense, you have to disclose non-cash expense, depreciation and amortization. Disclose segment result. Disclose segment assets. This is special again. What is the cost price at the time of acquisition? What is the book value at the end of the year? And segment liabilities and reconciliation statement. Clear, everybody? Simply, no need to remember, but remember one thing. You have to disclose every element. Now you have to remember, for secondary segment, you have to disclose only most important item. Sir, what is most important item for a business segment? segment revenue, segment asset. So if business segment is secondary, then most important item is segment revenue and asset, and hence you have to disclose segment revenue and segment asset provided respective test is satisfied. Again relaxation is given. Are babu, if your secondary segment, no need to disclose all. Disclose only most important item provided if that test is satisfied. And what is the meaning of this, sir? Business segment is secondary, but it did not satisfy segment revenue test. It did not satisfy segment assets test. This had satisfied segment result test. Now no need to disclose anything. Is it clear? Whichever element is satisfied, disclose only that element. Say segment result is satisfied. Is there any need to disclose segment result? Because A17 is telling, Arey Babu, if it business segment is secondary, only segment revenue and segment assets are enough. That too if respective test is satisfied. Respond clear. For geographical location of assets, segment asset is important. Disclose only when segment asset test is satisfied. For geographical location of customer, segment revenue is important. Disclose only when segment revenue test is satisfied. But another beauty, under segment revenue, no need to disclose all. Disclose only direct revenue. Respond everybody clear. And that is the end of accounting standard number 17. I hope you have clearly understood. Accounting standard number 18. And accounting standard number 18 is nothing but related party disclosures. Related party disclosures, which is nothing but accounting standard number 18. Sir, always between related parties, it is assumed in a deemed way that there is no arm's length price. Hope you have remembered what is arm's length price. Price between two related or unrelated. Unrelated parties, but they should have knowledge and willingness. I mean to tell, price which is decided between two unrelated parties who are knowledgeable willingful buyer and knowledgeable willingful seller in an arm's length transaction. Arm's length transaction is nothing but between two new persons. If the transaction is entered, we will call it as arm's length transactions, because between two new persons, obviously there is no such concept of influencing, and hence we will call it something like arm's length price transaction, and which is nothing but arm's length price. And always AS18 is related party disclosures, in the sense transactions are happened between related parties. Whenever transactions are happened between related parties, obviously such sort of doubt will be there whether price is affected or not, and hence this standard is asking all the related party transactions and related party relationships have to be disclosed. Clear everybody? Hey, what are the two things that are to be disclosed, my dear children? Related party relationships and related party transactions. Even though related party transactions are affected at arm's length price, it is deemed assumed that arm's length price is affected, because nobody will trust that. Understood everybody? And let me move on to the scope. Sir, this standard is hardly with scope and disclosure. Very, 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 very important. Listen very carefully. Scope, applicability, entities which are directly or indirectly control or controlled by or in common control with the reporting entity. In this 6 relations, 1, 2, 1, 2, 3, 2 into 3, 6 relations are covered here. In a single word, the 6 relations are nothing but holding, subsidiary and fellow subsidiary. What are the 3 things covered, Amma? Holding, subsidiary, fellow subsidiary. What is the relationship between among these 3 entities, Amma? Control. So you are supposed to know what is control now. So tell me what is control. Point number 1, greater than 50% of the voting power. Point number 2, controlling the composition of board of. Sir, as per law and as per accounting standard number 21, control includes only these two items. What are those two items, Amma? Greater than 50% of the voting power, controlling the composition of board of. But as per accounting standard number 18, third more thing is also included, which is nothing but substantial interest. Substantial interest in voting power is nothing but greater than 20% of the voting power. But a straight question, how will you get control just with 20% of the voting power? Along with this 20% of the voting power, you should have a power to direct. You will be having agreement. That's it. In that agreement, you will be given a power to direct. What to direct, sir? Don't tell power to direct. Power to direct companies operating and financial policies. Power to direct companies operating and financial policies. And then we will be telling it as control. Respond everybody clear. And moving on to the next thing, holding company. Sir, please be very, very careful. This standard is not just applicable for company. This is also applicable for other than companies also. So it's better to call not holding company, holding entity. But our discussions will be in the viewpoint of company only. Remember, this standard is also applicable for other than companies. But our discussions and our questions, institute questions, were framed only in line with company. But say, for example, if at all somebody is asking, is IS 18 applicable for other than companies? Yes. Don't be in a wrong notion that holding company, subsidiary company. No, no. Our discussions will be like that. But the standard is also applicable for other than companies. Now moving on to the next thing. Holding entity is an entity which is controlling another entity which is called subsidiary. And subsidiary is an entity which is controlled by holding company or holding entity. Now very important, fellow subsidiary. Fellow subsidiaries are nothing but those subsidiary companies which are under common control. Those subsidiary companies which are under common control are called as fellow subsidiary companies. Understood everybody? And remember one more thing, if at all in a group there is only holding and subsidiary companies, each and every company is relative to the other company. In a group, if there are holding and subsidiary entities, then each and every company is relative to the other company. Remember, say for example, A is having B and C, B is having D and E, C is having X and Y. Sir, say for example, every company is having something like more than 50% of the voting power. So to tell you, every company is relative to the other company. Let me crack with two companies. Let me start with B. For B, A is holding company. D and E are subsidiary companies. C is fellow subsidiary company. X and Y are relatives or not relatives? Relatives, not relatives. Relatives, I told you. Group is always relative if holding and subsidiary are there. Now what is the relation called? Fellow subsidiary. How it is fellow subsidiary, sir? B is controlled by A. X and Y are ultimately controlled by, and hence they both are in common control, and hence dash fellow subsidiary. Let me pick another company, say Y. For Y, C is holding company. For Y, A is also holding company. We'll call it as ultimate holding company. For Y, B, fellow subsidiary, because B is controlled by A. Y is ultimately controlled by A. And for Y, D, E and X, fellow subsidiaries, because ultimately everything is controlled by A. Understood everybody? So in a group, if there is only holding and subsidiary, each and every company is relative to the other company. Respond everybody clear. And the next one, associate to investing party and investing party to associate, joint venture to venturer and venturer to joint venture. But remember, co-associates are not relatives, co-venturers are not relatives. I mean to tell, say A is having B and C, which are nothing but associates. Which are nothing but associates. Now you answer me. For A, who are the relatives? B and C. For B, who are the relatives? Only A. For C, who is the relative? or B and C relatives among themselves? Because they are called as co-associates. Clear, everybody? Now, what will be called as an investment company or investing party, and what will be called as associate? Very simple. Whenever a company is having significant influence on another company, whenever a company is having significant influence on another company, then we will call it as an associate company. Whichever company is having significant influence, we will call it as investing party. Clear? Now, how will you get significant influence, sir? Greater than 20% of the voting power, or greater than or equal to 20% of the voting power. But remember, not being a subsidiary. Not being a. So significant influence is possible through more than or equal to 20% of the voting power, but not being a subsidiary. Respond, everybody. Clear? One more thing. Okay, sir, it's not being a subsidiary, more than or equal to 20% of the voting power is there. Then even substantial interest is also more than or equal to 20% of the voting power. Then what is the difference between these two things? Here you are having power to direct. Here you will be having power to participate. What you are having, Amma? Power to participate in companies operating and financial policies. Respond, everybody. Clear? And moving on to the next thing, joint venture and venturer. Venturers will be commonly starting a joint venture, which is nothing but sharing of economic benefits from the joint venture. Sharing of economic benefits from the joint venture. For joint venture, who are the relatives? V1, V2, V3. For these parties, who is the relative? Only joint venture. These people are not relative among themselves because they are called as co-venturers. Co-venturers are not relatives. Co-associates are not relative parties. Respond, everybody. Clear? Hey, please check out this concept. Indirect influence through influence are not related. A is having 30% in B, B is having 40% in C, or A and C relatives are not relatives. But indirect influence through control are related. Check out the example. A is having 60% in B, B is having 30% in C. And indirectly A is having 30% in C. So are A and C relatives or not? So indirect influence through control is relatives, but indirect influence through influence are not relatives. Respond, clear, everybody? Sir, associate of associate, is it relative to the original investing party? No, that is what this concept. Associate of associate is not related to the original investing party, but associate of subsidiary is relative to the holding company. And I mean to tell, you can get any style of terminology in the examination. Associate of associate may not be a relative party, but associate of subsidiary is a relative party. Is it okay with the terminology? Sir, in examination, you have to analyze, which will give you the answer. If you are not in a position to analyze, you can't get the answers. That's the only thing. So be careful in analysis. And moving on to the next one. Till now we have seen about companies. Now we have come to individuals. Individuals along with their relatives, whether they are having control or significant influence over the reporting entity or relatives to the reporting entity. Say Mr. A is having 60% in P Limited. So for P Limited, Mr. A is the related party. We can't tell holding entity here. Clear, everybody? Hey, understood, huh? Mr. P is having 60% in A Limited. So for A Limited, P is a related party. Sir, for Mr. P, A Limited, not a related party, because Mr. P is an individual. He is not doing any business. For individuals, accounting standards are not applicable. Accounting standards are applicable only to commercial, business, economical, industrial nature. Hope you have remembered. So Mr. P is a normal individual for which accounting standards are not applicable. And hence, if you observe the terminology, see here, vice versa relation is given. one to other, other to one, holding to subsidiary, subsidiary to holding, subsidiary to fellow subsidiary, fellow subsidiary to subsidiary. Clear? Even associate to investing, investing to associate, joint venture to venturer, venturer to joint venture. But here only one end is given, individual and relatives or relatives to the reporting entity. Respond everybody. Clear? Now who are included in relatives, sir? Relatives are nothing but individual and individual spouse, individual mother, individual father, individual brother, individual sister, individual daughter, individual son. Clear everybody? And the next one, KMP and relatives are always relatives of the entity. What is the next one, Nana? KMP and relatives are always relatives of the entity. Respond everybody, pakka. This is all about relations up to point number 4. Now the fifth point is very, very important. Listen carefully. Very carefully. Entities in which individual or KMP along with their relatives are having control or significant influence are also relatives. What do you mean by this one? Entities in which individual along with their relatives having control or significant influence are also relatives. Let me give you a best example. Say Mr. P is having 60% in A Limited and having 70% in B Limited. A and B are now A and B are relatives or not relatives? Relatives. As per point number 5, not point number 1. Because point number 1 is applicable only for entities. Point number 5 is applicable for individuals. Understood everybody? You're not supposed to tell common control here. You're not supposed to tell fellow subsidiaries here. Because he is just an individual. A response clear? One very, very important thing. Very important thing. 30%, 35%. Now A and B are relatives as per point number 5. Significant influence. Sir, listen. P Limited is having 30% in A Limited and 35% in B Limited. Now A and B are not relatives because they are called as co-associates. As per point number 2, they are not relatives. As per point number 5, they are relatives. And if at all the holding is done by an individual, they are relatives. Holding is done by an entity, they are not relatives. Because entity is not controlled by one person, kada. Entity is having many things. Management, board of directors, members, many people will control an entity. But here an individual ante, he is not having any business knowledge. He is just an individual. Correct or wrong? And hence, if at all individual is having significant influence in 2 companies, then those 2 companies are relatives. But company is having significant influence in 2 companies, they are not relatives since they are called as co-associates. Respond everybody. Clear? Now next, Mr. P is having 60% in A Limited and also Mr. P is having a sole proprietary business. These 2 are answer. These 2 are relatives. Because Mr. P is having sole proprietary business ante P is controlling the entire business kada. So he is controlling A Limited. He is also having control on his sole proprietary business. And hence these 2 things are also relatives. Respond clear. Now Mr. P is having 70% in A Limited. Mr. P's brother is having a partnership firm. Now these 2 things, relatives, because brother is relative. If brother-in-law, then these 2 things are not relatives. Hope the concept is absolutely clear. Now Mr. P is having 70% in A Limited and Mr. P is a normal director in K Limited. A and K Limited. Let me tell you KMP definition. Key managerial persons are those people who are having authority and responsibility over planning, directing, controlling on the operating and financial policies on the enterprise. Here I have told a normal director who is not satisfying the definition of KMP. KMP should have authority, responsibility over planning, directing, controlling. Sir, there's no such thing that every director is a KMP. How a small shareholders director can become a key managerial personnel of the company? Small shareholders director is never a KMP of the company. Hope the concept is clear. Now answer me. These two are not relatives. Clear. Point number 1. Mr. P is not at all a relative to P Limited. K Limited. Mr. P is not at all a relative to K Limited. Then how A and K will get relatives? Say if he held it, CEO. Now relatives. Because Mr. P is a KMP in K Limited. Logic clear, everybody? So that is all about the relationships. Now moving on to the next thing, non-applicability. Sir, non-applicability implies they are relatives, but AS 18 is not applicable. Okay, what is non-applicability? They are relatives, but AS 18 is two companies having a common director. Not relatives, not related parties at all. Don't confuse that AS 18 is applicable. Exception. If at all he is KMP in both the companies, then they are relatives. They respond clear. Next one. A single supplier, single distributor, single franchisor, single agent. Simple. I'm having only a single person. That single person might not be relative. Of course, he's controlling to the extent of some portion, but he's not controlling all the operating and financial policies. Say you're having a single supplier. Supplier is telling, you fix the selling price only for 2000 rupees. Only then I will sell a product. Ever know? Supplier, how can supplier control on selling price of my product? He can ask like this, pay me 1500 rupees, only then I will sell you. He can control only on the selling price of that product, but he can't control the selling price of final output. I hope the logic is clear. A single person can also be not relatives. Next, other parties who are having limited control, like providers of finance, who given you the loan, trade or workers union, public utilities. Public utilities are nothing but water facilities, electricity facilities, etc. And government sponsors who had given you the government grant. They are not having any control on your enterprise. Sir, government can control only with respect to that grant. This grant has to be used only for this purpose, but it cannot control the entire company, kada. I hope the concept is clear. And these three parties are not relatives. Take care. AS 18 is not applicable. Now the next one. Exemptions for disclosures. Sir, they are related parties here, but no need to disclose. Under non-applicability, straight away they are not related parties at all. Even though they are related parties, AS 18 is not applicable. Sir, point number 1, under non-applicability, they are not at all related parties. Even though related parties, AS 18 is straight away not applicable. Now exclusion law, they are related parties, but no need to disclose. Who are those? In the matters of confidentiality, law is asking you, statute is asking you, you are having specific contracts and agreements. So you have to maintain some confidentiality, and hence you are not supposed to disclose. Next, while preparing consolidated financial statements. Sir, while preparing consolidated financial statements, elimination of ICTs, intercompany transactions, or elimination of mutual owings. Hope you have remembered. Why you are eliminating? Because everything is belonging only to a group company, single company. And hence, remember my dear children, while preparing CFS, transactions between holding and subsidiary, no need to disclose at all. Transactions between government enterprises, State controlled enterprises are nothing but government companies. Sir, government companies might be having many secrets and many confidential things. You can't ask them to disclose each and everything. That is practically not possible because they are involved in many confidential elements. Clear, everybody? Now, listen very, very carefully. The last and final example of ASIT. Say, for example, Mr. P is CEO of a bank, and also Mr. P is having an account in the bank. Mr. P is depositing, Mr. P is withdrawing some huge amount from the bank. And also to Mr. P, bank is paying huge amount towards salary. Understood? Frankly speaking, P is depositing and withdrawing from his bank account. Will these things are related party transactions or not? No. Why no? Mr. P is a CEO. P is a related party to the bank. No. Exceptions are secondary. Primarily, every deposit and every withdraw is a related party transaction. Clear? But no need to disclose the same by the bank. Because Banking Regulation Act 1949 law is asking you to maintain confidentiality. Understood, everybody? And hence no need to disclose each and every deposit item and each and every withdrawal amount. But remember, whatever the salary that is paid by bank to Mr. P, then it has to disclose the same. Ante simple. Did you remember partnership? Partners loan is separate, partners capital is separate. In the same way, those transactions which are done by Mr. P in the position of CEO has to be disclosed. Those transactions which are done by Mr. P in the ordinary customer, no need to disclose. Is the logic clear? If at all P is doing any account in a ordinary customer, doing transactions as an ordinary customer, no need to disclose. But if at all Mr. P is doing anything as a position of CEO, then that must be disclosed. Respond clear. Last and final clarification. A is having 60% in B Limited and B is having 20% in C Limited. Or A and C relatives are not relatives. Something like A is having in B 60%, A is having in C how much percent? 20%. You're not supposed to tell 60% of 20% is equal to 12%. You can't claim A is having indirectly only 12% in C and hence A and C are not relatives. This is wrong. In one of the RTPs of institute material, they have given like that. But that concept itself is wrong, and since whatever the subsidiary that I had invested, indirectly holding is also having the total power. But remember, while preparing consolidated financial statements, 12% is correct. I hope you have remembered. For deciding whether he is relative or not, never take percentage of percentage. For deciding whether he is relative or not, never take percentage of percentage. But for preparing consolidated financial statements, you have to take percentage of percentage. Respond, everybody clear? And my dear children, that is the end of accounting standard number 18. And let me start with the next chapter, that's all about consolidated financial statements. So consolidated financial statements will be prepared by the holding company by considering the group companies. As per, sir, normally group companies includes holding company, subsidiary company, associate company, joint venture company. But as per accounting standard number 21, group companies includes only holding company and subsidiary company. Remember. So consolidated financial statements as per accounting standard number 21 will be prepared only for the group companies. That is the combination of holding company and subsidiary company. So in a single word to tell, consolidated financial statements of the group companies is equal to standalone financial statements of holding company plus standalone financial statements of subsidiary company minus intercompany transactions, or in some others language it will be nothing but mutual owings. To tell you mutual owings is a result of intercompany transactions. I mean to tell, holding company might have transacted with subsidiary company. So this is a transaction between the companies, which is nothing but intercompany transactions. But since these two companies are within the same group, this is called as intra-group transactions. Now ultimately, because of these transactions happened, there will be something called as mutual owings. Holding has to pay to subsidiary company, subsidiary has to pay to holding company. This intermutual owings will arise only when there are transactions between holding company and subsidiary company and holding company. Clear everybody with point number 1? Is it clear? Now listen carefully. Sir, under consolidated financial statements, first of all, we'll be learning about consolidated balance sheet, and then we will be coming back to consolidated P&L account. Coming to consolidated P&L account, your institute material is having only one problem. And in examination, he has asked a totally a different problem. Even in examination problem versus institute problem, for solution, there's a different way of, there is a different approach for solving. I'll tell you a uniform approach for that. And let me come back to consolidated balance sheet first. Consolidated balance sheet. Generally, if I was not wrong, everybody of you might have learnt in stepwise approach itself. But here and then somewhere steps will change up and down, down and up. Apart from that, everything is normal itself. So let me start. Step number 1 is basic data. Under basic data, hey, are there anybody who learnt in 4C approach? 4C approach. Okay, fine. Step number 1 is basic data. Under basic data, you are having 4 things actually. Date of acquisition, date of consolidation, percentage of holding interest, and percentage of minority interest. So these are the 4 things that you're going to hear. Date of acquisition is nothing but date on which holding company acquired the shares in subsidiary company. Date of consolidation will be generally at the end of the year. Percentage of holding interest is nothing but major part is blocked here and minor part is with the outsiders, which is nothing but minority interest. Clear everybody? And now coming to the next one, as I used to tell that this is the heart of consolidation. If step number 2 is wrong, 3 will be wrong, 4 will be wrong, 5 will be wrong, 7 will be wrong, 8 will be wrong, CBS will be wrong. So please listen very, very carefully. This is very, very, very important step. Step number 2, which is nothing but analysis of reserves and surplus of subsidiary company by holding company. And all the reserves and surplus were actually analyzed into pre and post. So listen very carefully. Sir, even though you have learnt in a different style, you can follow this one because it's going to be easy. Of course, once or twice practice is required. Now listen. Generally, what are all the reserves that you are getting in this point, in this chapter? Sir, basically, you have to take the reserves and surplus, and the reserves and surplus have to be separated into 2 parts. Number 1, till the date of acquisition, and number 2, after the date of acquisition. Till the date of acquisition is nothing but pre, after the date of acquisition is nothing but post. But almost in all our problems except in one problem, date of acquisition happened in current year only. So your reserves and surplus can be like this. Separate them. Take the closing balance first and then separate it into opening balance and current year. Opening balance is always pre. Since the date of acquisition happened in the current year, till the date of acquisition let it be pre, and after the date of acquisition let it be post. Respond everybody clear. This is all about reserves and surplus of dash company, subsidiary company. So you have to analyze the reserves and surplus, all the reserves and surplus of subsidiary company. Respond everybody clear. Now let me tell you in detail. Point number A. First of all, generally we might analyze P&L account. This P&L account of dash company amma, subsidiary company. Take dash balance and closing balance. Separate it into two parts amma. Number 1, opening balance. Number 2, don't go like that immediately. Read the question carefully. Sometimes in the question he is giving that from the opening balance of P&L account, company is declaring the dividend. So from this you have to deduct pre-acquisition dividend. Which dividend has to be deducted, amma? Pre-acquisition dividend, which is nothing but total dividend declared by subsidiary company has to be deducted here. And then you will be getting the net balance. Now you take the balancing figure, which is nothing but current year portion, and declare this as pre. From current year portion, again you make into two parts, till the date of acquisition, after the date of acquisition. My dear children, if the date of acquisition is at beginning of the year, then entire current year will become post. If at all the date of acquisition is at the ending of the year, entire current year will become pre. Ante kada? If date of acquisition is during the year, some portion will become pre, some portion will become post, depending upon the number of months. Clear everybody? And so ultimately pre and post depending on number of months. And you add these two things, which is nothing but capital profit. And whatever the post concept is there, this is nothing but revenue profit. Clear everybody? And my dear children, this is all about P&L account in a single stretch. More than this, you will not get any other adjustment. More than this, you will not get any other adjustment. This is the final adjustments that you're going to get here. Shall I proceed further? And moving on to the next one, after P&L account, let me go with general reserve. Again same, take dash balance of general reserve, closing balance of general reserve. You have to separate into dash and dash. Opening balance and current year. Again same, listen very, very carefully. Now what happened? In one of the questions it was given that opening balance, no balance is given in the question. So if no opening balance is given, assume that opening balance is equals to closing balance, and hence current year will be absolutely 0. This is very important note. Now you take the opening balance here. In one of the questions, if you observe, very clearly given that company had declared bonus issue. So from opening balance, you have to deduct bonus issue, which is declared by subsidiary company. So deduct the bonus and then you will be getting the net, and the remaining will become balancing figure if any. Again, it has to be separated into pre and post. The opening is always called as pre. And now finally, this pre is nothing but capital profit. This post is nothing but revenue reserve. Name is different. For P&L account, we will call it as revenue profit. For general reserve, we will call it as revenue reserve. But if at all you have learnt even the same is revenue profit, then you can continue like that. But strictly speaking, it is not revenue profit, it is a revenue reserve. Respond everybody clear. One more adjustment is there in general reserve. In one question, we have to take general reserve closing balance and then separate it into opening and current year. In that question, opening is actually 0. Current year, you are having some portion given. Minus, company had given bonus issue out of current year portion of general reserve. Very clearly given in the question. In the sense, bonus might be declared either from opening balance or bonus might be declared either from current year portion also. Respond everybody clear. And this is the ultimatum adjustment with respect to general reserve. More than this, you will not get any other adjustment in general reserve also. Respond everybody understood. Now let me proceed to point number C. What is point number C, sir? Revaluation reserve. In some of the questions, you will be seeing something like asset gets revalued. Did you remember? In some of the questions, you will be seeing something like asset gets revalued. Sir, whose assets are getting revalued? Subsidiary company assets are getting revalued. So upward revaluation is nothing but revaluation reserve. Downward revaluation is nothing but loss kada. So ultimately, you are getting affected with respect to the profits of dash company, subsidiary company. If subsidiary company reserves and profits are affected, straight away put only in step number 2. Logic clear, huh? If dash profits are getting affected, subsidiary profits are getting affected, straight away you have to record in dash step, step number 2. So let me start with revaluation reserve here. First, sir, please be very, very careful. Check out the opening balance of fixed asset. And automatically you have to check out the revalued figure. Am I correct or wrong? But please be careful. In one question, it is totally different. Because your opening balance is 1-1 or say for example 1-4, whatever, 1-1 or 1-4. And the date of acquisition happened exactly at the mid of the year. Did you remember? Date of acquisition happened exactly at the mid of the year. So how to find revaluation reserve ante? First of all, take the opening balance of the fixed asset and then provide a depreciation. From which date to which date, sir? Year starting to date of acquisition. Provide the depreciation. Then you are going to get WDV as on the date of acquisition. Sir, say for example, if this part is not there, then better don't do that one. I mean to tell, if date of acquisition is starting of the year. If date of acquisition is starting of the year, will you have any depreciation once again? No depreciation. So don't do that one at that point of time. Clear? So check out. If date of acquisition and year starting are different, then automatically you have to provide depreciation for that time period. And find the WDV as on the date of Chappali, find the WDV as on the date of acquisition. And moving on to very, very important thing. After finding WDV as on the date of acquisition, you have to compare it with revalued figure. And then check out whether is it upward or downward. If it is upward, we will call it as capital profit. If it is downward, we will call it as capital loss. Just represent the same in a negative balance. Respond understood. One more thing. Say for example, you might have two assets which are getting revalued at the same point of time. Then do for asset 1, do for asset 2 and take the net portions. Say for example, from asset 1 you got revaluation upward 1 lakh. From asset 2 you got revaluation downward 20,000. So set off these two things. Revaluation upward 80,000. Call it as capital profit. Respond everybody clear. 99.99999% revaluation will always become capital item only, because holding company is revaluing subsidiary company assets only at the time of acquisition but not after the time of acquisition. Clear everybody? Who is revaluing? Whose assets are getting revalued? At the time after the acquisition. Since it is at the time of acquisition, it will be obviously capital profit or capital loss. Respond everybody clear. And this is all about revaluation reserve. So how to find revaluation reserve? First of all, you have to find the opening balance. Then you have to provide the depreciation from year starting to date of acquisition. If year starting and date of acquisition is same, then no need to provide depreciation. And then find the WDV as on the date of acquisition. And now compare it with revalued figure. If it is upward, it is called as a capital profit. If it is downward, it's called as a capital loss. Respond everybody clear. If there are more than one assets, then you can do set off. Then you can set off and you can find the net figure. Respond everybody clear. And after point number C, now we have to go with point number D. Not yet over. Still we are learning step number 2. So till now what are the things that I told in step number 2? Number 1, P&L account. Number 2, general reserve. Number 3, revaluation reserve. Now number 4, very very important, depreciation on revalued assets. What is the next one, Nana? Depreciation on. So how to find it? Sir, please don't straight away compute. I mean to tell, don't take capital profit here and multiplied by rate of depreciation. That's wrong. All the time that logic will not be working out. All the time that logic will not be working out. So what to do then, sir? How to find depreciation on revalued assets? Depreciation on original value, or it is also called as depreciation already provided by subsidiary company. From which date to which date, sir? From date of acquisition to year ending. My dear children, here from year starting to date of acquisition. Clear? Now you have to provide depreciation from date of acquisition till year ending. Respond, everybody understood? So provide, check out depreciation which is already provided. Already provided by subsidiary company from date of acquisition till the end of the year. Now you have to compare it with depreciation on revalued figure. Check out, say if this depreciation on original value is 10,000, on revalued figure is 12,500. Then you have to provide 2,500. Say if original depreciation is 10,000 and you need only 8,000, then you have to write off 8,000. Sorry, you have to write off 2,000. Clear, everybody? Again same, you might have more than one asset here. Do the set off and take the net figure. How, sir? Provide 2,500 ante it is decreasing the revenue profit kadamma, which is nothing but revenue loss. Write off the depreciation 2,000 ante it's like a profit kadamma, because depreciation is getting decreased and your overall profit will get increased, and hence this is nothing but revenue profit. Take the set off figure, revenue loss, which is nothing but 500. Represent the same in negative figure. Respond, everybody, pakka. This is all about point number D. Step number 2 is not yet over. There is one more thing. That's all about point number E, which is nothing but unrealized profit on upstream or downstream. In step number 2, we will consider only those items which are affecting the profit of subsidiary company. Remember, my dear children, holding is always at top, subsidiary is always at bottom. So if holding is selling to subsidiary company, we will call it as downstream. If subsidiary is selling to holding company, we will call it as upstream. Now if holding is selling to subsidiary company, listen carefully, if holding is selling to subsidiary company whose profits are affected, holding company profits are affected. Holding company profits are there in step number 7. So we don't touch right now. Now if subsidiary is selling to holding company, subsidiary profits are getting affected, which is there in step number 2. So we will be doing only unrealized profit on upstream here. Is it clear? Some of you people might be doing the same in step number 3. Finding unrealized profit, and again you will be doing multiplication. Multiplied by holding interest multiplied by minority interest. You will be finding it separately while doing minority interest and while doing holding interest. That is in step number 4 and step number 5. So did you understand what am I telling? I mean to tell, some of you people might have done like this. Like what, sir? Sir, this unrealized profit on upstream has to be apportioned between holding interest and minority interest kada. So minority interest is there in step number 4. So after finding all the minority interest, share in share capital, share in capital profit, share in revenue profit, share in revenue reserve, minus unrealized profit. Hope you have remembered. You might have done like that, but the best option is to do here itself, because duplication work will be eliminated. In step number 4, you might forget the same, or in step number 7, you might forget the same. But here itself, you have done this. This will become the simplest thing ever. So please remember, unrealized profit on upstream has to be computed in step number 2. This has to be eliminated kada. This has to be eliminated kada. Revenue profit has to be eliminated ante, which is nothing but revenue loss. Profit is getting decreased, which is nothing but revenue loss. Intaki, how to compute it, sir? Very simple. Unsold stock multiplied by, in all our problems, it was something like rate by 100 plus rate. But be careful, in the examination, it might be a different thing. Hope you have got my point. In all our existing institute material and all the problems, it was given like unsold stock multiplied by rate by 100 plus rate. It was given like that only. But be careful, in the examination, it can turn out to rate by 100 also. Hope you might have understood my intention. 55,000 into 20 by 120. Like that we have solved. Be careful. Be careful with the terminologies that were given in the question. It might change in your examination question. So be very, very careful. Check out whether the percentage of profit is expressed on cost price or selling price. If it is expressed on cost price, then rate by 100 plus rate. If it is expressed on selling price, directly you can do rate by 100. Logic clear, everybody? But in all our question, it was expressed only on the cost price. But this is nothing but selling price. And hence unsold stock multiplied by rate by 100 plus rate. How much ever you get, we will call it as a revenue loss. Okay, how much ever we get, we will call it as a revenue loss. Respond everybody clear. And represent the same in a negative figure. And my dear children, this is the end of step number 2. Wherever, whichever problem you go, more than this, you will not get a single item. You know, of course, I can't give the same guarantee for the examination, because in your examination, some minute differences might be there. But to the maximum and most of the extent, these are all the maximum items that you are going to get in step number 2. Tell me, in step number 2, you can get P&L account, general reserve, revaluation reserve, depreciation on revalued figures, unrealized profit upstream. What is considered, Nana? Unrealized profit upstream is there in step number 2. Downstream will be there in step number 7. Downstream is there in step number. Remember, upstream is there in step number 2. Downstream will be there in step number 7. Respond everybody pakka. Instead of doing 2 to 3 times multiple adjustments, if you have done here, for further steps it will become very, very easy. How further steps it will become easy? Once if I have done, you will get clarity. Anyways, shall I proceed further, everybody? Now, step number 3. That's the reason I told there will be little differences for what you have learned and for what I am teaching. The minute differences, you will be able to understand those things very easily. But concentrated, you will get very easy tranches at last. And let me start with step number 3. What is step number 3, Amma? Apportionment of reserves and surplus, or apportionment of profits. Now listen very carefully, everybody. Something like, take all the list of items, whatever you have got in step number 2. What we have got, sir? Number 1, P&L account. Number 2, general reserve. Number 3, revaluation reserve. Number 4, depreciation. Number 5, unrealized profit. Now you will take this one also. They respond clear. And you just separate it into capital profit, revenue reserve. If you have considered these two things as one and the same, just maintain one column only. Understood? I told you, for P&L account post, we will call it as revenue profit. For general reserve post, we will call it as revenue reserve. But while learning, if you have learned these two things are one and the same, you just maintain only one column until now. Respond understood. Now listen, P&L account, capital profit, revenue profit. General reserve, capital profit, revenue reserve. Revaluation reserve, always capital profit. Depreciation, always revenue profit. It will never become capital. Unrealized profit, always revenue profit. Understood? Now the next one. If they are profits, put it in positive figures. If they are losses, put it in negative figure. Say, what can become loss? P&L account can become loss. So put the same in Cheppali, negative figure. General reserve will never become negative, sir. Either it will become 0 or it will become a positive figure. Revaluation reserve, it can become a negative figure. Depreciation, it can become a negative figure. Unrealized profit, it is always a negative figure. It can kadu, it is always a negative figure. Respond everybody clear. So automatically now you are going to get the total. So take the total and distribute this total between holding interest and minority interest. Respond everybody clear. Sir, I'm pretty sure and challenging to you, if you try of solving one problem in this nature, this methodology will become very, very easy for you. There will be no confusion at the end for sure. You can try if needed. Anyways, holding interest and minority interest, you have to separate between each and everything. Respond everybody clear. So this is called as a pre-holding interest and this is called as post-holding interest and this is nothing but total minority. Clear everybody? And that's all about step number 3. Sir, whatever that was recorded in step number 2 has to be transferred to step number 3. Just segregate like capital and revenue, and if it is profit, put a positive figure. If it is a loss, just put a negative figure. And in step number 2, to the max extent, you will get 5 items: P&L account, general reserve, revaluation reserve, depreciation, unrealized profit, upstream will come there. Clear everybody? And let me continue with step number 4. Step number 4 is nothing but aggregate of minority interest. What you are going to get here? Number 1, share in share capital. Number 2, share in capital profit, share in revenue profit, share in revenue reserve. As I said, if you people have maintained these two things at one and the same, you will get simply share in revenue reserves. Respond everybody clear? And sir, no need to deduct unrealized profit now. Already deducted in step number 3. So otherwise what you will be doing ante, you will find unrealized profit 5,000 multiplied by minority interest has to be deducted at this point. That is obviously a big headache. You can forget there. So since already you have deducted in step number 2 and 3, you just distribute the final profits. That is highly enough. Respond everybody clear? And one more very, very important thing, in one of the questions, you will be having preference share capital also. If you have remembered, share in equity share capital will be total share capital of subsidiary company multiplied by minority interest. Now check out the preference share capital. In that question, holding interest in preference share capital is 0. Because to get control, no need to hold preference share capital. Holding equity share capital is highly enough. Am I correct or wrong? And hence my dear children, preference share capital by holding company in that question is absolutely 0. Understood everybody? So now what happens? If holding interest in preference share capital is 0, entire 100% of preference share capital is held by minority interest only. And hence share in equity share capital, share in preference share capital, share in capital profits, share in revenue profits, share in revenue reserves. And the total whatever you are having, that will be treated as a liability and it will be transferred to consolidated balance sheet. Respond everybody understood? After your small relaxation, let's continue with step number 5. Step number 5 is nothing but cost of control. Remember, listen very, very carefully. Under cost of control, you have to compare 2 items. Number 1, cost of investment. And after getting cost of investment, sometimes if you observe the question, Subsidiary company will be declaring the pre-acquisition dividend and holding company will be receiving the pre-acquisition dividend, and it will be doing it in a wrong way. So strictly speaking, pre-acquisition dividend will be reducing the cost of investment. Post-acquisition dividend will be increasing the profits or income of holding company. But sometimes holding company will be receiving the pre-acquisition dividend and it will be treating the same as post-acquisition dividend, and it is doing an error. Am I correct or wrong? Strictly speaking, pre-acquisition dividend entry should be like this: cash or bank account debtor to investment account. But holding company has done something like cash or bank account debtor to P&L account. Sir, already I told you one thing. Subsidiary company profits are available in step number 2. Holding company profits are available in step number 7. Holding company profits are available in step number 7. Remember that. Subsidiary company profits are available in step number 2. So, strictly speaking, holding company has to deduct it from cost of investment, but unfortunately it is adding to its P&L account, which is absolutely wrong. So now this has to be rectified. How it will be rectified, sir? What is the rectification journal entry, Amma? P&L account debtor to, since it did not deduct the investment, it has to deduct the value of the investment. And since unwantedly it had added it to the revenue profits of holding company has to deduct the same from its profits in step number 7. Remember that one. Of course, while coming to step number 7, I will tell you what to do. Clear? Even though you don't know the reason, just by holding mechanically, you can solve basing on this format. Absolutely no problem. Now let's come back. So step number 5, cost of control. Part 1 is nothing but cost of investment minus pre-acquisition dividend. This is nothing but rectification of error. Pre-acquisition dividend, which is nothing but rectification of error. Subsidiary company has declared a dividend which is nothing but pre-acquisition dividend. Subsidiary company has declared a dividend which is nothing but pre-acquisition dividend. Pre-acquisition dividend has to be deducted from the cost of investment, but unfortunately it is adding the same to the P&L account of holding company. Since it has done an error, the same error has to be rectified. How the error will be rectified, sir? Very simple. You have to deduct from investment kada. So deduct it from cost of investment in step number 5. You unwantedly you have added it to P&L account of holding company kada. So deduct it from P&L account of holding company in step number 7. I hope the logic is clear for you. And let's come back. Step number 5, which is nothing but cost of control. Roman number 1, cost of investment, and deduct pre-acquisition dividend if any error has been committed by the company. And after that you will be getting one figure. And then Roman number 2, which is nothing but value of net assets represented by share capital, and capital profit only must be considered, remember, which is nothing but share in share capital, share in capital profits. Clear, everybody? My dear children, once again no need to do the revaluation here. My dear children, once again no need to do the revaluation in step number 4. Because already you have perfectly computed the concept of revaluation in step number 2 and transfer it to step number 3. Multiple times computation will be not needed. It gets eliminated. Clear, everybody? And hence straight away share in share capital and share in capital profit. This share in share capital profit is as from step number 3. See here, I have shown you this one if you have remembered. This is nothing but pre-holding interest. This is nothing but post-holding interest. This is nothing but minority interest. Total minority interest is transferred to step number 4. Now I am picking pre-holding interest. This will be transferred to step number 5. Clear, everybody? So if you observe here, step number 5, you have got share in capital profits. Understood? And see the total. Now compare 1 and 2. If cost of investment is more, we will call it as capital loss and it has to be transferred to goodwill. If cost of investment is less, We will call it as capital profit and it has to be transferred to capital reserve. Respond everybody clear. So this is another important thing in step number 5. What is step number 5, Amma? Cost of control. And cost of control, you're going to compute cost of investment minus pre-acquisition dividend, if any. And the next one, value of net assets represented by share capital and capital profit. Share in share capital, share in capital profit. Once again, no need to do any other adjustments. No need to adjust revaluation reserve. Clear everybody? While doing step number 4, minority interest, no need to adjust revaluation reserve, no need to adjust stock reserve, unrealized profit, no need to adjust depreciation, because everything very subtle way we have done in step number 2. Anyways, and after comparing this 1 and 2, if cost of investment is more, we will call it as capital loss and transfer it to goodwill, and if cost of investment is less, it's capital profit, we have to transfer it to capital reserve. And now moving on to the next thing, step number 6, elimination of intercompany transactions or elimination of mutual owings. Some people will not be doing this step at all and they will be straight away representing the same in balance sheet. But the advantage of doing this step is you can eliminate notes to accounts there. Hope you have got my intention. If you have done this step number 6, no need to do notes to accounts at all. If you did not do this step, it is highly recommended to you to do with notes to accounts there. Clear everybody? This is the main difference between the other things and my thing. I'll be introducing this step. Some of the people will not be doing this separately and straight away you will be doing this in balance sheet. But at that time you have to open notes to accounts again. Anyways, let me take here elimination of intercompany transactions or mutual owings. Let me write all the items like debtors, creditors, bills receivable, bills payable, and also let me write stock. So that what happens now, balance as represented in holding company, balance as represented in subsidiary company minus intercompany transactions or mutual owings or unrealized profit. Even in balance sheet also you will be doing the same kada. Holding company balance creditors plus subsidiary company balance of creditors minus mutual owings. So did you remember? In balance sheet you will be doing holding company debtors plus subsidiary company debtors minus mutual owings. Holding company bills receivable plus subsidiary company bills receivable minus mutual owings. So instead of computing there, I am doing here itself. So anyways, take the amounts here and deduct intercompany transactions or mutual owings and deduct unrealized profit. And finally, you will get one net figure kada. You take that net figure and straight away transfer to consolidated balance sheet. That's it. Clear everybody? But to everybody, step number 6 is not mandatory. If you wish, you can do here. Otherwise, you can straight away do the same in consolidated balance sheet. Understood everybody? So now whatever I tell step number 7, to those people who did not do this step will become step number 6. Sir, whatever I am calling it as step number 7, to those students who did not solve this elimination of ICT step will become step number 6. Clear everybody? Sir, those who have done elimination of ICT, this will become step number 7. Those who did not do ICT, this will become step number 6. Intaki, what is this one, sir? Reserves and surplus for consolidated balance sheet. Reserves and surplus for consolidated balance sheet. Some of the people will be doing like this. Balance as mentioned in holding company's balance sheet. You will be taking general reserve of holding company plus P&L account of holding company and you will be putting the total here. For this one, you will be adding post-holding interest. Post-holding interest is nothing but in step number 3, you have computed this part kada, which revenue reserve of holding company. You will be taking revenue reserve of holding company and you will be putting the total here. And finally, you will be deducting unrealized profits. Am I correct or wrong? You will be deducting unrealized profit upstream here, unrealized profit downstream here, and also you will be deducting pre-acquisition dividend and also you will be deducting depreciation on revalued figures also. But that will become very hectic if you have kept these many steps at this point. Now, no need to deduct unrealized profit upstream because already deducted there. No need to deduct depreciation because already deducted in step number 3. So automatically your work will get less. Clear everybody? So now how to do this one? I'll separate it as P&L account and general reserve here also. But if you want, you can maintain a single figure. There's nothing wrong here. Clear everybody? Now, balance as mentioned in holding company's balance sheet. Take P&L account separately, take general reserve separately. Or if you want, you can club and take only one figure. Now for this one, I will be adding post-holding interest. There I have segregated into two parts if you have remembered. Revenue profit, revenue reserve. Revenue profit is nothing but P&L account. Revenue reserve is nothing but general reserve. If you don't want to classify it like this, take a single total. That is enough. Now, enough of doing only two adjustments. Adjustment number 1. Pre-acquisition dividend wrongly treated. Pre-acquisition dividend wrongly treated. Here you are having a rectification journal entry if you have remembered. P&L account debtor to investment account. You have to deduct it from investment account. And also you have to deduct it from P&L account of dash company. Holding company. And the same is there in step number 7 as per my style. As per your style, it might be there in step number 6. Respond everybody clear. So you have to deduct pre-acquisition dividend which is wrongly adjusted. And remember, you have to deduct unrealized profit downstream. No need to do upstream again. Unrealized profit downstream is highly enough. Because, sir, you might get a point. Sir, why one unrealized profit upstream is deducted there and why one unrealized profit downstream is deducted here? For your kind information, if you have remembered, your working will become very clumsy because unrealized profit upstream will be deducted only to the extent of holding interest. Unrealized profit downstream will be fully deducted. That will become a confusion again. But to eradicate that confusion, remember, holding company is always at top, subsidiary company is always at down. If holding is selling to subsidiary, we will call it as downstream. Total profits of holding companies are getting affected. So deduct from holding company profits. In which step holding company profits are there? Step number 7. As per some of the people, it will be there in step number 6. Next, listen very, very carefully. If subsidiary is selling to holding company, it is called as upstream. Whose profits are getting affected? Subsidiary company profits are getting affected. So subsidiary company profits are there in step number 2. So you have to compute in step number 2 only. Respond everybody clear. Total step number 2 is transferred to step number 3. And hence, since already there you have deducted, once again no need to deduct one part at minority interest, another part at holding interest. Respond everybody clear. Of course, to those people who have learnt it newly might be a bit different. But as per my knowledge, this style of computation will become very easy for you because there will be no confusions left out at all. I hope the concept is absolutely done. So take care. Just quickly answer me. Step number 2. Sir, a simple format apart from all the logics. Apart from all the logics, a simple format. Step number 2. Tell me what are all the 5 items available. P&L account, general reserve, revaluation reserve, depreciation, unrealized profit upstream. And next step number 3. Total step number 2 is transferred to step number 3. And at the end, you have to segregate between holding interest and minority interest. What is step number 4, Amma? Aggregate of minority interest. Tell me under aggregate of minority interest what you are going to get. Share in share capital. That is also share in equity share capital, share in preference share capital, share in capital profits, share in revenue profits, share in revenue reserves. Respond everybody clear. And the total of minority interest will be transferred to consolidated balance sheet as if it is a liability. And moving on to the next thing, Amma. Step number 5, cost of control. Tell me the first part. cost of investment minus pre-acquisition dividend if wrongly accounted. You have to compare this with Roman number 2. Share capital and share in capital profits of which interest? Holding interest. And if you come to a conclusion, if cost of investment more capital loss, it has to be transferred to goodwill. If cost of investment is less capital profit, it has to be transferred to capital reserve. Respond everybody, understood. And let me move on to step number 6. Some people are not doing step number 6. It's okay. Those people who are doing step number 6. What is step number 6, Amma? Elimination of CTs or mutual owings. You take the balance of holding company plus balance of subsidiary company minus mutual owings or intercompany transactions, and finally stock also you have to eliminate, which is nothing but unrealized profit, whether it is upstream or downstream. Respond clear, everybody. And step number 7. To those people who did not do this step, this will become step number 6. What is that, Nana? Reserves and surplus for consolidated balance sheet. You take the balance as mentioned in holding company plus post holding interest. Plus you have to take only post holding interest. Clear, everybody? And then minus pre-acquisition dividend wrongly treated, and finally minus unrealized profit downstream. That's it. Because since holding company profits are affected, holding company profits have to be deducted. Respond everybody, understood? This is all about the steps of consolidated balance sheet. Understood? And last and final, step number 8, consolidated balance sheet. One more thing, one small point. In step number 5, if you found capital reserve, in step number 5, if you find goodwill, straight away transfer it to consolidated balance sheet. But in step number 5, if you find capital reserve, bring to this step. Step number 7 or step number 6, so that you can add capital reserve here, so that the total figure can be directly taken to the consolidated balance sheet. The respond, is the logic clear? In step number 5, if you have got goodwill, straight away transfer the goodwill to consolidated balance sheet. In step number 5, if you got capital reserve, bring it to the last step, that is reserves and surplus for consolidated balance sheet. Respond everybody, understood? And last and final, step number 8, which is nothing but consolidated balance sheet. Share capital. Always share capital will be shown only with respect to holding company. Reserves and surplus, no need to do anything. Step number 7, there ends the matter. Minority interest, step number 4, there ends the matters. And next one, all other non-current liabilities you are having. If you are having creditors, clear everybody? If you are having outstanding expenses, if you are having dividend payable, if something is there in step number 6, represent it as step number 6. Bills payable, step number 6. Creditor, step number 6. Those elements which are not there in step number 6, I mean to tell elimination of ICT. Just do the line by line addition. Holding company data plus subsidiary company data. That's it. Those people who are not doing step number 6, they just need to deduct intercompany transactions or mutual owings. Respond, understood? Now coming to assets, Amma. Coming to assets, everything is same again. Everything is same, but be careful, PPE. Holding company balance plus subsidiary company revalued figure minus subsidiary company revised depreciation. This is important. Holding company balance plus subsidiary company revalued figure minus subsidiary company revised depreciation has to be considered. Remember. Okay, respond, understood? And next one, any cost of investment will not come here, because in place of cost of investment you will be getting either goodwill or capital reserve. Goodwill will be shown in intangible asset. If it is capital reserve, it will be shown in reserves and surplus. And last and final, all other assets. Simply if it is there in step number 6, bring the same from there. Otherwise simply line by line addition. balance of holding company plus balance of subsidiary company minus intercompany transactions if any. Respond everybody, understood. This is all about consolidated balance sheet. But you're having one special point here, that is all about if minority interest is negative. Hope you have remembered. If minority interest is negative, how to treat it? So as long as minority interest is positive, that is step number 4 is positive, it has to be transferred to consolidated balance sheet and it will have to be shown as a liability. If at all aggregate of minority interest is negative, then remember this has to be adjusted against the reserves and surplus of holding company. Further profits, if any are there, will be first enjoyed by holding company, and first it has to set off. Only the balance has to be attained to minority. Respond everybody, clear? Sir, negative minority interest. Can you show negative minority interest in consolidated balance sheet? Negative minority interest has to be adjusted against the reserves and surplus of holding company, and minority interest will be shown as 0. But to that extent of negative minority interest which is borne by holding company, in future if any profits are there for subsidiary company, first of all those profits will be enjoyed by the holding company, set off, and only the balance shall be given to minority. Respond everybody, clear? Huh? So this is negative minority interest. Be very careful in this area. Okay, fine. Again same, relax for 3 to 4 minutes and then I'm going to tell you the different adjustments relating to consolidated balance sheet. Different adjustments relating to consolidated balance sheet. Sir, if you observe this one, Z Limited declared and paid 20% dividend on its equity shares as at 31st March 2011. Face value of share is rupees 10. X Limited purchased shares of Z Limited at rupees 20 per share. Find the dividend if the cost of investment is 70 lakhs. Hope you have remembered this one. You're one of the questions where you will be generally confused and you will be doing directly 70 lakhs into 20%. Hope you have remembered. You'll be confused a bit and you will be straight away computing 70 lakhs into 20%. But that's wrong, because dividend is always given only on the face value. So your cost of investment is 70 lakh and per share value is nothing but 20 rupees. So 70 lakhs divided by 20 rupees, which comes to 3,50,000. So 3,50,000 equity shares multiplied by rupees 10 is the face value, multiplied by 20%, which comes to rupees 7 lakhs. Respond everybody, clear? This is all about point number 1. Be careful. Reason behind incorporating this adjustment, don't compute dividend on 70 lakhs. And let me move on to the next thing, how to treat negative minority interest. Already I have told you, negative minority interest has to be adjusted against the reserves and surplus of holding company. Be careful. And next, let me go with point number 3. If you have remembered, I told you 2 assets will be there. So machinery book value is 2 lakh, but revalued to 3 lakh. 2 lakhs to 3 lakh, upward or downward? Upward. How much is upward? 1 lakh. So it is called as capital profit. Furniture 40,000 to 30,000. Downward. So which is nothing but capital loss. Set off this 1 lakh and 10,000, net amount you will be getting 90,000. Understood everybody? And check out point number 4. And yes, of course, depreciation. So you have to provide depreciation also. How to provide depreciation? Depreciation on original figure, that is 2 lakhs into 10%, which comes to 20,000. Depreciation on revalued figure, 3 lakhs into 10%, 30,000. In the sense you have to provide 10,000 depreciation. Whereas for the other thing, you have to write off the depreciation. So simply set off. Understood? Now moving on to point number 4. Be careful. I told you sometimes the date of acquisition is different from date of year starting. At that time, you can't take direct comparison. Check out. Plant and machinery stood at 1,50,000 on 1st January 2011, which is considered as worth rupees 1,80,000 on 1st July 2011, which is nothing but revalued. And the date of acquisition is 31st December 2010. Date of acquisition is 31st December 2010, which is nothing but 1st January 2011. Respond, is it clear? So now tell me how much is the revalued figure. So can I tell 1,50,000 minus 1,80,000? That is what I am telling. 30,000 is wrong answer. Because year starting is different and date of acquisition is different. Hey, one second. Make the date of acquisition. This is wrong here. Date of acquisition is 1st July 2011. My dear children, one second. Make the date of acquisition is 1/7/2011. Clear everybody? Now check out. Sir, what is the opening balance of your machinery, Amma? 1,50,000. As on the date of acquisition, what is the machinery value, Amma? 1,80,000. So can you compare directly? 30,000 is a revenue profit. 30,000 is a revaluation profit. No, you can't tell like that. First take 1,50,000 and then provide depreciation right from year starting to date of acquisition, and then you will get one net figure, and then this has to be compared with 1,80,000. Respond, everybody understood? Pakka. And next, you have to provide depreciation on the same kada. Even at the time of providing the depreciation on the same, depreciation already provided. My dear children, depreciation is already provided on 1.5 lakh. Original figure kada. 1.5 lakh into some rate of depreciation multiplied by date of acquisition till year ending. And you will get another 6 months there. Sir, is it understood? 1/1 year starting, 1/7 date of acquisition, 31/12. This is nothing but year ending. This is year starting. Here the value is 1,50,000. Here they are telling that I don't know how much is your value, but you have to make it at 1,80,000. This is what holding company is telling. But subsidiary company had already provided depreciation on 1,50,000. Clear everybody? Say for example, let me take the 10% is the depreciation rate. So 1,50,000 into 10%, which comes to 15,000 is the depreciation. So the balancing figure will become 1,35,000. Let me take this as closing book value. Respond, is it clear? Now the biggest point, listen very carefully. So from 1/1 till 1/7 until year starting till date of acquisition, depreciation is equal to 1,50,000 into 10% into 6/12, which comes to 7,500. So 1,50,000 minus 7,500, 1,42,500. So now it stood at 142,500, where the value should become 1,80,000. Ante upward you have got 37,500, which is nothing but revaluation profit. So it is nothing but capital profit. Respond, everybody, clear? Now let me start with the depreciation. Depreciation already provided by subsidiary company on 1,50,000. So depreciation already provided from, sir, for whole of the year subsidiary provided depreciation kada. So 1,50,000 into 10% into 6/12. But this 6 months is 1/7 to 31/12. Sir, is the logic clear? Don't be in a wrong notion that this 6 months is 1/1 to 1/7 from date of acquisition till the year ending. Again, one more thing, my dear children, you are not supposed to compute depreciation on 1,42,500. That is year between WDV. How will you compute on year between WDV? That's wrong. You have to compute on the year starting WDV. Respond understood. So automatically you are going to get another 7,500 is the depreciation. Now, revalued figure is 1,80,000. So they have to provide on 1,80,000 into 10% into 6 by 12, which comes to 9,000. So they have provided 7,500, but they have to provide 9,000. Automatically, 1,500 is revenue loss. Respond everybody clear. So be careful with this adjustment also. And check out this problem. Point number 1, cracking holding interest in this problem is very typical. Because if you observe, in subsidiary company, you are actually having 4,800 subscribed capital. Given in the question that holding company had acquired 180 lakh shares, face value is 10 rupees, so which comes to 1,800 lakhs. So if you have done a direct acquisition, direct divided by 1,800 divided by 4,800, 37.5%. But is it possible to have 37.5% as holding interest? Hope you have got the question. 37.5% as holding interest is absolutely wrong. So if you observe point number C, there was something called bonus. Okay. Anyways, let me go with the adjustment of these questions, so you might understand still in a better way. So H Limited purchased 180 lakh shares in S Limited on 30th March 2010 when the balances of general reserve and P&L accounts stood at 3,000 lakhs and 1,200 lakhs respectively, which is nothing but opening balances is given because 30th March 2010. But if you observe, the balance sheet is given on 31st March 2011. Ante 31st March 2010 is equal to 1/4/2010. So these two things are absolutely nothing but opening balances. Now, on 1st April 2010, S Limited declared a dividend. S Limited, subsidiary company declared a dividend. For the year ended 31st March 2010, until it has declared the dividend for the previous financial year. So, for the previous financial year, it will be declaring dividend from which account? From which account, Amma? P&L account. From which balance? Opening balance or current year balance? Because this is for the last year, it has to declare only from the opening balance. And H Limited, see, the hardest part, since it is from the opening balance, it is pre, right? So pre-acquisition dividend has to be deducted from the cost of investment. See, the Highness, H Limited had credited the dividend to its P&L account, which is wrong. Am I correct or wrong? And hence this is not to be accounted. I mean, that is an error. So you have to rectify the error. And next one, on January 1st, S Limited issued 3 fully paid up bonus shares for every 5 shares held. Very important. Out of the balances of general reserve as at 31st March 2010. So who is giving the bonus now? Subsidiary company is giving the bonus to all the shareholders in the ratio 3:5. For every 5 shares, 3 is the bonus shares given from dash account general reserve as at 31st March 2010. That is like opening balances of general reserve is given. Respond everybody clear, huh? And this is intercompany transactions. I'm ignoring this part because you can understand this very easily. Let me come to this one again. On 31st March 2011, take care, S Limited's inventory include goods which is purchased from H Limited. And who is purchasing from which company? Subsidiaries included, purchased from holding company. And who is selling to whom? Holding is selling to subsidiary. So this is dash stream, Nana. And purchased for how much price and Tamma? So S is purchasing for 100 lakhs. And H is selling for S is purchasing for 100 lakhs ante H is selling for 100 lakhs ani kada. So for H Limited, this is nothing but selling price. But unfortunately, the profit rate is given on cost price. 25% is on cost. And hence I told you, like all the time, unrealized profit is equal to unsold stock into rate by 100 plus rate. But be careful in the examination, this might be changed. At that time, it will become rate by 100. Hey, respond everybody clear. So first of all, biggest task in this question is to crack the holding interest. Check out very carefully. Your opening is 31st March 2010, or which is nothing but 1/4/2010. You have given the bonus on 1st January 2011. Clear? Antena? Year ending is 31st March 2011. Given that originally you are having 5 shares, I have given you a bonus of 3 shares, and hence at the end of the day you are having 8 shares. This is original, this is bonus, this is total. Now how many shares are there in subsidiary company? 4,800. On which date? 31st March 2011. And here you are having 480 lakh shares. 4,800, face value 10 rupees kada. So 480 lakh shares are there. Now, how much will be the bonus? Compute. 480 lakh shares multiplied by 3 by 8. 180. So automatically original balancing figure is nothing but 300 lakh shares. These are the shares data of dash company, subsidiary company. Now holding interest. Holding company purchased how many lakh shares? 180 lakh shares. On which date purchased? Very clearly given that it has purchased on 31st March 2010. Ante this lot. Purchased how many shares, Andi? 180 lakh shares. Plus it is getting some bonus kada. 180 lakhs multiplied by 3 by 5. 3 by 5. 108. So ultimately 288 lakhs. Respond everybody clear. So now check out the holding percentage. 180 by 300 into 100 or 288 by 480 into 100. 60%. But what you people have done previously, 180 by 400 lakhs. Correct or wrong? Wrong. Respond everybody clear. So let me, I don't solve this problem. I will solve a different problem by inputting many other adjustments. Concentrate on the screen. Sir, wantedly I have chosen more time for consolidation, and also amalgamation will be like this itself, because you need to get everything in a very exhaustive way with respect to these 2 chapters. In amalgamation, I won't solve any problem, but almost all I'll deal with each and every purchase considerations in every question. Anyways, let me speak out there whenever the topic comes. Now let me concentrate on consolidation. I'll input almost every adjustment here and I'll be solving. Straight away I'll be solving from step number 1. What is step number 1? Basic data. What is the date of acquisition given? 31st March 2010, which is nothing but 1/4/2010. And date of consolidation 31st March 2011. Percentage of holding interest. After doing this much working, you have come to a conclusion that 60% is the holding interest and percentage of minority interest. 40% will be the minority. Respond everybody clear. And let me go with step number 2. What is step number 2, my dear children? Analysis of reserves and okay. Let me start whatever the heading. First reserve. What is the first reserve you are having? P&L account. My dear children, you have to take which balance, Nana? Closing balance. What is the closing balance of P&L account given here? P&L account of subsidiary company 1620. So let me take here 1620. And I told you this has to be separated into dash and dash. Opening and current year. What is the opening given in the question, Nana? 1200 is the opening. Second, let me change the color. 1200 is the opening. Okay, now check out 1200 is the opening. So let me take the same here. Opening is 1200. I can't do directly balancing figure. Yes, see the question very clearly given that S Limited declared the dividend. So let me do here minus pre-acquisition dividend. But again $1,000 question, how much is the dividend? Sir, check out here. If you observe this one, subsidiary company data. Now subsidiary company is declaring the dividend at the rate 20% for the year ending 31st March 2010. Now tell me, so subsidiary company will be declaring the dividend on how much number? That's very important, not 480, because 480 is the ending 2011. It had declared the dividend ending 2010. So it is on 300 lakhs. Respond everybody clear. So straight away it will be something like 300 lakhs multiplied by face value 10 multiplied by 20%. 600 lakhs. So automatically opening will become 600 lakhs now net. Now this will become balancing figure, which is nothing but 1020 lakhs. Respond everybody clear. And answer me, this is nothing but pre. Am I correct or wrong? Sir, again current year you have to segregate between pre and post. Fortunately in this problem, your date of acquisition is starting of the year. Since your date of acquisition is starting of the year, total current year will become post. But say for example, if it is a different figure, again then you have to take number of months. Pre is to post. Respond clear. Anyways, let me come back here. So it's all about pre-0 this time. Post totally 12 months. So totally 1020 lakhs, which is nothing but post. Respond clear. Since this is P&L account, I will call it as a revenue profit. Understood with P&L account to each and every one. Let me move on to B. What is B, Nana? General reserve. Again, which balance I need to pick out, my dear children? Closing balance. How much is the closing balance of general reserve given? 1380. Let me take the same here. And you have to separate into two parts. Opening and current year. Let me check out what is the opening given in the question. 3000 lakhs. And very, very important. You don't take a harsh decision that current year negative general reserve is there. Yes, if you observe carefully in the question, company has declared bonus from general reserve balances as on 31st March 2010. And hence it will be something like this. Minus bonus issue. My dear children, how many bonus shares that subsidiary company is declaring? Is it 180 or 108? 180, then holding company got 108. Respond logic clear. Anyway, so it will become 180 into 10, which is nothing but 1800. So balance is? So now this will become balancing figure. 1380 minus 1200. 180 lakhs. And again same, again you have to check out pre is to post. But luckily in this problem pre is 0. Post is 12 months, and hence this will become your capital profit. This will become your revenue reserve. I will call it as revenue reserve, but if you want, you can call it as normally revenue profit. Respond everybody clear. And frankly speaking, this question is done with. But let me take one more point here in order to get better clarity. In this point, I'm even changing the date of acquisition also. Only for this point, in order to get better clarity, and I'm considering point number 4 in this situation. Okay, so check out very, very carefully what I'm going to do. Say the date of acquisition is on 1st July. And year starting, the book value of the asset stood at rupees 1,50,000. Rate of depreciation is equal to 10%. And as on date of acquisition, asset was revalued to 1,80,000. Now let me crack the scene. Opening balance as on 1/1/2010, which comes to 1,50,000. Now immediately I have to provide depreciation from year starting to date of acquisition, that is from 1/1/2017. Totally how many months you'll get, Nana? 6 months. On 1,50,000 multiplied by 10% multiplied by 6/12, which comes to 7,500. So automatically it will become 1,42,000, which is nothing but book value as on date of acquisition, that is 1/7/2010. Understood? Now at this time revalued. At what price it was revalued, Amma? 1,80,000. Now very, very important, from 140 to 180, upward or downward? Upward. So upward revaluation, how much it comes to? And which is nothing but capital profit. Respond, understood? If at all one more asset is there, do the same procedure. Check out whether is it capital profit or capital loss. If it is also capital profit, add. If it is capital loss, set off. Respond everybody, done. Now whenever this revaluation is there, automatically point number 4, you are having depreciation. My dear children, you might have solved this revaluation and depreciation at some other steps. But if you solve it in step number 2, it will become very easy. I've told you the different format. So now to get the easiness of that format, I'm solving and I'm showing you. And also it will be a good blend for you to revise the entire topic. So that after the completion of this class, frankly speaking, just you go with different adjustments, automatically right from CRD number 1 till your CRD number 9. I mean, not with consolidated P&L account. Apart from that, everything will be completed. And uniformity in accounting policies, you prepare by your own. Because that's a very small concept. Uniformity in accounting policies. You prepare by your own, you will get all the remaining things. Anyways, let me come back. Depreciation. Sir, depreciation on original figure or depreciation already provided. 1,50,000 into 10% into 6/12. But this is from date of acquisition till year ending. Ante 1/7 till 31/12. Respond, understood? Which comes to 7,500 again. Sir, please don't compute it on 1,42,500. That's wrong. Will you compute WDV for every half year? WDV is completed for every 1 year. So you have to take only that year. Respond, clear? And compare it with depreciation on revalued figure. What is a revalued figure, Nana? 1,80,000 multiplied by 10% multiplied by 6/12, which comes to 9,000. Respond. You still need to provide 1,500, which is nothing but revenue loss. Not capital, revenue. Revaluation is always capital. Depreciation is always revenue. Because depreciation is provided after the date of acquisition. Revaluation is done as on the date of acquisition. Respond, everybody, understood? And hence 1,500 is your revenue loss. Shall I proceed further? Now point number E. Let me take one more thing. Let me speak about upstream. Clear, everybody? Say upstream transaction, you are having 1 lakh into 25/125, which comes to 20,000. My dear children, upstream in the sense who is selling to whom? Subsidiary company selling to holding company. That will be done only in step number 2. Respond everybody, understood? Okay, sir, these two are the additional adjustments I have taken in order to make the concept understand in a better way. Shall I proceed further? Now, as usual, step number 3. What is step number 3, Amma? Apportionment of reserves and surplus. CP, RP, RR. If you want, you can make it only one column also. And this 20,000 unrealized profit kada, which has to be eliminated. Until this will become revenue loss. Shall I start now? Check out everybody. A. P&L account. What happened with P&L account? P&L account pre-capital profit 600, revenue profit 1020. Shall I continue? 600 and 1020 here and somewhere like 1020 here. And B. What is B, Nana? General reserve 1200 180. Check out CP 1200 180. That's the last column. Okay, respond, understood. C. Take the revaluation reserve. If you observe revaluation reserve, see, you got 37,500 capital profit. Am I correct or wrong? For the time being, I'm taking it as 375. I know the figures are separate, but I want to show you how the effect will be there. For the time being, I'm taking it as 375. A respond, understood. And this is revaluation. 1 second. Okay. Next point number D. Depreciation. If you observe depreciation, it's revenue loss 1500. 1500 rupees revenue loss. And in this column, you have to take it as a negative figure. Let me take it as 150 for the time being. Respond everybody, clear. And point number E, stock reserve. And stock reserve is also revenue loss, which is nothing but 200. Again, let me take it as 200 for the time being. Respond everybody, clear. Like this, after computing step number 2, you have to bring each and everything to step number 3. Now you take a total 2175 and this will become 670 and this will become 180. So now this has to be distributed between holding interest and minority interest at the rate 60% and at the rate 40%. 1305, 870, 402, 268 and finally 108, 72. And let me move on to step number 4. And my dear children, step number 4 is nothing but aggregate of minority interest. Check out very, very carefully. Number 1, share in equity share capital. One very important thing. Now the revised share capital is 4,800, my dear children. So 4,800 multiplied by 40%, which comes to 1920. And share in preference share capital, luckily nothing is there. Share in capital profit, share in revenue profit, share in revenue reserve, where it comes to these 3 things, Nana. 870, 268 and 72. If you would like to maintain a single column, you will get a single figure for these 2 things. And anyways, the total comes to 330, which has to be straight away transferred to consolidated balance sheet. Respond everybody, clear. And now let me move on to step number 5, which is nothing but cost of control. Cost of control, Roman number 1, you have to check out with cost of investment. Check out the cost of investment given in this question. Cost of investment is 3,000 lakhs. So take the same, something like 3,000. Take care. This company had done a wrong thing. Whatever the dividend received by H Limited was credited to its P&L account. So this is obviously wrong. Minus pre-acquisition dividend. Sir, Very important. In step number 2, subsidiary company declared the dividend and hence you have to take the total dividend. In step number 5, only holding interest is getting affected. So you are not supposed to take the total dividend. 600 into 60%. Only holding interest portion has to be taken here, which comes to 360. Where it comes to 2640. And finally, Roman number 2, which is nothing but share in equity, share capital, share in capital profit, which is nothing but 4,800 into 60%, which is nothing but 2880. And capital profit, you have to pick this one, which is nothing but 1305. Check out 4185. So check out, my dear children, cost of investment is less. So 4185 minus 2640, 1545, and hence you have to transfer it to capital reserve since it is capital profit. Cost of investment is less. Respond everybody clear. And now step number 6. This is your choice. If you want, you can solve. Otherwise, it's not needed. Even I'm not telling this one, because that's like holding company balance plus subsidiary company balance minus intercompany transaction or minus unrealized profits. So straight away, let me concentrate on step number 7. Step number 7 is nothing but reserves and surplus for consolidated balance sheet. Those who did not solve this step, that will become step number 6 to them. Now take care. Sir, I'll tell under 2 options. First, let me tell you normal way. I mean to tell, let me take P&L account separately. Let me take general reserve separately. Balance as mentioned in holding company's balance sheet. What is a balance mentioned in holding company's balance sheet, Nana? 2784 general reserve, 2715 P&L account. For this, I have to add post holding interest. So let me go for step number 3. See here, 670 and 180. Sorry, 402 and 108. 402 here, 108 here. Now very important. Only 2 adjustments will come. Minus pre-acquisition dividend wrongly treated. 600 into 60%, which comes to 360. Minus unrealized profit downstream will come. Downstream, that was given in the question, which is like 100 lakhs into somewhere given, yes, 100 lakhs into 25 by 125, 20. Respond clear, and you will be getting final figures. 2737, and this is nothing but 2892. Clear everybody? Ledu, you can also, how you will be doing? You will be adding these 2 figures. You will be adding these 2 figures. And these will be deducted separately. That's it. I hope you have got a crystal clarity with consolidated balance sheet. And of course, I can't tell 100%, but to the maximum extent, almost every concept and every topic is covered. But I told you uniformity in accounting policy is not covered. I don't cover that. That's a very simple and easy thing. You just solve the same. My dear children, revaluation point is not there in this problem. I have wantedly added that point in order to show you a better picture of the adjustment. Ante. Revaluation point ఈ క్వశ్చన్ లో లేదు. అది వాంటెడ్ గా నేను ఒక పాయింట్ యాడ్ చేసి ఎఫెక్ట్ ఇలా ఉంటుంది అని చూపించా అంతే. Just a clarification, revaluation, depreciation concepts are not there in this problem. To show you the effect I have taken, and also I have changed the figures even here. Just in line with these amounts, I have changed the figures in order to get some clear picture. Like this is how the effect would be. To show the effect, I have changed the figures. I have included the trivaluation point here. Your book, textbook answers and this answer will never get tally because this is totally a hypothetical point. And yeah, let me go with consolidated P&L account. Sir, first and foremost thing, people are concentrating on consolidated balance sheet right from step 1, 2, 3, 4, 5, 6, 7, 8 and they are leaving consolidated P&L account. But in examination, always a shock, they will ask consolidated P&L account. And at the end of the day, you will be doing wrongs and you will be coming out. But you know, consolidated P&L account is very easy when compared to consolidated balance sheet. First of all, for solving consolidated P&L account, you have to read the adjustments. Remember, always two elements will get eliminated. For one party, if it is debtor, for the other party, it is creditor. For one party, if it is bills receivable, for the other party, it is bills payable. For one party, if it is sales, for the other party, it is purchases. If purchases is not there in the question, better to eliminate the same from cost of raw materials consumed. The same point you will be having in your assignment problem. For one party, it is sales. And for the other party, it is purchases. If you did not find purchases, if you are not able to find purchases in the question, then better eliminate the same from cost of raw materials consumed. And for one party, if it is income, for the other party, it is nothing but expense. Say administration expenses will be in other expenses. Consultancy fees income will be in other income. Selling and distribution expenses will be in other expenses. Commission income will be there in other income. Hope the concept is clear. And one very, very special thing, that is all about dividend. If one party had declared the dividend, that amount has to be deducted only from appropriations. Say for example, generally who is investing in which company? Holding company is investing in subsidiary company. Clear everybody? Holding company is investing in subsidiary company. So who will declare the dividend? Subsidiary company will declare the dividend. So subsidiary company, say if it is declaring 100 rupees dividend, and if holding interest is 60 rupees and if outsiders is 40 rupees, no need to show 60 rupees now. Because 60 has to be paid only to the holding company. Only the amount due to the outsiders 40 rupees will be shown. So this time only one amount will get eliminated. Another amount will get eliminated in the next year. Because as per accounting standard number 9, dividend has to be recognized only when right to receive is established. Right to receive is established only when the dividend is declared. Dividend is declared in AGM. AGM will be held only in the next financial year after closing the books of accounts of previous financial year. Respond, is the logic clear? So this is one more point that you have to take care. So if any dividend is declared, then that declared dividend has to be deducted with respect to the holding interest. Only outsiders point has to be shown there. Respond clear. And one more thing, preference dividend will be there in one of your questions. Remember, treat this preference dividend as if it is like an interest. I mean to tell, preference dividend is given for 6 months. Let it be given only for 6 months. For the remaining 6 months, they will be given at the end of the year. Respond clear. Sir, treat preference dividend similar to interest. Ante, treat as if it is charge. For consolidated financial statements, it's one more peculiar point. For the purpose of solving consolidated financial statements, treat preference dividend similar at par with interest, which implies that preference dividend has to be treated as charge itself. Whether or not profits are there, you have to provide preference dividend. But show the same at appropriation place. Logic clear? Show the same at the place of appropriation, but you have to treat it as charge. Ante profit before appropriation 100. Now minus appropriation preference dividend 250. Yes, deduct total 250 here. Adenti sir, I can declare dividend only when profits are there. But remember Babu, that is preference dividend. For the purpose of consolidation, it has to be treated as if it is charged. Whether or not profits is there, you have to book the accounting treatment. In the sense, my profit had become negative 150. Yes, that's correct only. So this is treated at par with interest, which implies that it has to be treated as a charge. But it will be continued to be shown at appropriation. Respond, everybody understood? Now, the last and final part, how to solve the problems relating to consolidated P&L account. Sir, your CRD problem is solved in the following style. Your assignment problems were solved in the following style. First of all, let me tell you how CRD problem is solved. I mean to tell, your institute material problem is followed in the following style. Your examination problem, let me show you. This is the examination problem. X limited, Y limited is given, and if you have seen the adjustments, these are the adjustments which were given. This is one of the examination problem. Clear everybody? This is one of the examination problems. In these problems, he had followed the following style. Only for this problem, only for this type of problems, he followed the following style. What is that, sir? Step number 1, you just draft a consolidated P&L account. How to draft consolidated P&L account, sir? Sir, very simple. Expenses of holding company plus expenses of subsidiary company minus intercompany transactions or mutual owings. Incomes of holding company plus incomes of subsidiary company minus intercompany transactions or mutual owings. You prepare consolidated P&L account. And after that, step number 2, you have to prepare subsidiary company's P&L account. Why to prepare subsidiary company's P&L account? Listen very carefully. Here consolidated P&L account ante, you have considered the total data of holding company plus the total data of subsidiary company. Am I correct or wrong? But my dear children, consolidation is prepared by which company? Holding company needs to incorporate the total data of subsidiary, only holding interest. Question clear, huh? Sir, listen. Holding company had taken total data of subsidiary company. Total data of subsidiary company. You think with common sense. Holding company invested in 100% of subsidiary company, only to the majority share. Ante, holding company has to take only holding company's share. But it is also taking minority's share. Am I correct or wrong? And hence, from the total consolidated P&L account, you have to eliminate minority interest share of profit. And one more thing. If you have acquired this company in the current year during the mid of the year, then some portion will become pre, some portion will become post. Pre portion has to be adjusted against the cost of investment. In consolidated P&L account, you should not get that pre portion kada. Simply to tell you, please try to understand step number 7. What is step number 7, Nana? Reserves and surplus for consolidated balance sheet. Am I correct or wrong? Here what you have done, holding company's P&L account plus post holding interest is taken. And minority interest is not taken. Pre-holding interest is also not to be taken. Am I correct or wrong? But here you have taken the total data of subsidiary company. So you have to eliminate minority share of profit. And also you have to eliminate pre-holding interest. But how will I come to know how much is holding interest and how much is minority interest, sir? For that purpose, you have to prepare subsidiary company's P&L account. Respond logic clear, huh? Please try to understand. Step number 1, you prepare a consolidated P&L account. How to prepare consolidated P&L account, sir? Total expenses and incomes of holding company plus total expenses and incomes of subsidiary company. But I want only which data? Holding company total data plus post holding interest is only needed. But here you have taken the total data of subsidiary company. So what is extra taken, sir? Minority interest is extra taken. Pre-holding interest is extra taken. So eliminate minority interest and pre-holding interest from consolidated P&L account. Is the logic clear? So now how to eliminate minority interest and pre-holding interest? For that purpose, I am asking you to prepare step number 2, which is nothing but subsidiary company's P&L account. Is the logic clear? If you prepare subsidiary company's P&L account, you will be getting at the end subsidiary company's profit or loss. Then this subsidiary company profit or loss has to be proportioned between holding interest, minority interest. Again malla, pre-holding interest, post-holding interest. Eliminate minority interest and pre-holding interest from consolidated P&L account. Respond everybody clear, huh? So conclusion, consolidated P&L account minus minority interest profits minus pre-holding interest profit, or add minority interest loss. If profit is there, eliminate it by deducting, ra. If loss is there, eliminate the loss by adding. Non-cash expense has to be eliminated by adding. Correct or wrong? So add pre-holding interest loss. So you have to eliminate minority interest and pre-holding interest profits by deducting, and minority interest and pre-holding interest loss by adding. Respond everybody understood, huh? Now remember one more important thing. If any pre-acquisition dividend is there, it also has to be deducted. Because pre-acquisition dividend should not be there in consolidated P&L account, kada. Pre-acquisition dividend has to be deducted against cost of investment. So if any pre-acquisition dividend is there, it has to be deducted. Respond everybody clear. So this is what the adjustments that is to be done for those questions which are given in this style. This style, and you have to go through the question. Now listen. In the institute material, you were provided with one question, and that is of similar to this one. In this question, he had stopped just by computing consolidated P&L account. There itself the problem is solved. Is the logic clear? He did not separately compute subsidiary company's P&L account. He did not separate between holding interest and minority interest. He did not separate between pre and post. But logically speaking, this is to be done in order to get a good impression. Because we don't know for which kind of question in examination he is giving which kind of solution. So what I recommend is that even for this question also, you have to do like this. And what to do, sir, now? Prepare subsidiary company's P&L account. After that, find the profit or loss. Distribute between holding interest and minority interest. The luckiest part, in this question, holding interest is not acquired in the current year. Holding company acquired prior to the current year. So total is called as post-holding interest. So no need to eliminate anything, because you have to eliminate only pre-holding interest, kada. So post-holding interest no need to eliminate. Enough of eliminating minority interest. And there will be no pre-acquisition dividend also, because you have acquired prior to the current year. There's no pre-acquisition dividend also. Respond everybody understood. So this is the concept of consolidated P&L account. And in a conclusion mode, first you prepare a consolidated P&L account minus 3 things have to be done. What are those things, sir? Minority interest, pre-holding interest. If these are profits, eliminate it by deducting. If these are losses, eliminate it by adding. But in order to know these two things, you have to prepare subsidiary company's P&L account. And last but not least, pre-acquisition dividend. If any is there, it has to be deducted. Otherwise, ignore the same. Respond understood? That is the end of consolidated P&L account. I'm seriously telling you, hold on these things, you solve the problem, you'll get very easily with respect to CRD question. And this examination question, if you observe, there is one point here that is other income, something like preference share dividend up to 39/2020. Subsidiary company is Y Limited and it is having 400 preference share capital. So 400 into 7% is nothing but 28. Up to 39 is nothing but 6 months. So 28 into 6 by 12 is nothing but 14. 14 is declared by subsidiary company. 7 is received by holding company. So this is nothing but other income to holding company. Is it clear? This will be having a place only in standalone financial statement, but this is not having any place in consolidated financial statement because it has to be given only by the subsidiary company, which is nothing but intercompany transaction. Clear? Subsidiary is giving 7 to holding company, so it has to be getting eliminated. Respond clear? And that's the end of consolidated P&L account and consolidated financial statements. And let me start the first topic, which is nothing but buyback of securities. My dear children, remember one thing, before telling buying back of securities, you must know something about redemption of preference shares also. The biggest problem is that you people belonging to the old scheme of CA Foundation and new scheme of CA Inter, and hence in the meanwhile you missed some topics. One of that topics is nothing but redemption of preference shares. But even though we have taken a chance and we have explained this concept before starting of your syllabus, but unfortunately majority of the students did not attend for that, and for post batch student it was not taught at all. Anyways, let me tell you one common rule between these things. So even in redemption of preference shares, share capital is getting decreased. Even in buyback of securities, share capital is getting decreased. Sir, if it is a company, the company has to repay first. Is it need to repay to the shareholders or to the outsiders? It has to repay to the outsiders. But in redemption of preference shares, company is repaying to the preference shareholders. In buyback of securities, company is buying back the equity shares and it is repaying to the equity shareholders, which implies that company is repaying to the shareholders before repaying it to the outsiders. Then automatically who will protest now? Outsiders will protest and outsiders will tell that, "Arey, these funds first must be repaid to us because we are outsiders. But how could you repay to the shareholders?" Like outsiders will be questioning the company. A company, why are you repaying to the shareholders when we, being the outsiders, are there in the organization? First of all, you have to repay to the outsiders. Only then if any fund is remaining, you have to repay it to the shareholders. Am I correct or wrong? But outsiders are, and hence outsiders are protesting and hence outsiders are protesting this redemption of preference shares and buyback of securities. Respond everybody, clear? So who are protesting now? Or allowing the company to repay or not allowing the company to repay? Not allowing the company to repay. And hence company should satisfy the outsiders before redemption of preference shares and before buyback of securities. Who has to satisfy? Company has to satisfy the outsiders before redemption of preference shares and buyback of securities. Now, how to satisfy the outsiders, sir? Sir, you just convey, you just go ahead with a discussion with the outsiders. Array outsiders, what's your real problem? Our real problem is very simple, sir. First of all, you have to repay to us, but you're not repaying to us and you're repaying it to the shareholders. This is our real problem. Of course, I do understand shareholders, but I can't repay you now. Why I can't repay you? Because their term has been received. Preference share capital maximum 20 years. Our board of directors have decided to buy back the equity shareholders. But you are the debenture holder. We promised you that we will repay you after 20 years. Till now 20 years did not complete. And hence I can't repay you creditor. But since as per the decision taken by the management of the company, I have to redeem and buy back the preference shares or equity shares. Company told it clearly. But shareholders are telling, no, no, sir, first you have to repay us. Why? What is your problem? Simply shareholders, creditors and outsiders are telling, sir, if you repay the shareholder, share capital in the company will be getting decreased. If share capital in the company is getting decreased, how will you do the business reliably? How can we trust you? How can we extend our reliability on you? Because your capital is decreasing. Your capital employed is decreasing. If your capital employed is decreasing, obviously your net assets will decrease. Yes or no? But here no liability is decreasing. Capital is decreasing. Hope you have got the main intention behind this concept. Sir, if at all your net assets are decreasing because of settlement of liability, then it's okay. Or if you have settled the liability, then your net assets will increase. Or they will remain same. If you settle a liability, what is a journal entry for liability settlement? Liability account debtor to cash or to the most of times, exceptions whenever there are prepayment penalty, discount received, etc. and etc. To the most of times, because of settlement of a liability, your net assets will never get affected. Because simultaneously your asset will decrease, simultaneously your liability also gets decreases. Am I correct or wrong? But the biggest problem in this buyback of securities or redemption of preference shares is that capital is getting redeemed, with which net assets is getting decreased, with which there is no enough funds in the business, with which company cannot do the business properly, with which trust and reliability by the outsiders is not extended to the company. Clear, everybody? Now company understood what is the real problem that creditors are facing. So now let the company solve in that aspect. How to solve, sir? Very, very, very simple. First of all, let the company fill the capital gap. Some people will be telling it like matching the capital requirement or maintain capital intact. Everything is one and the same. So before buying back the before buying back the equity shares or before redeeming the preference shares, first of all, you have to do the exercise. What is that exercise, Nana? Fill the capital gap or matching the capital requirement or maintaining the capital intact. In a single word, these three are absolutely same. How much ever capital in face value is getting redeemed, that much ever capital has to be raised first. Clear, everybody? Check out how much is the face value of preference share capital due for redemption. 1 lakh, sir. Immediately raise the capital. Check out how much ever equity shares you have decided to buy back. Rupees 2.5 lakh face value, sir. Immediately raise the capital. Respond, everybody. Clear? What is maintaining capital intact or filling the capital gap? Face value of capital getting redeemed or bought back must be raised first. Respond, everybody. Clear? Then How can this capital gap or raising capital can be done in three ways? Number one, through fresh issue. Number two, by creating CRR. And finally, number three, combination of both. What is number one, Nana? Fresh issue, creating CRR, combination of both. What do you mean by fresh issue? Go for a new public issue. What is fresh issue? Go for a new public issue. CRR is nothing but creating, reserving some portion exclusively for the purpose of equity shareholders. Hope you are aware of that. CRR can be utilized only for the purpose of issuing the not bonus shares, fully paid up bonus shares. Respond everybody clear. So tell me, CRR can be utilized only for the purpose of issuing the fully paid up bonus shares. Issuing the. So this is second option. Reserve some portion only for equity shareholders by form of creating CRR from free reserves. From. Respond everybody clear. This is combination. That's quite okay. Now listen very, very carefully, my dear children. What do you mean by fresh issue or new public issue? If it is in the case of redemption of preference shares, you might ask me, sir, why you are telling redemption of preference shares when we are going through buyback? For your kind information, my dear children, in one of the institute questions, there was also given in the question that redemption of preference shares. Company has redeemed the preference shares and also company has bought back the securities. If at all in examination, all of a sudden, if he had highlighted redemption of preference shares along with buyback of securities, then you might become a big fool if you did not learn the provisions of that. Because both provisions are almost similar except one or two changes. And those changes are being taught now. So listen very carefully. Till now it is same. Whether you are buying back the securities or redeeming the preference shares, you just need to maintain the capital intact, which is nothing but how much ever capital which is bought back or redeemed has to be raised first. It can be raised either through fresh issue or by creating CRR and combination of both. So now starting with the first part, that's all about new public issue. Remember, my dear children, public issue, new public issue can be either equity shares or preference shares if you are redeeming the preference share capital. But if you are buying back the securities, the new public issue has to be other kind. What is that, Amma? Sir, other kind of securities only can be issued. Normal securities cannot be issued. Respond clear, huh? What do you mean by other kind of securities here? Point number one. What are you buying back? Chapali, what are you buying back? Equity shares. So fresh issue, you have to give the other kind. Other kind implies preference shares or differential equity shares also. Hope you have remembered. Differential equity shares are nothing but generally equity shares are having one share, one vote with respect to voting. Dividend is not fixed to them. Respond. But differential equity shares are having differential rights with respect to voting. One share, two votes, or two shares, one vote. But generally this will not be there practically, but theoretically exist. Two shares, sir, dilution of equity shareholders' right is not possible. So generally one share, two votes, one share, four votes, so two shares, three votes is possible. Two shares, one vote is practically not possible, theoretically possible. And is dividend fixed? Not fixed to equity shareholders. Chepali. But in this context, it may be fixed whenever they are issuing differential equity shares. Respond everybody clear. So now, very, very important. What is first mode of matching capital requirement? Fresh issue. In that you have to go for new public issue. If you are redeeming the preference shares, then you can go for either equity shares or preference shares. If you are going for buying back of securities, then you have to issue the other kind. Most probably it might be either preference shares or equity shares with differential rights. Respond everybody clear. Now let me come to the second part, CRR. CRR is created with the help of dash reserves, free reserves. Free reserves are those reserves which are freely available for distribution of dividend. What are free reserves, my dear children? Freely available for distribution of. So what are the reserves which are freely available for distribution of dividend? General reserve, reserve fund, revenue reserve, P&L account, dividend equalization fund, capital reserve realized in cash. Respond understood. Tell me what are the 6 reserve, my dear children? General reserve, reserve fund, revenue reserve, P&L account, dividend equalization fund, capital reserve realized in cash. Respond everybody clear. And there are some other reserves like investment allowance reserve, workman compensation fund. Getting my point, everybody? So, development rebate reserve. Remember these 3 reserves: investment allowance reserve, workman compensation fund, development rebate reserve. These 3 can be, some portion can be fixed, some portion can be free. Hope it's clear. Some portion can be fixed and some portion can be free. You might ask me, sir, how will I come to know? No problem. In the question, he will be giving that. 10,000 of investment allowance reserve is made as free by the company, which implies that you can use 10,000 for the purpose of creating CRR. Respond everybody understood. All these are the free reserves, everybody. All these are the free reserves for the purpose of redemption of preference shares. Very important. For the purposes of section 68 of Companies Act 2013, which is nothing but buyback of securities. Free reserves also includes securities premium. Free reserves also include. So my dear children, at last, if these reserves are not sufficient, even you can utilize securities premium for the purpose of creating CRR exclusively for the purpose of buyback. Respond everybody clear? Hey, please mark my words, okay? Please mark my words. If you have utilized all these reserves, if these reserves are not sufficient, it is recommended to pick securities premium for the purpose of creating CRR. If you are creating CRR for the purpose of buyback. Respond everybody clear? Starting initial words of mine is very, very important. After utilizing all these reserves, if there is any other reserve which is insufficient, then you can pick securities premium. This is what followed in your institute material, and hence I am telling the same. In your institute material, first they have utilized all the free reserves for the purpose of creating CRR, and then they are utilizing securities premium in case of insufficiency of these reserves. Respond everybody, pakka. Now moving on to the next thing. Now exclusively we are learning about buyback and exclusive buyback elements. So my dear children, I'm not going with the simplest provisions. I mean to tell, after buying back, you cannot do one more buyback till the completion of 1 year. You cannot issue same kinds of securities within 6 months from the end of buyback. And after buying back, you have, after the date of resolution, you have to complete the whole process of buyback within 365 days. Hope you have remembered all these provisions. Somehow I covered 3 provisions, but I'm not covering on legal aspects of the provisions, even because these are least important when we are speaking with accounting part. So accounting part, very, 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 very important. Maximum number of buyback. What is the part, Nana? Maximum number of buyback. And one more thing, my dear children, buyback is such a very important chapter. In every attempt, minimum 8 to 10 marks is getting covered. Since now the marks are different, you can get 7 to 14 marks easily. Yes, even though there are only 3 problems from buyback, to the most of the times he will be testing from the buyback. If not in main questions, at least in MCQs he might test you. So listen very, very carefully. Simple chapter, don't leave at all. So now let me go ahead. Maximum number of buyback. How many maximum number I can go ahead with? For that purpose, there are actually 3 tests. Test number 1, shares outstanding test. What is test number 1, my dear children? Maximum number of equity shares is equal to 25% of outstanding equity shares. Respond everybody clear. What is shares outstanding test, my dear children? Maximum number is equal to 25% of outstanding equity shares. Respond everybody clear. Test number 2, resource test. What is test number 2? First of all, you have to check out maximum funds that can be used for the purpose of buyback, or maximum resources. Maximum resources is equal to 25% of share capital plus free reserves. Free reserves include securities premium. Share capital is nothing but paid up equity share capital and paid up preference share capital. Respond everybody clear. If at all you are going ahead the buyback without passing the special resolution, for buyback dash resolution is required, special resolution. But if at all board of directors have decided to go the buyback, to approve the buyback without passing special resolution, then maximum resources they can utilize is all about 10% of paid up equity share capital plus free reserves. Respond everybody clear. So that's very, very important, my dear children. Be careful in that context. And let me move on to the next one. That's all about one more thing. Here in test of resources, you have got maximum resources that can be utilized. But now you need to find what is the maximum number. Maximum number is equal to maximum resources divided by buyback price. Maximum resources divided by buyback price. Respond everybody clear with test number 2. And the final dangerous test is nothing but debt equity test. What is that test, Nana? I already told you there is a shortcut for doing debt equity test by considering only single variable, and also there is a long form for doing debt equity test by considering 2 variables. Now what is to be attempted in the examination? To the maximum extent it is recommended to follow 2 variable model. But if you so feel that the time is not sufficient, in such a case, not a very big deal, do the single variable model and you can continue the problem. Marks may not be deducted until it's judgmental decision. One evaluator might deduct marks and one evaluator might not deduct marks. How many marks can be deducted? Hardly 1 mark. If the question is of 14 marks, he might deduct for 2 marks. If the question is for 8 marks, hardly 1 or 1.5 will be deducted. You might think something like, sir, that 1.5 is very important for passing. And hence, I'm not telling this concept to those people who are attempting only buyback in the exam. And let me go ahead for debt equity test. Debt equity test, you have to maintain the debt equity ratio in 2:1. I mean to tell, debt by equity is equal to 2/1. Therefore, minimum equity to be maintained is equal to half of debt. What is minimum equity to be maintained, Amma? Half of debt. Respond everybody clear. Half of debt to be maintained after buyback. That word is very, very important. Minimum equity to be maintained is equal to half of debt after buyback. But you have to do this test before buyback only. Something like net profit is equal to 20% of sales, or managerial commission is equal to 20% of net profit after charging commission. But you will be providing the data only before charging commission. This is the loop even here also. You have to maintain half of debt after buyback, but you have to compute the entire concept before buyback. So minimum equity to be maintained is half of debt after buyback, or minimum ratio, debt equity ratio should be 2:1 after buyback. Respond everybody clear. So for this purpose, there will be 2 equations, and the 2 equations are very, very simple. Just check out carefully here. Say for example, let me take an example. 1500 is the debt that you are having. What is the debt you are having, Amma? No, let me take it as, okay, 1500. And say, for example, equity is equal to 900. What is equity you are having? Now start telling me minimum equity to be maintained is equal to half of debt. Am I correct or wrong? That is equal to half of 1500, which is nothing but minimum equity to be maintained is 750 after buyback. Say for example, buyback price is equal to 20 and face value is equal to 10. Respond everybody, shall I proceed? Sir, how much is present equity? Respond, how much is present equity? And how much is minimum equity to be maintained? So how much is the equity that you can utilize? 900 minus 750, which is nothing but 150 after buyback. 150. So very simple, maximum number of shares is equal to minimum equity that can be utilized. That is 150 divided by face value divided plus buyback price. I'm telling this as a single variable model. Single variable model is nothing but maximum number of shares that are to be bought back is equal to maximum funds that can be utilized for the purpose of buyback, which is nothing but 150 divided by face value 10 plus buyback price 20, which is nothing but 150 divided by 30. 5 lakh shares or 5 number of shares can be utilized for the purpose of buyback. Respond everybody, clear? This is dash model. Single variable model. Quickly answer me, my dear children. What is test number 3? Debt equity test. Debt equity test. How much minimum ratio you have to maintain? 2:1 after buyback. So minimum equity to be maintained is equal to half of debt after buyback. So for that purpose, you have to check out the present debt. Minimum equity to be maintained is equal to half of debt. Maximum funds that can be utilized is equal to, sir, how much is the maximum fund that you can utilize here? 150. How did you get that 150? 900 minus 750, which is nothing but present equity minus minimum equity to be maintained. How much is the maximum funds that can be utilized as per test number 3? Present equity minus minimum equity to be maintained. So 900 minus 750, which is nothing but 150 to be maintained before buyback, after buyback. And hence 150 divided by face value plus buyback price. 10 plus 20, the total comes to 30. Respond everybody, clear? And let me go ahead under 2 variable model. Shall I start now? 2 variable model. First of all, what is the maximum number of equity shares that can be bought back? Tell me, what is the maximum number we can buy back? Hey, what is the maximum number we can buy back? How to find it? What is that? 25% of? No, I'm asking as per test number 3. Maximum funds available minus some portion has to be transferred to CRR kada. So maximum funds available minus CRR whole divided by buyback price. Respond everybody, clear? So now how much amount has to be transferred to CRR, sir? Maximum number of equity shares that are to be bought back multiplied by face value. Respond everybody, clear? So maximum funds available here is absolutely nothing but as per test number 2. Respond everybody, clear? Maximum funds available is nothing but 25% of paid up share capital plus free reserves, where free reserves also include securities premium. Respond everybody, clear? So let me show you something like here CRR. Let me call it as Y. Clear? Y is equal to maximum number. Let me call it as X. X into face value. Respond everybody, clear? And now X is equal to maximum funds available minus CRR. Maximum funds. You already know how to compute maximum funds. A response R, which is nothing but 25% of paid up share capital plus minus CRR. I have called CRR as Y. Whole divided by buyback price. Respond clear. And if you substitute Y, automatically you are going to get the solving of the equation. Respond clear. So X is equal to maximum funds minus X into face value divided by buyback price. Therefore, in our example, buyback price is nothing but 20x is equal to maximum funds we have computed directly 150 minus 10 into x. Am I correct or wrong? Face value is nothing but 10. 150 here I have computed directly kada. See this one. 900 minus 750. Hey, respond clear. So let me move on further. That implies 20x plus 10x is equal to 150. That implies x is equal to 150 divided by 10 plus 20, which is nothing but maximum funds that can be utilized for buyback whole divided by face value plus buyback price. Respond everybody clear. So this is the single variable shortcut that I have told you initially. Something like single variable here, this one. If you want equation, the equation will be this one. Yes, maximum number and CRR. Respond everybody clear. And my dear children, that is the end of buyback. But let me go through the problematic and let me tell you the differences that you are having. Yeah, one more thing, journal entries for buyback. Point number 1, a partly paid up share can't be bought back. A partly paid up share can't be bought back. A partly paid up share cannot be redeemed. So you have to go with a final call and then you can buy back. Respond everybody clear. So final call entries, hope you know that one. Equity share final call account debtor to equity share capital, cash or bank account debtor to equity share. So I'm not concentrating on the final call. I'm concentrating on the entries that are relating to buyback. Shall I start now? So start buyback journal entries. You're buying back. Tell me the journal entry. Equity share capital account debtor to equity share holders account, or you can also write equity share buyback account. Respond everybody clear. One very important thing, this will be with the face value. This will be with the buyback price. Whatever the difference is there, that difference has to be transferred to premium on buyback account, or it will become a profit which has to be transferred to capital reserve. Respond clear. But before, you also have to pay the same. Am I correct or wrong? So what is the journal entry? Equity share buyback account debtor to cash or bank account. This is nothing but a kind of payment entry. And this premium on buyback has to be set off. First preference is to pick securities premium now. Securities premium account debtor to premium on buyback account. Respond everybody clear. First preference is to pick securities premium. If securities premium is not there, pick any other free reserve. My dear children, at the time of creating CRR, first utilize all the reserves, and if all the reserves are not sufficient, then utilize securities premium. But for the purpose of writing off premium on buyback, first pick securities premium, and if securities premium is not there, go for all other reserves. Respond everybody clear. I have taught you these things basing on the institute materials stand. Everybody understood? Okay, my dear children, and hope you know the entries relating to the basic elements. I mean to tell fresh issue, cash or bank account debtor to equity share capital account, CRR, free reserves account debtor to CRR account. At the time of giving bonus, utilize CRR, CRR account debtor to bonus to equity shareholders account, and finally bonus to equity shareholders account debtor to equity share capital account. I'm not explaining the journal entries, I'm just revising the journal entries. Later on if you feel to revise it again, just rewind and then revise. And fine, my dear children, check out. Sir, one very, very important thing you're supposed to know. This is an examination question. This is one of the examination questions. If you observe in the data, it was very, very clearly given that the company has decided to buy back 25% of the paid up capital, which implies that 25% of paid up preference share capital plus paid up equity share capital. Am I correct or wrong? This is correct as per provisions only. But as far as problems are concerned, 25% of paid up capital implies 25% only equity share capital. I hope clarification number 1 is absolutely clear. So 25% of paid up capital implies 25% of equity share capital as per problems are concerned. But as per provisions, 25% of paid up capital implies 25% of both equity and preference. Respond clear, everybody. But if you have seen something like 25% of total paid up capital in your problems, clear, everybody? In your problem, company has decided to buy back 25% of total paid up capital. At this time, you have to pick 25% of both paid up equity share capital plus paid up preference share capital. And you will get one number, kada? Respond, sir. That many number of equity shares has to be bought back. Respond, everybody, clear. After buying back, you should not hold any share. That share has to be cancelled immediately. I told you, like, whenever provisions are there, physically shares are existing, within 7 days share has to be physically extinguished, either torn out or fired or thrown or garbaged, etc. But now, since everything is dematerialization, such kind of element is not there at all. Respond, concept understood? 25% of paid up share capital for provisions implies 25% of both equity and preference for the purpose of provisions. For the purpose of problems, only equity. But if 25% of total is given, then both equity and preference. Here, respond, everybody understood? Okay, and yeah, this is one of the important models. All the time they are being testing with these models. What is the maximum number of buyback? In 3 cases. Existing case is 1500, 1, 1200, 1 and 1800 is 1. Different cases will be given. You just need to compute the same. That's very simple, nothing great. And coming to problem number 3, yeah, if I was not wrong, this is the question. Company has redeemed all the preference shares. Company has redeemed the preference shares and also company has bought back the equity shares. And my dear children, preference shares are redeemed at premium. Now one more thing, one more last and final thing. Whether can we use premium on redemption of preference shares to set off the same with securities premium? We told like securities premium can be used for the purpose of setting off a premium on buyback. Now, can we use securities premium for the purpose of premium on redemption of preference shares? Listen, if at all your company is section 133 company, then you cannot use premium or securities premium for the purpose of premium on redemption of preference shares. If your company is not a section 133 company, you can use securities premium for the purpose of premium on redemption of preference shares. What is section 133 company, sir? I told you, yes, in this marathon class itself, in introduction to accounting standards. Central government has to issue the accounting standards to the company through section 133. So section 133 is the section where accounting standards will be issued by the company. And those accounting standards are applicable to the company. So conclusion, if at all company has to follow section 133, then don't utilize securities premium. If company is not required to follow section 133, utilize securities premium for the purpose of premium on redemption of preference shares. Next question. Generally, Section 133 is applicable to the company or not? You use the common sense. 133 is having accounting standards. Clear, huh? 133 is having straight question. Is section 133 applicable to company or not? Seppali. Yes, because standards are applicable to the company, sir. Accounting standards are applicable to the company, and hence section 133 is also applicable to the company, and hence securities premium is not to be utilized for the purpose of writing off of premium on redemption of preference shares. Respond everybody, clear? And this is an exclusive point for problematics, remember. So for the purpose of problematics, SP can't be utilized for premium on redemption of preference shares, where SP can be utilized for the purpose of buyback. Respond everybody, understood? And my dear children, that is the end of buyback of securities. And those students who are watching on YouTube or understanding the concepts, and hence please like, share and subscribe. After buyback, let's start with the next chapter. That's all about accounting standard number 12. What is accounting standard number 12, my dear children? Accounting for government grants. My dear children, a very simple standard. You just need to know the receipt journal entries and the refund journal entries so that the standard is absolutely done away with. So let me start. Before that, when to recognize government grant in your books of accounts? Only when two conditions are satisfied. Condition number 1, when you are having certainty of fulfillment of conditions, and when you are having certainty that government grant is receivable. So if these two conditions are there, you have to recognize it as a government grant. Otherwise, it is not supposed to recognize as a government grant. And one more important thing, always government grant must be received either in cash or in kind. Mere reduction in prices shall not be amounted to government grant. Respond clear? Mere reduction of prices shall not be amounted to government grant. If you have seen here something like those government grants which are not measured reliably are excluded from the government grant. As I told you already, government grant is a grant which is received from the government either in cash or kind. Mere reduction in prices will not be amounting to government grant. And one more thing, GG excludes those government grant which can't be measured reliably. Example, government has given you a technical assistance. It is sending one technical person, technical knowledge person, or it is giving you a computer, not as an asset, as just as a form of technical assistance, or it had given you a suggestion with which your business had increased a lot and lot. Clear everybody? So such kind of things can't be treated as. Clear everybody? My dear children, I told you that government is giving you a computer for technical assistance, but it is not giving computer totally. After the completion of that installation of software, it will take back the computer again. Respond clear. And those GG which cannot be distinguished from ordinary course of business, which implies that government itself is a customer and purchasing from the business entity. At that time, we can't tell that it is a government grant. You can't tell government has given me the cash. Why did it give you the cash? Because I sold the good. In such a case, it can't be treated as a government grant. Respond everybody, clear? Okay. Now, sir, do anybody gives you anything at free of cost? No. If they give anything at free of cost, they will put some condition. Am I correct or wrong? In the same way, while government is giving some grant, it will put some condition. It can be in two styles. Listen very, very carefully. Already cash is received by the entity. It has to fulfill the conditions in future. Shall I start the entry? You have already received the cash. Am I correct or wrong? So what is the entry now? Cash or bank account debtor to. If you are having certainty that you are going to fulfill the conditions, then you can write to government grant account. If you are very sure, I receive this cash, I will use it for some other purpose, I don't use for the set purposes which are done by the government. In the case, do the government gives you the amount at free of cost or it will take it back? You know that one, right? Because you are not fulfilling the conditions. So you are thinking, government given 1 lakh cash. It is telling to help the employees, but I am using this for my business purposes. So in future, if government is asking, I have to give the amount back, because I am not utilizing this for the conditions as said by the government. So in this case, the entry will be cash or bank account debtor to government grant payable account. Respond everybody clear. Next, government told, I will give you cash in future. Rah. First of all, you fulfill the conditions. Rah. Business is thinking, I don't fulfill the conditions, it will not get the grant. So no entry. Clear. I will fulfill the conditions in future, so that I will receive the grant amount in future. So what is the entry now? GG receivable account debtor to government grant account. Respond everybody clear. So these are the 4 entries that you have to be very, very careful. And one more important thing. Now, whether to record it as government grant or deferred government grant in my books of accounts. If at all, no, it's not like more than 12 months. If at all the GG is relating only to one accounting period, then you have to call it as government grant. If GG is spreading over through 2 different financial years or more than 2 accounting periods, commonly for our better understanding in class, I told you less than 12 months and greater than 12 months, but it's not exactly like less than 12 months and greater than 12 months. It's exactly like within the same accounting year, more than 1 accounting year. If it is more than 1 accounting year, then it is recommended to write deferred government grant. Respond clear? Sir, if at all the grant is relating only to 1 accounting period, then government grant. If it is relating to 2 different accounting periods, then deferred government grants. Let me give you an example. Sir, say for example, you have received the grant in January. You have to fulfill the conditions. You have to fulfill the conditions till May of next year. In between, you are having 31st March. Okay, is it clear? So totally you have received 5 lakhs. So what is the journal entry for this now? Cash or bank account debtor to DGG account 5 lakhs. Even though the grant is there only for Jan, Feb, March, April, May, 5 months, you are writing it as DGG because it is spreading over through 2 different financial years. So now out of these 5 months, 3 months is relating to current year, 2 months is relating to next year. So 3 months proportion amount has to be closed and transferred to P&L account, and remaining 2 months amount will be carried forward as DGG. Respond everybody clear? Sir, respond, is a concept understood? So quickly answer me whether to use GG or DGG. If at all the grant is relating only to 1 accounting year, we will call it as government grant. If it is relating to more than 1 accounting year, we have to call it as DGG, which is nothing but deferred government grant. Respond everybody clear? And shall I proceed further? And the next concept is all about receipt of government grant. So listen very, very carefully and answer me. Simultaneously, I'll also cover the refund of government grant also. You can receive the government grant either in cash or in kind. So let me start with cash concept. Cash is nothing but monetary. Kind is nothing but non-monetary. What is cash, my dear children? Monetary. What is kind, my dear children? But remember, the definition of monetary is cash, non-monetary is kind, is confined only up to AS 12. For AS 11 and AS 26, monetary and non-monetary are having different definitions. For AS 11 and AS 26, monetary and non-monetary are having different definitions. As per AS 12, monetary is nothing but cash, non-monetary is nothing but kind. Sir, I hope the speed is actually okay. I mean, it's not very speed, it's not very slow. Okay. And now, if you are receiving the government grant in cash, first of all, you have to check out whether is it for depreciable asset, is it for other than depreciable asset. Clear everybody? Is it for or is it for other than depreciable asset? If it is for other than depreciable asset, again you have to check out whether is it received in the form of in the due course of business, or is it given for establishment of business. If you have received the grant in due course of business, then we will call it as income approach. If you have received the grant for establishment of business, we will call it as capital approach. Respond everybody, done. And if you are receiving the grant for non-monetary, again you have to check out whether you have received it for free of cost or you have received it for concessional price. Respond understood. Tell me, you can receive grant either in the form of cash or kind. If it is received in cash, you have to check out whether is it depreciable asset, other than depreciable asset. If it is other than depreciable asset, again you have to check out whether the grant is received in due course of business or is it relating to the establishment of business. Clear everybody? And the next one, if it is non-monetary, again you have to check out whether is it for free of cost or whether is it for concessional price. Respond everybody, understood. Now let me move on to the next thing. If government grant is monetary, which implies that it is cash, in that it is depreciable asset. Shall I start now? First of all, you are purchasing an asset. What is a journal entry if you are purchasing an asset? Fixed asset account debtor to sure bank account. Say it is 1 lakh. Now government had given you a grant of 20,000. What is the entry? Cash or bank account debtor to government grant account 20,000. Government, now wait. This is actually a biggest question. Now if at all government is giving you a grant for the purpose of one depreciable asset, you are having two methods to record the same. Method 1 is cost reduction method or asset reduction method. Method 2 is deferred government grant method or deferred grant approach method. Respond everybody, clear? So listen very carefully. If at all it is asset reduction method, cash or bank account debtor to government grant account debtor to fixed asset account. Respond clear. If at all it is deferred government grant approach, then the entry will be cash or bank account debtor to deferred government grant account. And then DGG has to be closed and transferred to P&L account every year in proportion to the expenses spent. In this context, what is the expense on fixed asset, Nana? Depreciation. So in proportion to depreciation, DGG has to be transferred to P&L account. So DGG has to be closed and transferred to P&L account in proportion to the expenses spent. Here the expense is depreciation and hence in proportion to depreciation. Respond everybody, clear? Sir, in this case 1, my asset originally is 1 lakh and grant received is 20,000. In case 1, cost of asset is reduced, which implies that 1 lakh minus 20,000, on a whole you will be getting only 80,000. Provide depreciation only on 80,000. Say for example divided by 10 years where it comes to 8,000 per annum. Respond clear. In option 2, you have purchased the asset for 1 lakh divided by 10 years. 10,000 is the depreciation per annum. And you also have received the grant for 20,000 divided by 10 years. So 2,000 has to be amortized every year as an income. And hence what happened? In case 1, 8,000 is the depreciation. In case 2, 10,000 is the depreciation and 2,000 is the deferred government grant amortization. And ultimately the expense comes to 8,000. Respond everybody, understood? This is the first thing, that is monetary grant received which is relating to depreciable asset. It can be either asset reduction method or DGG method. Respond, shall I proceed further? Now if at all government is asking you to give back the grant, refund of government grant, very very simple. My dear children, at the time of receipt of entry, what is the set of entry you have written ultimately? Cash or bank account debtor to fixed asset account. So if refund, what is a journal entry? Fixed asset account debtor to cash or bank account. Respond clear. How many years completed as per our example? 1 year. So as of now, 1 lakh minus 20,000 minus 8,000. So what is my book value? 70. So for 72,000, now another 20,000 refund of grant will be added and it will become 92,000, and 92,000 has to be depreciated for 9 more years, which is nothing but prospective effect or retrospective effect. Because you are considering only the remaining period. So if any change in depreciation is there, it has to be given dash effect, my dear children, prospective effect. Shall I proceed further? And next one, under case 2. Under case 2, is my fixed asset account affected? Did not affect. Because of grant, my fixed asset portion affected or did not affect? Because originally it is shown at 1 lakh. Even after receipt of grant also it is shown at 1 lakh. Because I did not do any adjustment for my fixed asset kada. Hey, respond understood. So if you are following asset liability method or DGG approach, then your fixed asset account will not get affected at all. So now let me go ahead for refund of grant. So how much government grant is asking? How much government is asking to refund the grant? 20,000. So I have to pay 20,000 to cash or bank account 20,000. DGG account debtor. Sir, originally my DGG is 20,000, of which already 2,000 is closed and transferred to P&L account. So balance is how much there? So only 18,000 will be debited. And remaining 2,000 has to be debited too. Respond everybody clear. So as simple as such, refund journal entry will be, if at all you are following asset reduction method, refund journal entry, fixed asset account debtor to cash or bank account. If you are following DGG method, then refund journal entry will be DGG account debtor with the balance. If balance is not there, it has to be debited to P&L account as balancing figure, finally to cash or bank account. Respond everybody clear. At the time of receipt, what is the journal entry? Please tell me, my dear children. Cash or bank account debtor to GG account debtor to fixed asset account. And for DGG, what is the journal entry? Cash or bank account debtor to DGG account debtor to totally once transferred, every year proportionately transferred. Proportionately, in proportion to the expenses spent. Here the expense is depreciation. Respond everybody clear. And now let me move on further. You receive the monetary grant, which is relating to the other than depreciable asset. Now you check out whether did you receive the same in due course of business. Like you have started the business, you are doing the business. In the meanwhile, government given, since your company is doing well, take this 1 lakh and utilize this 1 lakh for the purpose of health of the employees. Or take this 1 lakh and do the COVID vaccines to the employees. Or take this 1 lakh and just help the slum area. Like this, government had given you 1 grant in due course of business. In this case, it will be called as dash approach, my dear children. Income approach. So what is a journal entry you have to write? Cash or bank account debtor to government grant account if it is completed only in 1 accounting period. If it is spreading over 2 different accounting periods, cash or bank account debtor to deferred government grant account. And finally, GG account debtor to P&L account or DGG account debtor to P&L account. Since it is only relating to 1 accounting period, total GG is closed. Since it is spreading through different accounting periods, deferred government grant has to be closed in proportion to the expenses spent. Respond everybody understood. Now, if at all government is asking you to refund the grant, very simple. What is the entry for refund of grant here? P&L account debtor to cash or bank account. Here, DGG account if balance exists. If balance is not there, P&L account, which will become a balancing figure, and finally to cash or bank account. Respond everybody understood. And if at all, then moving on to the next thing, you have received the cash, not relating to your business at all. So I mean to tell, not relating to your due course of business. It is relating to your establishment of business. You establish the business at the backward area, in the slum area, in the village area, or in the area where GDP is very less, where per capita income is very less, or you establish a company in SEZ area. Immediately I am going to give a grant. That is dash approach, my dear children. Capital approach. What is that approach, Nana? So now what is a journal entry? Cash or bank account debtor to government grant account. Government grant account debtor to, since this is capital approach, it has to be transferred to capital reserve. At the time of refund, what is a journal entry now? Capital reserve account debtor to cash or account. Respond, everybody understood. That's it. Now, if at all you are receiving a non-monetary asset, if non-monetary asset is received at free of cost, what is the entry? If it is at free of cost, then you have to record it with nominal value or immaterial value. Don't tell that. Accounting standards are not applicable for immaterial items. If there is a controversy between framework and accounting standard, dash will prevail. Accounting standard. Framework is telling that standards are not applicable for immaterial items. But AS12 itself is telling that you have to record it at immaterial value. Is it a controversy or not? So now in this controversy, who will win? Accounting standards. Respond, everybody clear? And hence those non-monetary assets or those assets which are received at free of cost, you have to record it with immaterial or nominal value, like asset account debtor to government grant account and GG account debtor to P&L account with either 1 rupee, 10 rupees, 100 rupees, 1000 rupees, even 1 lakh is also okay. But this value should be Chapali, immaterial. Respond, everybody clear? A company whose turnover is 1000 rupees, a company whose turnover is 1000 rupees is recording a non-monetary asset received by government at free of cost at rupees 1 lakh. Correct or wrong? So is the question clear? Company whose turnover is 1000 rupees receiving an asset from the government at free of cost. It is recording the same at 1 lakh rupees. Correct or wrong? 200% correct. But as per schedule, because as per schedule 3 or Companies Act 2013, the material amount will be 1% of turnover or 1 lakh, whichever is higher. Till that point, it is considered as immaterial only. So up to 1 lakh, we can consider it as immaterial if it is a company. That's very important. Hey, respond, is it clear? Say for example, he is sole proprietor, then it's wrong. He can't record it at 1 lakh. It will become material amount to the sole proprietor. Hey, respond, everybody clear? Okay. And if at all government is asking the refund, you have to give the asset back. Am I correct or wrong? So what is the journal entry at that time? P&L account debtor to asset account. If you are purchasing the asset, then asset account debtor to cash or bank account. Sir. If you are paying extra cash, is it clear? Then the entry will be, and the government had given you at free of cost, kadra. Now government is asking you give back the asset, but you are telling asset is already employed. Sir, I can't give back the asset. Then give the cash immediately. So asset account debtor to cash or bank account. Respond, understood? Now if at all you are receiving an asset at concessional price, say for example asset market value is 1 lakh, but you got it at 60,000. Tell me the journal entry. Fixed asset account debtor to cash or bank account. How much? 60,000. In this case, grant is not recorded. In this case, grant is not recorded. And you have to start providing the depreciation on 60,000. And whenever government is asking you to refund the grant, then automatically the journal entry will become fixed asset account debtor to cash or bank account. Another 40,000 has to be paid. Take care. If government is asking you to refund the grant, it will never ask you to give the fixed asset, because you paid some portion of cash kada. In this context, government will ask you to pay the difference of cash, and that difference of cash is nothing but 40,000. Respond, everybody clear? last and final two parts are there. Number one, presentation. Government deferred government grant or government grant which is amortized to P&L account is having two options. Option number one, you can show it under other income. Option number two, you can set off the same with respective expense. Option number one, that can be shown under other income. Option number two, set off with respective expense and show the net figure. Respond everybody, clear? This is point number one. And next, DGG which is not amortized will be continued to be shown in balance sheet, either in reserves and surplus, option number one, or option number two, it will be shown after shareholder funds but before non-current liabilities as a separate line item. You'll create a line, point number two, deferred government grant, and you can show it. Respond everybody, clear? And next, capital reserve will automatically shown in reserves and surplus. That's it. Last and final. What is receipt of government grant? Dash item. Receipt of government grant is ordinary, exceptional, extraordinary. Already discussed. Exceptional item in AS5. Refund of government grant is dash item. Extraordinary item. But check out here, there's a special point where you have to take care. So, in the following two situations, receipt of government grant will become an extraordinary item. Situation number one, government grant is received in the current year for the past year expenses we have spent. And the same was not recorded in the previous year because you are not having certainty. Clear? Current year I am spending the expenses. But I thought of like government will not give the grant and hence I did not record. But in the next year all of a sudden government had given you the grant. Clear? So government grant received in current year for the past expenses spent. But you did not record it in the past year because you are not having certainty. In this case, it has to be treated as an extraordinary item. Clear everybody? Second thing, government grant had given you under due course of business or under income approach. But no condition attached to it. Logic understood? Government had given you a grant in due course of business but no condition attached to it. Since no condition is attached to it, it will become dash item, extraordinary item. My dear children, whereas to all other business concerns in your entity, if grant is given by the government, it will attach some condition. I mean to tell, say for example, yours is a textile industry. To all the companies which are there in textile industry, if government gives a grant, it is putting some fulfillment of conditions. But for your business entity, government had given you the grant in due course of business, but it did not put any fulfillment of conditions. Clear? In such a case, it will be treated as an extraordinary item. Received in due course of business or not? But no conditions are there, and hence it must be treated as if it is an extraordinary item. Respond everybody, clear? One last and final thing. I told you like in AS10 and also I told you I'll tell the same point in AS12. That's all about when your government grant received is greater than the book value of PPE and you are following asset reduction method. Asset is shown at 1 lakh. But government grant received is 2 lakhs. And you are following asset reduction method. Then depreciation will become 0. Depreciation will become 0. Respond everybody, clear? The difference of 1 lakh has to be immediately transferred to P&L account. But if you are following DGG method, absolutely no problem because asset is continued to be shown at 1 lakh. Your DGG will be continued to be shown at 2 lakhs. Respond everybody, understood? That's it. And I actually would like to, refund I told you. Check out this one. As I said, your existing value of the machine is 20 lakhs. Accumulated depreciation is 12 lakh. WDV is 8 lakh. Grant received is 16 lakhs. So company has followed dash method here. DGG method, asset reduction method. Not understood. Asset is shown at 8 lakhs, Nana. Grant received is deducted from the asset value. And which method is followed, Antuna? Asset reduction method. And hence you are having a negative balance of 8 lakh, which has to be immediately closed and transferred to P&L account. If you are following DGG approach, I don't have any problem because asset will be at 8 lakhs and DGG will be at 16 lakhs and simultaneously two things will be written off. And this one, if I was not wrong, your last CRD in your material. Yeah. Here, if you observe, on 1st April 2021, you have purchased a machine of 60 lakhs, 10 years used to useful life, and 10 lakhs is the salvage value, and government grant received is 20 lakhs. If you observe, just wait, point number 3. If the grant amount is deducted from the value of the plant, but at the end of 2020-23, grant is refunded to the extent of 4 lakhs due to non-compliance of certain conditions. If you observe, 21-22 is the current year. 22-23 is the next year. You know, in all the problems which are given by institute material, it had done like this. For your kind information, how many years completed here? Cheppali. End of 22-23 antunar kada. So how many years completed antuna? 2 years completed. If 2 years is completed, then automatically you have to provide 2 years depreciation. How much is that, sir? 60 lakhs minus 10 lakhs is the salvage value minus 20 lakhs is the government grant, because they are following asset reduction method, deducted from value of the plant. Is it clear? Divided by how many years? 10 years, which comes to Entama? 3 lakhs. Ante it is something like this. My original asset price is 60 lakhs. Grant received is 20 lakhs. It comes to 40 lakhs. Now depreciation is equal to 40 lakhs minus salvage value 10 lakhs divided by 10 years, which comes to 3 lakhs per annum. Like this, how many years completed? Then automatically how much is depreciated? 6 lakhs. So balance how much will be there? At this point of time, grant is refunded to the government to the extent of 20 lakhs. So it will become 54 lakhs, which has to be amortized for the remaining period of 8 years. Am I correct or wrong? But in your institute, in all the institute materials, ICAI sources, he followed the same thing. But this is an examination question. In examination question, he had gone it with a different approach. Clear, everybody? By taking 10 years and assuming after taking 9 years. Initially, he'll take 10 years, original depreciation. After that, he'll take 9 years. And as if it is getting, the second year is not yet depreciated. Respond, everybody understood? Second year is not get depreciated, he'll be taking like that. At the end of second year, but he'll be taking second year was not yet depreciated. Respond, everybody clear? So now what to do? Nothing great. You do normally, because in all the ICAI sources, since he had done like that, there will be nothing great. You do it normally, your marks will be allotted. But better to write note. It is assumed that since the government grant is refunded at the end of the year, company had already depreciated the asset for the second year. Hey, respond clear? Moreover, shall I tell you a logic behind this sense? You have to assume only after depreciation grant is refunded. Reason is very simple. In the second year, your value of the asset is only, first year 40 lakhs kada, 3 lakhs decreased kada. In the second year, your value of the asset is only 37 lakhs. You have utilized 37 lakhs for entire second year. And hence your depreciation should only be 3 lakhs. Respond clear. But you can't do 37 lakhs plus 20 lakhs, which comes to 57 lakhs minus 10 lakhs is the scrap value divided by 9 years, which comes to 5.2 2. Antona? This concept is actually wrong. Better not to consider like that at all. Respond everybody clear. And my dear children, the conclusion is very simple. Since in the question it was very clearly given something like the grant is refunded at the end of 2022-23, assume that depreciation is already provided for the second year and let the government grant be refunded. Respond everybody clear. Frankly telling, the examination solution will be different. Initially he will be taking 10 years and then he will be taking 9 years, but originally it should be taken at 9 years and then it has to be taken at 8 years. So his intensification between these things may not be 100% correct when compared to the institute sources that were published by him, and hence he is writing an assumption and he is solving that, but you write it normally and you do it normally. Respond everybody clear. And that is the end of accounting standard number 12. Just relax for 2 to 3 minutes and then we are going to start with investment accounts. Let's continue with the next chapter, that's all about investment accounts, including accounting standard number 13. Sir, one thing that you have to remember, that assets held as stock in trade are not considered as investments. That's very important. Investment is something which is held for the purpose of what is it called, capital appreciation, generating income or any other benefits for a period more than 12 months. That's all okay, but the most important part is just assets held as stock in trade are not to be considered as investments. Remember that. And now moving on to the next thing, as usual, recognition and measurement. Whenever we speak about recognition and measurement, there will be two parts. Number one is initial recognition. Number two is subsequent recognition. Initial recognition depends on modes of acquisition. Subsequent recognition depends on, in yesterday AS10 we have seen that subsequent recognition depends on models. But here in AS13 now subsequent recognition depends on classification. And what are the classification of investment we have given? Current investments and long-term investments. Whereas coming to recognition and measurement, it is depending on mode of acquisition. It can be acquired either for cash or credit, exchange of assets or issue of securities. As usual, the first thing, if any investment is acquired at cash or credit, it has to be recorded at purchase price plus direct expenses. Purchase price is the price which is quoted in the market, simply quoted price. There will be no invoice here. If at all it is raw material or if at all it is PPE, then you will be having price which is stated in the invoice. In invoice, you will be having trade discount, volume rebate, quantity discount, taxes and duties. But coming to investment, such kind of things will not be there. If you purchase a land, it's an investment, but you will not get any invoice for land. Document will be there. If you purchase a share is an investment, but you will not be having any invoice for purchase of share. Clear everybody? So purchase price is a price which is simply quoted price which is quoted in the market. And direct expenses are those expenses which are directly connected to the acquisition of that particular investment. And some of the examples for direct expenses are nothing but brokerage, stamp duty, commission, etc. Respond everybody clear. So that's all about cash or credit. Now moving on to the next thing, exchange of assets. My dear children, remember, coming to accounting standard number 10, exchange of assets, you have to check out for the element of commercial substance. But remember, for all the remaining standards, that's like accounting standard number 13 or it might be accounting standard number 26, always commercial substance exists. Always commercial substance exists. If the exchange is between the same asset, is commercial substance exist or did not exist? Exchange is between same assets. No commercial substance, because to have commercial substance you need risk, timing, nature, cash flows should significantly differ. But if the exchange is between same assets, then the risk, timing, nature, cash flows will not differ. Am I correct or wrong? Whereas coming to investment accounts. If you are giving one company's investment in equity shares and if you are taking another company's equity share also, even though it is between the same asset like equity share versus equity share, there will always be commercial substance because one company's risk and reward is different, another company's risk and reward is different. Respond everybody clear. So you have in exchange of assets always you have to check out for dash element, my dear children, commercial substance. But you have to check out commercial substance only in accounting standard number 10. For all the remaining standard, it is a deemed assumption that commercial substance exists. Anyways, in exchange of asset, it has to be recorded at what price? Fair value of asset given up or fair value of investment acquired, whichever is more clearly evident. If two things are clearly evident, then first preference will be fair value of asset given up and the second preference will be fair value of investment acquired. If fair values are not there, straight away recorded at book value of asset given up. Clear everybody? Even here also I'm telling you the journal entry. Whatever I told in AS10, the same thing. Might be it's one more time revision for you. Listen very carefully. Because yesterday, for all the remaining topics you are active, but while telling AS10 you are sleepy. Tell me the journal entry for investment now. You are getting investment and my dear children, you are giving one old asset. This is always to be recorded at book value. Check out if you have paid cash. Cash or bank will never change and if you get any cash, that also will never change. And this total will become this total. I mean to tell fair value of assets given up. If this is not there, fair value of assets acquired. These two things. Even yesterday I told you, if cash is 10,000 and if fair value of assets given up is 90,000, then investment value will not become 90,000. After deducting 10, it only will become 80,000. Take care. And of course, the balancing figure will absolutely becomes P&L account. Respond everybody, understood? That's all about exchange of assets. And moving on to the next one, issue of securities. If you want me to tell the rule, then fair value of securities issued or fair value of investment acquired, whichever is more clearly evident. If these fair values are not there, face value of securities issued. But while telling the class, I told you like check out the fair value of securities issued. If it is not there, straight away face value. Because 99.99999% in this context, always there will be fair value of securities. Respond everybody clear. But the strict provision is this one. If two fair values are available, then first preference will be fair values of securities issued. The second preference will be fair value of investment acquired. Respond everybody clear. The difference, if any, will be transferred to securities premium. I mean to tell, say investment account debtor to equity share capital. 2 shares are issued at 10 rupees 20. 2 shares market value 40 rupees 80. Whatever the difference 60 is there, it will be transferred to securities premium. In this context, you might get one duffed out. If 2 shares are having face value of only 8 rupees, then it will become 16 kada sir. But at that time, you are not supposed to write discount on issue of securities. That's wrong. Clear everybody? Straight away it can be transferred to P&L account at that moment. Respond understood? My dear children, this situation exists only theoretically. This will never exist practically. Why sir? If the market value of the share is less than the face value, are you a fool to purchase an investment by issuing the security? Hope the concept is clear for you. Yes sir kada. Meer chepparu. And that's all about initial recognition. Sir, hope the last point is clear for you. I mean to tell, if the share value is less than the face value, and if you're telling, sir, I will issue the share, you give me the investment. What is your market value? Less than the face value, sir. Get lost. He is not willing to take. So practically that situation is not possible. If exists, it will be like this. Shall I proceed further? Now the next concept is all about subsequent recognition. What is the next concept, my dear children? Under subsequent recognition, it actually depends on classification. What is the classification of investments that you are having? Current investments and long-term investment. Long-term investments are those investments which are not current investments. Current investments are those investments which are held for a period. Not which are not long-term investments. Current investments are those investments which are held for a period less than or equal to 12 months from the date of investment or date of purchase, but not from the date of balance sheet, my dear children. Clear, everybody? Less than or equal to 12 months from the date of purchase of investment, and it should be readily realizable. It should be readily, and hence we have given one of the questions also. If you are purchasing a land at a backward area, your intention is to sell within 12 months only, even though it's not called as a current investment, because land itself market is not readily realizable. Land at a backward area, impossible. Sir, logic understood? Purchase the land at backward area where you would like to sell it within 12 months only, even though it will become long-term investment. It will not become current investment. Reason being, land at backward area is not readily realizable. Respond, everybody, clear? So point that you have to understood is all about two conditions should satisfy, not just one condition. Respond, everybody, clear? And moving on to the next thing, valuation. If it is current investment, it must be valued at cost or fair value, whichever is lower. If it is long-term investment, it has to be valued at cost price. Temporary fluctuations have to be ignored. Permanent increase has to be ignored, but permanent decrease has to be considered. In this situation, long-term investment has to be recorded at fair value. Permanent increase after permanent decrease. Once it is decreased, now you would like to increase again. At this time you can do it, provided it should be limited only up to cost price. Respond, everybody, clear? This is all about investment accounts. Subsequent recognition. Respond, everybody, clear? And moving on to the next thing, my dear children, reclassification. Sir, initially you thought of like you would like to hold the investment, but later on you have decided to sell the investment. So it is reclassified from long-term investment to current investment. Or initially you thought of like you would like to sell it, current investment, but later on you would like to hold it, and hence it's long-term investment. Now, if it is long-term to current investment, if it is long-term to current investment, it has to be recorded at cost or book value, whichever is lower. If it is current to long-term investment, cost or fair value, whichever is, very important, as on the date of reclassification. In your standard, the terminology is nothing but date of transfer. Date of transfer. Transfer is nothing but date of reclassification. Respond, everybody, clear? Why this rule? Very simple. From long term to current, in future it is current investment, but today is the date of reclassification. So today is the last day to become long term. So you have to follow the long term rule. What is the long term rule? It has to be valued at cost price. But sometimes book value might be lower than the cost price because you might need to write off the permanent decline. Am I correct or wrong? And hence the rule is cost or book value, whichever is lower. Current to long term. This is the date of reclassification. From tomorrow it will become long term. So only the last day to become current investment today. So value it immediately. As per the principle of current investment. What is the principle of current investment? Cost or fair value, whichever is lower. Simple. If it is reclassified from current to long term, follow the rule of current investment. If it is reclassified to long term to current, follow the rule of long term. Rule of current, cost or fair value, whichever is lower. Rule of long term, actually cost price. But sometimes book value is lower and hence cost or book value. Respond, everybody, clear? Shall I proceed further? So that is all about reclassification. Now, This is one of the problems which is also an examination problem. To decide whether it is long term or current investment, you need the intention to hold period. Whether you would like to sell it after 12 months or you would like to sell it before 12 months. I need that one. But in one of your examination questions, he did not give the intention to hold. He had given the date of purchase and he had given year endings. Clear everybody? He had given the date of purchase and given the year ending. Clear everybody? Say for example 31/3/2021 is the year ending. You have purchased the investment on 1/4/2019 itself. Long term or current term? Is it long term or current? 200% long term. Because you are holding the same for more than 1 year. And your intention is also to hold more than 1 year only. Logic clear? You are holding it for more than 1 year. So your intention to hold is also more than 1 year. My dear children, if at all you are purchasing an investment on 1/9/2020, now how you are telling it is short term? Ayyo, even though you are purchasing an investment on 1/9/2020, to decide whether it is long term or short term, first of all I have to question what is your intention of holding. Sir, I'll hold this investment for next 10 years. Long term. I will sell within 12 months. Current or short term. But this data is actually missing in that question. So now how to consider? Since there is no other option, you have to do the wrong answer only. That wrong answer itself will be the correct answer because the data is not there. And that wrong answer is nothing but, actually, you have to see the holding period. Clear everybody? As you people said, from 1/9/2020 to 31/3/2021 is less than or equal to 12 months and hence assume it as a short-term investment. Respond everybody clear. To decide current or long term, you have to see the intention to hold. If this intention to hold data is not there, you have to consider the period of holding. Respond everybody clear? Last and final with respect to the standard related aspect, the difference between initial recognition and subsequent recognition, or the difference between the book value and reclassified figure has to be transferred to P&L account. Respond everybody clear? And let me move on to the next one, which is all about the problematic related part of investment. And the problematic related part of investment are actually divided into two types. Number one, investment in debentures or bonds or government securities, which will give you fixed return. Number two, investment in equity shares, which will give you variable return. In the problematic context, investment in preference shares is absolutely not bothered because preference share is not actively traded. Now, if it is fixed return like debenture, bonds and government securities, it is very, very simple. You have to check out X interest price plus interest is equals to cum interest price, which implies that cum interest price is nothing but, which implies that X interest price is nothing but cum interest price minus interest. Clear everybody? You have to check out the question. Sir, I told you like if investment is acquired at cash or credit, it has to be recorded at dash plus dash. Purchase price plus direct expenses. Purchase price is nothing but dash price, quoted price. This quoted price can become either X interest price or cum interest price that is chosen by that particular business concern. I respond clear. That business concern can choose on what price it can quote. It can quote either on X interest or it can quote either on cum interest. Respond everybody clear. Now, coming to the X interest price, listen very, very carefully. X interest price is equal to dash minus dash. Cum interest price minus interest. Cum interest price is equal to X interest price plus. Now, the biggest point that you need to take care is all about interest here. Interest is always computed for break-up period. Some of the people might not know the terminology that it is break-up period, but break-up period is nothing but last date of interest to date of transaction. I hope you know this one, but the terminology is nothing but breakup period. Hey, respond everybody clear. Sir, my dear children, in fixed income bearing securities investment, interest has to be computed for dash period, breakup period. Breakup period is nothing but last date of interest to date of transaction. What is breakup period? Last date of interest to date of transaction. Now listen very, very carefully, everybody. Say for example, 31(3) and 39 is the dates of interest. And your date of transaction is equal to 39. What's your breakup period now? Is the question clear? Answer. Interest dates 31(3) and 39. Your date of transaction is 39. What is the breakup period? I told you in the class itself that it is 6 months. I told you in the class itself very, very clearly that the breakup period is 6 months. And my dear children, if the date of transaction is 110, then it is 0. Listen, if the date of transaction is 39, what is the last date of interest for 39? 31(3). From 31(3) to 39, it is 6 months. If it is 110, 39 is the last date. So 39 to 110, it is 0 months. But there may be students who might have learnt that the breakup period of even this is also 0. But remember, I told you this by again considering the institute stand. In one of the RTPs which were released by institute material, it had very, very clearly done that if the date of transaction is equal to date of interest, then it is considering the breakup period as 6 months. If at all the date of transaction is exactly after the day of date of interest, then breakup period is 0. In your classroom notes and classroom materials, you are having date of transaction is a day after date of interest. But there is no such question that date of transaction is equal to date of interest. But remember, if date of transaction is equal to date of interest, then automatically 6 months is the breakup period. Respond everybody clear. Pakka. Hold on this thing because you might get such sort of elements in examination. So be careful. And let me proceed further. That's all about interest. And moving on to the next thing. Direct expense is always to be computed on quoted price. Direct expense is always to be computed on. Hey, doesn't mean that direct expense has to be computed on X interest price or direct interest has to be computed on cum interest price. No, I'm not telling that. It is always to be computed on quoted price. Quoted price can be either X interest price or cum interest price. And if it is purchase transaction, direct expenses have to be added. And if it is sale transaction, direct expense have to be deducted. These are the simple rules. Respond everybody clear. Quickly answer me. X interest price is equal to dash minus dash. Cum interest price minus interest. Cum interest price is equal to X interest price plus interest. Interest is always computed for dash period. Breakup period. Breakup period is nothing but last date of interest to date of transaction. If date of transaction is equal to date of interest, then the breakup period will be total period. If at all the date of transaction is exactly a day after the date of interest, then breakup period is 0. Respond everybody clear. And direct expense are always to be computed on dash prices, quoted prices. If it is purchase, direct expense has to be added. If it is sale, direct expense has to be deducted. Respond pakka. And one more last and final point for fixed income bearing securities. If you are seeing in the question that date of interest and year beginning are different. Company's date of interest are 31(3) and 39. But your year, investor year, this is investee date of interest. Investor's year is from 1/1 to 31/12. In this case, 3 months gap will be there. So for that 3 months, you have to record opening balances and closing balances of interest. Hope you have remembered. You have to record opening and closing balances of interest. Remember, that's very, very important. I mean to tell, yours is 1-1, right? So on 1-1, you will be writing 2 balance brought down. 3 months already completed, but interest not yet received. Earned but not received, accrued but not received, accrued but not due. Because it will become due on 31/3 again. Hey, is the concept clear? 3 months interest earned, but did you receive it? Ante it's nothing but outstanding kada. Is it due now? No, it will become due only on 31/3 and 39. On 1/1 it will not become due. On 31/12 it will not become due. But the 3 months interest you have earned but not due and hence not received. So this has to be recorded as opening outstanding interest receivable. Respond, everybody understood? And one last thing, my dear children, what's that called? Remember, on a confusion note, you will be computing interest only for the holding period, but interest is always to be computed for the total period. Remember, is it clear? I mean to tell, say for example, you are purchasing an investment on 1/1. Your interest date is 31/3. How many months interest you will receive on 31/3 now? 3 months or 6 months? 6 months interest you will receive, because first 3 months you will be already paying to the outsider kada. Don't forget, this is an important point. Respond, everybody understood? Is the concept clear, everybody? And for the purposes of solving the problems, you are having 2 methods. One is FIFO method and the other is weighted average method. FIFO method, first in first out. Please consider opening balance also. Under first in first out, you will be ignoring the opening balance hurriedly, but take care, opening balance is the first slot. And moving on to the next thing, weighted average method. Weighted average method is nothing but total price divided by total number of debentures. Respond, everybody clear? Let me proceed to the next thing, my dear children. Equity shares. Under equity shares, you have to learn 3 things. Number 1, bonus. Number 2, dividend. Number 3, rights. Bonus. Bonus is received at free of cost. Bonus is received at? There is no journal entry for receipt of bonus. My dear children, I am not telling there is no journal entry in company's books. At the time of telling buyback, we have seen the journal entry. CRR or free reserves account debtor to bonus to equity shareholders account, bonus to equity shareholders account debtor to equity share capital account. Clear, everybody? Now, here in company books there will be journal entry, but in shareholder books there will be no journal entry, but it will be posted in number column. It will be posted in dash column, my dear children. Number column. There will be no journal entry, but it will be posted in number column. Respond, everybody clear? Moving on to the next thing, dividend. My dear children, there are 2 types of dividend. Number 1 is interim dividend. Number 2 is final dividend. Interim dividend is always a revenue item. You will receive interim dividend on each and every share that is there till that point, including bonus shares and right shares. Interim dividend is received on both bonus shares, right shares, original shares, and interim dividend is always a revenue item and it will be transferred to P&L account. Respond, everybody clear? But coming to the final dividend, point number 1, final dividend is not received on current year bonus shares and current year right shares. Because final dividend is received for current year, for last year. For last year in current year. You have issued the bonus shares in current year. So how will you get final dividend on those shares which are issued in the current year? Clear? Current year new issues, final dividend will not be received. Current year new issues, final dividend will be received or will not be received? Will not be received. Clear, everybody? Now you have to check out whether this final dividend is pre-dividend or post-dividend. Interim dividend is always dash dividend. Post-dividend, are cheppam kadra, revenue item. Interim dividend is always dash dividend, post dividend, and hence it is revenue item. But coming to final dividend, you have to check out whether it is pre or post. Very simple. Pre is the dividend which is received for non-holding period. Post is the dividend which is received for holding period. Let me give you the simple shortcut. If at all on opening balance you are receiving, it is called as post. If at all on current year purchases you are receiving, it is called as pre. Current year you have purchased and you are receiving the dividend for last year, the period which you did not hold. So it is pre. Last year you are holding and also received in the current year, and hence it is nothing but post. Respond, is it clear? So take care, if you are receiving the dividend for holding period, it is post. Last year I am holding, that is nothing but my opening in the current year. On opening, if you are receiving, that is nothing but post. Last year I am not holding, current year newly purchased. On those shares I am getting dividend for last year for the period which I am not holding, and hence it is pre. Respond, everybody understood? So conclusion, interim dividend is always dash, post. Final dividend on opening balance, it is post. On current year purchases, it is pre. Interim dividend is received on each and every number of shares that is existing at that point. Final dividend will not be received on current year new issues, current year public issue, current year rights issue, and current year bonus issue also. Respond, everybody clear? And whatever you are telling pre item, that has to be closed and transferred to investment account. Cost of investment reduces. Whatever you are calling it as post, it has to be treated as revenue item and it has to be transferred to P&L account. Respond, everybody understood? That's the end of dividend. Now let me go with the last and final part, right shares. My dear children, right shares, again shareholder is having three options. Point number one, company is giving right to equity shareholders at free of cost. Company is giving right to equity shareholder at free of cost. With this right, he is having three options. Either subscribe or renounce or ignore. Subscribe is nothing but converting right into right share by paying rights price, which is nothing but investment in equity shares accounted or to cash or bank account. Renouncing is nothing but selling the right to others at a price called value of right. But this price will be given in the question itself. So the journal entry will be, you are getting cash and you are selling the rights. And this sale of rights is nothing but income which has to be transferred to P&L account. Ignore, since he ignored, you also ignore. And one special case is there here. Sir, rights issue, if renounced, it has to be transferred to P&L account. But in the following situation, it has to be transferred to investment account and it has to reduce the cost of investment. What is that situation? That situation is having three conditions. Condition number one, shares are purchased at cum rights price. After becoming X rights price, the actual price fell down and it is representing a loss. And third condition, you are not subscribing the rights, you are selling the rights and you are getting the income. This income can be used to set off this loss and transfer to investment account but not to P&L account. Respond, clear? What is condition number one? Shares are purchased on cum rights price. After that, shares had become X rights price. Hope you know cum right and X right. Cum right implies including the right. X right ante excluding the right. So initially you purchased the share at cum rights price. Later on it had become X rights price. Respond, clear? And the next one. After becoming X right price, price is decreasing, representing a loss. And condition number three, you are having sale of right which is representing income. So use this income to set off the loss by transferring to dash account. By transferring to dash account, investment account, but not to, say for example, you are purchasing a share at 100 rupees on cum rights basis. After becoming ex-right, it had become 80, representing 20 rupees loss. You have sold the rights. You got 8 rupees profit. How much is the income you got? How much is the loss? How much is the loss? 20. How much is the income? So set off only 8. Clear. Remaining is loss itself. No, you can't do anything, Ra. Your loss is 20, but your income is only 8. So you can set off only. Remaining loss is loss only. A response clear. Say for example, if your income is exactly 20, set off. There's no profit, no loss. If your income is 24, set off 20. And remaining 4, hey, don't think it is profit to you. It is sale of rights income. So after setting off 20 loss, remaining 4 is there, which has to be transferred to P&L account as like normal sale of rights. Respond everybody clear. And that is the end of your rights issue. Last and final point with investment accounts. Remember, my dear children, multiple times computing weighted average price is not needed under weighted average method. You can compute one time and use the same weighted average price for the entire problem. But there might be situation where you might need to compute 2 or 3 times weighted average price. Listen, in all our problems, maximum it is something like this. You are having opening balance initially. Then you will be having purchases. Then again you will be having purchases. In some questions you are having conversions. Am I correct or wrong? And then you are having sale. And then closing balance. Okay, is it clear? So, to find profit or loss, you can go either for FIFO method or weighted average method. If no method is mentioned in the question, dash method is followed. Weighted average method. For equity shares, always weighted average. For debentures, if FIFO is given, you have to follow FIFO. Now, the next one, which is very, very important. Take care. At the time of sale, you will be computing weighted average price, kada? Response, sir. The same weighted average price can also be used for closing balance. Clear. Say for example, in between if you are having purchases, then this weighted average price is different. This weighted average price is different because one more purchases is there. Remember, my dear children, weighted average price changes with purchases but not with sale. Because sale and you are selling something. Why your cost price will change? Your cost price will change only with purchases. Respond clear. So you can come in all our problems are designed like this. Compute weighted average price once and follow the same weighted average price. But in between sale and closing balance or in between 2 sales, if there is another purchase and then you have to compute weighted average price once again. They respond everybody clear. That's it, my dear children. And in one of the problems, it was given that bonus shares are sold. Don't think that bonus shares are free of cost and hence cost of bonus shares is 0. No, that's wrong. Because you are following weighted average method. Respond clear. Maybe if in the question, if he had given FIFO method, then it could have been a different picture. For FIFO method, bonus share might be 0 cost. But under weighted average price, bonus shares cost is not 0. So take care. If bonus shares are sold, then don't think that cost of bonus shares is 0 because for all equity shares you have to follow weighted average method. Respond everybody clear. And my dear children, that is the end of investment accounts. Coming to cash flow statement, nothing great to explain, but whatever indirect method is there, that's all. That will take more time to tell actually. Coming to direct method, there's nothing great to explain at all. And anyways, let's start with cash flow statement, which is forming part of financial statements. So cash flow statement is a part of financial statements, and as usual accounting standard number 3 is taking care about cash flow statement. Likewise, how investment accounts is dealt as per accounting standard number 13. In the same way, cash flow statement is dealt as per accounting standard number 3. And let me continue. Cash flow statement is a part of financial statements, and cash flow statement is a statement which shows the inflows and outflows of cash and cash equivalents in activity wise. So now you're supposed to learn what is cash. Cash as per accounting standard number 3 includes both cash and bank. Coming to bank, which is nothing but business account, current accounts will be there. Not the savings bank account, not the recurring bank account, not the fixed bank account. Only current bank accounts are considered. And cash is nothing but which can be in coins, notes, etc. and etc. And coming to the bank here, it also includes foreign banks also. Foreign bank accounts will be included, or foreign currency will also be included in cash and cash equivalents, remember. And next one, cash equivalents. What do you mean by cash equivalents? Number 1, cash includes dash and dash, amma. Cash and bank as per accounting standard number 3, including the foreign currency also. And now moving on to the next one. What is that, amma? Cash equivalents. Tell me what is cash equivalent? Yes, cash equivalents are short-term basis. Number 1, simply to tell you, cash equivalents are in the form of investments. Investments for a short-term period and highly liquidable, negligible risk or insignificant amount of risk. Now, what do you mean by short-term period? Generally, short-term until less than or equal to 12 months. But as per accounting standard number 3, short-term is less than or equal to 3 months, not clearly 90 days, it's all about 3 months. And highly liquidable, in the sense easily convertible into cash. For your kind information, equity shares are also easily convertible into cash. Am I correct or wrong? But can they be called as cash equivalents? No, because high risk. So along with these two things, cash equivalent is also having another feature, that is negligible risk or insignificant amount of risk. Negligible risk or insignificant amount of risk. In the sense, risk should almost get minimized. Risk should get almost minimized, or very less amount of risk. Very, very remote risk antam kada in such a style. Respond everybody, clear? So tell me, cash equivalents are in the form of investments for a short-term period. Short-term is nothing but less than or equal to 90 days. Clear everybody? And the elements are highly liquid. Hey, yes or no? And what about the risk, Nana? Cheppali. Negligible or insignificant amount of risk. Respond everybody, clear? Investment in equity shares. Cash equivalents are not a cash equivalent because risk is more. Investment in equity shares for a period less than 3 months? No, it's not a cash equivalent. Investment in debentures or preference shares which are not actively traded for a period less than 12 months. Cheppalamma. Not a cash equivalent. Say investment in debentures or preference shares not actively traded for a period less than 3 months. Not a cash equivalent, because not actively traded implies cash cannot be easily convertible. Say debentures or preference shares investments which are actively traded for a period less than 12 months. Not a cash equivalent. If it is less than 3 months, yes, it is cash equivalent. Respond everybody, clear? And also investment in money market securities. What are those, amma? Money market securities. Like T-bills antuntarga. 91 days treasury bills, commercial papers, certificate of deposits, etc. all these things will be called as cash equivalents, because generally money market securities will be only up to 3 months and they can be easily convertible into cash. Respond everybody, clear? So what are the two markets? I mean, what are the cash equivalents, Nana? Definition of cash equivalent in the form of, please participate, in the form of, for a short term period. Short term in the sense less than or equal to, next one, highly liquid, which is nothing but easily convertible into cash, and risk is almost negligible or insignificant. Respond, clear? And moving on to the next thing, 3 activities. What are the 3 activities you are having? Operating activity, investing activity. Operating activities are those activities which are in due course of business and incidental to the due course of business. Those activities which are in due course of business are incidental and related to due course of business, or nothing but operating activities. Investing activities are those activities which are relating to acquisition and disposal of long-term of fixed assets or investments. Clear everybody? So investment activities are those activities which are relating to acquisition and disposal of both fixed assets and financing activities are those activities which are causing the changes in composition of capital funds. Composition of capital funds. This capital fund can be either borrowed capital or owned capital. Owned fund or loaned fund. It might be either equity share capital, preference share capital, or it also might be the loans. Respond everybody, understood? Now, I'll just ask you some things, you just tell me the answers. What is interest paid? Financing activity, because it is relating to loans. What is interest received? Investing activity, because you will be receiving the same. Rent paid? Operating activity. Rent received? Investing activity, because you will receive rent only on the land and buildings investments. Next, dividend paid? Financing activity. Dividend received? Investing activity. Commission paid? Operating activity. Commission received? Operating activity. Respond, clear everybody? Now listen very, very carefully. For banks, interest received and interest paid. Okay. For banks, dividend received. Investing activity. Dividend paid. Okay. Any other changes? Listen. Dividend received can be operating activity to the bankers. Because for bankers, they can, during their course of business, they can also invest. Banks and financial institution, investing institutions can invest. A bank's daily activities of the business is also included with investments. Respond everybody, clear? And hence for banks, dividend received is nothing but operating activity. For banks, dividend paid is financing activity, because dividend is always paid on share capital raised. Share capital is always Chapali. Financing activities. Respond everybody, understood? Answer me. For banks, loans given. Operating activity. What is it called? Deposits accepted. Operating activity. Loans and advance. Loans taken. Loans taken. Financing activity, because it will take loan only to finance its business. Clear everybody? So that's all about banks or special financial institutions. Take care. Respond. Shall I proceed further? And let me move on to the next thing. Insurance claim received. Which activity? If no clue is given, then it is recommended to consider as operating activity. If even that insurance claim is received on the damage of machinery, investing activity. On the damage of goods, Operating activity. But if nothing is given, just insurance claim received, then it is dash activity. Operating activity. Respond everybody clear. Okay, tax paid. You have to check out. If nothing is mentioned, operating activity. What about capital gains tax paid? Investing activity, capital gains tax. TDS on salary. So TDS on salary is not to be classified at all. Okay, in your context, it's operating activity because business concern is deducting and business concern is paying. Am I correct or wrong? Okay, TDS on interest paid. Financing activity. TDS on interest received. Strictly speaking, it's non-cash, but investing activity. Sir. Because TDS on interest received ante, say for example, you are receiving interest from an outside entity. It has to give 1 lakh, but it will deduct 10,000 towards TDS and it will give only 90,000 to you. I'll receive 90,000 in my hand. Another 10,000 TDS on interest received is not received by me. It is paid to the government. I will set off the same at the time of paying the tax. So frankly speaking, TDS on interest received is a non-cash item. Because what is the entry? You'll write cash or bank account debtor 90,000. TDS on interest received account debtor 10,000 to interest account 1 lakh. So out of this 1 lakh, only 90,000 is received. This TDS 10,000 is not received. And hence, strictly speaking, it's a non-cash item. But as per accounting standard number 3, it's a non-cash. But since it is relating to investing, let us call it as investing activity. Ante, it will be shown like this in your cash flow statement. Total interest income 1 lakh minus TDS deducted 10,000. Outer column will be 90,000. Respond everybody clear, ah? Whereas TDS on interest paid and TDS on salary paid is simple. I'm paying salaries 1 lakh. I'm paying TDS 20,000. Total comes to 1 lakh 20,000. Respond, sir. In the same way, interest also. I mean to tell, interest account debtor 1 lakh 20,000 to cash or bank account 1 lakh to TDS payable account 20,000. TDS payable account debtor to cash or bank account 20,000. Sir, respond everybody understood. I mean to tell that whatever the TDS that was deducted, it has to be remitted to the government immediately. Respond everybody understood. This is all about tax. Shall I proceed further? Listen very carefully and answer. What is it called? Profit on sale of investments. Please respond. Investing activity. Loss on sale of investments. Non-cash. Because you won't receive loss in cash, amma. But it is relating to investing activity as per accounting standard number 3. Respond everybody understood. Profit will be received in cash. And hence profit on sale of investment is nothing but investment activity. But loss on sale of investment will not be received in cash and hence it is not to be considered as if it is cash item. Since it is not received, it is not a cash item. It is dash item, non-cash item. But it is investing activity as per accounting standard number 3. Respond everybody clear. And let me proceed further, my dear children. Listen very, very carefully, everybody. So now this cash flow statement is totally divided into 2 types or 2 methods. Number 1 is direct method. Number 2 is indirect method. It's a wrong impression by the students. Always direct method is easy and indirect method is tough. No. Even there are tougher problems in direct method also. Because under direct method, what generally we are going to do? Listen very carefully. Under direct method, what generally we are going to do? We will take the cash book as base. We will take the cash book as base and we will prepare a cash flow statement. Whereas under indirect method, we will take P&L account as base and we will prepare cash flow statements from operating activities. Whereas coming to investing and financing activities, for both direct method and indirect method, it is same. Respond clear? My dear children, what are the three activities we are having? Operating activities, investing activities, financing activities. And what are the two methods we are having, Nana? Direct method, indirect method. And coming to operating activities under direct method is prepared from dash think cash book. Under indirect method, P&L account. Whereas investing and financing under direct method, cash book. Under indirect method is also from cash book. Respond everybody, logic clear. Now let me proceed further. Under direct method, if cash book is given, it is the super easy problem. Because he is giving the cash book, you just need to segregate the activities, and after segregation of activities, you just need to present in the form of cash flow statement. Likewise, cash flows from operating activities. All the inflows will be added, all the outflows will be deducted. Cash flows from investing activities. All the outflows will be deducted and all the inflows will be added. And cash flows from financing activities. All the inflows will be added and all the outflows will be deducted. In this course of action, listen very carefully. If any extraordinary items are there, then those items must be disclosed separately. And if any tax paid is there, it also has to be disclosed separately. Respond everybody clear. Hey, not capital gains tax, not TDS, tax paid, which is nothing but provision for tax or current tax. Hope you have remembered. If any current tax, CT or provision for tax is paid, that has to be disclosed separately. And if any extraordinary items are there, that has to be disclosed separately. And it is also recommended to disclose exceptional items separately. Strictly speaking, only dash items have to be disclosed separately. Extraordinary items as per accounting standard number 3. But it is also recommended to disclose exceptional items separately. It's recommended. It's not as per AS3. It is a generally accepted accounting principle. Respond everybody clear. And after the completion of these things, you have to do the reconciliation. Take the opening balance of cash and cash equivalents. Find the changes in net cash flows during the year. How to find it, sir? Operating activities plus investing activities plus financing activities. And finally, you are going to get closing balance of cash and cash equivalents. Respond everybody clear. My dear children, this is dash method. This is dash method, direct method. So you can prepare direct method very easily just by classifying the activities, whether is it operating, investing or financing. You can classify the activities with the help of cash book. You can classify the activities with the help of. But direct method problems will be going to be tougher to you if at all cash book is not given. And instead of cash book, he will be giving you P&L account and corresponding balance sheet information. If he had given like this, then of course direct method is also tough. Because you have to convert each and everything into cash. Say for example, wages incurred will be given in dash account, P&L account, but in cash flow statement. Listen, wages paid is given in dash account. Hey, please respond. Wages paid is given in dash account, my dear children. P&L account. Wages, strictly speaking, I'm sorry, wages incurred will be given. But for cash flow statement, you need wages paid. So these two things must be adjusted with outstandings and prepaids. Am I correct or wrong? This P&L account is like income and expenditure account. This cash flow statement is like receipts and payments account. If income and expenditure is account is given, and if you're supposed to pay receipts and payments, draft the receipts and payments account. However, you have to do the adjustments like that you have to do. Let me tell you, in general, expense paid, add current year outstanding minus last year outstanding, add last year prepaid and minus current year prepaid, and then you are going to get expense incurred in P&L account. Now in your question this data is given. In your question this data is given and these things were given. This will become balancing figure. So do you need to do the forward working or the reverse working? In the sense, current year prepaid has to be added, last year prepaid has to be deducted, last year outstanding has to be added, current year outstanding has to be deducted. Respond everybody clear. You can do the same working even for income, but instead of payment you will be booking the word like received. Income received. Respond clear. But those students who are habituated to draft the account, it will be like this. Expense account. Expense account debtor. Sir, listen very carefully. Outstanding expense is a liability. What is the outstanding expense? So opening outstanding and closing outstanding. Opening prepaid expense is an asset and closing prepaid, and expense account debtor to cash or bank account, while closing the expense P&L account debtor to what is the closing entry for expense? P&L account debtor to expense account. So in expense account you will be booking a dash side, credit side, by writing by P&L account. This is given and these elements were given. So this will become balancing figure. Respond everybody clear. Whereas if you are working out the same for income, it will be exactly opposite. Respond everybody understood. Okay. So that is all about your direct method when P&L account information and relevant balance sheet information is given. Like this, you have to convert all the expenses and all the incomes. Now still we have to work out on sales and purchases. How to find it, sir? My dear children, first of all check out the question carefully. Are there any credit and cash sales and credit and cash purchases? Find it first. If any cash purchases and cash sales are there, immediately book it in cash flow statement. And for credit sales and credit purchases, it is recommended to draft debtors account and creditors account. Debtors account opening balance, closing balance. Debtors account debtor to sales account, and finally by cash or bank account. This will be given, this will be available, and this will become a balancing figure. And coming to creditors, opening balance, closing balance. By purchases, finally payment to cash or bank account. This is given, these two will be available, and this will become balancing figure. Amount paid to creditors, amount received from debtors. Respond everybody understood. So this is all about your direct method when the P&L account and relevant balance sheet information is given. Respond everybody clear. Sometimes he might block you in a question with different styles. He won't give P&L account and also he won't give relevant balance sheet information. He will give some, what is it called? Some points will be given on a random basis. Ante. He will be giving some points just in a random basis. Apart from that, he don't give any other thing. Random basis in the sense, there will be no base for that. He'll pick some points and he'll give you the information which is relevant to cash flow statement. Like that, in one of the questions, you will be provided with some data like this. All the sales were made in cash, which implies that there are no credit sales. Total sales can be comfortably taken to cash flow statement. Some other information. He will be giving about wages. He will be giving about opening stock. He will be giving about closing stock. And he is also telling the total purchases. Sorry. This will not be given. Clear everybody? And he will be giving gross profit. he will be giving creditors information like opening balance of creditors and closing balance of creditors and how much amount is paid to the creditors. Respond everybody clear. So point number 1, all the sales are made in cash, which implies that there is no credit sales at all. But what about purchases? He did not give anything in the question. Whether is it credit purchases or cash purchases, he did not give anything in the question. But instead of that, this total data is given. Ante just to check whether purchases is cash purchase or credit purchase, this much data is there. Wages, opening stock, closing stock, gross profit, creditors opening and closing, amount paid. Now how to find whether the purchase is cash or credit? Now you have to draft two things. Number 1, trading account. What is the first one you have to draft, my dear children? In trading account, you will be getting a balancing figure called GP is there, sales is there, wages, opening stock, closing stock is there. So what is a balancing figure? What is a balancing figure? Can it be more clear? Total purchases, which implies that it is nothing but both cash and credit purchases. Of course, some of your friends told net purchase is also correct, but it is net total purchase. I want it as total. Next, with this information number 4, you have to prepare creditors account. Opening cash, opening balance is there, closing balance is there, amount paid is there. Now again you will get a balancing figure. And that balancing figure is nothing but credit purchases. And my dear children, if total purchases in trading account is equal to credit purchases in creditors account, then total purchases are credit purchases. This is how you have to find that. Respond, is it clear? Say for example, if total purchases are greater than credit purchases, then the difference is nothing but cash purchases. If total purchases is less than credit purchases, such kind of situation will never arise. Because total purchase has to be transferred to P&L account, kada sir. Sir, if at all such kind of situation is there, Manam, see, we always think that that kind of situation will not be there. But in exam, we'll get only that kind of situation. Say for, let me tell you, purchases balancing figure in your trading account is 4,99,000. Clear? Creditors balancing figure purchases is 5 lakhs. Think carefully, you will get it. Discount. Discount is used for payment, amma. Perfect answer. This is nothing but purchase returns. So you have to understand that this is nothing but a kind of purchase returns, because you will be getting net purchases in trading account, kada. So in such a case, 1,000 has to be treated as if it is purchase returns. Anyways, my dear children, is the whole concept clear? Okay, and there will be some extraordinary items in your problems, and those extraordinary items are insurance claims okati, voluntary separation cost or voluntary separation payments okati, and one more thing, what is it called? Compensation paid okati. I mean to tell, there are many extraordinary items, but in all the institute sources relating to cash flow statement, these are the 3 extraordinary items that are available, and in cash flow statements, these must be presented separately. Respond everybody, clear? Separately is nothing but cash flows from operating activities before extraordinary items, cash flows from operating activities before tax, tax paid, cash flows from operating activities after tax. Is it clear? I mean to tell, did you remember cash flows from operating activities? All the inflows have to be added, outflows have to be deducted. Then you will be getting cash flows from operating activities before extraordinary items. And then you have to adjust all the extraordinary items. and then you are going to get cash flows from operating activities before tax, and then you have to deduct tax paid, and then you are going to get cash flows from operating activities after tax. Respond everybody, understood? Okay, so generally the extraordinary activities as per your institute material or insurance claims okati, voluntary separation cost or voluntary separation payments. Voluntary separation payment ante you will be having in tax kada, voluntary retirement. To those people we will be giving some amount which is nothing but voluntary separation cost and compensation paid on account of suing by outsiders. A case has been sued on our business concern by the outsiders, for which we have to pay the compensation. Respond everybody, clear? And my dear children, this is the end of dash method. Direct method is absolutely done. And now I have to start with dash method, amma. Indirect method. Coming to indirect method, be careful. Under indirect method, operating activities and investing activities and financing activities, it is as same as direct method, but the difference is always only with dash method, dash activities, operating activities. So listen very, very carefully. Under indirect method, operating activities is prepared from Chapali P&L account. Under dash method, indirect method, dash activities, activities are prepared from dash account, P&L account. Shall I proceed further? Now, my dear children, net profit is available to you. You have to convert this net profit into operating activities of cash flows. What is your aim, Mama? Converting net profit into cash flows from operating activities. Now, first of all, net profit. Which net profit I have to consider, sir? Is it, wait. Is it net profit before tax or minus provision for tax? Then you are going to get net profit after tax. And this is net profit before appropriations minus appropriations. My dear children, there will be many appropriations again. But as per cash flow statement, only two appropriations will be considered. Number 1, dividend declared. Number 2, transfer to reserves and surplus. What are the two appropriations, Amma? Dividend declared, transfer to reserves and surplus. And then you are going to get net profit after appropriations, which will be straight away carried forward to balance sheet, and this will be added to P&L account. Sir, cheppandi, everybody understood? So now which net profit you have to take? Net profit before tax. Which net profit you have to take, Amma? Net profit before. This is as given in cash flow statement. Ante, in your cash flow statement under indirect method, it was given as net profit before tax. Sir, if net profit before tax is not available, what to do? Find it by taking net profit after appropriations. Add back appropriations. Then you will be getting net profit after tax. Then add back provision for tax. Then you are going to get net profit before tax. Respond everybody, understood? So be careful. This is what the first part that you need to remember. Respond clear. So tell me how to find net profit before tax, Amma? Net profit after appropriations. Add appropriations. What are the two appropriations you are having? Dividend declared, transfer to reserves and surplus. And then you will be getting net profit after tax. For this one you have to add provision for tax. And then you are going to get finally net profit before tax, which has to be considered for the purpose of cash flow statement under indirect method. Respond everybody, clear? Okay, now let the business concern start its indirect method by considering net profit before tax. Sir, what is your aim? Converting net profit into Cash flows from operating activities. Point number 1. Net profit is a combination of cash and non-cash activities. So net profit is available in dash account, P&L account. P&L account is a combination of cash and non-cash activities. Respond clear, huh? You need only dash flows, cash flows. You don't need dash items. And hence eliminate all the non-cash items. Eliminate all the non-cash items. What are all the non-cash items available? Depreciation is a non-cash item which has to be added back. Loss on issue of debentures is a non-cash item, or discount on issue of debentures is a non-cash item which has to be added back. Inka. Appreciation, if any is there, it has to be deducted. Because appreciation is income kada. If income is deducted, overall profit will increase. Increase or decrease? Decrease or if income is eliminated, overall net profit will decrease. Respond clear. If non-cash expenses are eliminated, your profit will increase and hence have to be added. If non-cash incomes are to be eliminated, then automatically your overall net profit will decrease. Respond everybody, understood? And even loss on sale of asset, what to do? Added under dash item. Non-cash expense, investing activity. I hope you have remembered. Loss on sale of asset is also a non-cash item. So it has to be eliminated by added. But even though it's a non-cash item, it is an investing activity as per accounting standard number 3. Respond pakka. What is depreciation activity as per AS3? Non-cash. It's neither classified under any activities. Hey, logic clear? Depreciation is neither operating activity nor financing and nor investing activity. It's non-cash. Ante. But loss on sale of asset is clearly classified. Even though it is non-cash, it is to be treated under investing activity only. This was clearly clarified by AS3. Similar item is TDS on interest received also. TDS on interest received is also non-cash. But even though it's non-cash, it is classified as investing activity. Clearly classified again by accounting standard number 3. Respond everybody, clear? Okay, so all the non-cash have to be eliminated. All the non-cash have to be eliminated. And then you will be left only with dash items. Cash items. But again there is a problem. Your cash item is a combination of operating activities, investing activities, financing activities. But what is your aim? Conversion of net profit into cash flows from operating activities. But cash items are combination of investing, financing, operating. You want only dash activities? You don't want dash activities? And hence investing and financing have to be eliminated. Clear? Investing activities. Investing incomes have to be eliminated by deducting. Investing expenses have to be eliminated by adding. Financing incomes have to be eliminated by deducting. Financing expenses have to be eliminated by adding. Simple, Nana. If it's an expense, eliminate by adding the expense. If it's an income, eliminate by deducting the income. But there's one more point here. If it's investing activity, then generally no investing expense will be there. If it's financing activity, generally no financing income will be there. Investing is always income, financing is always expense. Respond clear. Something like interest paid is financing expense. Respond clear. Interest paid is dash expense. And discount on issue of debentures, loss on issue of debentures is non-cash. Whereas coming to investing activity, interest income received, profit on sale of investments, these are incomes which have to be deducted. But loss on sale of investment is non-cash. Respond clear. Now remember one more thing. those activities which are not satisfying the definition of three activities: operating, investing, financing, then it comes under operating activities. Respond clear? Those activities which did not satisfy all the three activities, then it will be considered as dash activities, operating activities. Respond everybody clear? Shall I proceed further? Now listen very carefully. What is prepayment penalty? As per age 16, you are having prepayment penalty. Did you remember? Prepayment penalty is the penalty which is paid before the expiry of the loan term. Is it clear? Now what is prepayment penalty under dash activity? So do you know? I mean, you got the question right. Prepayment penalty, financing activity. Correct or wrong? Actually, it's a wrong answer. Listen. It comes under operating as per standard. I'll tell you the reason. Listen. Sir, prepayment penalty is not causing any change in the capital funds. Prepayment penalty is not causing any change in the capital funds. Respond clear. Prepayment penalty and you are paying extra. Say if your loan is 1 lakh, you are paying 1,10,000. Respond clear. Say if your loan is, you are paying, and logically speaking, it is not causing any change in capital funds. Moreover, one more point has to be considered. As per accounting standard number 16, borrowing cost includes only those ancillary costs which are relating to acquisition of borrowings but not relating to settlement of borrowings. Gurtochinda? As per accounting standard number 16, ancillary cost includes borrowing cost only when they are relating to acquisition of borrowings but not relating to settlement of borrowings. Respond everybody clear? So what is prepayment penalty classification? If you take accounting standard number 16 as base for classifying as per accounting standard number 3, then prepayment penalty should not become financing activity. It has to become operating activity. But there might be some other business concerns who will be classifying it as financing activity on the stand that since that prepayment penalty is paid on account of clearing the loan, since it's a financing activity, since loan is a financing activity, prepayment penalty is also a financing activity. They respond, is it clear? As per the base of accounting standard number 16 linked to accounting standard number 3, we can classify prepayment penalty is an operating activity because it is not a borrowing cost. But some other business concern can classify prepayment penalty as a financing activity on the stand that this is relating to loan. Since loan paid is a financing activity, prepayment penalty paid on loan is also a financing activity. Now what is to be written in the exam? Write the both things. Yes, it's recommended to write both things because listen, my dear children, for those elements which are not clarified by the institute material, but whenever there are different approaches for answering, it is recommended to write all the approaches for answering. Okay. I hope the concept, the point is absolutely clear to each and everyone. Sorry, let me come back. Baga sync ayindi. Investing activities will be generally income. Financing activities will be generally expense. All the expenses will be eliminated by adding and all the incomes have to be eliminated by deducting. Respond everybody clear? And finally, you will be left only with cash flows from operating activities in your P&L account. But the real problem starts now itself. Hey, what's your aim actually? Converting net profit into cash flows from Operating activities. So P&L account is included of both cash items, non-cash items. Eliminate non-cash items. You will be left only with cash items. Cash items includes both operating, investing and financing. Eliminate these two things. So you will be left only with operating. But the real problem is that these cash flows from operating activities are there in P&L account. But you need to prepare cash flow statement, which implies that again each and every item has to be converted from P&L account to cash. But this time we are not going to adopt what we have done under direct method. Under direct method, what we have done for expense account and income, for expenses and incomes, we have drafted the accounts. Did you remember? Or expense paid, add current year outstanding minus last year outstanding, like that we have done. For debtors and creditors, for sales and purchases, identified how much is cash, identified how much is credit. And for debtors, we have drafted debtors account, and for credit purchases, we have drafted creditors account. And cash paid and cash received is considered. But here we are not going to do that one. Then what are we going to do for this thing, sir? For conversion of those items from P&L account to cash flow statement, we will adopt a new point called working capital change. What is that, Amma? Working capital. This is applicable only to those current assets and those current liabilities which are related to operating activities. That is very, very important. Sir, working capital change is applicable only for current assets and current liabilities. Ante tappu. Applicable for current assets and current liabilities which are relating to operating activities. Ante there are some current assets which are not operating. There are some current liabilities which are not operating. For that you have to go with normal procedure. Let me tell you. Say for example, wages outstanding is there. Interest outstanding is also there. Under liability side, under current liabilities, you are having both wages outstanding, interest outstanding. This is dash item. This is dash item. So working capital change has to be applied only for wages outstanding. For interest outstanding, working capital change should not be applicable. This has to be taken to cash flows from financing activities, and there you have to adjust normally. Ante interest paid, add outstanding interest minus last year outstanding, add last year prepaid minus current year prepaid. You have to adjust all these things. For those current assets and current liabilities which are relating to investing and financing activities. Respond everybody, clear? But those current assets and current liabilities which are in the nature of operating activities, you have to do the working capital adjustment. Working capital adjustments are nothing but check out from the last year to current year. From last year to current year, whether increase is there or decrease is there. Ante increase in current assets, decrease in current assets, increase in current liability, decrease in current liability. Respond everybody, clear? My dear children, you are learning dash adjustment, working capital adjustments, applicable only for current assets and current liabilities which are relating to operating activities. So you have to compare dash to dash. Last year to current year, you will get 4 adjustments. What are those 4 adjustments? Increase in current assets, decrease in current assets, increase in current liabilities, decrease in... No need to buy heart anything, no need to take anything. I'll tell you the simplest thing. Current assets, cash, it is having inverse relation. Current liabilities, cash, it is having direct relation. Because, hope you know balance sheet. Cash is here, current asset is here. If current asset is increasing, cash will decrease. Inverse relation. If current asset is decreasing, cash will increase. Inverse relation. Current liability is here. If current liability is increasing, cash also will increase. If current liability is decreasing, cash also will decrease. But there are some people who will be doing the analysis by assuming purchase of inventory. They'll assume purchase of inventory. If I purchase the inventory, inventory will increase, cash will decrease. So like that you will be doing. Even that is also okay. But remember, this is the simplest thing. Simplest thing is all about current assets and cash dash relation, inverse relation, current liabilities and cash. So simple, increase in current asset minus, decrease in current asset, add, increase in current liability, add, decrease in current liability, minus. Respond everybody clear. These are applicable only to those current assets and current liabilities which are relating to operating activities. Respond everybody clear. Except provision for tax. Except provision for tax. Because you are taking net profit before tax. You are taking net profit. So this has to be done separately. I'll tell you. Sir, as of now, is the whole concept understood to each and everyone? Okay, just answer me. Bad debts. How to adjust in cash flow statement? Bad debt has to be added back under non-cash expense. Am I correct or wrong? Wrong answer. Sir, one thing remember, if it is of easy and if it is of simple, why will I discuss that in marathon class? Prepayment penalty, it appears to be financing. So you told it is financing. Obviously it will be wrong and hence I will ask you here. This is not a class to discuss each and every simple item. I'll discuss only those items which are different. I know that you will tell this answer and hence I have asked you, which is wrong answer. My dear children, depreciation is non-cash. It has to be added in cash flow statement under non-cash expense. But bad debts has not to be done like that. Because it will get automatically adjusted when you adjust the debtors opening and closing balance under working capital adjustment. Hey, is it clear? No need to adjust bad debts. No need to adjust discount received. No need to adjust discount allowed. No need to adjust bad debt. But depreciation has to be adjusted. Enduku sir, discount received is not to be adjusted because creditors opening and closing balances is adjusted in working capital change. Discount allowed and bad debts are not to be adjusted because debtors opening and closing balance will get adjusted automatically while doing working capital change. Depreciation has to be adjusted because you are not adjusting fixed asset opening and closing balance, sir. Sir, is the logic clear? That's the end of your cash flow statement from indirect method with respect to operating activities. But let me tell you at a single stretch. Point number 1, your aim is to convert net profit into cash flows from operating activities. Here you are taking net profit before tax. And your P&L account is a combination of cash and non-cash items. All the non-cash items which are relating to investing activities and financing activities have to be adjusted. Non-cash expense have to be added. Non-cash incomes have to be deducted. Respond everybody clear. Simply to tell you, in another style I'll tell, wait. Non-cash items have to be adjusted except those non-cash items which are relating to operating activities. Because this will get automatically adjusted while doing working capital change. And hence here you should not adjust. Respond clear. So likewise, depreciation, discount on issue of debentures, loss on issue of debentures, even loss on sale of asset, appreciation, all these things have to be done. Respond clear, okay. Even to tell you, capital grant amortized. Capital grant amortized. No idea? Very good. If you received the grant, what is the entry? Cash or bank account debtor to GG or DGG account. Take, say for example, DGG only. So what is the journal entry? Cash or bank account debtor to DGG account. Clear everybody? Now close DGG. DGG account debtor to P&L. Will you close totally or partly? So what is the entry for closing part of DGG? DGG account debtor to P&L account, which is a non-cash item existing in P&L account. Logic understood? In P&L account, there is something called by DGG, deferred government grant. This is also nothing but non-cash income. The same has to be deducted. Respond everybody clear? So my dear children, if you observe asset depreciation, these are relating to investing. Correct or wrong? And discount, these are relating to capital and financing. This is appreciation, ante this is nothing but asset. This is capital grant, ante it is either relating to investing or financing. Ante no single operating activity related non-cash item was adjusted. Remember. Respond clearly. My dear children, I am not telling depreciation is investing activity. Depreciation is relating to investing activity. Antunna. Logic understood? I'm not telling depreciation is investing activity. I'm not telling bad debts is operating activity. Bad debt is relating to debtor, relating to operating. Depreciation is relating to fixed asset, relating to investing. I hope the concept is absolutely clear. Adjust those non-cash items which are not relating to operating and which are relating to investing and financing. Clear with part 1? Part 2. Now ultimately you left with cash items which is operating, investing, financing. Eliminate all the investing and financing item and you will be left only with operating items. But cash flows from operating items available in P&L account. You have to convert this into cash flow statement. For this purpose, you have to do working capital adjustments. So now, working capital adjustments are applicable only those current assets and current liabilities which are relating to operating activities. Respond everybody clear. So now tell me, increase. You have to compare from dash year to dash year. Last year to current year, like opening balance to closing balance. That's very, very important, Amma. Because sometimes opening balance will be given first, closing balance will be given next. Sometimes closing balance will be given first and opening balance will be given later. So finding opening and closing is very important in cash flow statements. And finally, you will get 4 adjustments. What are those 4 adjustments, Nana? Increase in current assets, decrease in current assets. Current assets and cash is having inverse relation. Current liabilities and cash is having direct relation. Minus, plus, plus, minus. Respond everybody pakka. And then you are going to get cash flows from operating activities before tax paid. So now you have to do minus tax paid and then finally you are going to get cash flows from operating activities. Respond everybody clear. Now in this context you have to learn some connections. Connection number 1. I'll ask you some current assets and current liabilities. Tell me whether they will be adjusted under working capital adjustment. If not, tell me under which activity it has to be adjusted. Respond clear. Start. Debtors. Working capital adjustments, operating activities. Creditors. Inventory. Interest received. Sorry, interest receivable. Interest receivable. Point number 1. What is interest receivable? Current asset or not a current liability? Current asset. Current asset relating to. So it has to be adjusted under investing activity. Interest payable. Financing activity. Clear everybody? Depreciation. Non-cash. It has to be adjusted there. Amortization. Non-cash. It has to be adjusted there itself. Respond everybody clear. Bad debts. No need to adjust. Why no need to adjust? Automatically adjusted. Discount received. No need to adjust. Discount allowed. Bank overdraft. It's a financing activity. What is bank overdraft, Amma? Okay, and I'll speak about bank overdraft within the next couple of minutes. Be careful with this. Keep it aside, okay? Next, current investments. Current investments. Will it be adjusted in working capital change? Even though it is a current asset, it will not be adjusted there. It has to be adjusted under investing activities. Respond everybody, pakka. That's the end, my dear children. And now moving on to the next special element, provision for tax. My dear children, even though provision for tax is a current asset, current liability. Even though provision for tax is a current liability relating to operating activities, it should not be adjusted under working capital changes. It has to be adjusted separately. Listen very carefully. What is provision for tax, asset or liability? Cheppali. It's having a credit balance, opening and closing. Listen, very important. If nothing else is given in the question except opening and closing, opening is paid in the current year, closing is created in the current year. Opening is paid in the current year. Because opening ante last year provision, last year tax has to be paid in current year. Current year tax will be paid in the next year kada, and hence it is existing as closing. Respond pakka. If nothing is mentioned, opening is paid in the current year and closing is created in the current year. So to cash or bank account by P&L account. This has to be deducted at the last cash flow statement before tax paid minus tax paid. This has to be considered. This has to be added at first. Net profit after tax, add provision for tax. This has to be added there. Respond everybody clear. That's all about the special item called provision for tax. And let me proceed further to the next one, dividend declared account. I hope you're getting the depth of cash flow statement. Actually, to tell you, my planned time is around 1.5 hours for cash flow statement because it's a very lengthy part. Of course, preparation of financial statements is comparatively very lengthy, but it is format based. But cash flow statement, you will be having many logics. If you have got a 5 marks question, you will be the super most happiest person. But if you have got a 14 marks or 7 marks question, the problem is that everybody will be feeling that cash flow statement is easy and they will start it. But in between, you'll stop there. But if it is coming to independent branches, nobody is ready to start the problem at all. Dividend declared account. My dear children, dividend declared. Dividend is dash activity, financing activity. And take care, even it is also a current liability. Opening balance, closing balance. Again same. If nothing is mentioned, opening is paid in the current year, closing is declared in the current year. Opening is paid in the current year, closing is declared in the current year. To cash or bank. This has to be considered under financing activities as a payment. Whatever the portion by P&L account, current year declared portion is there, this has to be added back while doing appropriations. Net profit after appropriations, add back appropriations. There you have to add it back. Respond everybody clear. And my dear children, if it is interim dividend, it will be created in the current year. It also will be paid in the current year. And two things should match in the current year only. Declared in current year, payment in current year. A respond clear. If nothing is mentioned, opening is paid in the current year, closing is declared in the current year. If it is interim dividend, it will be declared in the current year, payment in the current year. Respond everybody clear. So with respect to provision for tax and with respect to dividend declared, if you are having a different figures given, then automatically the remaining will become balancing figure. Ante opening is given, closing is given, payment is given. Created will become balancing figure. If created, it's not appropriation, provision for tax. So if at all creation is given, then cash or bank account will become balancing figure. Listen, for dividend, opening is given, closing is given. If stopped, opening is paid in the current year, closing is declared in the current year. But if declaration is given, payment will become balancing figure. If payment is given, declaration will become balancing figure. This is nothing but appropriation. Respond, everybody understood. So this is all about provision for tax account and dividend declared account. Shall I proceed further? Not yet over. You want break, huh? Sorry, relax for 2 to 3 minutes. And of course, just another 15 to 20 minutes concept is there with respect to cash flow statement. I have to start actually with provision for depreciation account. How the provision for depreciation account is there. Yeah, relax for 2 to 3 minutes. I'll start again. One more clarification. If at all debentures and preference shares are given like actively traded, then better not to take it as cash flow state, cash equivalent itself, because actively traded in the sense they are in the stock market. If they are trading in the stock market, then they will be very risky and hence better not to consider. I mean to tell, like if investment in equity shares, they are always actively traded in general if nothing is given, and hence it's not a cash equivalent at all. And if at all given like investment in debentures or preference shares which are actively traded, and you have to check out the risk. If nothing is given, it will be always risky, and hence even though less than or equal to 3 months, it is not a cash equivalent at all. But if at all it is such a kind of business concern where the risk is almost negligible, there will be some debentures which will be trading always just like 2 to 3 rupees around. Bond market is comparatively less risky. So in such a case, you can take it as cash equivalents. But if nothing is given, actively traded, better don't take it. Clear? I mean to tell, investment in debentures or preferences actively traded. Actively traded in the sense actively traded in stock exchange. So if actively traded in stock exchange, they will be generally always risky only. And hence don't take it as cash flow statement under cash equivalents. But if at all the risk is almost negligible, then you can consider. Okay. And while telling the initial part, I told you if they are actively traded for less than or equal to 3 months, then I asked you to take as a cash flow statement, cash equivalent. Okay. But actually the point here is that you have to compare the risk. If the risk is negligible, then it will become cash equivalent. Otherwise, it won't become cash equivalent. Of course, covering each and every minute element in marathon is not possible. But of course, anyways, you have to compare it with the risk. Okay. The next part, that's all about provision for depreciation. My dear children, in cash flow statement, another biggest task is all about provision for depreciation. If at all you are having only fixed asset account, then absolutely no problem. Opening balance, closing balance, 2 purchases by sales. And if at all profit is there, then automatically 2 P&L account, profit. If loss is there, by P&L account, loss. Am I correct or wrong? Because loss and loss is having debit balance. So P&L account debtor, 2 fixed asset account. And next, by depreciation. This is how the fixed asset account will be. Now, depreciation is a non-cash item and hence it has to be added. Next, cash or bank, sale. This is sale and hence it's an investing activity which has to be added. This is purchase, investing activity which has to be deducted. This is profit. So profit on sale of asset which has to be deducted while doing operating activities. Even this is operating. Loss is also under operating activities. While performing operating activities, it has to be added. So if it is a fixed asset account without provision for depreciation, this is the account that is available. Sometimes depreciation will not be given. If I was not wrong, there is one problem for you, Mr. Zen. Relating to Mr. Zen problem, a sole proprietor. He is a sole proprietor. If I was not wrong, again it will be there in ACSP. If not, that problem is not there. Listen. No, in one of the concept questions, we have included the same question, something like Zen's capital, opening capital is given, closing capital is given, and net profit is given. Concept question number 13 anta. Sir, listen. Sometimes, listen please. Sometimes, while drafting fixed asset account, he will not give the information relating to depreciation. So you have to find the depreciation. So for finding depreciation, sometimes he may give you opening balance, closing balance, and rates of depreciation. So depending upon rates of depreciation, like opening balance plus purchases minus sale multiplied by 15% will give you the depreciation. If at all you have purchased after 6 months, then you have to provide depreciation only for 6 months. If you are purchasing after 8 months, you have to provide depreciation only for 4 months. If you are selling after 9 months, you have to provide depreciation for 9 months. Yesterday we have learned, as per accounting standard number 10, depreciation has to be provided proportionately. So sometimes depreciation will not be given. At that time, with the available rate, you can find the depreciation. Sometimes depreciation will not be given, even rate will not be given. Instead of that, he will be giving you provision for depreciation data, or which is also called as accumulated depreciation. So provision for depreciation or accumulated depreciation is nothing but opening balance will be here, closing balance will be here, because it is a liability. And what is the entry for depreciation, amma? Depreciation account debtor to provision for depreciation when provision is there. So by depreciation account. Clear everybody? This will become balancing figure at that time. And if at all any asset is sold, then that related depreciation has to be deducted at debit side. Respond everybody clear. Sir, I am telling to depreciation on sale of asset. I hope it's clear. Respond everybody done. If at all total information is given, then fixed asset account will be like this. Now say for example depreciation data is not given. So for depreciation, check out if any rate is given. Apply the rate and find the depreciation. Say if rate is also not given, check out in the question if any provision for depreciation data is given. Hey, I am not telling provision for depreciation account. Provision for depreciation data. Then you have to draft provision for depreciation account like opening, closing, depreciation, and sale portion has to be debited. Because such portion of depreciation which is not needed now. PFD is having dash balance, credit balance. If at all it is increasing, credit. Now if at all any asset is sold, corresponding depreciation will decrease kada, and hence the same has to be debited. Respond everybody clear, huh? And this is what your PFD account. Sir, up to this clear? In question, he is telling that fixed asset is maintained at WDV only. But while drafting the fixed account, you did not get the depreciation. But in additional information, he given the data relating to provision for depreciation. In such a case, you have to do like this. Respond clear? Then automatically you might get any balancing figure in fixed asset account that will be counted as adjustment in a cash flow statement. So respond, is this adjustment clear? In balance sheet, fixed asset is maintained at WDV, but dash information is missing, depreciation. But in additional data, he is giving the information relating to provision for depreciation. So it is a sign to you to find the depreciation by drafting PFD account. Done everybody? This is style 1 of testing. Style 2 of testing. In balance sheet itself, fixed asset will be maintained at cost price minus accumulated depreciation will be given. Clear? Huh? In this case, you have to prepare fixed asset account at cost price. Opening, closing, cost price. But here it will be WDV. Take more care. Anyways, so fixed asset account at cost price, opening and closing is there. Now such portion which is purchased to cash or bank, purchase, sale by cash or bank. Very important, very, very important. Whatever the portion is sold, don't immediately write like cash or bank. You open a special account called sale of asset or disposal of asset account. Respond clearer? By sale of asset or disposal of asset account, which is the sold assets cost price. Now open one more account called provision for depreciation account. Opening, closing. Current year depreciation by depreciation. To sale of asset account, such portion of depreciation on sold asset. Such portion of depreciation on sold asset. Clear everybody? Now, my dear children, you have to prepare one more account called sale of asset or disposal of asset account. In such a case, to fixed asset account cost price by accumulated depreciation account, total depreciation on this asset, and finally here you draft the things by cash or bank account, by P&L account or to P&L account. I mean to tell this is loss and this is profit. Respond everybody clear? Ante first of all you have to check out the question. If question is having fixed asset only, then simply draft a fixed asset account like this. Problem solved. Put all the figures and find the balancing figure. Next, sometimes in the question fixed asset at WDV will be given, but wantedly he will miss depreciation and some other information. But for depreciation he will be giving one rate. You find the depreciation and go the balancing figure. Find the balancing figure. Clear? Sometimes fixed asset is given at WDV, along with depreciation some other figure will be missing, but no depreciation rate is given. In this case, in data he will give you provision for depreciation data. Open a PFD account, find the balancing figure depreciation, put the depreciation here and you find another balancing figure what is missing. Respond clear. Another style of testing is that in balance sheet itself fixed asset will be given at cost price and accumulated depreciation is separately given. In this case you have to prepare an account, fixed asset account, provision for depreciation account, sale of asset or disposal of asset account. Respond everybody clear? So this is what your fixed asset and accumulated depreciation. And next, some other points to tell you. Number one, bank overdraft. Sir, if at all bank overdraft is given you, like what is the activity of bank overdraft? Then you have to write it as a financing activity. Because bank overdraft is nothing but banker is extending a loan to you, which is nothing but a kind of financing activity. Respond everybody clear? But if at all you are doing a cash flow statement, if at all you are doing cash flow statement, no need to adjust bank overdraft at all. It will get automatically adjusted while doing the opening and closing balances of cash and cash equivalents. Why, sir? Bank overdraft is nothing but negative cash balance. What is bank overdraft, Amma? So what is bank overdraft, my dear children? Negative cash balance. So what happens? Opening balance of cash and cash equivalents, net cash flows changes during the year. If you add operating plus financing plus investing and if you find closing, automatically you will get a negative cash balance. I mean to tell, say if your opening is 1 lakh, but net cash flows changes during the year or 1,20,000. How much is opening? Cheppali, how much is opening? How much are the payments during the year? 1,20,000. So your balance is negative 20,000. Now you go back to the question and check. You will be having there bank overdraft negative 20,000. Respond logic clear, huh? If bank balance is at debit side, then closing will become positive. If bank balance will be at credit side, ante credit side. In other words, it is nothing but liability side. At that time, you will be having a negative balance. Respond everybody understood. Which implies that this 20,000 is the bank loan, which is nothing but a kind of bank overdraft. Respond everybody clear. My dear children, one more thing. I'm not telling this process for bank loan. Exactly for bank overdraft only, because bank loan taken is nothing but financing activity. What is bank loan taken? And it has to be adjusted in cash flow statement also. Bank overdraft is also dash activity, financing activity, but no need to adjust in cash flow statement. It gets automatically adjusted while drafting the cash flow statement. Respond everybody clear. What is bank loan? Financing activity. Need to be adjusted in cash flow statement or no need to adjust? Need to be adjusted. What is bank overdraft? Dash activity? Financing activity. But need to be adjusted or no need? No need, because it will get automatically adjusted while drafting a cash flow statement. Next, drawings is dash activity. Drawings is dash activity. Financing activity, because drawings will change the composition of capital funds and hence it's a financing activity, remember. And next one, advance tax. My dear children, be careful. In some questions you will be getting advance tax paid. Advance tax paid is also nothing but operating activity. What is advance tax paid, Amma? And next, interest paid if it is a qualifying asset. Sir, if nothing is mentioned, if interest paid, it is financing activity. But interest paid for a qualifying asset. Wait. If the qualifying asset is inventory, then interest paid is operating. If the qualifying asset is machinery, then interest paid will become investing item. Respond everybody clear. I hope you have got an exhaustive revision with respect to cash flow statement. Next concept, that is all about preparation of financial statements. So first of all, I'll discuss the main theme of my topic, that's dividend, and then I might discuss one or two different areas where you have to extend concentration. So first of all, dividend. My dear children, first of all, check out the question. If at all, first of all, check out the question very carefully. If at all your question, my dear children, be careful. If at all your question is having dividend declared on or before 31st March, then immediately adjust the same in your financial statements. If at all given in the question that dividend is declared after 31st March, say 2nd April, 3rd April, 4th April, like that, if you have seen, then remember, then don't adjust this in your financial statements. Respond everybody clear. This is point number 1 that should be understood. Now point number 2. If at all any proposed dividend is being seen in the question, this proposed dividend has to be disclosed in note to reserves and surplus. Remember, if at all any declared dividend is already seen in balance sheet, or I'm telling that it has to be adjusted in the balance sheet, kada, in such a case, this declared dividend has to be shown under other current liabilities. And check out the question. Sometimes you are having interim dividend directly given in the question. In all those cases, interim dividend has to be treated as appropriation. Respond everybody clear. Generally, what is the entry for dividend ante? What is the entry for dividend? First of all, declare the dividend. P&L account debtor to dividend declared account. Then pay the dividend. Dividend declared account debtor to cash or bank account. Whether it is interim or final dividend, the same treatment is there. But in one of your questions, he is giving interim dividend at debit side. In one of your question, interim dividend is given at debit side. My dear children, if interim dividend is given at credit side, absolutely no problem. It's a payable part and hence it has to be shown under other current liabilities. But the saddest part is that interim dividend is given at debit side. Debit side interim dividend is representing it is paid but not yet closed. Ante, first he passed this entry, interim dividend account debtor to cash or bank account. This entry was passed first. And hence you have to close this interim dividend by transferring it as an appropriation. appropriation. Respond everybody clear. So take more care, my dear children. If interim dividend is given at credit side, it was already adjusted to P&L account, but it is still to be payable and hence it will be under other current liabilities. But if interim dividend is given at debit side, first he is doing the payment, then you have to do the appropriation. Respond everybody pakka. So this is first part that you have to take more care. Shall I proceed further? Okay. And now coming to the next thing, how much dividend can be paid, sir? How much dividend can be paid? Remember, if at all you are paying dividend from the current year, there is no restriction. You can pay any portion or how much of a current year part is there, you can pay the total amount as dividend. But remember, my dear children, such portion of dividend which can be declared from past profits is restricted as per company's declaration and payment of dividend rules 2014. And what are those rules? Point number 1 or rule number 1, maximum rate of dividend will be the average of past 3 years rates of dividend. Whether it is preference or equity, the same has to be applied. And one more thing, my dear children, in some of the questions you might not be have past 3 years data, but you will be having past 5 years data. In such a case, assume that past 5 years average is exactly equal to past 3 years average. Shall I proceed further? And the next one, my dear children, maximum amount of withdrawal. You can draw up to that extent which is 10% of paid up share capital and free reserves. Here paid up share capital includes only preference and equity. Free reserves will not include securities premium. Something like those reserves which are freely available for distribution of dividend. Respond everybody clear. And sir, rule number 3, amount so withdrawn has to be first utilized to set off the carry forward losses or current year loss, and then you have to utilize it for the payment of dividend. And last and final rule number 4, which is nothing but minimum amount of reserves and surplus to be maintained is equal to 15% of paid up share capital. Respond everybody clear. So this is all about dividend concept, which is an important concept frequently getting tested in the examination. And one more thing, if at all in the question he is telling that equity dividend is declared, it is implied that preference dividend is already declared. In the question he is telling that equity dividend is declared. If at all in the question he had given that equity dividend is declared, it is implied that preference dividend was already declared. He will not give specifically preference dividend is declared. No need to give specifically. If equity dividend is declared, hope you know that preference shareholders are having preferential right over repayment of capital, declaration of dividend. In the same way, here dividend to preference shareholders has to be declared first and then to the equity shareholders. Respond everybody clear. That's the end of the concept of dividend. I'm not going to leave it. No. Wantedly, I did not cover cash flow statement questions. So now I'll cover those. And I already told you preparation of financial statements, 1 or 2 important disclosures I'll tell you. So coming to important disclosures, number 1, share capital. Remember, if any calls in arrears are there, then calls in arrears have to be deducted from called up capital in order to find the paid up capital. And if any calls in advance is there, it has to be treated under other current liabilities. This is important thing, take more care. And the next one, coming to share capital, you have to disclose those shares which are issued for non-cash and free of cost. Clear everybody? You have to disclose separately those shares which are issued for non-cash and free of cost. That is like bonus shares also. Also give the total data of bonus shares and buyback and ESOPs, employee stock options plans, which are issued for the past 5 years. Buyback, bonus and ESOPs. For the past 5 years, if you have issued any shares, then give the data relating to the past 5 years also. Respond everybody clear. And all the remaining are quite normal. And coming to reserves and surplus, as you all people know one thing, that if any negative reserves or negative P&L account is there, then no need to show it under asset side. You have to show it under liability side as if it is a negative figure. And all the remaining are common. Long-term borrowings only will be tested under non-current liabilities in general, whereas under current liabilities, short-term borrowings will be there, trade payables will be there, other current liabilities and short-term borrowings. And all the remaining are quite normal. Even asset side also it's quite normal, nothing great to discuss. But there's one more important thing with respect to P&L account. That's all about adjusted purchases. Sometimes in the questions adjusted purchases is given. So what institute material is taking a stand that this adjusted purchase is directly treating it as purchases. But that's wrong. Because adjusted purchases is equal to opening stock plus purchases minus closing stock. If at all you are having either opening stock or closing stock in the question along with adjusted purchases, you can get what is the purchases. I mean to tell in the question he is telling change in inventory will be given. If at all change in inventory given, opening minus closing is given under 2. So already adjusted purchases is there. You can find purchases as balancing figure. Respond everybody clear. But in some questions, no data is separately available. In such a case, what to do, sir? If I was not wrong, Roman number 4, expenses. Under expenses, you are having first one, cost of raw materials consumed, purchase of stock in trade, changes in inventories of finished goods. Of course, work in progress, that all there, but keep it aside. Changes in inventories of finished good or stock in trade, which is nothing but opening minus closing or closing minus opening. Opening minus closing. So this part is very, very important. Concentrate here. Purchase of stock in trade is nothing but purchases plus opening stock minus closing stock, which is nothing but adjusted purchases. So if you are able to find purchases separately, then find purchases separately and put under point number B. And then opening and closing will be kept under point number C. But my dear children, if at all you are unable to find these data separately, then whatever the total amount of purchases is there, you put it under, if you are unable to find the data separately, whatever the total amount of adjusted purchases is there, write B and C and put a flower bracket like this and write the total. Respond, is the logic clear? Because adjusted purchases is equal to purchases of stock in trade plus changes in inventories. Also, the same part you are having even in consolidated financial statements. In consolidated P&L account also, you will be having the same line. Respond everybody clear. So this is adjusted purchase that has to be taken more care. And one more thing, director's remuneration is not employee benefit expenses. Director's remuneration has to be taken under other expenses. But director's sitting fees can be taken under employee benefit expenses because director sitting fees under director is himself presenting in the company and he is sitting attending to the meetings and he is taking some salary. So director sitting fees can be treated under employee benefit expenses. But remember, whatever that is paid to managerial remuneration or director's remuneration, better put it under other expenses. There itself the problem is over. And one more thing, if you're going with institute material, sometimes institute material is creating some new heads. Administration and office expenses, selling and distribution expenses, like that it is creating new heads. So obviously being students will get such confusion whether is it correct or wrong. Remember, as per the strict format that is wrong. But whatever done by the institute is not wrong. No, I'm not telling that. Whatever institute has done, it is correct. In this context, institute is not wrong. Reason being, I already told you in schedule 3 general instructions it will be given very clearly that this is the format given for preparation and presentation of financial statements. But this general format can be altered as per the convenience of the business concerns. And hence in that context, if it wants, it can alter. But as per the format that you have learned, it's absolutely wrong. Don't write like that. And one more element, that's all about current maturities of long-term debt will be under short-term borrowings, but current maturities of long-term finance lease obligations will be under other current liabilities. Get the difference between these two things also. Respond everybody clear. And that is the end of preparation of financial statements. Not yet over, just wait. I wantedly did not tell the different adjustments of cash flow statements after the completion of cash flow statements, since for preparation of financial statements I am covering only a limited items, so I'll cover the both different adjustment at once itself. So just have a look. Cash flow statements, different adjustments. Number 1, interest received is 68,000, TDS deducted is 8,200. Even though it is a non-cash item, it has to be treated as if it is an investing activity, and hence in the inner column 68,000 minus 8,200, and the outer column you have to show the net amount. Respond clear, or TDS of 8,200 was deducted on the above interest, and hence net figure 6,800 shall be shown separately. Respond everybody clear. My dear children, if at all this 8,200 is not included in this, then you have to show like this: 68,000 plus 8,200. Enta? 76,200 minus 8,200. Outer column will become 68,000. Respond clear, Sir, I have told you the two alternatives. I mean to tell, if interest is not if TDS is not included, this is correct. Antena? No, one second. Let me not confuse you. Sir, if at all this 68,000 is inclusive of 8,200, this procedure is correct. If 68,000 is already deducted with 8,200, then first you have to add that 8,200 and present like this. Respond everybody clear. So for this one, you have to read the question properly. Which alternative is given? According to that alternative, you have to prepare the cash flow statement. Respond, shall I proceed? Underwriting commission, which activity? Financing activity. And check out, this is a different one. Say for example, this is last year and this is current year. Advance tax is 180 in the last year, and last year provision is also 180. Sir, last year provision for tax 180. Already last year how much is paid? 180. Now come to current year. What is current year provision? 200. What is current year advance tax paid? 195. How much shortage is there? This will be paid in the next year. Logic clear? How much I have to pay? 200. How much I have paid? 195. So shortage how much? 5 will be paid in the next year. But what is current year tax paid? 195. That will be only shown. Respond clear. Say for example, last year advance tax paid is 170. Now what to do? How much is current year tax paid? Or tax paid during the year? How much? 195 relating to current year plus 10 is relating to the last year. So total tax paid in the current year is 215. 205. Sorry, 205. Respond everybody clear. You are holding calculators, but I am not holding. Anyways, listen. Sir, this one I already told you. Likewise, purchases is not given in the question whether it is cash or non-cash. For that, you have to draft both trading account and creditors account, and you have to decide. And listen, this is a very different one. Sir, it was very clearly that net profit is adjusted only with the following items: depreciation, discount on issue of debentures, interest, profit on sale of asset, and interest received on investments. Now listen, there is something called premium on redemption of preference shares. Premium on redemption of preference shares is also given in the question, but no need to adjust the same while doing operating activities, because given that only following 5 items are adjusted. Hey, respond clear, huh? Say if like this it is not given. Net profit before income tax is 30 lakhs. Only this point is given. Then along with these 5 items, you also need to adjust premium on redemption of preferences. Hey, my dear children, is the logic understood? Take care, given in point number A that only these 5 items are adjusted. So while doing cash flow statement under indirect method, you will take net profit and you have to adjust some items kada. Those items will become only these 5. You should not take premium on redemption of preference shares, because premium on redemption of preference shares is a separate point. It's not given as a subbit in point number A. Respond understood. But say for example, if this data is not given, then even you have to adjust premium on redemption of preference shares also. Respond logic clear. And sir, check out. Next one, grant received for capital projects. Sir, what is the nature of grant received? If nothing is given, it will be taken under financing activities. Sir, grant received. Only if grant received is there, then it is financing activities. If grant is received for the purpose of providing health facilities to employees, then it will become operating activity. If grant is received for investing in capital project, then it will become investing activities. Respond clear, huh? If loan is received for investing in capital projects, dash item. Loan is received for investing in fixed assets. Loan is always financing. You should not check the purpose for loan, but you have to check out the purpose for grant, because Export Advisory Committee of ICAI had clarified the same. Hey, respond everybody clear, huh? Export Advisory Committee of ICAI had clarified the same, that if any grant is received, you have to check back for the purpose. If any loan is received, you should not check it for the purpose. Respond clear. Sir, capital grant received amortized to P&L account. I already told it's a non-cash income. Did you remember? DGG account debtor to P&L account annam kada. These are all normal. Yeah. If you observe one more thing, in some questions, profit on sale of land and profit on sale of assets were transferred to capital reserve. Generally, profit will be transferred to P&L account. Then you have to adjust the same while solving the cash flow statement under indirect method. But if at all profit is transferred to capital reserve, then don't adjust it at any cost. Respond clear, because it is not transferred to P&L account. Provision for depreciation account done, asset account format done, provision for tax and proposed dividend formats were also done. I mean to tell, it's not proposed dividend, it is declared dividend. And this is another question wherein check out, you have to check out with the securities premium. Equity share capital 25 lakhs and 35 lakh 60,000 is there, and securities premium 5 lakh and 5 lakh 50,000 is there. Equity share capital for the year ending includes 60,000 equity shares issued at par for supply of machinery of rupees 60,000. Show how the related items will be appeared in the cash flow statement. So automatically you have to check out the difference, and that difference were issued at premium money ardham. Hey, respond everybody clear. I mean to tell, sir, check out 25 lakhs and 35 lakh 60,000. How much is the difference you have got? 10 lakh 60,000. And out of which 60,000 if equity shares were issued at par for supply of machinery at 60,000. And 60,000 were issued at par. And how much balance is there now? 10 lakhs. These 10 lakh shares were issued at a premium of 50,000. Because securities premium 50,000 is there. That analysis is very much important here. In this context, totally 10 lakh 60,000 increase is there. Securities premium 60,000 increase is there. But given in the question that rupees 60,000 shares are issued at par. So out of 10 lakh 60,000, if 60,000 were issued at par, then 10 lakh equity shares are issued at a premium of rupees 50,000. Respond everybody clear. That's the end of cash flow statements. Yeah, one last thing. With this, I'm going to close the session. Coming to preparation of financial statements, in one of the questions, you are having contractual commitments. Remember, my dear children, sir, contingent liabilities and contractual commitments have to be disclosed at the footnote of balance sheet. And in one of the question, he had given that there is a company which has to perform the contract after 5 years. That is also a contractual commitment which has to be disclosed at the footnote of balance sheet. And in one of the preparation of financial statements question, be careful, suspense account is given. Don't take it as light year because these kind of models are getting repeated in exams. So you have to rectify the error and you have to adjust. And my dear children, that is the end for today's session. Coming to leases. Sir, I already told you while telling accounting standard number 2 and accounting standard number 10 that if it is an asset related standard, then one non-applicability is quite common. And that non-applicability is nothing but renewable and non-renewable resources. For renewable and non-renewable resources, industrial norms are applicable, but not any specific standard. In the same way, if at all any crop is given under lease, or if any mine is given under lease, accounting standard number 19 is not applicable, only industrial norms are applicable. And of course, land is also an industrial, renewable resource for which Landlord Act is applicable. And this is important again. If there are any lease agreements or lease arrangements for motion picture films, which are nothing but cinemas, video recordings, which are nothing but short films, documentaries, etc., plays, which are nothing but K-drama, C-drama, I-drama, Indian dramas, serials, and next manuscripts. Manuscripts are nothing but handwritten books. For all these things, accounting standard number 19 is not applicable. Accounting standard number 26 is applicable. So take more care. This is also one of the important parts coming to accounting standard number 19. And one of the another important non-applicabilities is all about contract for service. My dear children, point number 1, if it is contract of service, there is no need to speak at all, because contract of service is nothing but employer-employee relationship. What is contract of service, Nana? Participate everybody. What is contract of service relation? Employer and employee relationship. So if at all it's a relationship between employer and employee, which will become employment, but it will never become a lease. And hence, if it is contract of service, we don't speak about contract of service at all. So we will speak only about contract for service. Under contract for service, listen very carefully. If we have given an asset by transferring the right to use, then AS 19 is applicable. Under contract for service, if we have given the right to use, if we did not transfer the right to use, then AS 19 is not applicable. So what is most important in accounting standard number 19 is all about right to use. What is most important part, Nana? Right to use. Listen very, very carefully. Everybody, very, very important. Be careful. If at all it is contract of service, no need to speak at all, because contract of service is nothing but employment. Employment will never become a lease. Hey, you can't tell that I have taken employee for 5 years lease. Chichi. Hey, is it clear? Whereas if it is contract for service, we have to speak out. Check out in that contract for service whether right to use is transferred or right to use is not transferred. If right to use is transferred, AS 19 is applicable. If a right to use is not transferred, AS 19 is not applicable. Say for example, we are employees and management is employer. So the relationship between management and we team of faculty is nothing but employer-employee relationship, for which lease is not applicable. And say for example, ours is a traveling agency and we will be giving cars. Car. Okay, listen. We will be giving these cars for rental basis. Clear everybody? So now in situation number one, one family had come and they are telling that we would like to go on a family tour for which we need your car for a period of 6 months along with a driver, and that driver has also to be provided by the traveling agency itself. Clear everybody? And second family had come and they are telling we want your car for rentals, but we don't need any driver or anybody else. I just want a car. Hey, respond everybody clear. A driver is not for rental, ra. Only car is for rental. Along with driver, traveling agency has to provide. Hey, respond everybody clear. So in these two situations, right to use of asset is transferred under case 1, case 2 or both cases? Case 2. So this will be coming under the purview of leases, which is nothing but accounting standard number 19. And whereas the first part, since the car is transferred along with a driver, so now driver is going to take care about the car. Clear everybody? How many kilometers they have to travel, what are the repairs and maintenance, how much petrol has to be pumped, everything shall be taken care only by the driver. So here right to use is not transferred. We are just providing a service. Respond everybody clear. So in case 1 AS19 is not applicable, but in case 2 AS19 is absolutely applicable, because along with the asset dash is transferred, my dear children. Right to use is transferred. Respond everybody clear. This is the non-applicability, which is very, very important. And one of the very important things is all about definitions. In the definition of lease, lease is a contractual agreement. What is lease, Amma? Contractual agreement. Did you remember accounting standard number 7, Nana? Case 7 is applicable for both. Case 7 is not applicable for both. It is applicable only for contractor but not for contractee. Whereas coming to accounting standard number 19, it is applicable for both lessor and lessee. Case 19 is applicable for both lessor and lessee. As per accounting standard number 19, there are two types of lease, Nana. What are the two types of lease, Amma? Operating lease and finance lease. So strictly speaking, AS 19 is applicable for 4 parts. Operating lease in lessor books, operating lease in lessee books, finance lease in lessor books, finance lease in lessee books. Respond everybody clear. And lease is nothing but dash arrangement, Amma. Contractual arrangements or contractual agreements. And wherein, very, very important, right to use is transferred. What is transferred, Amma? Ownership is not transferred. Only possession is transferred. What is not transferred? Ownership. But what is transferred? Possession is transferred. Right to use is transferred. The party who is transferring the right to use is called as lessor. The party to whom the right to use is transferred is called as lessee. Respond everybody clear. And moving on to the next thing, these leases are of generally two types. Generally, not from the viewpoint of AS 19. I'm speaking leases is of generally two types. Number 1, cancelable lease. Number 2, non-cancelable lease. What are the two types of leases, Amma? Cancelable lease and non-cancelable lease. If at all a lease can be cancelled at any point of time during the lease period, it is called as cancelable lease, for which AS 19 is not applicable. During the lease term, if the lease can't be cancelled, then we will call it as non-cancelable lease, and AS 19 is absolutely applicable. So lease which can be cancelled is called as cancelable lease. Lease which cannot be cancelled is called as non-cancelable lease. For dash AS 19 is not applicable, cancelable lease. For dash AS 19 is applicable, non-cancelable lease. Respond everybody clear. And let me move on to the next thing, very important. Generally, non-cancelable lease can be cancelled or can't be cancelled. But in the following 4 situations, even though it's a non-cancelable lease, it can be cancelled. In the following 4 situations, even though it is a non-cancelable lease, it can be cancelled. In that situation, number 1, upon occurrence of remote contingent event. Upon occurrence of remote is nothing but very, very, very less chances. Some sort of contingent events may or may not occur. Likewise, flood, earthquake, etc. due to which the asset gets destroyed. And hence automatically there is no asset to continue the lease. And hence the lease gets cancelled. So lease is getting cancelled normally or due to some unforeseen contingent event. due to some unforeseen contingent event, and hence it amounts to cancelable or non-cancelable? Cancelable or non-cancelable? Non-cancelable lease which can be cancelled. Is the logic clear? Now we are learning about dash lease, amma. Non-cancelable lease. Generally non-cancelable lease cannot be cancelled. But in the following situations, even a non-cancelable lease can be. But it will continue to become a non-cancelable lease. Respond everybody clear. In that first situation is upon occurrence of remote contingent events. Second one, prior permission of lessor. My dear children, not prior notice to lessor. Prior permission. Notice is not considered. Prior permission is considered. Respond everybody clear. What is condition number 2? With the prior permission of lessor. Say lessor and lessee are entering into the contract. This lease can never be cancelled. But now lessor himself is telling, okay, cancel the lease. What is the problem to you? Because it is the understanding between lessor and lessee. So with the prior permission of lessor, it can be cancelled. It is their wish, not our wish. And next one, entering into the new lease agreement either for the same or similar asset. Say for example, you have taken one asset on lease and you have taken it for 5 years lease. But the life period gets completed after the completion of 2 years. Machine is unable to run after the completion of 2 years. You have intimated the same to the lessor. Lessor told, yes sir, the life of the machine is absolutely completed and hence let us replace the machine now. I'll replace either the same machine or the similar machine. Clear? So a renewal agreement is being entered or entering into a new lease agreement either for the same or similar asset. So old agreement is cancelled, a new agreement is entered. Ante kada? Even though it is called as a non-cancelable lease, because we are going to we are learning the situations where a non-cancelable lease can be cancelled. Last and final, if you want, you can cancel at any point of time. That decision was taken at the inception, starting of the lease itself. But it was very clearly mentioned in the agreement that upon cancellation of the lease, you are supposed to pay huge penalties. You are supposed to pay huge penalties. Even in that case also, it will become a non-cancelable lease. Respond everybody clear? Lessor is telling to lessee, you can cancel at any point of time. I don't have any objection, but pay me huge penalties. Respond everybody understood. So tell me, my dear children, what is a non-cancelable lease? Lease which cannot be cancelled during the lease term. Exception, in the following situations, even a non-cancelable lease can be cancelled. What are those situations? Upon occurrence of remote contingent events and prior permission of lessor, entering into new lease agreement, same or similar asset. Last and final. So decided at the inception of the contract that the lease can be cancelled at any point of time, but you are supposed to pay huge penalties. Respond everybody clear. So my dear children, accounting standard number 19 is applicable only for non-cancelable leases. It is not applicable for cancelable leases. Respond everybody clear. Now AS 19 is applicable for both lessor and lessee, whether it is an operating lease or a finance lease, which implies that AS 19 is not applicable for cancelable lease. AS 19 is applicable for only those operating and finance leases which are non-cancelable in nature. AS 19 is applicable only for those operating and finance leases which are non-cancelable in nature. Respond everybody clear? And anyways, let me proceed here. Now, what do you mean by operating lease and what do you mean by finance lease? My dear children, ownership is not transferred in either of the leases. Possession is transferred in both the leases. Right to use is also transferred in both the leases. But the deciding factor is all about risk and rewards. This is the deciding factor. If generally risk and rewards is transferred along with ownership as per accounting standard number 9. Significant and related risk and rewards are transferred. But in accounting standard number 19, risk and rewards are transferred along with possession. What are transferred, my dear children? Please participate. What are transferred? Risk and rewards are transferred along with possession. Then it will become a finance lease. If risk and rewards are not transferred, then it will become an operating lease. Respond everybody clear. My dear children, if at all the risk and rewards are transferred along with possession, we will call it as a finance lease. If the risk and rewards are not transferred if the risk and rewards are not transferred, then we'll call it as an operating lease. Respond everybody clear. Now, accounting standard number 19 is giving you 8 conditions. How many conditions, Amma? In these 8 conditions, it will become a finance lease. In these 8 conditions, the lease will become a finance lease. If not, it will become an operating lease. Respond everybody clear. You might ask me, sir, why the conditions are being given in the standard? Because you have clearly mentioned that if risk and rewards are transferred, it is a finance lease. If the risk and rewards are not transferred, it is an, then why what is it called? Conditions are given. It is as simple as such. Listen very, very carefully, my dear children. It is as simple as such. If at your mentioning of agreement is absolutely not bothered by me. These 8 conditions are actually divided into 2 types. 5 plus 3. And 5 are called as deterministic conditions. 3 are called as suggestive conditions. 5 are called as deterministic conditions. 3 are called as suggestive conditions. Now point number 1. What do you mean by deterministic conditions? Whatever you write in the agreement, hell with the agreement. Whatever you write in the agreement, hell. I don't care. I don't bother. In all these 5 situations, it will be deemed assumed that the lease is a finance lease, whether or not risk and rewards are transferred as per your agreement. Whether or not risk and rewards are transferred as per your agreement, we will consider that as a finance lease. Respond everybody clear. But coming to the second part, 3 suggestive conditions. We are suggesting in these 3 conditions, we are suggesting in the following 3 conditions, better to transfer risk and rewards. So if at all in your agreement you have specified risk and rewards were transferred, we will consider it as a finance lease. If in your agreement risk and rewards are not transferred, we will consider it as an operating lease. Respond clear. What are the 2 conditions you are having? Deterministic conditions, suggestive conditions. We don't bother about agreement under deterministic conditions, but we will bother about agreement under suggestive conditions. Whatever you spell out in the agreement, we don't bother. All the 5 conditions, we will deem it assume that the lease is a finance lease. Whereas coming to the 3 suggestive conditions, it is recommended to transfer risk and rewards. If you transfer as per your agreement, we will consider it as a finance lease. Otherwise, we will consider it as an operating lease. Respond everybody clear. So check out here 5 deterministic conditions. Deemed assumption, don't bother with the agreement. Suggestive conditions, consider the agreement. And one last point, if it's not a finance lease, it will become an operating lease. Respond everybody clear. Now let me tell you the 5 deterministic conditions, but I'm not going to speak about the logic here. I'm not going to speak about the logic because the logic itself will take more time. Let me tell you what are all the 5 conditions. Condition number 1, at the end of lease term, ownership is transferred to lessee. At the end of ownership is transferred to lessee. Say your total life period is 20 years. Your lease term is 12 years. After 12 years, the ownership is transferred to lessee. In this situation, it is dash lease, my dear children. Finance lease. Because majority of the lease period, majority of the asset period is held by lessee. So risk and rewards must be borne by lessee. Whatever you write in the agreement, I don't bother. Even though you have written in the agreement that for these 12 years, lessor is having the risk and rewards. For the purpose of accounting, I will consider that risk and rewards are transferred to lessee. Hey, logic understood? Because for 12 years, asset is used by lessee. For the remaining 8 years, asset is used by lessee, but in owner position. Logic understood? I told I don't tell the logic, but I have told the logic. Respond everybody clear. I mean to tell, what is condition number 1, Amma? At the end of lease term, ownership is transferred to lessee. At the end of lease term, ownership is transferred to lessee. In this situation, it will be considered as dash lease, Nana. Finance lease. Next, condition number 2. Listen very, very carefully. Very carefully. Lessor is having reasonable certainty. Who is having reasonable certainty? Is having reasonable certainty at the inception of the contract. At the of the contract that lessee is going to exercise his option to purchase. In condition number 1, ownership is transferred. In condition number 1, ownership is transferred at the end of lease term. But in condition number 2, option is given to lessee at the end of lease term. If lessee wants, he can purchase the asset. Otherwise, he can ignore the option to purchase. But if at all lessor is assuming, that is lessor is having reasonable certainty, maximum chances that lessee is going to exercise his option at the end of lease term, then we will call it as a finance lease. Otherwise, we don't call it as a finance lease. Respond clear? In condition number 1, dash is transferred, ownership is transferred. But in condition number 2, option is given. If lessee wants, he can purchase, or if lessee did not want, he cannot purchase. Clear, everybody? Sir, this assumption has to be considered by the lessor at the inception of the lease, that the option to purchase is having reasonable certainty, ante maximum chances that lessee is going to exercise the option to purchase. Respond, everybody, clear? But the biggest problem here is all about how can lessor assume the reasonable certainty at the beginning of the lease period. Hope you have got the question here. Lessor has to assume whether lessee will purchase the asset at the end of lease term or not. If lessee will purchase the asset at the end of lease term, then it's a finance lease. If lessee is not going to purchase the asset at the lease term, then it is an operating lease. But I have to tell this at the starting of the lease term. Is it difficult or easy to estimate? Difficult, because situation every day is different. Am I correct or wrong? But think with common sense. If at all the market value of the asset is 2 lakhs at the end of lease term, if you offer it for 50,000, will he subscribe? Will he purchase or not? Yes, because 2 lakhs is the fair value, but the offer price is only 50,000. Is the logic clear? So you will get that reasonable certainty only when the bargain price is less than the fair value as on the date of purchase. You will get the reasonable certainty only when the bargain price is less than the fair value as on the date of purchase, that is at the end of lease term. Respond, everybody, clear? Sir, it is a bit clumsy because it's a different and lengthy condition. Listen carefully. Say for example 20 years is the lease term, life period of the asset, 12 years is the lease term. Now listen very carefully. At year 1, lessor has to estimate whether lessee will purchase the asset at the end of 12th year or not. If yes, that lease is called as a finance lease. If no, that lease is called as an operating lease. At the end of 12th year, everybody will tell that. But you have to assume the same, you have to estimate the same at year 1. So it is a difficult task. So option available to lessor is all about, if at all I am offering at a lesser price than the fair value of the asset, then lessee will exercise this option. Say market value is 2 lakh, but I'm offering it 1 lakh, 50% discount. Everybody will come forward to purchase. If market value is 2 lakhs, I'm offering it at 20,000. Super huge discount. Everybody will come forward to purchase. Respond, everybody, clear? So this is what called as a finance lease. Please take care, my dear children. Who should have reasonable certainty? Lessor. When should he has the reasonable certainty? At the inception of the lease. What should be the reasonable certainty? lessee is going to exercise his option to purchase at the end of lease term. But he can estimate it well only when the bargain price is less than the fair value of the asset as on the date of purchase. Respond everybody clear. And condition number 3, most important conditions while doing the problematic, present value of MLP is almost equal to the fair value of leased asset. What is the most important condition? Present value of, say MLP is nothing but lease rentals. What is MLP, my dear children? Every year he is paying the lease rentals over a period of 12 years. You bring each and every lease rent at the end of, for the period of 12 years at year 0. And now compare this with present value of lease rentals with fair value of leased asset. If maximum is covered, we will tell that it as a finance lease. If maximum is not covered, we will tell it as a operating lease. Respond everybody clear. How much is the maximum, sir? More than or equal to 90%. More than or equal to. Condition number 4. Majority of economic life is covered under the lease term. Majority of economic life is covered under the lease term. Say for example, life is 20 years. Economic life of the asset. And the lease term is 18 years. Is the major portion covered or not? And hence it will become a finance lease. What do you mean by major portion, sir? Greater than or equal to 75%. Greater than or equal to. Last and final, asset is of specialized in nature where lessee only can use it without major modification, which is simply nothing but a kind of customized or specialized asset. Respond everybody clear. Lessor is not having any interest in manufacturing that asset. Lessor is manufacturing that asset only for the purpose of lessee. Respond everybody understood. These are nothing but the conditions of finance lease. Quickly answer me condition number 1. At the end of lease term, ownership is transferred. Option number 2. Who is having reasonable certainty? For what is having reasonable certainty? Lessee will exercise the option to purchase at the end of lease term. But this certainty lessor should have at the inception of the contract. But he can get that certainty only when bargain price is less than the fair value as on the date of purchase. Clear everybody? Condition number 3. Present value of MLP is almost equal to the fair value of leased asset. Almost in the sense how much percent will be considered? Greater than or equal to 90%. Majority of economic life is covered under lease term. How much percent is considered? More than or equal to 75%. Last and final. Asset is of specialized in nature which lessee can use it without major modifications. Respond everybody clear. I am not going to cover suggestive conditions. You just go through the material, you will get it. And moreover, for problematics, it's not at all important. And moving on to the next thing. What do you mean by inception of the lease? Date of signing the agreement or date of confirmation of negotiations, whichever is earlier. Date of signing or date of fixation of terms and conditions or confirmation of negotiations, whichever is earlier. Of course, now very important thing from the problematic part is all about MLP. What is MLP, my dear children? Minimum lease payments. So minimum lease payments includes lease rent, additional amount, bargain amount, GRV, guaranteed residual value, and it excludes UGRV, which is nothing but unguaranteed residual value, repairs and maintenance, taxes, contingent rent. My dear children, MLP includes lease rent, additional amount, bargain amount, GRV, excludes UGRV, repairs and maintenance, taxes, contingent rent. Don't forget. Shall I proceed further? Now very important thing, what is GRV and what is UGRV? Because you know lease rent, additional amount is in excess of lease rent. Contingent rent is in excess of lease rent, but its payment depends on happening or non-happening of a factor. Difference between additional amount and contingent rent is only one thing. Sir, both things are in excess of lease rent, but additional amount mandatory you have to pay. Contingent rent, only if the event happens you will pay. If the event did not happen, you will not pay. And bargain amount is already you know. At the end of lease term, who will purchase? Lessee will purchase at a price kada. That price is nothing but bargain amount as per condition number 2. Very good. And moving on to the next one, residual value. Sir, as per AS 10 residual value is different, as per AS 19 residual value is different. Most of the people will confuse for these two things. Take care. As per AS 10 residual value is the value attained to the asset at the end of economic life. As per accounting standard number 19, residual value is the value attained to the asset at the end of lease term. Don't forget this one. Residual value is the value attained to the asset at the end of lease term. As per accounting standard number 19. As per AS 10, it is at the end of economic life. And the total residual value is divided into two parts. One is GRV and the other is UGRV. Guaranteed residual value or unguaranteed residual value. Now, the guarantee can be given. Sir, listen very, very carefully. Guaranteed residual value for lessor is different. Guaranteed residual value for lessee is different. Guarantee. Will be giving guarantee? Lessee is giving guarantee to lessor, or any other party is giving guarantee to lessor. Clear everybody? So at the end of lease term, your asset will be fetching this much amount. If not, we will pay you the difference. A logic understood? Lessor is telling this asset is 1 lakh. Take the asset, use it for 12 years. After 12 years, you have to use this asset in such a way that this asset should fetch a minimum of 60,000. No, lessee is telling, no, I can't guarantee for that much amount. I can guarantee for 35,000. I hope the logic is clear for you. So now let me start. Now, guaranteed residual value is nothing but either lessee or outside party. Some other party will be giving guarantee to lessor. Now listen very carefully. What is a GRV to lessee? GRV to lessee, the guarantee given either by lessee or on behalf of lessee. Whereas coming to lessor, guarantee given either by lessee or on behalf of lessee or independent third party. They respond everybody clear. There's no such rule that lessee always have to give guarantee. Even on behalf of lessee, some other person can also give guarantee. Respond everybody clear. Sir, coming to guaranteed residual value from the viewpoint of lessee, guarantee can be given either by lessee or on behalf of lessee. From the viewpoint of lessor, guarantee can be given either by lessee or on behalf of lessee or by independent third party. Respond everybody clear. Now coming to the next one, UGRV, unguaranteed residual value, is no way connected to lessee, because UGRV is only connected to lessor. It is no way connected to lessee because lessee is not giving any guarantee. Respond everybody clear. UGRV is equal to total residual value minus guaranteed residual value. Respond everybody understood. So tell me, what is a guaranteed residual value? Guarantee either given by lessee or on behalf of lessee from the viewpoint of lessee. From the viewpoint of lessor, guarantee given either by lessee or on behalf of lessee or by independent third party. Who is no way connected to UGRV? Who is always connected to UGRV? Lessor. Respond everybody understood. Now, very important thing, reclassification of lease is not permitted. What is not permitted, Amma? Even in case of renewal period also, renewal lease also, reclassification is not permitted. Only in the case of new lease agreement, reclassification is permitted. Respond clear everybody. Now very, very important thing, what is the lease term? Lease, sir, I'm not speaking about economic life and I'm not speaking about useful life. I'm speaking only about lease term, so take more care. Period of non-cancellable lease plus any other extended period. Plus any other extended period. We will tell it as a lease term. period of non-cancelable lease plus any other extended period. Say for example, lessor is telling that lessee will initially take the lease for 12 years and after that lessee is telling, so to the maximum extent I will take even the lease for another 4 years also. He did not take, but reasonable certainty. To the maximum extent I will take even for secondary lease period of 4 years. So now what is the total lease term? Is it 12 or 16 years? 16 years, because lease term includes two elements. Number one, period of non-cancelable lease plus any other extended period. Even in that extended period also, you can't reclassify the lease. What is the original lease? If it is finance lease, it is always a finance lease. If it is operating lease, it is always an operating lease. Say for example, old agreement is totally cancelled and they are entering into a new agreement. Then they can transfer it as a different lease. Respond everybody clear. Reclassification of investment is permitted or not permitted? Reclassification of investments permitted. Reclassification of lease not permitted. Even for renewal also not permitted. It is permitted only for a new lease agreement. Respond everybody clear. So now let me go with the accounting treatment for finance lease. Sir, there are two types of leases. What are the two types of leases? Operating lease and finance lease. Under dash, risk and rewards are transferred. Finance lease. Under dash, risk and rewards are not transferred. Operating lease. So operating lease is similar to rent. Finance lease is similar to loan. Dash is similar to loan. Finance lease. Dash is similar to rent. Operating lease. And hence whatever you pay will be treated as expense by lessee. Whatever is received is treated as income by lessor. Under dash lease, operating lease. Whereas coming to finance lease, since it is a loan, it will be, the repayments will be treated as EMI, which is including both principal plus interest. Respond everybody clear. Now, very, very important. Under finance lease, since it will be treated as a loan, you have to write an entry as if the asset is transferred. Who are the two parties you are having, Amma? Lessor and lessee. Who is transferring dash to whom? Lessor is transferring asset to lessee. Tell me the journal entry in the books of lessor. Entry. Lessee account debtor to asset account. This has to be recorded at present value of gross investment in lease. Strictly speaking, this has to be recorded at NIL, which is nothing but net investment in lease. Net investment in lease is nothing but gross investment in lease minus unearned finance income. Unearned finance income is nothing but gross investment in lease minus present value of gross investment in lease. Ultimately, GIL and GIL will get cancelled and you will be left only with present value of gross investment in lease, and hence net investment in lease is nothing but present value of gross investment in lease. Respond everybody clear. And what is gross investment in lease, sir? MLP plus UGRV. What is gross investment in lease, Amma? MLP plus UGRV. Respond clear. I'm not going to explain the logic, but I'll tell you the methodology how it will work out. Shall I continue? Sir, listen very, very carefully, everybody. Listen very carefully, everybody. Whatever lessee has to pay to lessor, we will call it as MLP. Am I correct or wrong? Along with this, on that particular asset, lessor will also get UGRV. And this total we will call it as gross investment in lease. What is this total? Call it as, Nana? Gross investment in lease. So simply your lessor has to record the same at present value of gross investment in lease. Present value of gross investment in lease is nothing but present value of MLP plus present value of UGRV. Respond everybody clear. But as per accounting standard number 10, he is not 19, he is not telling like this. Then how is he telling, sir? A lessor under finance lease has to record it at net investment in lease. Net investment in lease is nothing but gross investment in lease minus unearned finance income, which is nothing but interest, Nana. And gross unearned finance income is nothing but total payments minus present value of total payments. So total minus present value is nothing but interest kada. Respond. Total payments minus present value of total is nothing but interest income. Total payments minus interest income is nothing but present value of total payment, which is nothing but net investment in lease is equal to present value of gross investment in lease. Respond, everybody understood? Pakka. Sir, simply to tell you, who has to record now? Lessor has to record. At what price? NIL, net investment in lease. In a single word, net investment in lease is nothing but present value of gross investment in lease. That is equal to present value of MLP plus present value of UGRV. Respond, everybody, clear? Whereas now in the books of lessee is getting the asset correct or wrong. What is the entry he has to record? Asset account debtor to lessor account. He has to record it at dash price. Present value of MLP plus present value of UGRV. Strictly speaking, even lessee has to record at same price. Am I correct or wrong? Since lessor is recording it at present value of MLP plus present value of UGRV, lessee also has to record it at same price. But UGRV is no way connected to lessee. So it has to be recorded only at present value of MLP. Respond clear. Now lessee is always having two options. Option number one, either to take the asset on lease. Option number two, let him purchase the asset. Clear? If he is purchasing the asset, he has to pay the fair value of the leased asset. Correct or wrong, sir? If lessee is purchasing the asset, he has to pay the fair value of leased asset. And hence, my dear children, lessee has to record this asset at present value of MLP or fair value of leased asset, whichever is lower. See, two options has to be blended for lessee. Option number one, lease. Option number two, purchase. Two options has to be blended and you have to follow a prudence concept. Respond, everybody understood? That's it. This is the most important journal entry in the books of lessee. And all the remaining entries I am not going to deal. You can just go ahead with. Tell me, lessor has to record the same at dash price, Nana? Dash price. Net investment in lease, which is nothing but present value of gross investment in lease, which is nothing but present value of MLP plus present value of UGRV. Now lessee has to record it with present value of MLP or fair value of leased asset, whichever is lower. Respond, everybody understood? Shall I proceed further? Now, all the remaining journal entries are quite common, like interest, receipt, very important. Depreciation. Depreciation has to be claimed only by lessee under finance lease, because risk and rewards are in the hands of, my dear children, since the risk and rewards are in the hands of lessee, depreciation has to be claimed only by lessee. Clear? Shall I proceed further? Now listen very, very carefully. I am going to tell you the recognition table to solve any kind of problem under finance lease. To solve any kind of problem under finance lease, I am going to tell you the recognition table. If you follow this one, you can get any kind of finance lease. You take the year first. You take the year. Generally, say 1 to 5 years. For 1 to 5 years, lessee is supposed to pay lease rent. So take the amount. Say lease rent is 30,000. After that, you have to bring everything to the present value. Am I correct or wrong? Sir, you have to bring everything to the present value. Correct or wrong? So this is 30,000 per annum. And you have to do the present value factor. You have to do the present value factor. This is for how many years, my dear children? 5 years. So present value factor, say for example at 10%. So take the calculator and compute 10% for 5 years. Say for example, how much? Whatever, 3.39. 3.7. Sorry, whatever is that. Please listen carefully. 3.7. Sir, I have taken 1 to 5 years, which is nothing but lease rent, 30,000 per annum, and the present value factor is nothing but 3.7. I'm finding the present value now. 3.7 into 30,000. Let me take it as 3 for better understanding. 3 into 30,000, which comes to 90,000. Respond everybody, clear. And at last, take year 5. Year 5 will be taken only with GRV. Year 5 is taken only with GRV. Say for example, GRV is 10,000. What is GRV? 10,000. You have to find the present value factor at the end of year 5 now. Say it is 0.5. No, for our better understanding, I am taking it as 0.5. 0.5 into 10,000, 5,000. I mean to tell computations will become easy, kada. Present value at some rate. Okay. Now, very important. Lease rent plus GRV is nothing but MLP. Clear? And the total MLP is nothing but, please take care, don't do 30 plus 40. 30 plus 10. That's wrong. Because 30,000 per annum. For how many years, Amma? So 30,000 into 5. 1,50,000 plus 10,000, which comes to 1,60,000. And present value is 90,000 plus 5,000, which is nothing but 95,000. Respond everybody, clear? My dear children, this is nothing but MLP. This column is nothing but present value of MLP. Clear everybody? Not yet over, wait there. Take once again year 5. This time take UGRV. Say UGRV is 5,000. Again take the present value factor, 0.5. This time it comes to 2,000. Now finally, MLP plus UGRV is nothing but gross investment in lease. The total gross investment in lease is nothing but 1,65,000. 1,65,000. And next, present value is nothing but 97,500. Now check out, my dear children. This is gross investment in lease. And the last column is present value of gross investment in lease. So in a single table, you are going to get the coverage of both lessor and lessee. Just in a single table, you will get both parties coverage very clearly. From the next time, you follow this kind of methodology for computation, which will become very, very easy for you. Respond everybody, pakka. Now, lessor has to record a dash price, my dear children. Check out that and tell me the price directly. 97,500, which is nothing but present value of gross investment in lease. Lessee has to record it at dash price. 95,000, which is nothing but present value of MLP. Of course, you also have to compare it with the fair value of leased asset and take whichever is lower. Respond everybody, understood? This is all about recognition table. And moving on to the next thing, as you all people know, and the next is amortization table. Well, you will be going with your FM. Separation between principal and interest. Sir, lessor had recorded a dash price now. 97,000. So now you have to start with 97,500 and separate 97,500 for 5 years. You are going to get principal and interest. And the next one is 95,000 in the books of lessee. Start lessee's amortization table with 95,000. You check out the question. If the question is asking, find the amortization of finance income that is to be recognized in the books of lessor, then you have to start with 97,500. If the question is asking you with respect to lessee, then it has to start with 95,000. Respond everybody, understood? And this is what your finance lease is all about. So in finance lease problems, you'll get three tables. Number one is recognition table, as I have showed you here. And number two is amortization table. I don't know, you'll call it with a different name, like separation between principal and interest. IRR. You'll be using IRR, kada? You have to use IRR and you have to separate everything between principal and interest, kadamma. That's what I'm telling. Use 10% rate and separate 97,500. Every installment is 30,000. Each and every installment is separated with principal and interest. Hope you have remembered. So that is the concept. I mean to tell you, just wait here. This is what the table I'm speaking about. Year 1 beginning, end of year 1, end of year 2, end of year 3, end of year 4, which is nothing but outstanding liability, which is nothing but principal portion. This is nothing but interest portion. This is nothing but payment, MLP, lease rentals. Hope you have remembered. So let me tell you at one stretch. Say for example, the outstanding liability is 97,500. Lessor has to start it with 97,500, where lessee has to start it with 95,000. And you have to compute interest. Say for example, interest is 10% per annum. Interest comes to 9750. And your total installment is 30,000 as I have taken in my example. See here, 30,000 per annum. So 30,000 and 9750 is the interest. So automatically balancing figure, how much you will get? 30 minus 9750, which is nothing but principal portion. So in the next year, the principal portion will become 97,500, of which 20,250 is repaid. So balance will become, this 77,250 is the balance of principal portion. In the next year, interest will be charged on 77,250. Respond everybody, clear? Like this, you have to complete the lease term totally, and at the end, lessor amortization table will be left with GRV plus UGRV. Lessee's amortization table will be left with GRV, provided if you have started it with present value of MLP. But say you are starting with present value of MLP or fair value of leased asset, whichever is lower. Say if fair value of leased asset is lower, at the end of the lease term, lessee's amortization table will show you a different figure. It won't show GRV because you did not start with present value of MLP. Only when you start with present value of MLP, you will be left with GRV. If you started with a different figure, you will be left with a different figure. Respond everybody, clear? Sir, whatever the concepts that I'm teaching you, you can understand this concept only when you are somewhat okay with AS19. If you are absolutely left AS19 for choice, and if you did not listen the class, and straight away if you are listening to the marathon class, you will not understand the concept. At least you should have minimum knowledge in AS19, and whenever you are listening to the marathon class, you'll understand. Hey, not only this topic, every topic is as such. Yesterday cash flow statement taught around for 1.5 hours. Provided if you did not go with the main course, you can't get the marathon class at all. So you can get the marathon revisions only when you have gone with the original classes or original concept. Only when you're having minimum knowledge of original concepts, this marathon could be understood to you. Anyways, respond everybody. Is the finance lease clear to each and everyone? And now moving on to the next lease, that is all about operating lease. My dear children, operating lease is very, very simple. But remember, depreciation is claimed only by lessor, not by lessee. And whatever the lease rent is there, that has to be treated as income to lessor and expense to lessee. One peculiar and very important feature of this concept of operating lease is all about lease equalization account, or it is also called as DLR, deferred lease rentals account. This is a very peculiar point. What is this one, sir? Check out the total lease rentals in operating lease. And this total lease rent has to be apportioned to P&L account in proportion to depreciation, which is nothing but expenses spent. Respond everybody clear. Let me give you an example. Say for example, lease rents are 10,000 plus 20,000 plus 30,000, whole divided by 3 years. Strictly speaking, say lease rent, year 1, 10,000, year 2, 20,000, year 3, 30,000. Clear everybody? Say for example, lessor is following SLM method of depreciation. What is the method of depreciation? And hence lease rent under operating lease also has to be amortized in proportion to depreciation. That is nothing but dash method, Nana. Cheppali dash method. So now lease rent has to be amortized in proportion to dash method, my dear children. Because depreciation is under dash method, SLM. And hence lease rent is also under dash method, SLM. So divided by 3. So you will be getting 20,000 per annum. How to record these journal entries? Concentrate carefully. In the books of lessor and in the books of lessee, who has to pay, Nana? Lessee has to pay. Lessee has to pay. My dear children, your institute material is going with due entry, but I'll write a direct entry. Yes, absolutely no problem. You can write a direct entry. And what is the entry in the books of lessee? He has to pay the rent. Am I correct or wrong? What is the entry? Lease rent account debtor to cash or bank account. As per the agreement, he has to pay 10,000 in year 1. But as per accounting standard number 19, lease rent has to be apportioned in proportion to depreciation. That comes to 20,000. So the difference is transferred either to lease equalization or DLR account, another 10,000. Exactly reverse entry in the books of lessor. Clear? Now second year, lease rent to cash or bank. Payment is also 20. Amortization also 20. Second year, Nana. Payment to 20, amortization to 20. Third year, payment 30, amortization 20. Let me show you the third year. Lease rent, amortization 20. But payment 30. Difference 10,000 is transferred to DLR or LE, lease equalization. Once if the lease term completes, your DLR shall gets automatically closed. Respond everybody clear? So you also have to adopt the similar kind of things in lessor books. Say cash or bank, he is getting 30. But as per amortization principles, he has to go only with 20. That difference 10 will be debited to DLR or lease equalization. Respond, I hope the concept is absolutely clear for you. My dear children, this is not just by following SLM method. This is in proportion to depreciation, which implies that it can be either WDV, production units method, or even machine hours method. Respond, everybody understood. That is all about operating lease. Now, the last and final part of accounting standard number 19, which is nothing but sale and lease back. There is a party called seller who is selling the asset to buyer. And again seller will take back the asset from buyer under lease. So now he is a seller and he is the buyer. Buyer is a lessor, seller is lessee. Clear everybody? And this is nothing but a way of arranging a finance. Something like in AS1 I told you. A is selling to B and A is purchasing the same good at a later point of time at an extra price. So this is similar to that one. Sale, lease. Strictly speaking, for sale, you have to follow AS10. For lease, you have to follow AS19. But the peculiar and special feature of sale and lease back is all about how to recognize profit or loss in the books of seller lessee. How to recognize profit or loss in the books of seller lessee. Concentrate for the next 15 minutes. We are going to complete AS19, and if you people are having doubts in this concept, that will get away for sure. And if at all sale and lease back is a finance lease. If at all sale and lease back is a finance lease, profit or loss in the books of seller lessee has to be amortized over the lease term in proportion to depreciation. Respond, is rule number 1 clear, everybody? If sale and lease back is a finance lease, profit or loss in the books of seller lessee has to be amortized over the lease term in proportion to depreciation. Respond, everybody, pakka. If at all sale and lease back is an operating lease, if at all sale and lease back is an operating lease, then you have to check out the following 3 cases. Case number 1, if selling price is exactly equal to fair value of leased asset, absolutely no problem. Profit or loss has to be immediately recognized. Case 2, if selling price is less than fair value of leased asset. Sir, even in this situation also there is no problem for me. If selling price is less than fair value of leased asset, my dear children, are these two things individual concepts or dependent concept? Sale, lease, under the concept of sale and lease back, dependent or independent? Dependent. If more selling price is offered, more lease rent will be collected. Ante kada? If less selling price is offered, less lease rent will be collected. That is how it will get compensated. Hey, is it clear? So, if selling price is less than the fair value of lease asset, then lease rent has to compensate. If lease rent compensates, it has to be amortized. If lease rent does not compensate, even though selling price is less, lessor is not compromising in lease rent. He is asking you to pay the full amount. In such a case, you have to immediately recognize. Respond, everybody, clear with case 2. My dear children, case 2, if selling price is less than fair value, if lease rent compensates, then amortize. If lease rent does not compensate, then immediately recognize. Case number 3, if selling price is greater than the fair value. Very simple. Up to fair value, we don't have any problem. So up to fair value, profit or loss has to be immediately recognized. In excess of fair value, it is obviously a problem and hence it has to be amortized. Respond, everybody, clear? These are just the cases. You have to remember these cases. Before applying these cases, you have to check out a common condition. And the common condition is all about, so compare book value with the fair value. If book value is greater than the fair value, bring down book value to the fair value, which is nothing but a loss which has to be transferred to P&L account. This is similar to impairment of loss, because net book value is compared with selling price annattu. Respond, everybody, clear? Sir, respond, is the whole concept understood? If book value is greater than fair value, bring down book value to the fair value. It is representing a loss which has to be transferred to P&L account, and amortizer immediately recognize. Immediately recognize. Respond, everybody, clear? Sir, in case 1, immediately recognize. In case 2, if compensate, then amortize. Otherwise, immediately recognize. In case 3, up to fair value, immediately recognize. Respond, understood? So now, listen very carefully. I'll tell you a kind of situation, how to solve the problem. Provision is okay, but how to solve the problem? Pick the 3 things, my dear children. Number 1, WDV. Number 2, selling price. Number 2, fair value. Clear, everybody? Number 1, WDV. Number 2, selling price. Number 3, fair value. Difference between WDV and selling price is nothing but profit or loss. But how to recognize this profit or loss depends on selling price and fair value. So better to take this in this order, which will become very easy for you. Take the 3 items in this order. Clear, everybody? WDV, selling price and fair value. Or if you want, you can also take like this. Fair value, selling price, WDV. WDV is nothing but book value. Difference between these 2 things is nothing but profit or loss. Difference between these 2 things is nothing but difference you have to compare and you have to recognize how the profit or loss is to be recognized. Respond everybody. Shall I start? Let me take some examples which were actually given here. See here. I'm not concentrating on case 1 because it's simple. I'll start from case 2. First of all, WDV is 40 lakhs. Fair value is 60 lakhs. What is WDV? Fair value. Let me start everybody. So first of all, I have to compare the common condition, right? What is the common condition? Book value is greater than, what is my book value? 40 lakhs. What is my fair value? Is it greater than or not greater than? So don't apply the common condition at all. Shall I proceed further? What is the order I told you? Number 1, fair value. Number 2, selling price. Number 3, WDV. What is my WDV? 40 lakhs. What is my selling price? Selling price is 50 lakhs. Okay, selling price is 50 lakhs and fair value is 60 lakhs. Shall I start now? Everybody be very, very careful. Profit or loss? 40 lakhs is sold for 50 lakhs, Nana. Profit hai kada? Simply to tell you, it's more than the selling price. I mean WDV, and hence it's profit. Profit is equal to 10 lakhs. Next, how to recognize this profit? Observe the case. Selling price is less than the fair value. Clear everybody? If selling price is less than the fair value, then you have to check out whether the lease rent compensates or did not compensate. If lease rent compensates, this has to be amortized. If lease rent did not compensate, this has to be immediately recognized. Respond everybody. Clear? That's it. Let me take one more thing. Say C. Okay, start again. What is my book value? 40 lakhs. What is my fair value? 45 lakhs. Common condition is not satisfied because if 40 is not greater than 45 kada, throw it aside. So tell me the order. Fair value 45 lakhs. Selling price 38. Okay, and book value is nothing but 40 lakhs. Compare. 40 is sold for 38. How much is lost, Nana? Now compare these two things. Selling price is less than fair value. Again the same thing will be there. Respond, is it clear? Pakka. So actually to tell you here, there's one more rule. If selling price is less than fair value, lease rent compensate, amortize. Lease rent does not compensate, immediately recognize. This is applicable only for losses. If it is profit, it has to be immediately recognized. And now if you observe, in this case it is profit. So this has to be immediately recognized. In this case, this is loss. So that condition is applicable. If lease rent compensates, amortize. If lease rent did not compensate, immediately recognize. A respond understood? I'm refining the condition, take care. If selling price is less than fair value, if it is profit, immediately recognize. If it is loss, if lease rent compensate, amortize. If it is lease rent did not compensate, then immediately recognize. Now, this case is selling price is less than fair value with profit. So this has to be immediately recognized. This case is selling price is less than fair value with a loss. So if lease rent compensates, amortize. If lease rent did not compensate, immediately recognize. Respond everybody, pakka. Now let me go with two more things, that is D and F. Let me start with D first. 40 lakhs. What is my book value, Amma? Is 40 lakhs greater than 40 lakhs? So common condition is not applicable, throw aside. So now tell me fair value, selling price and WDV. What is the fair value, Nana? 40 lakhs. What is the selling price, Nana? 50 lakhs. What is the WDV, Nana? Start. 40 is sold for 50. How much is the profit? There itself the point is over. Now the next one. Selling price is greater than the fair value. Am I correct or wrong? Selling price is greater than the fair value. So up to fair value, immediately recognize. What is the fair value, Nana? Up to fair value, and you have to compare these two things. For if selling price is up to fair value, if selling price is up to fair value, and 40 versus 40, nothing is there, kada. So total profit 10 lakhs is in excess of fair value. Clear? Total profit of 10 lakhs is in excess of fair value and hence it has to be amortized. Respond, everybody understood. Okay, let me go with point number E also. Fair value is 46 lakhs. Book value is 40 lakhs. Is 40 greater than 46? No, throw it this aside. So let me go ahead with the next thing. Tell me what is the fair value? 46 lakhs. What is the book value? 40 lakhs. And what is the selling price? 50 lakhs. Start. Profit or loss? How much is the profit? Now next condition, selling price is greater than the fair value. Let me tell you the simplest part here. What is the selling price, Nana? 50 lakhs. What is the fair value, Nana? In excess of fair value, how much is the selling price? This 4 lakhs has to be amortized. So out of 10 lakhs is 4 lakhs is amortized. Balance how much is there? This has to be immediately recognized. I hope this is simple for you. In the previous case, selling price 50 lakhs, fair value is 40 lakhs. And your total profit is 10 lakhs. In this case, Nana, total profit is 10 lakhs. So if you observe, selling price is greater than fair value. In excess of fair value, how much selling price is there? 10 lakhs. And hence total 10 lakhs has to be amortized. Respond, everybody clear. The last and final case, common condition is applicable actually. Fair value is 35 lakhs, Nana. What is my book value? What is the fair value? Is book value greater than the fair value or not? Yes. And hence 40 lakhs has to be immediately brought to 35 lakhs. So how much is the loss, Nana? This is loss and this has to be transferred to P&L account and this has to be immediately recognized. Now let me start taking the figures again. Fair value, selling price, WDV. What is the fair value now? 35 lakhs. What is the selling price amount? 39 lakhs. What is WDV, Nana? Now start telling me. 40 lakhs. 40 lakhs is sold for 39. Loss. How much is the loss? Entama? 1 lakh is the loss. Clear, everybody? Next. Selling price is greater than fair value. Selling price is greater than fair value. Take care. If you have done like this, it's absolutely wrong. Yes, wantedly I have taken this one to show you in examination also you will become this much hurry and you will do that wrong. Already 40 lakhs WDV is written off with 5 lakhs. So this will become only 35 lakhs. Respond, everybody clear? Even in examination you will do the same mistake. Take care. Now it's no more 40 lakhs. You have to take the revised WDV which is 35 lakhs. Now finally tell me, 35 is sold for 39. Profit or loss? Profit. How much is the profit, Nana? 4 lakhs is the profit. Now compare. Selling price is greater than the fair value. What is the selling price? 39 lakhs. What is the fair value? 35 lakhs. How much is in excess of fair value? 4 lakhs. And hence entire 4 lakh has to be amortized. Respond, everybody clear? Okay, the last and final 2 minutes spare with me with respect to, yes, Lisa's questions. You'll get that. Sir, this question is a very, very different question where lease rent is missing. So you have to find the lease rent. Clear, everybody? Present value of cash outflows divided by present value of lease term has to be considered. Present value of cash outflows is nothing but fair value of leased asset minus present value of UGRV whole divided by present value of lease term. From this you will get lease rent per annum. If I was not wrong, this is your CRD number 2. And in one of the questions, you will be given with 16,99,999.5. AP1, whatever. Remember, never alter even point not 1 rupee which is given in the question. Don't take it as round of figure. You are not here to change the question. If you want, you change the answer however you want. Respond clear, everybody. If given 16,99,999.5, you start your answer by considering the same figure. Respond, everybody, clear. So that is question number 1, where lease rent is missing. So you have to find the lease rent. So that's very important. Take care. And yeah, I wantedly included this question because check out a very, very different question where if this question had come into the examination, you might confuse if you're concentrating on each and every part of the question. If you did not concentrate on each and every part of the question, you'll solve the solution without any hastiness. ABC Limited took an asset on lease from XYZ Limited. So ABC Limited is a lessee, XYZ Limited is. Now check out XYZ until lessor is estimating the residual value is 35,000 only. But lessee ABC Limited is promising that he'll give 50,000. Is it mismatched or not? Total residual value is estimated as 35,000, but lessee is giving guarantee to the extent of 50,000. So this is the mismatch. So be careful, especially when you are in examination. What to do ante em ledu, because in the question he is asking about ABC Limited. For ABC it is 50,000. Clear, everybody? Whereas there is no concept of UGRV here. There is no concept of, that's it. Sir, we did not give any wrong here. Institute material had given like that. Not only in study material, this question is also tested in one of the RTPs. Even there also it was given like that. And hence wantedly we did not change, and hence I am alerting you. Be careful if this kind of situation is arised. And whereas this question is absolutely reverse. XYZ has taken, now XYZ is lessee, ABC is lessor. Total estimated value is 5 lakhs, GRV is 2 lakhs. Hey, is it clear? In all the question, total residual value will be greater than GRV. But only in this question, it is in a reverse way. So take care. Respond, everybody understood. And my dear children, that is the end of accounting standard number 19. Just relax for 2 to 3 minutes. I am going to start accounting standard number 20. Accounting standard number 20. So what is age 20, my dear children? EPS, earnings per share. Sir, as simple as such, earnings per share is nothing but total earnings divided by total number of shares. There itself the standard is over. But total earnings here is nothing but EAES, earnings available to equity shareholders, whole divided by weighted average number of equity shares. Our greater concentration in accounting standard number 20 is extended only to the denominator but not to the numerator. Anyways, even numerator is clarified in the standard itself. EAES, earnings available to equity shareholders, is nothing but earnings after tax minus preference dividend. Only this has to be considered. If any portions are transferred to either specific reserves or general reserves, that should not be considered. Listen, that's very, very important. How much ever profits you are having, that profit might be either transferred to general reserve. Don't consider that in EPS, because that is also a profit available to the equity shareholder. Sir, I have to transfer it to mandatory reserve, sir. Let it transfer. But it's a profit. Equity shareholder earned it, and hence don't deduct it while computing EPS. Sir, is it understood? Say for example, profit before tax is equal to 1 lakh minus tax 20,000. So profit after tax is 80,000. From this you have to give preference dividend. Say the preference dividend is 5,000. The balance is like 75,000. Respond, everybody, clear? You have to consider only this one. Say for example, given like this, earnings after tax is 80,000, from which we are transferring to general reserve 10,000, and we are transferring to a mandatory reserve called debenture redemption reserve 6,000, and we are giving a preference dividend of 5,000. So after appropriations, earnings available to equity shareholders is equal to entamma 59,000. You may call this as earnings available to equity shareholders from your end, but not as per AS20. As per AS20, earnings available to equity shareholders is equal to EAT minus preference dividend. Even we are having one of the concept questions also. Earnings after tax minus preference dividend. What is earnings after tax, sir? 80,000. What is preference dividend, sir? 5,000. So what is earnings available to equity shareholder as per AS20? 75,000. Respond, everybody understood. So what is EAES, Amma? Earnings after tax minus preference dividend is equal to earnings available to equity shareholders. Respond, everybody clear? Now, how to find earnings after tax? Earnings after tax is nothing but earnings before tax minus tax expense. Tax expense is computed in accordance with accounting standard number 22. Earnings before tax is to be computed as per accounting standard number 5 by considering all the period items, prior period items, changes in accounting policies and changes in accounting estimates. This is part 1. And part 2, preference dividend. Check out what is a kind of preference dividend. If preference dividend is cumulative preference dividend, irrespective of declaration, you have to deduct it every time. If it is non-cumulative preference dividend, you have to deduct only if it is declared. Respond, everybody clear? This is the end of numerator, Amma. Yes, that's the end of numerator. What is the numerator, my dear children? Earnings available to equity shareholders is equal to dash minus dash, nana. Earnings after tax minus preference dividend. Earnings after tax is equal to dash minus dash, nana. Earnings before tax minus tax expense. Tax expense is dealt as per AS22. EBT is dealt as per, and preference dividend you have to deduct irrespective of declaration for cumulative preference share, and you have to deduct only if it is declared for non-cumulative preference shares. Respond, everybody clear? That's the end of numerator, and let me straight away come to the denominator, which is nothing but weighted average number of equity shares, which is popularly called as WANES. And shall I start now? Sir, under weighted average number of equity shares, you are going to consider a special item called time weighing factor. What you are going to consider, Amma? Time weighing factor. This time weighing factor is very, very, very important. Until and unless you did not know about time weighing factor, you can't solve any kind of question. Time weighing factor is nothing but number of equity shares multiplied by number of months divided by 12. So the logic behind time weighing factor is all about, say for example, year starting you are having 1 lakh shares, year ending you are having 1,20,000 shares. What happened in the meanwhile ante, you have issued 20,000 equity shares. You have also issued 40,000 equity shares, and ultimately you have bought back 40,000 equity shares. Clear, everybody? So, and ultimately you left with 1,20,000. Okay, so this is not happened at a single point of time. This had happened at a different points of time. If at all everything is getting happened at a different points of time, then you can't take 1,20,000 shares are there for whole of the period. So different shares at different time period. So you have to consider the time period. If the time period is given in the question, then 1 lakh initially these shares multiplied by 12 by 12, and check out the date of issue and multiplied by number of months by 12 plus date of issue multiplied by number of months by 12. This is buyback. So minus multiplied by number of months by 12, and you are going to get one figure, which is nothing but weighted average number of equity shares. Respond, everybody clear? So to tell you, my dear children, point number 1, weighted average number of equity shares is nothing but number of equity shares should be multiplied with time weighing factor. Time weighing factor is nothing but number of months by 12. And now there are certain different categories. You need to know what is the time weighing factor for all those categories. Number 1, those shares which are issued for cash or credit. Chichi, cash or credit ante? Those shares which are issued for cash. What is the time weighing factor? Date when cash is receivable. Clear everybody? What is the date when cash is receivable ante? Date of allotment ani ardham. Am I correct or wrong, sir? Date of allotment. Of course, it's only for allotment stage. First call, second call, it will be a different date kada. And hence, if at all any shares are issued for cash, then please respond, Amma. What should be the time weighing factor? Date when cash is receivable. Respond everybody clear. And when shares are issued in conversion of debentures, date of conversion. In conversion of loan, date of conversion. But for these two things, there is one more point that has to be taken care. Date when interest ceases to accrue. This is the original terminology. Date when interest ceases to accrue. But generally, we will simply call it as date of conversion. Respond everybody clear. Simply we'll call it as date of allotment, but the original terminology is all about date when the cash is receivable. You are issuing shares for rendering the services. Date when services are rendered. Clear everybody? Now two special elements which must be taken more care. Amalgamation in the nature of merger. Beginning of the reporting period or first day of the reporting period has to be considered. If it is amalgamation in the nature of purchase, then date of amalgamation, that is date of purchase, has to be considered. Respond everybody clear. Sir, if it is amalgamation in the nature of merger, then beginning of the reporting period. But more correct word is all about date from which the previous company is existing. Date from which the previous company is existing. Let me give you an example. Listen very carefully. Say for example, a company A Limited incorporated on 1/5/2012. And after incorporation, somewhere on 1/1/2013, A Limited was sold to B Limited. A Limited was ultimately sold to B Limited. And this is, say for example, amalgamation in the nature of purchase. B Limited will issue some shares to A Limited. Am I correct or wrong? Respond, Amma. These shares have to be taken with a time weighing factor. Correct or wrong? What is the time weighing factor you have to consider? 1/1/2013. Clear everybody? If it is amalgamation in the nature of merger, then you are supposed to take 1/5 but not 1/4. Please don't be in a wrong notion. Date of beginning of the reporting period doesn't mean 1/4 here, because company gets incorporated only on May. How can you take from April? I hope the logic is clear for you. So you have to consider only 1/5 but not 1/4. Respond everybody clear. And this is all about your time weighing factor. Tell me, date when cash is receivable is the time weighing factor for those shares which are issued in cash for conversion of debentures and loans. Date when interest ceases to accrue. Amalgamation in the nature of merger. Date when the previous company is existing in the previous period. Clear everybody? In the previous period has to be considered, not the total period. And amalgamation in the nature of purchase. Date of amalgamation or date of purchase. Respond everybody clear. Of course, there are many other things, but these are actually important, and hence I've covered these things. And moving on to the next thing, very important. If at all different face values are there or different paid up values are there, even in case of different face values and different paid up values, you have to convert each and every equity share into equivalent number of equity shares. You have to convert into equivalent number of equity shares. How to convert it into equivalent number of equity shares, sir? Number of equity shares multiplied by partly paid up value divided by fully paid up value, or number of equity shares multiplied by smaller face value divided by larger face value. Clear, everybody? Say for example, you are having 10,000 equity shares at the rate rupees 5 each, and you are having 25,000 equity shares at the rate rupees 10 each. So to convert it into equivalent number of equity shares, my dear children, you are having two options. You can convert each and every share into rupees 5, or you can convert each and every share into rupees 10. But generally, in all the contexts, we will be converting the smaller into the larger values. That's generally accepted principle. Ante. Anyways, so what is the equivalent number of equity shares? 10,000 into 5, which is nothing but 50,000, divided by, assume that each and every share face value is 10. So where it comes to 5,000. Ante 10,000 equity shares at the rate 5 anna, 5,000 equity shares at the rate 10 anna, one and the same. Respond clear, ah? So equivalent number of 10,000 equity shares at 5 is nothing but 5,000 shares at the rate rupees 10. Along with this, I am having 20,000 equity shares at rupees 10 kada, and hence the total comes to 25,000 equity shares at the rate rupees 10. Respond, everybody, clear, ah? So let me give you an example. Say for example, net profit before tax is equal to 1 lakh and tax expense is equal to 20,000, and preference dividend non-cumulative something like 10,000 10 percentage preference shares declared for 2 years, and preference dividend cumulative rupees 10,000 5 percentage preference shares declared for 2 years. Clear, everybody? First of all, tell me what is the numerator from this data. Hey, just staring will not get you. You have to solve it, only then you will get. Sir, I am telling you the most complicated parts of AS20 so that the remaining you can do it very easily. 70. Okay. Let me check out the same. Okay. So first of all, 1 lakh minus 20,000, which is nothing but 80,000. And hope you have remembered the rules. You have to deduct preference dividend if it is cumulative, irrespective of declaration. If it is non-cumulative, only when it is declared. Now first one is non-cumulative. You have to deduct only when it is declared. For how many years it was declared now? So you have to deduct for 2 years. So under 10,000 into 10% into 2 years. Enthamma? So minus 2,000. And coming to preference dividend cumulative. Sir, cumulative has to be deducted irrespective of declaration. Even though 2 years parts were declared here, already last year cumulative preference dividend might have deducted in the last year. Is it clear? Huh? Already cumulative preference dividend might have deducted in the last year irrespective of declaration. Understood? Huh? So here, even though the declaration is done for 2 years, you have to take only for 1 year. So rupees 10,000 into 5%. So minus 500. On a whole, you will get 77,000. So take care. This is first important point. Respond, everybody, clear. Now let me proceed with shares. Say for example, opening 10,000 equity shares at the rate rupees 10, fully paid up, and 15,000 equity shares at the rate rupees 10, only 7 paid up. Next, calls, final call is made on 15,000 equity shares at the rate rupees 3 on 1/1/2013 and finally buy back. No, let me give you issue, because as I said, I'm giving you all the complicated parts. Issue 5,000 equity shares at the rate rupees 7, or just wait, let me modify the figure like rupees 5 and finally buy back 2,500 equity shares at the rate rupees 10 on 1/1/2013 on 1/2/2013. Find the veins. Find the weighted average number of equity shares. Okay, let me tell you. So these 10,000 shares or 10 rupees each fully paid up, and hence let me take something like 10,000 equity shares into 10 by 10 into 12 by 12. This is time weighing factor and this is into equivalent number of shares. Of course, even if you did not take this, it's absolutely fine. Now, the second one, these 15,000 equity shares are there at the rate rupees 10, but only 7 is paid up. In the sense, remaining 3 is unpaid and it is there for whole of the year. Let me convert the same. How, sir? 15,000 equity shares into 7 divided by 10 into 12 by 12. Whatever. Next, you have made a final call on 15,000 shares only at the rate rupees 3, which will become 15,000 equity shares into 3 by 10 multiplied by 3 by 12, because we have made it on 1/1 and you have made a new issue. So 5,000 equity shares into 5 but converted into 10 multiplied by 3 by 12 and finally buyback. So 2,500 equity shares multiplied by 10 by 10 multiplied by 2 by 12, because it is being taken only on 1/2. Respond everybody clear, and hence ultimately you will get 2833, which is your perfect answer for the computation of veins, weighted average number of equity shares. Check out what are the mistakes you have done. As I've said you, I'm giving you all the complications only in one problem, one example, so that you will be getting how to solve it. Respond everybody clear. And my dear children, actually the basic EPS is done. Yes, we have done with basic EPS, and one more thing that's all about. Sir, you have to present EPS even when there is loss. The same has to be presented in a negative figure. Generally, EPS will be presented, don't think only when profits are there. EPS has also to be presented even when losses are there, but the same has to be represented in a negative figure. Sir, one more thing. If you have got loss before tax, then tax expense has to be added, because you will be having a deferred tax asset as tax shield as per accounting standard number 22 minus preference dividend for sure. And then you have to tell, Are Babu equity, your total loss is before tax this much, but because of this in future this much tax is saved for you. But don't think that the remaining loss has to be borne by you. Wait. Even you have to bear one more loss, which is nothing but preference dividend. In future, if profits had come, you can't take them immediately. First of all, dividend has to be declared to the preference shareholders. Only then the remaining has to be taken by you. And hence loss before tax plus tax expense minus preference dividend whole divided by weighted average number of equity shares. Respond everybody clear. This is nothing but EPS in case of loss. Respond understood. Okay. And my dear children, that is the final point for basic EPS. And now let me start with adjusted EPS or it is also called as revised EPS, or it is also called as restated EPS. With whatever language you call, it is one and the same. Remember, this concept is applicable to those shares which are increased or decreased in number but without change in resources. This is applicable for those shares which are increase or decrease in number but without change in resources. For example, bonus. For example, share split. For example, consolidation of shares. For example, right shares. But popularly in all our problematics, we will be using bonus and rights. Rights is obviously a different computation. I will tell you separately. But first, let me concentrate on bonus. Sir, again, your concentration is highly appreciated. Listen carefully. Even bonus share computation is a bit complicated. What is the time weighing factor of bonus shares you have to take? Right from the beginning of the reporting period of previous year or current year? Previous year, not the current year. Of course, subjected to the original number of shares. Subjected to the original number of shares. People generally will not concentrate on this point, but subjected to original number of shares is very much important. Let me give you some of the examples for computation of gains, which will become very better for you. Shall I start now? Now, before that, adjusted EPS or revised or restated EPS is current year EPS or last year EPS? Last year EPS in current year. Simply to tell you, last year column in current year is nothing but restated or adjusted. Clear, everybody? Hey, are you going to change the original EPS of the last year? No, you are going to change the last year column in the current year. You are going to change the last year column in the current year. Respond, everybody, clear? Okay, so let me give you an example. Again, I'm not going to tell you the logic. The main reason is that number of shares have increased. Say last year with 1 lakh shares, you have done the business. Current year with 1.5 lakh shares, you have done the business. People will be thinking that number of shares were increased. So your capital is increased. So your business should expand. So you have to get more profits. Arey Babu, wait. The reality is that no capital is increased. Because these 50,000 are bonus. I am utilizing my reserves to give bonus to the equity shareholders. I did not get a single rupee. So capital is not increased. My business will not expand. I will not get more profits. I have to convey this to the shareholders, kada. In order to convey the same to the shareholders, I will be restating the last year EPS. Clear, everybody? Okay, so now you have to tell me, my dear children, how many shares will be considered in the current year, how many shares will be considered in the last year, how many shares will be considered for restated EPS until last year in current year. Shall I start now? Respond, just check out. Say for example, opening, you are having 1 lakh equity shares. Current year issued. Bonus. 50,000 equity shares. Clear, everybody? That's it. Quickly answer me. That's it. Nothing else is there. Data on 1/1/2013. That's a very simple question. Current year, how many shares you will consider? 1 lakh into 12 by 12 plus 50,000 into 12 by 12 is irrespective of the date of issue. Clear, everybody? Now, last year, how much shares you will consider? While doing the last year this bonus concept is not there, kada. So you have to consider only 1 lakh. Respond, clear? Now, for restated EPS also, 1 lakh into 12 by 12 plus you have to assume these 50,000 as if they were issued in the last year starting only. So that is 50,000 into 12 by 12. Respond, everybody, clear? Now check out very carefully, everybody. Last year opening 1 lakh. Next, last year issued on 1/7/2013, 50,000. Clear everybody? Current year opening 1,50,000. Current year bonus on 1/1/2013, 1:2 ratio. Answer needed. Shall I tell you or you will solve it? I did not get you. Current year, huh? Current year how much? Okay. Last year 1 lakh. Restated. One lakh 30. This one, huh? Okay, last year 137,500. Restated. Two lakh 12,500. Okay, shall I start now? Check out. First of all, let me take current year. Current year 1,50,000 into 12/12 plus I have given bonus on these shares kada in the ratio of 1:2. Ante I'll get 75,000. So 75,000 into 12/12. So where the total will become 2,12,500. Kada? 2,25,000. Respond everybody clear. So current year is absolutely correct. Shall I proceed further? Last year. It's also very simple. Originally 1 lakh is there. 1 lakh into 12/12 plus 50,000 issued on 1/7, Nana. If nothing is mentioned, it's obvious the year ending will become 31/3 only. If you're taking 31/12, it's wrong. I wantedly did not give that because that should inculcate in your brain. So anyways, 50,000 into 9/12, which comes to, respond everybody clear. Huh? Now the biggest task is all about restated. Listen very carefully everybody. Sir, listen very carefully. Coming to restated EPS. Sir, totally last year 1 lakh shares are there. Am I correct or wrong? So 1 lakh into 12/12 plus 50,000 into 9/12. That will never change kada. Very important thing, bonus will change now. On this 1 lakh, bonus is 50,000. Use the time weighing factor of this 1 lakh, 12/12. On this 50,000 into 1/2, that is 25,000 multiplied by same time weighing factor, 9/12. Is it clear? But what students will be generally doing is that since bonus right from the beginning of the previous year, let me take directly 75,000 into 12/12. No, that's wrong. Out of 75,000, 50,000 belongs to 1 lakh shares. This exists for whole of the year. So this also should exist for the whole of the year. This 25 is for 50,000 shares. This exists only for 9 months. Even this also has to exist only for 9 months. Hey, respond everybody clear. So take care. Bonus shares time weighing factor is not the beginning of the previous year. It is the time weighing factor of original shares. That's very important. Anyways, the total comes to 2,06,250. Respond everybody clear. Anyways, let me give you the last and final example, my dear children. Just concentrate. Say for example, last year, this time let me take 15,000 equity shares just to get computation in a better way. 15,000 equity shares. Next, issued 5,000 equity shares on 1/1/2013. Current year 20,000 equity shares opening. This is opening. And current year also issued 10,000 equity shares on 1/7/2013 and current year bonus also given in 1:2 ratio on 1/3/2013. That's it, my dear children. Again need the three things. Current year, last year, restated. Last year 16,250. Okay. Task is always restated only. 30. What is 35,000, Nana? What is that? Restated, huh? Okay, tell me. 625. Okay, let me start. Check out. First, let me start with the current year. Huh? Okay, so current year. Everybody check out very, very carefully. Everybody. 20,000 into 12/12 plus 10,000 into 9/12 plus, again don't do the same mistake by taking on 30,000 bonus is 15,000 and 15,000 into 12/12 is wrong again. Time weighing factor of original shares has to be considered. So on this 20,000 bonus is 10,000 multiplied by 12/12 irrespective of date of issue, plus on this 10,000 5,000 multiplied by the same time weighing factor 9/12 irrespective of the date of issue, where it comes to 40. This is the correct answer. But you told something 31,250. How many of you have got 41,250? Not bad, take care. And if you have got that one logic, what is that one logic? Time weighing factor bonus shares will become the time weighing factor of original shares. If you have got that one, everything will become very easy. Anyway, shall I consider the last year part, my dear children? So last year, 15,000 into 12/12 plus 5,000 into 3/12. Enta? Even a bacha person will tell this one. And now let me start with the last and final one, restated. Shall I start now? Sir, last year originally 15,000 are there. So 15,000 into 12/12 plus 5,000 into 3/12 plus on this 15,000 1/2. 7,500 into 12/12 plus 2,500 into 3/12. We are not going to consider those bonus shares for which on current year issues. These 10,000 equity shares are issued in the current year. These shares are not there in the last year. So how will you take the bonus shares for last year? Sir, logic clear, huh? I mean to tell, so you are taking the bonus only for 15 plus 5 under 20,000 shares. So you will take the bonus only for these number of shares, not on this issue. Why? This 10,000 is a new issue in the current year. This is not there in the last year. Respond everybody clear. So ultimately, my dear children, what is the number of shares you will get? 24,000. That's it, my dear children. That's the end of your bonus issue. Hey, respond everybody. Got it. Sir, the only one logic is that bonus shares time weighing factor will be the time weighing factor of original shares. Respond everybody, pakka. And hence these 10,000 shares are issued only in the current year but not issued in the last year. So ultimately these shares will not be considered in the last year. If you have got this one logic, the revision examination could become with respect to bonus as very, very easy. Yes, my dear children, that's the end of bonus issue. It's 10:32. I'll meet you exactly by 11 o'clock.